Good morning, Tyler Crowe.
Good afternoon, Jayson Hall.
Love the response. It is 8 a.m. Eastern time here in the U.S. For Tyler Crowe, it is indeed the afternoon in the part of the world he is in. And for everybody watching, welcome to Motley Fool's Fool 24 live stream, whether you're watching on YouTube or you're a Motley Fool member watching behind the paywall. Today is Wednesday. I believe it's the 26th of March. So that means that we're still in that week. It's the 5-year anniversary of the bottom of the market broadly, not the bottom of the market for oil stocks. We talked about that the other day, Tyler. But it's time for the weekly check-in hour. So we've got a little bit of news we're going to talk about, a few things we're going to highlight. And of course, like always, we want to answer your questions. Get those to us, whether you're watching the live stream on YouTube or you're watching it on the Motley Fool's website. Go to slido.com, put in the event code FOOL24. Tyler, I have a question for you. If somebody sends us a question, will we tell them what to do? Will we give them individual advice?
Well, and when it comes to investing, no. If they want individual advice on how to improve your hair, we'll absolutely do it. But if it becomes to actual personalized financial advice, we're going to, leave this to just sharing our thoughts. And anybody looking for that professional advice should go seek an actual professional.
That's right.
I mean, look at his hair. How can you believe anything this guy says?
Come on. Have you not seen Peter Lynch's hair? Come on, pal. All right.
That's fair.
Okay.
Very fair.
All right. So, but yeah, just to be clear, we'll be happy to answer your questions, share our thoughts, but for so many reasons, please don't consider it to be personalized or individual financial advice. All right, Tyler. So I want to do something here. I want to start off. I'm going to do a screen share. This is something that Lou Whiteman does a lot on the weekends with some of the programming that Motley Fool members have access to. And there's something that you can get you can get every day too, and there's multiples of them. As Natasha shared this, thank you, Natasha. One of the things that I subscribe to, and I get it in email, and you can read it again for Motley Fool members, is Breakfast News. So it's a morning update of the 3 to 5 main things going on in the investing world. There's a lunchtime one, and I think there's one that goes on and after the market as well. But there are a few stories that I want to hit. And again, just for those that haven't seen this before, excuse me, sorry, my brain just completely froze up. So some interesting things that are going on. So we see again, Amazon, which we know AWS, a lot of generative AI, large language model programming is happening. It's being used to build a lot of AI, but we're starting to see Amazon build more and more AI as well. Andy Jassy pushing employees to build some 1,000 apps and wants to continue pushing out more and more apps to have tailored apps to do different things. A couple that they're working on in particular, one is essentially an AI-powered search tool for Amazon.com that they're going to roll out sometime in the next few months, and a healthcare-related Gen AI answering tool that some of the answers will actually be clinically verified by US-based clinicians. So that's positive. To get actual information that's been verified by a professional in the healthcare arena versus the things that sometimes artificial intelligence can make up. And also, Tyler, the stuff on the internet that humans make up. So
wait, are you telling me that the internet isn't 100% true all the time?
I know. Hard to believe.
Oh, hard to believe. Breaks my heart.
Yeah. Well, let's break your heart a little bit more. Maybe get you a little excited. This is one that's right up your lane. So more tariffs on commodities could be coming. We've already seen a lot of tariffs on steel and other things related to the steel industry. And now it looks like we could be seeing tariffs on copper. We're going to circle back around to this, Tyler, and talk about it. Some of the investing implications, but also when I think this is a good jumping off to talk about investing in commodities businesses in general and how to think about in this heightened age of tariffs, how you think about that space as the long-term investor and follower of it. Another interesting story, we're starting to see more and more around autonomous vehicles and AI in vehicles, and China. Probably, I don't think it's really any argument that it is the hottest market for electric vehicles in the world, and probably the most important one in terms of the potential growth there. BMW has partnered up with Alibaba through an Alibaba JV to work on AI to go into BMWs specifically for the Chinese market. So that's going on. And another related auto thing, more bad news for Tesla. In this case, our Canadian neighbor north here is putting the brakes on EV rebate payments for Teslas, going so far with their transport ministers to ban future rebate programs for the company as long as U.S. tariffs persist against Canadian exported goods imported into the United States. So something else we can talk a little bit about the auto industry in this age and environment. We've got some earnings that are coming in. Chewy reported. We've got one of Chewy's competitors, Petco, is reporting, I believe, today. Another story that something you and I can talk about here too, Tyler. Dollar stores. If you look at the dollar stores broadly, they are down a lot of pressure on those business models. Dollar Tree is actually selling off its family dollar business to a private equity company that's going to be taking that business private. So my guess, Tyler, what's the over under? I'm going to say 3 years before Brigade Capital Management and its partner, private equity company, load it up with debt and spin it back out as a publicly traded company again. I'm going to say 3. Are you taking the over? That's going to be more than 3 years. Or are you going to take the under that it's less than 3 years?
Does it have to stay solvent the entire time before going public?
That's fair.
We're talking about a business that was acquired for $9 billion in 2015 that just got sold for $1 billion.
Yeah. So there's some pretty big write-downs on the goodwill on the books that's happening there for Dollar Tree. So yeah, we'll talk more about that with you as people have questions. We've already had some questions come in. Have you had a chance to look at the questions yet, Tyler?
Quite a few questions, a few comments, saying it's nice to have us and or Lou around at any given moment. So thank you I need input on that. Seen some questions about energy. Cena giving us a nice aloha from the multiple time zone introduction here. And and then there's some older ones as well. So we'll get into these. But what I want to do is, and I want to hit one a little bit older because it was right in my wheelhouse. It was asked yesterday. I didn't have a chance to get it because I wasn't on yesterday. I thought it would be a good time to,
That's no excuse for not answering the question, Tyler.
Not being there? Oh, well, yeah.
Terrible excuse. Oh, fine. We'll take it. Answer the question.
So yesterday, SB asked about a recent IPO, StandardAero, because we were just talking about private equity, and I think this is an appropriate time to do it because StandardAero IPO'd last year, and excuse me, is very much in that private equity backed sort of space. So the question that SB had was, any thoughts on recent IPO StandardAero? They have a lockup expiration approaching later this week, wondering if it's a buy at current price. So StandardAero, as the name kind of hints at, is an aerospace company. Primarily, actually not just primarily, their core function is maintenance and servicing of commercial jet engines. Their biggest thing has been on a lot of the older generation models. So, they have what they have is called an OEM license agreement. So, they'll go with the original manufacturer and get a licensing agreement to do operations, maintenance, servicing, and things like that. And they have it with all of them. They have it with GE Aerospace, Pratt & Whitney, Safran, Honeywell, anybody that makes a...
What's the ticker?
SARO.
Okay, got it.
So this is they're like one of either the largest or the second largest in aftermarket service and repair for fixed and rotary engines. This is not Anybody that makes an engine these days, StandardAero is one of the largest in North America that does the servicing for this. Most of what they have has been kind of the older engines. Anything like on a old Boeing 777, older things like that. And they've been spending a ton of money lately trying to get the first independent license in the Americas to service the jet engine that's on the Boeing 737 MAX and the Airbus A320 Neo. This is CFM's LEAP engine. It's supposed to be within like the 6 or 7 years, supposed to be the largest engine platform in the world, because the 737 MAX and the Airbus 320 Neo and that family of narrow body aircraft are like the workhorses of commercial airlines. Anything domestic in North America, most of cross-continental Europe, things like that. So it's a really interesting business. Service, maintenance, very much in like some of the discussions you and I have had for a long time. That means like recurring revenue, maybe not necessarily the highest margin business, but incredibly durable. Like, especially when we start thinking about the aging of fleets of airplanes that are going to need more service, more maintenance, more routine check-ins, things like that. It's a very interesting business. And to get to SB's question about it being a lockup, about 80% of the stock is owned by its private equity partners, or the original private equity backers. I think one of them was Carlyle, and I can't remember the other one. I want to say GIC. GIC was the other one. And they own about 80% of shares outstanding. So as the lockout period expires, it means that Carlyle and GIC will be able to unwind their position if they want to, right? So I'm not going to say that they're going to sell 80% of their stock tomorrow or within this week or so, but it gives them an opportunity to start selling it down. So as to the question of whether or not this is like a buy now with a lockup period expiring, people might see this big, well, they're going to unload shares. It's going to be cheap, right? Which is true. But the one thing to take into account with this business, like I said, they're spending a lot of money relative to who they are as a business on this licensing agreement. They have to build out train personnel. They have to actually get repair facilities built. All of the things that are going to be necessary to actually do this sort of work. Costs a lot of money. The company already had a lot of debt. I mean, like I just said, it was a private equity backed business. Anybody that's in private equity is levered way, way more than you would ever expect to see on a public market. If you see a company that's on the publicly traded market that has as much leverage as a private equity backed company, it would scare all of us to death. And so with that in mind, I think this has been one of those businesses. I think it's a fascinating concept. It's a fascinating idea. I think there's bones of a good business, but with this really, really high debt load, with this need for more capital, and this period where you have your private equity backed people being like, we want to kind of unwind this position. I'm perfectly fine watching this company just kind of bake for a while. And
I just sent over a screen share that is this is from, I guess, from its S1, the balance, some key parts from the balance sheet, so people can take a look at it. Natasha, if you can share it when you get a moment to. And I want to say, Tyler, this is the difference between a venture capital backed IPO and a private equity IPO. This is pretty typical of what we see. Again, not always. There are plenty of companies that were VC backed that went public with some debt, but it's a difference in the business model with venture capital, where you're typically starting with something small, and along the way, you're going through multiple rounds of investor funding, where investors they're investing in equity stakes in the business, right? And once the company goes public, that equity rolls into public equity, from the private stakes to public equity, right? And those lockouts still matter that the questioner was talking about. And what those are is that the lockouts are when insiders can start selling their stakes, right, Tyler? So they can start monetizing their stakes. So that is something that's often followed pretty closely with IPOs, and it's with venture capital, it can affect the stock price pretty closely. Private equity's business model is they're not funding startup businesses. They're buying going interests, mature businesses. Sometimes they're buying going interest when they're kind of troubled in some way, and they're able to buy at a discounted price. And the idea is they do some things and kind of buff it up and improve the business. But what they almost always do, because when they buy it, they use debt, they use leverage to buy it, so they're not risking as much capital. But then when they send it back out to public markets, they send as much of that debt out the door and retain the cash as they can. And that's the case here. So these numbers you see on the screen, the big one in purple, that's the debt load. The smallest number, $60 million, that's cash. I will say it's not atypical for businesses in this particular distributors, manufacturers, really turning the inventory is kind of the key to have a relatively small cash position. So that's why I've also included inventories. But this is, again, and I don't have, the total market size of the business here to contextualize these in terms of ratios, but it is again, typical of what we see from private equity when they spin companies out. There's a little bit of headwind. They got to kind of climb up a hill of debt that they're going to have to face that could, kind of put them on their knees coming out of the starting gate.
Yeah. Now, there have been, and I'll say this because I think you and I, things that we have invested in have been private equity backed things that went public before, or, things of this nature. And it does have a real hit or miss sort of nature to it, because like they can be seemingly quality businesses that just never can quite find their footing because of debt loads, because of things like this. Even if you do have a solid private equity backer that brings the company public, does not necessarily mean that the business itself is going to succeed. I like I said, the bones of this business, I think, if I were to look at it, as like, say it just IPO'd and wasn't like a private equity roll up, it was just like a startup business that had gotten to this position, or like a family run business that was going public because the family wanted to cash out or something like that, I think it would be a lot more interesting. It's just that there is, for a business that is as indebted as it is, that still requires more capital to meet its objectives, I think it's going to, it's in a very challenging position, despite the income statement can look good. I think, competitive position looks good. It's just that, on the balance sheet, things are scary enough for me, or not scary is maybe not the right word. There's enough caution flags with me with its capitalization and its cash requirements that, I want to see how it bakes. I want to see if the souffle rises, I guess, if you will, in the oven here. So until that happens, and with a lockup period ending, to me, it's just like, I don't really see any reason to be racing into this, because we know that a private equity backer is going to be trying to slowly unwind an 80% position in this company. So, hey, there's nothing wrong with sitting on the sidelines for a while.
All right, let me ask, how closely do you follow Murphy USA?
0.
Okay. Yeah. That's, I need input. That's kind of what I was figuring Tyler might say. We can talk just very briefly about it, but first I want to say this. I need input. I want to be clear here. It was always me. Okay. It's always been me for this hour. I'm not sure what our friends at the Motley Fool were putting out there, but Tyler is the one that subbed in here. Right, Lou? Or right, Tyler?
No, you and I have been scheduled on this one for a while. I know.
I don't know what people have been telling you guys out there, but Lou was always the outside of this hour.
Maybe you two are just interchangeable at this point.
I mean, we could be. I mean, our hairs are basically the same, so yeah, we absolutely could. Okay, so I'll say this. So I've never really followed Murphy USA very closely. So just for those that don't know, Murphy USA was a spin out of Murphy Oil. It's their retail gas station business, and the majority of their locations are co-located with Walmarts, like in the Walmart parking lot. I've never loved that business model. There are some that have done quite well, but I've never really loved that business model. So that's the main reason I've followed it. I've never saw it as a great place to earn market beating results. So I've largely avoided it. So could be a decent value there. But again, that's the why I don't know much about it, is because I've never seen it as being an opportunistic buy. Tyler, any particular reason you've never followed it?
No, other than it just it never really came across my desk. I mean, there are other retailers in this, convenience store space, like Alimentation Couche-Tard in Canada, which has been an incredibly successful company over a long term. But it's just one of those things where it's like there's a lot of things that we try to analyze and build out our knowledge base, and sometimes things just get skipped over. And Murphy USA has just been one of those.
Yeah, no, I think that's fair. All right, do we want to do a little bit of ranking here? Let It Ride's got us a ranking for 5+ years.
We can try for this. I might punt on one or two of them, but
okay, yeah. So the five tickers here from Let It Ride: Enphase, ticker ENPH; Clearway Energy, ticker CWEN. In this case, CWEN.A. I'll explain the difference in a minute. Brookfield Renewable Corporation, which is BEPC. I think typed in BPEC on accident there. BWXT, which is BWX Technologies, and then GEV, which is GE Vernova. So the interesting thing here is that you take 4 of those 5, and they're renewable energy, solar, some solar and wind. We've got manufacturers, we've got companies that actually own and operate the assets, and then we have the outlier, which is BWX Technologies, which is like nuclear subs, like nuclear stuff is like their kind of core business, right, Tyler?
Yeah, it's like a nuclear services business. So they build a lot of the components for commercial, military, and also do some nuclear power or nuclear munitions. So it's kind of a smattering of nuclear businesses that doesn't involve actually building reactors themselves.
Right, stuff for the reactors, and then of course the ammunition business, which they use for that's built from waste material, I think.
Spent uranium or tank shells.
Yeah, depleted uranium. Is that what that?
Yeah.
Yeah. So, all right. So let's rank these. I'll go first here. So, and this is a little challenging because the one that I think probably has the most upside is also the one that could be the most binary. Could be the one that does the worst, and that's Enphase, ticker ENPH. Enphase makes the microinverters and control parts for solar panels that actually go on the solar panel, and then all of the systems that integrate it into your home. Their business is essentially entirely residential. They are starting to look a little bit at moving up the food chain into some large some of the stuff for commercial panels, but largely this is their focuses on residential solar. Their battery business has done very, very well. That continues to grow. They're rolling out EV chargers, including bidirectional EV chargers, where the EV can actually be a battery for your home. So things like that they're doing. The residential solar market, especially in the US, has just tanked over the past few years as interest rates have gone up, as the residential real estate market has slowed down. Those things have weighed on it a lot. Changes in the regime in California for how they give you credits for the energy you produced, net metering 2.0, or is it 3.0 now? I can't even remember. They've changed it to essentially make it so the only way that it's feasible is that you have storage as well. So that's put some headwinds to the market. So it's been a tough, brutal period where Enphase's stock, and it's there's 2 companies that have basically a duopoly with close to 90% of the market share in North America. SolarEdge and Enphase, their stocks are both down a lot. Their businesses are down a lot. The difference between the two is that Enphase has consistently been able to generate positive cash flow across the cycle. SolarEdge has really, really struggled. It was only in the last quarter or so that we saw them turn a corner in terms of getting their balance sheet and their operating statement headed in the right direction based on the condition of the market. Enphase gained market share during that period. If you look at their results versus SolarEdge's results, it's pretty obvious that they've gained market share. And one of my favorite things about the business is the ecosystem. Looking beyond the quality of the operating business and how well they've delivered in this tough environment, the ecosystem that they have. And I might have a little bit of bias here, Tyler. So this is one of the challenges that I deal with the stock. Is I have Enphase microinverters and batteries, and their app, the platform, is so seamless and works incredibly well. I live in Massachusetts, so there's incentives through my utility for different things. Like I can sell the power from my batteries in the summer during peak energy days, and the app lets me opt out or opt in to that really, really quickly. There's default settings, but it gives me the ability to opt out if there's a storm coming or something like that. And it just works really, really well. And eventually at some point we're going to get an electric vehicle. And even though Enphase's chargers do sell for a little bit of a premium to some of the other things that I've seen out there, the fact that it's going to connect right in with my app and it's going to work seamlessly if I'm using, especially like the bidirectional, eventually have a vehicle that becomes part of the home for energy storage. having it all within that ecosystem, I do think is a little bit of a moat that Enphase has against some of its competitors. The quality of the business, eventually it's going to, solar return is going to rebound and start to grow again. I think from where the stock is now, it's the one that has probably the most upside. And then you look at Brookfield Renewable and Clearway Energy. I don't want to say they're interchangeable, but I would put both of those as my like 2 and 2B. They do essentially the same thing. They invest in, own, and operate utility scale wind and solar facilities. Clearway, actually, I think they have a little bit of new natural gas as well. But the key with both of these businesses is that by owning the assets, by securing good cost of capital, because of the massive financial strength of their sponsor entities. With Brookfield, it's Brookfield and Brookfield Asset Management, with their asset management funds being co-investors in the assets that they buy. And then with Clearway, you have Total Energies, and I can't remember the name of the global infrastructure. So you have the two co-entities there. They're not looking just to take assets off of their own balance sheets and sell them to deleverage their own balance sheet. They're using it as a co-investment vehicle. So I think it makes them very, very strong. I can't really weigh in on BWX Technologies in terms of valuation and opportunity. I mean, we're in this moment for nuclear, and I think there's a lot of focus on businesses that have some nuclear exposure. So that's probably a tailwind, maybe. But I mean, the life cycle for building out these nuclear facilities is so long, and all the focus on small modular reactors. Who knows when we're going to see any sort of proliferation of those going out there? My only caution with GE Vernova, the stock has done so well. I think it's a little bit expensive, not a lot expensive, but we still got to see if being a standalone business helps them solve some of the problems that they have with their solar, with their wind turbine business, when they were part of a fully integrated GE and maybe they weren't getting the resources that they needed. So I think there's probably a lot of upside for GE Vernova with a little bit of valuation and execution risk. And I've just got to leave BWX out because I don't think it's fair for me to rate it.
So in the same vein, I'm going to leave Clearway out because I don't spend any time analyzing it, and it sounds like you covered it pretty well.
Yeah.
If I were to rank,
as Charlie Munger famously said, just buy the damn stock. So,
sure.
There you go, Tyler. Is it too early? Is it too early to use that word?
No, it's perfect timing. I mean, I mean, it's almost cocktail hour for me. So who knows when I might start doing things more than that. But so I'm going to kind of go in the opposite direction because as Jayson said, Enphase is a little bit of a binary outcome. And I think a little bit more assured outcomes. And so if I were to rank these right now, it's going to go, I would have to say probably Brookfield Renewable to start.
Yeah.
Like, again, it's a pretty certain outcome. Valuation.
Well, you got a high floor and a pretty high ceiling, both for that business.
I would say high floor with a decent ceiling, not great. I mean, it's you know what you're getting. It's like 5 to 9% annualized with a current dividend in the 5% range. So that's decent returns. That could vary, based on a lot of things, interest rates, future of things like wind turbines, whatever. But Brookfield's always been good about capital allocation and buying when everyone else is scared. So
yeah,
there's that. I think I would actually have to go with BWX Technologies next. And one of the reasons I like this in the nuclear space, there's not a lot I like in the nuclear space, to be honest. I think all of this new developments, the small modular reactors, the new scales, the OCLOs, things like that. They're trying to do something so complex and so futuristic and so far out the road that it's hard to see. But there are a lot of like things we can do now in nuclear. A lot of it being like recommissioning existing or, recently decommissioned facilities. There is the extension of existing facilities with like new equipment and things like that to get them, extend their commissioning licenses, because the American nuclear fleet is old and it's going to require care and maintenance. And so that seems to all be there. There's maybe 1 or 2 nuclear reactors coming on in the next couple of years, which is nice, but let's be honest here, that's not the big reason. And for the other thing, BWX technology also has, pretty significant exposure to military nuclear reactors, so ships, aircraft carriers, submarines, things like that. And like we also said, they just recently purchased a nuclear munitions business, so they'll be able to take spent nuclear fuel from some of its other, from its other services and things like that, create it into munitions and kind of create an additional layer there. One of the concerns with them is like declining returns on capital, but they have been making investments. So it's kind of one of those things like, is it just like part of the investment cycle or is it actually diminishing returns? I can't determine that yet. I'm still watching. And then after that, I would probably go GE Vernova. I think despite the valuation high, maybe we'll take the valuation out of it, this has been a surprisingly strong business. It's almost like you see what has happened with the spin-offs of GE and wonder like, well, why were you a conglomerate for so long if this is what you could do as separate entities?
Right.
So I think, seeing like them take their renewable energy, which is their wind power business, that is gone from an absolute cost sunk at the original like corporate GE into like improving rapidly with like new contracts and things like that. Its power transmission business is really strong right now. Its natural gas turbine business is incredibly strong. There's like multi-year backlogs for new gas turbines. So there's a lot to like about this business, pretty assured returns for those three. And like you said with Enphase, it's very binary and very like interest rate sensitive because so much of what they do is residential based. If we see persistent high interest rates, you're not going to see the uptake of residential solar with battery backs simply because the financing, it's harder to pencil that at higher interest rates. And so as a result, I think, like you said, it's a binary outcome. Yes, the stock is way down. Yes, the business is still generating cash flow. There's some good components to it, but I don't know if we're going to get back to the salad days of what we saw in, zero interest rate environments. So that I'll do that, and then I'll punt on the last one.
Okay, I think that's a reasonable.
Completely inverted rankings.
Yeah, no, that's okay. We can do that here. So Ed, Tyler and I, neither one of us really follow Chewy very very closely, and I know there'll be we'll save that one for other fools that can answer it a little bit better.
There's one that we can. I think you and I can probably talk for the next 30 minutes on if we wanted to, because we got two semi-related questions. Moncho from I'm guessing Chicago. Any thoughts on Homebuilders? The stocks have been down recently. Maybe it's worth buying the dips, favorites in that sector. And I want to pair this with an older question because I was looking at this before we got on.
Yep.
Because Kent asked yesterday, the MBA, Mortgage Bankers Association, reported commercial and multifamily delinquency rates increased in the fourth quarter. What does it tell you guys? I think those are nice pairing of questions that we can kind of hit together and share our thoughts.
Yeah, I agree. So we'll definitely take. Before we do though, I just want to say, Cena weighed in. I used that word and I asked if maybe it was too early to use it. Cena completely. This is our unbiased, objective ruling. Says it's never too early to say Munger. So, thank you, Cena, for weighing in and clarifying that. And Fulio, thank you for reminding me of this. Fulio weighed in with a good morning. We are unofficially calling this the morning show. The morning show comes on at 9. Yeah. This is the morning show. So thank you for reminding me of that. And Fulio, it is wonderful to see your words on the screen this morning. All right, so do we have thoughts on Homebuilders? I will say this first of all, Tyler, for the past week, while you were away on your glorious backcountry ski trip, I spent every hour I was on Full 24 talking about home builders to some greater or lesser degree.
And you did it without me. I feel
I
scorned.
did. Well, I had to. You weren't here. You were off on a luxury frozen
There's nothing
tundra
luxury
vacation.
about a tent at 7,500 feet, buddy.
Yeah, frozen tundra. I keep calling it frozen tundra just to make you mad. So, all right. So, Mancho from Chi, the question here. So, whether you're from Chi Town or wherever you are, I love the name. Make sure we're pronouncing it correctly. If we're not, though, just drop in with some phonetic help in Slido if we're butchering it. So, okay. So, a couple things. I'm going to share a chart here in just a second that will give you an idea of the context of what these stocks have done, because that backdrop is definitely important. So, but before we get to it, I hit the wrong button. Before we get to the chart, though, I want to talk through the environment that we're in right now, Tyler. So let's start there before I'll let you know, Natasha, when we're ready for it. The environment for home building has certainly deteriorated in a few ways over the past year and a half. From some thinking about the present cycle. So interest rates have skyrocketed. We know that. So that's something that affects the price side. The price being, this is the buyer, price is the buyer, cost is the manufacturer and seller. Okay. So interest rates are affecting the price. Inflation broadly is affecting the price, because when you buy a house, there's other things that come along with that. The appliances, things on the cost side for the builder that affect the price. And now on the cost side, we're starting to see a lot more pressures. And there's two sets of earnings that we've gotten recently that have started to really inform my decision. We can go back a few weeks ago where we heard from kind of the last reporters for their fiscal quarter that was really at the end of the year. Some were into January, where they gave some outlooks that were relatively optimistic. LGI Homes outlook was pretty optimistic. Dreamfinders Homes was pretty optimistic. Now, these are smaller builders too, but they were generally guiding for pretty decent growth in the number of active communities they have. LGI was coming from a real low, over the past couple of years, where they blew through their inventory and they had to kind of rebuild their land pipeline. And Dreamfinders Homes picked up, despite what you see from the stock, Dreamfinders Homes kind of picked up some pretty good momentum in 2024 and is entering the year with pretty good momentum in terms of their build rate and active communities and that kind of thing. And then KB Home reported yesterday, Tyler, the day before. So this is the largest home builder by units, maybe units and revenue. And then you've got Lennar that's kind of right there in the mix too, as the biggest builders. But KB Home reported its first fiscal quarter that was through the end of February. So this is the freshest data, the newest data that we've gotten from any of the home builders. And it was by far the most muted. So there's a couple reasons why. Number one, all of the headwinds that we've talked about, they've become accelerated with things that are affecting both the prices and the costs. Interest rates we've already talked about are creating pressure. And now lumber, we get a lot of lumber from Canada. So with tariffs, if we see a persistent tariff situation on Canadian lumber, that by itself probably consumes 1 to 2 percentage points of gross margin, just the lumber. It's a pretty substantial thing, assuming that the builder has to eat it in their cost of goods sold, right? Which they probably largely will. And then the labor side, with the Trump administration's stance on immigration, the home building industry uses a lot of immigrant labor, probably a quarter of the pool in a lot of markets. It's 20% just about everywhere. And some portion of that is undocumented labor. These companies don't employ their home builders mostly. They have crew chiefs and heads, and a lot of that labor is just contracted labor. Some of it's day labor, some of it that comes on board for the length of the project. But again, it's contracted labor. So what's going to happen if the labor pool shrinks? Tyler, this takes me back to 2014, 2015, when home builders really started to finally ramp up coming out of the financial crisis. The available labor pool had shrank substantially, because coming out of the financial crisis, when home building collapsed, you had skilled laborers that had to find jobs and went to other industries to work. And you also had a lot of the older skilled labor that just retired. So what we saw happen in 2015, 2016, really, I guess kind of began in 2014, was this just kind of a dogfight over labor supply, which meant that labor prices went up and that cost went up for the builders. So everybody's margins took a hit, even though demand was starting to recover. And it made for a tough period. So now we've got the double whammy of those two things on the labor and lumber. And KB Home is the first home builder that I've heard in their guidance talked about land prices, land costs being a headwind for them. Now, again, they're very big. They're in a lot of markets. So for a lot of builders that are typically, they just focus on generally one region that they operate in. And there's a few that maybe have their fingers in a few. This is the first I've really heard of land pressures on a company's bottom line in a while. It's been a couple of years since I've really heard anybody talking about this. So they had a very muted outlook, right? So I think that's kind of the backdrop of what's going on with the business. That's the cycle. That's what's happening now. The greater picture here, we zoom up to 35,000 feet, and we're still probably 3 to 5 million houses underbuilt in the U.S. And a lot of that is regional. You get into the Sun Belt, especially, where those are the trends, the migration trends. That's where the population growth is happening. That's where a lot of economic growth is happening. A lot of businesses are looking to build and operate in those areas. It's a lower cost of living, better weather, lots of reasons that make the Sun Belt really attractive. So again, there's the cycle, and then there's the secular trend that's the backdrop. So the question, we've seen the stocks sell off, and Natasha, I'm finally ready to share that screen share. And you can see, largely over the past year, the home builder stocks, they're roughly flat. We'll see it in just a second here when Natasha sends it in. So what's your, Tyler, while we're waiting on that, what's your overall thoughts? Again, thinking about the bigger trend versus the cycle.
Well, bigger trend versus the cycle. I mean, you and I more or less are in lockstep with, I think the secular trends are eventually going to dominate here. Underinvested. There's a lot to be said of how it's going to, how it's going to play out in the coming years because of those challenges. But despite those challenges, houses need to be built. That's just kind of how it goes. What I would say, and the thing that stood out to me the most, and I do want to keep this in mind because, not to say that it was all, a little smoke and mirrors, but because one of the questions is about thoughts on home builders. And, the things that you were talking about was a lot from KB Home, and somebody who has followed the home builder industry for a long time. KB Home has always kind of been
They're kind of the doom and gloom.
Yeah, they've never been one of the better performers in the industry. They have this weird they have this niche where they're like, we're more affordable home housing, but we do really high customization work, which
which
sounds
eats into
nice
your margins.
Yeah, it's so, but from an investor's perspective, it's always been kind of meh. And most of their transcripts tend to be a little doom and gloom. It's like, well, this, and this, and it always seems to be excuses as to why everyone else is, outperforming them, and it's excuse ABC. So I'm gonna take what KB Home was saying with a little bit of a grain of salt, because that's just kind of been their par for the course. And generally speaking, I think a lot of what you said is directionally correct. However, I think investors who are looking at this industry can navigate it a little bit better. And looking at home builders, there are better quality businesses in this industry. And despite the up and down kind of aspect of this industry, there are exceptional players, and I think people who invest in those exceptional players will do well. I have mentioned for a long time Green Brick Partners here. I know you have.
We'll get into the specifics in just a second. I want to go over the chart just for the context for for everybody watching,
Sure.
and then we'll get into the specifics. So again, this is a 1-year chart. So you see essentially, and again, this is the thing that you always hear when we talk about from the starting point to the end of the stock end point. You say, well, Green Brick Partners stock is flat over the past year. That's not flat, right? NVR stock is down 7%. So again, broadly, these are all down over the past year, but they're all down a lot from their highs last fall in October when the stocks peaked. So we're talking 26% and more, down to a Dreamfinders that's down the better part of half over the past year. So that's the context of the past year and where they are from the highs. But I want to do this too. I just think it's really important. Look at the 3-year charts, and investors have made money. You look at the 5-year charts, again, context where we're getting from some of the lows of the market in 2023, but home builders started to go bonkers in 2023. The stocks were going up because everybody that didn't own a home was looking to try to buy one because they didn't want to work in their kitchen in their apartment anymore during remote work. So the key is that investors have made some money in some of these stocks over the past few years, but we're at this point now. Here's the last thing I want to share on the chart is we're just going to talk about valuations. So on a forward earnings multiple, NVR always trades for a premium to the industry, always has earned that premium. And Lennar has done some things that make it attractive, and part of why it probably trades for a premium. But then you start seeing single digit multiples broadly for a lot of these high quality home builders. All right, let's talk individual stocks and opportunity and risk.
Yep. So, like I said, you're buying individual businesses, and it always matters the quality of the business in which you're investing. As I've said, plenty of times on here, I think Green Brick Partners are some of the best underwriters in this business, and actually like capital allocation. I know you're a big fan.
Land well, they're good operators on the build side, and then they know how to buy, build, and price to make the margins that they want to make. They're exceptionally good. Yeah.
And then this one has been more up and down. As you mentioned earlier, LGI Homes sold out like crazy during the pandemic because they sell entry-level homes at much more affordable rates than a lot of the other companies. Very cookie cutter designs, speed.
Lots of townhomes, some condos, smaller footprint, that kind of thing. Yeah.
They blew through their inventory. They were recovering for much of 23, 24, but they seem to be back on track again. So that's one of the businesses I own. I particularly like. I know you're a fan of Meritage Homes, kind of that same vein, a lot of entry level stuff. And then if you're also just flight to quality in a times of like distress in the market, and you're going to like the most quality companies in this industry, it's really hard to go against NVR. They are the gold standard in this industry. They always trade for a premium. It's for a reason, not only for the fact that and for the fact that, I don't know, its stock is what, like 3,000, or it's a really, really high stock price. So it might keep a couple people away from it in a given moment.
Yeah, $7,300 a share at recent.
Oh, that's
prices.
it?
That's all, $7,300 a share. Well, it's down from over $9,000 back in October. So
yeah.
Go ahead.
Well, I wanted to follow up on one last point of this too, because I mentioned about the delinquency thing. And this has been something that, I don't know, I feel like it's been a boogeyman for a long time in the market, because as something that you and I have talked about for a long time is this idea of like always fighting the last battle in investing.
Yeah.
Where everyone's looking out for the risk of the thing that happened previously. And so, all of a sudden you hear the word delinquency rates ticking up is like this boogeyman of the 2006 to 2008 period where delinquencies started skyrocketing. And all of a sudden we're in a great recession again. And so I feel like ever since 2010, we've been in this like delinquencies are the boogeyman and we need to stay away from. But I want to share my screen because there is a lot of noise out there on delinquency rates. And like sensationalist headlines that you can give. And if Natasha can pull this up, I think it gives good context with it. This is Federal Reserve data on commercial real estate loan delinquency rates. So this includes multifamily and commercial as well. So the headlines that we could write or financial media could write on this is that delinquency rates are the highest in over a decade. And that is factually correct.
Yep.
To say that, at a current delinquency rate of 1.57%, we are at it's the highest since 2014, which, you can run with that and it will grab headlines. People will read highest delinquency rates in a decade. But if you extend it out over very, very long periods, a 1.5% rate of delinquency is incredibly low.
Yeah.
Underwriting quality in commercial loans, in residential loans, in all this stuff has been incredibly high to the level of restrictive post financial crisis. I mean, every single time you look at FICO scores.
Go ahead.
Things
go
like
ahead.
that.
Yeah. Well, I was going to say, there's some regulatory reasons why, but broadly, the lenders learned a powerful lesson, right? And I think that's the key thing. So it's not only is the underwriting quality good in terms of the credit worthiness of the counterparty, but you see even on so like I'll use Axos Financial, which is a big residential lender that does a pretty sizable amount of jumbo loans. So jumbo loans are the ones that don't have the Freddie and Fannie guarantee. The loan to values that they get are extremely attractive. So what that means is in the case that the borrower does default, there's so much margin of safety in how much is owed on it versus what the property is worth that they're able to, even if they have to foreclose on the property, they're able to recoup the loan easily. So we've seen that shift in the lending market very, very much. So, but I agree. But within the context of go ahead.
Well, the thing I was going to add, and we're probably actually going in the same direction here, is that yes, in this period of higher interest rates, we have seen some commercial, multi-family, residential business loans. They have been going through this extension period where lenders have given them a little bit more grace, maybe, extending the terms of a 5-year loan out to 6 or 7 years so they don't have to actually refinance it, things like this, in kind of this anticipation of lower interest rates down the road. The term that, financial talking heads want to use is the extend and pretend sort of thing, but which isn't great. I'm not going to lie that was, the worst thing in the world, but it is very much a lesson from the post-financial crisis where banks, they just don't want to own all this real estate. They don't want to go through the hassle of, taking the keys and then having to sell it in the foreclosure market. That was a huge headache for all of them. They would much rather work with businesses to keep them afloat for a while longer. I mean, there are problems in that in its own sense of like, you get zombie businesses, but for the most part, I don't think it's a huge problem. I think it's a little bit of a, I would be reticent to say that this is like a huge issue or anything like that. I think this is just kind of, the growing pains of a slightly higher interest rate cycle that we're all going to have to navigate through.
Yeah. Fulio says, Fulio writes, FinTwit should be arrested for chart crimes. I think that's
I'm sure that there's a 10-year chart of that delinquency rate that I just showed that makes it look terrifying. But, over a 30, 40-year period, you look at
the mountain before it, right? That's
exactly.
Yeah, no, that's exactly right. I think you're right. Context really matters. So anyway, so that's a lot of context. That's a lot of backdrop for the home builder industry. And here, I can tell you this, here's where my money has been over the past several months. The majority of the investments that I've made so far in 2025 have been in home builder stocks. I bought LGI Homes. I used to own LGI Homes and I sold it probably back in 2021 or 2022. I exited.
Good for you.
Because they were blowing through their inventory and I didn't know what was going to look like on the other side. So I got lucky. There's a lot of luck there. But I recently bought back after looking at this last quarter and their build rate and where they are with getting active communities back online so they can start monetizing all this debt that they have on the balance sheet that owns great land, and now they can start selling homes. Like, okay, this looks really, really compelling. I've added to all of the other home builders that I like. Green Brick Homes, Meritage, I'm a big fan of. I have not added to I've not added to Dreamfinders. I'm concerned about their balance sheet because they have a lot of corporate debt, but they don't own any land. So they don't have something to counterbalance that debt leverage because they only use land options to acquire land. So I've not added to Dreamfinders, but I've bought Lennar. I now own Lennar. I think their spinoff of Millrose helps make them a little more resilient by reducing some of their operating exposure. So that's where my money has gone. I fully expect that the businesses could suffer this year, that it might not be a good year for reasons that they don't have control over. I think it's going to be a great decade. That's why I added to my home builder stocks. If you look at their forward price to earnings multiples and you think about how much the stocks are down, their forward price to earning multiples are basically the same that they were a year ago, right? So you could buy at a good valuation. And again, most of these stocks are down from where they were a year ago. So as much as those forward multiples might look really compelling, you got to think many years out for the cycle to work. And
to kind of just, and this is cyclicals in general. This is not just housing. And I think it's an important lesson too, is, as Jayson said, this is kind of a buying window. And what ends up happening is
the best way to think about it.
Over the next year, these things could go down way more. But the whole point is like, this is a accumulation period in these stocks. And so you can think of it, it's like, yeah, you may, if you're making investments to this today, you could go down another 20, 30%. I wouldn't be shocked in the slightest. But you are, if people are investing in this area, it is on the idea of being it in a 3, 5, 7-year kind of housing cycle swing. And if you're looking at it that range, then like, yeah, a down cycle for the next year or so is an asset accumulation time and not a freak out because the stock is down.
There you go. No, I think that's exactly right. Well, we've got about 2.5 minutes, Tyler, which I think is enough for us to do a very truncated answer.
Because we did do 30 minutes on home builders.
Yes.
As Pro Shop Guy noted in our production channel.
Well, if that 30 minutes helps anybody watching this have a great decade as an investor and better understanding the home building industry, well, we did our job here. So Kim's question, good morning, Jayson. How do you think QuantumScape is doing executing its development plan? And Tyler, you and I can both weigh in on this one. So really quickly, QuantumScape is a startup with a technology and a process to manufacture solid state batteries. Solid state batteries, again, this is it's true. It's the holy grail for EVs because it is a game-changing technology that you charge faster, less weight, smaller batteries. The batteries last longer before they start to degrade, less risk of fire and things like that. So basically all of the things that EVs are challenged with versus internal combustion engines, it addresses just about every one of those things in some potentially meaningful ways. The problem is nobody has ever actually shown that you can commercially manufacture them at scale and at cost. The question, how do you think QuantumScape is doing executing its development plan? So from when the company went public, had some pretty aggressive schedules that they pulled back on and have kind of reset. I think the past 2 years, Tyler, they've done exceptionally well, meeting goals. The feedback from the OEMs on sample cells, the acceleration of their joint venture with Volkswagen to manufacture, help them start bringing in revenue on licensing. I think that's a great step. And I think they're probably ahead of Toyota. Toyota's been making noise about it lately, but Toyota does this. They make noise and then they delay. They actually just delayed one of their manufacturing facilities. So I think they're doing very, very well, but there's still a tremendous amount of risk. Anything to add? You get the last words on this.
Yeah, like I said, I think it's been executing maybe slightly longer than originally anticipated, and it's like a SPAC presentation. So, but yeah, that's, if we're grading on the curve, it's probably one of the better SPACs, SPAC businesses. Their solid state batteries do seem to be coming out of the woodwork. A lot of automotive companies that have been keeping that data tight to the chest or tight to the vest, I guess, if you will, are now starting to make announcements. I know Mercedes-Benz just made an announcement. I know Toyota, Hyundai has been making making references and overtures toward very quickly, perhaps faster than QuantumScape had originally anticipated. But they seem to have locked up strong enough customers with Volkswagen
Yeah.
that it should have an adequate outlet for its business for a little while. I don't know if it'll become like the premier supplier for everyone that perhaps we might have thought it was a little while.
Yeah, no, I think that's a good place to end it on, Tyler. So let's wrap up this hour, and it's time to hand it over to the morning show. So we're going to call an end to the morning show. Let's bring David Meier, Jayson Moser, and Kirsten Guerra to the screen. Hey, fools.
Hello.
Howdy.
Real quick story. I met Jagdeep Singh, CEO of QuantumScape, a long time ago when he was CEO of Infinera. He's a fascinating dude. It's amazing some of the things that, from a technological standpoint, that he's been associated with.
Yeah, you have somebody that actually now knows precision manufacturing too. So I think there's some serious value there. Yeah.
He has a big challenge there. It's hard to manufacture that stuff. If he can solve that problem, it'll be amazing. And so by solve it, I mean, make it work seriously at scale. They know how to manufacture them. They just can't do it at scale just yet.
No, that's the hardest problem. That's the hardest problem. So,
well, that's like what we were talking about yesterday with the robotics event that we did, Dave, right? When we were talking to Daniela, she was talking about the fact they have the capability to make these robots, but it's a lot of hard work and to actually scale it up.
Yep.
It's really hard, really expensive. And that's kind of the nut they have to crack before they can really get this mainstream.
Well, everybody's grandmother had a great cake recipe, but not everybody could take that recipe and manufacture 1 million boxes of cake a year, right? That's where we are.
Did it, didn't she?
There you go. All right, well, Tyler and I are out. You guys have a great hour.
Thanks gentlemen. Well done. Good morning, everyone, and welcome to the morning show. I'm your host, David Meier, here with my fabulous, foolish colleagues, Jayson Moser. Good morning, Jayson.
Morning.
And Kirsten Guerra, who is finally on the mend, thankfully.
I'm back. I'm here.
You're back.
And hopefully my audio's good. Yeah.
It does sound good. If not, Natasha will make you sound great.
Amazing. Thank you, Natasha. I want to add, I know we just transitioned into the new show, but I want to add, I had to look this up to be sure, but I thought that the CEO at QuantumScape changed hands, and it did, or that is true. About 1 year ago, February 2024, a new CEO took over. And I will say I haven't dug deeply into the new CEO, but Jagdeep Singh, the former CEO that you just mentioned, was one of the reasons I really liked the company, because again, this is a pre-revenue company, QuantumScape, so there's not a lot to go on, but sort of the leadership and the associations, who's on the board, how much you trust it, and so he was a big part of that for me. And I think digging into the new leader will be an important thing for investors going forward.
Well, I appreciate that correction, because I haven't looked at the company in a while, and appreciate bringing up the fact that management is important. You have to know who you're in business with, right? So
yeah, breaking news, management matters.
So we got a little bit of news to cover, and then we'll be getting into some questions. Jayson, should we start off with Chewy? Looks like the market is up, so they must have said something good.
Yeah, we can start off with Chewy, a company I think most people in our universe know, but if you don't, it is the pet supply provider of choice for many, myself included. Got a house full of animals here. We got 3 dogs and a cat. And I
got lots of Chewy boxes on my porch.
Regular subscription for Chewy. They show up just magically on my doorstep every couple of weeks, which is really nice. And I was looking at the chart here, the 5-year chart. It's not been the greatest investment. I mean, the stock is up technically. I mean, up about 8%. But in comparison to the market, that is not even close, right? Market's up 130+% over the last 5 years, whereas Chewy's up only 8%. So it's not been the greatest investment for long-term holders. And I get it. I mean, it's an e-commerce business. I think they're still kind of working their way towards really meaningful profitability, but I mean, they continue to get there. I think this was an encouraging quarter. I mean, sales grew 15% from a year ago, $3.25 billion in revenue, and they saw gross margin expansion there as they continue to expand their presence, right? I mean, a part of the story with this business is really trying to get that distribution network out to scale so that they can make the most of it, in sort of whittle those costs down. But it kind of comes in tandem with needing to make sure that they grow the number of actual customers, right? The number of customers that are using their services. And kind of like Wayfair in a lot of ways, I mean, it's really a business that depends on repeat customers, right? They don't want to have to worry about acquiring new customers. That's very expensive in this line of work. So you want to get customers in, you want to keep them in. Now, I think Chewy actually does a really good job at that. And part of that, I think, is just the nature of what they sell, right? I mean, when you get a dog or you get a cat, I mean, chances are you're going to have that friend in your life for the next 10 plus years. I mean, unless you're a loser and you get rid of the animal, and then I don't even want to talk to you. But I think for the most part, they are in a business that can be very sticky. I think it's just a young business that's still working its way towards maturity. I don't own it personally. I will say my daughters actually own shares of Chewy, and they are very proud owners. I mean, they're big animal lovers as well. So we'll get more information from the earnings call. I think something to pay attention to is the subscription revenue, not the subscription revenue, but the recurring deliveries and understanding sort of where they stand on how many customers they actually have. But I mean, it looked like a good quarter. That top line I was really impressed with. That's not bad at all. I mean, you're talking about 15% growth. That's okay.
Yes. And at least according to the summary that I'm looking at, that beat estimates. So that's always a good thing. One of the things also that at least is in the initial commentary is the CEO Sumit Singh said, our performance was underpinned by strong active customer growth and compelling auto ship customer loyalty. Those two have the first one is actually the important one in my opinion, because during its recent decline coming out of the pandemic, where the stock has struggled, it's because they had so many people sign up as a result of the pandemic. Yeah. And then it just stopped. It was just flat. And,
and I think that's a great point. I'm glad you brought that up, because we saw so many businesses through the course of the pandemic that the market had these just great expectations. They felt like this was the direction the world was headed. A lot of these stocks got bid up well beyond reasonable valuations. And then once everything got back to normal, obviously the growth stalled, and then everybody's asking the question, oh, well, what's wrong? Why aren't you growing like we thought you were going to grow? No, they grew. It's just they pulled forward a ton of growth in the course of like 2 years, right? So you got to give them a little credit for that. But, I think you have to ask yourself, like, directionally speaking, is this a trend, right? Oftentimes in investing, you want to look for a short-term catalyst or a long-term trend. And I prefer long-term trends because they last longer, right? Short-term catalysts kind of make me think of energy prices. But if you can find a long-term trend and then hit your wagon of that star, it can work out really well. And I mean, e-commerce is obviously a very strong long-term trend. I think pet ownership is something that is always going to be a positive opportunity, right? A long-term. I think people are always, want to own pets. I mean, we just are a pet-loving society here, and I think that's a great thing. And I think that Chewy, and you mentioned it, the auto ship customers. I mean, they make it so easy. And I mean, I remember vividly, like we used to just get our stuff from Amazon, and then I started getting a little frustrated with Amazon because sometimes they'd be like, oh, we're out of stock of that, or we don't have that. It's not available anymore. And it'd be like, look, dude, my dogs want the same food. Consistency matters when it comes to these pets. And what I found with Chewy was Chewy always has everything that you want. They do that one thing, and they do it very well. And now they've expanded into things like medicines, I mean, they're even introducing telehealth for pets. I just think all of these little add-ons, to me, they are really becoming the place to go for pet owners. And to me, that's a long-term trend that I think is worth considering.
You'll get no argument from me. Do you
Jayson,
look like are you going to argue?
Yeah, I'm going to take the other side of that. No, I wanted to ask if you, and I can say more about why I asked this, but did you get into anything on the vet side, on partner, like any growth in the vet sort of vector of their business?
Well, that is something that they are delving into now, right? They are opening up those opportunities with vet clinics, and they are also working to partner with veterinary clinics across the country. And veterinary clinics, I think, is a fascinating business. It's a really difficult one. And it's funny, my younger daughter, who's at William and Mary, she's actually majoring in biology because she wants to pursue animal medicine. And we talked about what she might do in that space, and just the idea that if you're going to be a vet, just understand that's not easy work. But as you can imagine, I go to my vet at least 4 times a year. And so that we frequent our veterinary clinic, and it's just a private practice, and there's a wonderful family that runs it. And they do talk about how, and they don't work directly with Chewy, but they do, like you can go through Chewy now to get your animal medicines, and all you have to do is just get your veterinarian to offer the prescription. And so they do see sort of where the puck is headed in that regard. And I think that we saw, what was it, VCA Antech back in the day, which was acquired by, I think Mars acquired VCA Antech. I think they also own Benfield. And yeah, Mars, the candy company, right? They also own veterinary clinics.
Thank you. I was just about to say M&M.
Fascinating business. Yeah, it's a fascinating business. But I think they saw the opportunity there, and in pets. But it's something that Chewy absolutely is delving into, and I think that is too new of an endeavor to really make a judgment as to whether it's going to succeed or work. It's a difficult space, and it's an established space. But I think that if Chewy can find a way to get in there and serve as a partner for a lot of those private practices that are out there, right? That the private practice is competing with like your VCA Antechs and your Benfields of the world. That's just very difficult, right? You're kind of going up against corporate medicine that has that scale and the resources. Well, Chewy kind of has that scale and some resources too. And so if Chewy can serve as a partner for a lot of those private practices out there, then I think that could be a real opportunity. But yeah, it's something we're following along with the story.
So they didn't specifically mention anything about it in the earnings release. Their call was at 8:00 this morning. I haven't was hoping to see an initial transcript in one of our sources, but there isn't one yet. So
that's exactly what I did. I don't see anything in their official release, as you said, about it. And I think I was surprised by that, because to some of what Jayson has talked about, I think there are some limited growth vectors for Chewy. The number of customers overall is going to be difficult to grow. It's pretty saturated. The going deeper with each customer, they're doing well with, but you can only do so much, right? Which I can hear some of my friends say, no, that's incorrect. My little boy always needs more treats, but it is a limited growth vector to some sense. And then, so to me, in my mind, for Chewy, one of the biggest growth vectors, and yes, it's very early in the game though, is this optionality of like, what if we move into vets and we have these partnerships and we just get people having Chewy top of mind more often. Right. So that one's interesting to me. That's why I went looking for it. I was surprised to see it not highlighted more prominently, but again, to Jayson's point, it's early. And so it could just be that where it's not quite to the scale where they feel the need to comment on it. So
I think that's it. I think the other thing, excuse me, that's overshadowing that was the numbers of their e-commerce business were very good. So they have the extension of the brand. I agree. Trying to use its brand equity to become more top of mind for its customers, more of a solution provider. They have specifically said they're looking to go international and took the huge jump of going to Canada first. But they still have dreams of being a global brand. So we'll see how that goes. There actually are the number of local providers similar to Chewy around the globe. One of them was a company called Zoo Plus, which serves Germany. So there's competition out there, but your point is still is very valid, that there's only so many more people, so many more incremental pet owners, right? That part of the growth is probably done, especially from a high growth standpoint, is probably done because of the pandemic. I mean, we look at Zoom, right? Zoom got everyone in about 18 months, and where else are they going to grow?
Well, that's it. And I think when you consider what Chewy does, they chose their lane. They're owning that space. They can only grow so much because there are only so many pets and only so many pet owners, and your pet can only eat so much food, right? So then how do you grow beyond that? Well, veterinary clinics is one way. I think another interesting opportunity that I've thought about before with them, and honestly, I've thought about doing this on my own, is pet boarding services, right? I mean, like when you go on vacation and you got to put your pets up, like when we go on vacation, I mean, I need to do something with my 4 animals, right? I have to board them because we typically can't take them.
Why not?
Well,
why can't they have their own room?
Most places won't take them, Dave.
We have two. We struggle with two. Most people are decent about one, like Airbnb, right? Things like that. They're decent with one, but 2 is hard. And we did 3 this winter, and that was a challenge. Sorry to interrupt. Keep going.
Not at all. No, I mean, when they're big dogs, it's even more difficult. But when we get back from vacation and I see that bill, and I'm just like, oh my God, I can't. Like, it costs as much to board them as it does for our Airbnb for the week, which it's okay. I'm not complaining. I'm just like, wow, the size of that bill. There's an opportunity here, right?
Right.
And not all boarding clinics are the same. Some are great, some stink. And so you got to be very picky. And I mean, there are some services where they'll come and take care of the pet at your home, but if you're gone for a long period of time, really, that's maybe not an option. So I don't know. I think it's just expanding that relationship, finding new opportunities, and covering every facet of pet ownership, I think, is ultimately what it is. And that's what Chewy is doing. I mean, they're rolling it out as they see fit. I mean, the flip side to that, if you want to be, an animal boarding company, I mean, that requires heavy capital expenditures, right? You got to own the property. You got to have a place to board these animals. So it's not necessarily that cut and dry, but it's another opportunity they can certainly consider looking at. And so, yeah, I think it's going to be interesting to see how they expand the relationship with pet owners as time goes on, because they've clearly moved beyond just being just a pet food company, right? And I think that's the interesting part about this company. But I mean, for investors, it's worth noting it is something that's going to take some time to unfold.
Yeah, Zach's a fool in the Slido. And please, if you're out there, we do want to hear your comments and questions. Says Chewy, in my experience, also has excellent customer service in the event of issues with deliveries. We have definitely experienced that as well. We didn't order this. Go ahead, keep it.
It's great. They tip. Yeah, their customer service is they've nailed that experience. And I really. For me, that's I won't switch, right? Because they consistently just deliver. And I mean, when a mistake happens, as it always does with anything in life, I mean, they own up to it. They take care of it in a pretty quick fashion.
I also like the little niceties, the little nice touches. That
like the little pictures. And
all that
stuff.
Happy birthday, Kamong and Belu. Like, we get little cards from them.
Yeah,
they know when our dog's birthdays are.
it's just
a lot of little things. Yeah. All right. Well, good for Chewy. that was a really good discussion. Kirsten, you want to take us in the next direction?
Yeah, would love to talk some updates in the autonomous driving network space if you two are open to it.
Of course, I just gave you the perfect segue.
We had
There
a
you
great
go.
conversation about it yesterday.
Starting with the most recent news, maybe, which is yesterday, Waymo announced that they are moving operations. They're fully autonomous, commercially available Waymo operations, robotaxi services into the DC area to be launched sometime in 2026. Now, they're currently already here and operating in a testing capacity. They've had, cars already roaming around, which is kind of the way it works, right? They start in a city, they essentially map it out with their cars within the geofenced area, feel comfortable with the operation before they will move that into commercially available rides. So they've been underway, but yeah, so now officially announced that they will be here. I'm outside of DC. I'm pretty sure it's going to be more tightly geofenced to actual
Right.
DC, but still, it's an interesting location because it's, a number of things. It's very, very heavy in traffic, right? It's a pretty congested area relative to some others in the US. I will say, as a driver that's not from this area and is more used to like Texas roads, they're very convoluted and confusing streets as well. So it certainly poses a challenge on that front. I think the reason it's most interesting to me is that this kind of technology, like it reminds me of there's an author, William Gibson, in sci-fi, if either of you are familiar, and he has a quote that's like, the future is already here, it's just unevenly distributed. And I think that's exactly what we're looking at with autonomous driving, where like if you go to a San Francisco or if you're in Arizona, if you're in the right city right now, you can see these cars all over the place. It's a common occurrence. You can like I said, you can call one and get a commercially available robotaxi ride. Here where I am, again outside of DC, I don't see that ever. It's not a part of my everyday life. And so it's a future that's not here for me. And yet it is happening simultaneously somewhere else. And so DC is a really interesting place, not just selfishly because it's where I am, but it's also where a lot of lawmakers frequently fly in and out, right? So like if these are lawmakers that are currently in cities and states where they don't see this as an everyday thing, they'll start to see it more prominently right in front of them when they are in this area, right? And so it just sort of pushes the issue forward in a way that I think could be really interesting. Have either of you ridden in a robotaxi, by the way?
I have not.
I have not. My wife at one point, maybe a year ago, not a year ago, maybe it was 6 months ago, but she went out to California for a business trip, and they rode one, and they thought it was so clever. And she called, like FaceTimed me when they were doing it. Like she was like, "This is, here to just check out what we're doing." And I was like, "Wow, that's pretty cool." And yeah, I mean, I think this is a very interesting conversation. It's a very interesting sort of idea, the autonomous driving and the potential versus the limitations. And so just for a little backstory, David and I and a few other analysts were part of a robotics event that we had yesterday. And we were discussing a lot of this stuff. And we had an interview at the front end of the presentation with Dr. Daniela Roos. And she's an expert in the field of robotics. And one of the things she was talking about was sort of the difficulty in getting from L4 to L5. Dave, I don't know about you, but that's one of the things that stood out to me in her conversation was just the leap from L4 to L5 is a really big one.
Yes.
And L4, right? That level 4 autonomy
It ain't easy.
is really good. I mean, it does some fascinating stuff. But there are a lot of requisites that kind of come with it, right? And you mentioned it, Kirsten, the geofencing and making sure that it's in an area that actually makes sense. That the technology, it can't handle every situation. It's weather dependent, things like that. And so the leap from L4 to L5 is just a really difficult one because L5 is just straight up pure automation. Like that car is doing everything, everywhere, in all conditions with no errors. And so getting to that L5 place, which she thinks we will get there. It's just going to be a while still. But L4 is, I mean, it's still not bad, right? I mean, there are places where they can really work out well if you're so inclined to get in one of those cars.
So I think Kirsten brought up a very good point about Washington, D.C. being a very difficult city to get around in. I mean, I used to live right next door and I would never drive. I would always metro in. I consider myself a pretty good driver.
Yeah.
And then I'm like, nope, I'm not going there. Right. You got streets going in every direction. You got roundabouts. You got lights in the roundabouts. You have so many things. But if we think about it again from a what's the purpose of this? The purpose of this is to get better. Like if you start getting more rides here, and the experience gets better, the training gets better, the feedback with so many it's so densely populated. There's so many things, places to go, right? There's so many situations. It's a very complex, city from everybody's going every which way at once. There's one-way street. There's so many things to handle. And if you can train and get better at this, right, then it makes the distribution into other places, cities that are less complicated, maybe a little smaller, right? That to me, that's got to be helpful. So, and to the other point that you bring up, yes, if they can get some sort of regulatory advantage by at least being in the front of a representative's or a senator's mind, right? That's got to be a good thing too.
Yeah. Just the visibility.
Yeah.
And so I think that one's a generally positive leaning story. I'll talk a little bit about a story from about a week ago regarding Zoox, which is a company in partnership with Amazon that is in the same area in robo-taxis and building out fleets and networks around that. And this one has its pros and cons. The actual story itself was that about a week ago, Zoox recalled 258 cars that had software issues with unexpected braking.
Uh-oh.
And I think it was, well, I shouldn't really get into details. I don't think it was, it wasn't catastrophic or anything. I think there may have been a couple of accidents. No one was seriously injured, I believe, but something that needed to be addressed. And so what this made me think of is the real pros and cons around the over-the-air vehicle software updates that were originally introduced by Tesla that have more and more come to every vehicle. And of course, as we move into having more robo-taxis, they are going to be piloted by these over-the-air software updates. And a lot of tech companies now operate, right, with this sort of continuous design, continuous implementation. That's not the acronym, but either way, but it's like, it's continuously, day by day, even by hour, potentially sending updates to applications, or in this case, to cars. And so on the pro side of that, you have really easy deployment. If you have a fix for something like this, you as a consumer, in a case where you actually own the car that's using software like this, you don't have to go in to a shop and have something updated for you, right? It just happens over the air. You don't even have to think about it. There's no direct cost. You're not peppered with a cost every single time. You don't feel that like pecking away at you that you have to pay for each of these updates. On the con side, though, as I think about this story, it's pretty worrying to think about the sort of terrifying scale at which, as this industry scales, if you have faulty deployed code, that's pretty scary. And again, right to the pro again, where like you can correct for that, hopefully pretty quickly. But, I just think back to midsummer last year, CrowdStrike releases some updated code, right?
Yeah.
and no one can fly.
Yeah. And 10% of the computers are like moved to non-functional, and it shuts down so much. And just thinking about that in our cars is scary. It's very scary, right? So not to end this discussion on a sour note, but real pros and cons there.
No, I agree. That is very scary, and it's one of the things I always remind myself of. If it's man-made, it's hackable, right? It can be hacked. It will be hacked, and it's okay if it's your laptop, right? But if it's a network of cars driving around the country, that's a problem. And I mean, I can see. Listen, I can see a world where, I mean, having these autonomous cars is a great option. Like traveling, you get somewhere unfamiliar, and now I'm going to get an Uber, right? And I don't know that I necessarily feel so strongly as to whether it needs to be a self-driving Uber or not, but I tend to prefer the human control, right? There's a trust factor there. I'm not saying I wouldn't get in an automated vehicle. I mean, I would. I mean, I would give it a shot. I think it would be kind of a weird feeling at first, and like most changes, I mean, you ultimately just kind of have to get used to it. But I would say day to day, I have zero desire for a self-driving car. I actually, and I mean, I know this is going to sound like, old man yelling at cloud, but I actually enjoy driving. Like, I like driving. Like, I like keeping my mind engaged, right? I mean, it's okay. Like, driving doesn't bother me at all. I mean, I'm not a fan of traffic and all that stuff, but I like being in control. I like driving my car. So I don't know that I would ever want a car that drives itself, but it seems like there are plenty of opportunities for this type of technology. And I think a lot of times, we sort of look at it as black and white, like it's going to be all or nothing. And I don't think this is going to be something where it's all or nothing. And I think a big challenge is going to be marrying the self-driving technology with the human factor that will likely always exist on our roads, at least for the rest of my lifetime. I mean, I don't know about y'all, but I kind of feel like that's gonna be around for the rest of our years. And that'll be a challenge, right? I mean, in sort of marrying the autonomous vehicles with the human driven vehicles and making sure we can all get along.
So your daughters are younger than mine. Did your daughters actually have any reticency about, if that's even a word, about getting their driver's license? The reason
yeah, go ahead.
The reason I ask is because there were actually a number of my daughter's friends in the DC area who were like, I'm scared. I don't want to drive.
Yeah.
And there are alternatives for those people, right?
There are. Now my girls, they couldn't get their licenses fast enough.
Okay. I figured
I went through I lost hair, and my hair went gray over the 2 years of teaching them. That was a fascinating experience, and I'm grateful I had the chance to do it. I'm kidding, of course. I mean, it was scary as a parent. It's a new challenge taking on teaching someone how to drive a car. But yes, they were very excited to be able to get their licenses. And but you're right, they do have friends that are like, oh, I don't really want to drive. And there are options, but we live in the suburbs here in Fairfax Station. Right. Having a car is it's a tremendous convenience.
Yes. And so, but what I'm getting at is there are little bits of different mindsets between, you and I and our generation and generations coming up. They think they have they experience the technology development in the world differently. And at different points, right, in their lives. And so I think that's going to be another thing that's interesting in the adoption curve.
Yeah.
To see if it's the younger folks who actually push this things higher. Because like you're not taking me from behind the wheel. Yeah. I like driving. I have, but I think based on what I have seen, even if it's in smaller numbers, there's definitely lots of people who are very, very, very excited about this. And
absolutely.
And we'll see about scale as well. Like if they can get to scale, that and the cost equation changes, right? Basically the switching costs get low enough where like, why am I doing this when I can take my time and use it differently? That'll be another catalyst that I'm dying to see how that plays out as well.
Yeah, I mean, the cost of car ownership, it's not insignificant, right? I mean, it
I've
is
bought
something.
too
It's a,
many
it's a
cars,
commitment. It's a
even if
commitment.
I love driving them.
By the same token, I mean, what does owning a car represent to you? But for me, it's two things that really come to mind: is convenience and freedom.
Yeah.
Right? It gives me the ability to go do whatever I want to do whenever I want to go do it, and I don't have to wait 20 minutes for someone to come get me. Right? I can just go. And I can listen to whatever I want to listen to. I can listen to as loud as I want. I can just make everything quiet and sit there and think about the nature of the universe, of whatever it may be. But yeah, I mean, there are obviously pros and cons, but it, we're not all the same. And I think they're going to be. It certainly feels like it's more location dependent. It reminds me of, you guys remember Maria Gallagher? She used to work here, and Maria, I think, is up in New York City now. But she was in that camp of, now I'm not interested in getting a license. I don't want to drive. Right. And so she found those solutions that accommodated her. Now she's in a place where it's a lot easier. I think it is somewhat location dependent where you are.
Absolutely.
Right. I mean, whether it's going to be more convenient or a hassle, but there are going to be plenty of places where this is a tremendous solution for a lot of people. And the technology is there. It's just a matter of time and rolling it out and scaling it up.
I would give up my car in a second if a robot car would pick me up and take me everywhere I want to go. I have no problem with that. I absolutely think younger generations, will experience that, where they grow up, they're used to it. It just becomes the thing for them. Many of them never question. And maybe we're talking 20, 25 plus years from now or more.
Right. Yeah.
But still, I think that very likely we will get there. I think so I don't doubt that will happen. To me, what's more interesting, or maybe up for debate, is which direction we will go, particularly in the United States, in terms of, is it going to be me sitting in my private vehicle that I own that's enabled to drive autonomously on the streets, or will I be hailing an autonomous robotaxi? Right. These are like, GM went the direction of ending its cruise service, where it was trying to build this out. And instead it reallocated a lot of the engineers from that toward working on Super Cruise, which is also autonomous driving, but it's for personal vehicles. Right. So I think that will be one of the biggest, in my mind, that's the bigger question, is it going to be which way?
That's an interesting question, because if it's yours, I mean, obviously the cost of ownership come with that. You still got to own it. You still got to insure it, and you still got to take care of it.
But Americans are obsessed with private vehicle ownership.
Sure. Yeah.
But for now, so it could change. But on the world stage, I think we're some of the most obsessed with owning our own vehicle and not sharing.
Yeah. It's a good discussion.
Yeah.
Thank you for bringing it up.
Yeah.
Should we look and see if there's some questions? And I have one right off the bat that I'll take and give you two some time to look. Meat Church, which is a fascinating screen name. David asks, David, how high is your conviction in IAS, which is the ticker symbol for Integral Ad Services? Give me a more widely known stock, possibly in the Motley Fool universe, that I can associate with your conviction rating. I can give you a good. I have high conviction in IAS. For those that don't know, Integral Ad Science. Excuse me. Essentially, what they do is they're like verifying that people, real humans, not bots, actually look at ads, and they're also like an insurance policy for advertisers. Basically, they make sure that the ad that they want to place is up against the appropriate content. You might not think that that's a big problem, but in today's digital world, where streaming is everywhere, right? How do you figure out where to, what's the right place to place an ad, and how do you make sure that the content that you're placing that ad against is in fact good for your brand and doesn't detract? And then again, is what is the real ROI, the real return on ad spend that I'm getting? So basically this company saw its growth slow a little bit coming out of the pandemic, but it's still solid. Management team is phenomenal in my opinion. CEO Lisa Utschneider is one of my favorites. She came from Amazon. She had background at Google. She knows the ad space well. She's really made this company more focused on having the right technologies to solve the customer's problems, in addition to being efficient at solving them. So they're, you got growth, you have some margin expansion, you have better cash flow generation. The stock just really hasn't responded. And that has been unfortunate. If I had to guess now, I would say there's a decent chance that this gets gobbled up by a private equity firm as a result of not seeing that multiple expansion, basically investor sentiment rising. It's not a guarantee by any means. I'm not saying it will happen, but this company was private before, and I imagine there's a decent opportunity that could happen again. But I still, what they do is provide a service that's needed in a growing market, and their business is growing. I just don't know why investors aren't as excited about the stock as I am. But it's still, like I said, in my opinion, it ticks all the boxes for a foolish company. Just the stock has been languishing for the last 18 to 24 months, unfortunately. That happens.
That
right?
happens.
It's happened to all of us.
It happens all the time.
It doesn't happen to you. All your picks are
The
awesome.
money is made in the holding, Dave. It's made in the holding. Sometimes that takes a decade, right? Look at Nvidia.
That's very true.
We held on that thing, and for 10 years, it basically did nothing. Look at Microsoft. The Ballmer years did nothing.
Yes,
right.
Also true.
If you held on to it, you're feeling pretty good about that decision today. So,
you two got anything?
Kirsten, what you seeing?
Well, I could address. I need input, and I can give output. I guess. It says, hey, Kirsten, what are your thoughts on Ulta for the long term, given some recent pullbacks and slow growth? Thank you. Well, you're welcome. I think what I would say about Ulta is that Ulta is not a fast growth, not a high growth business. If you're holding Ulta or considering Ulta as an investment, I would know that going in. I think for a company like Ulta, because it's a retailer, I've talked about Ulta in contrast with like an Elf Beauty before on the show, because people often see two businesses like this and don't grasp the difference in expectations between them, where you have one like Elf Beauty where it's a specific brand and therefore can rise and have a lot more quick growth in a market as it takes market share, versus an Ulta Beauty where it is the retailer and it is selling all of the brands, and within that collection of brands, some of them will rise and fall over time. And so what that means is that one of the main growth factors for a company like Ulta is just going to be the market itself. A general interest in things like cosmetics, hair care, and skincare, the things that Ulta sells. As the general market demand wanes or rises for that, Ulta will do better or will do worse. Of course, there are also other growth vectors. They can continue opening more stores, which I'm sure they are planning to do to some degree. They also have a really robust loyalty program. They are one of those where most of their revenue comes through their loyalty members, and they do a really good job of leveraging that and increasing order frequency and higher average ticket and things like that. So they have some levers there, but it is one where I think you should expect to pull back in times of lower overall demand. I guess you could say that's true of any company when there's lower overall demand, but it's going to be a big deal for Ulta because that is one of its driving forces in terms of growth factor. So I would just have that sort of in the back of your mind as an expectation of the company. That being said, it does not, I believe, pay a dividend, which I find interesting, because if you're, generally as you move towards a company not being one of high growth expectations, you'd like to start seeing potentially a dividend come into play as its growth story, sort of levels off and becomes more steady and stable. You like to see that potentially return to shareholders in the form of dividends. In this case, that is not there. So also something to keep in mind.
They bought back a lot of stock though.
But there is that, right? There are multiple mechanisms for returning. So Ulta themselves, you may interpret as seeing their share price a little undervalued.
And the new CEO too, right? Keisha Steelman just taking over. So it'll be worth paying attention to, seeing her vision for the company and her ultimate execution there. Maybe she's on board with your dividend, Kirsten. I guess we'll see.
Maybe.
Yeah, I mean, living in a household of all women, I think we can all speak to the resilience of the cosmetics market. And I mean, I'm being totally serious. I mean, my daughters and my wife, they love that stuff, and I get it. That makes sense. That's the idea. In Ulta is very often a last second gift idea. When I can't figure out what to get, boom, Ulta gift card. I know that's going to be a winner every time, and they love going there. So yeah, I mean, one thing I noticed with Ulta, and I don't know if you have thoughts on this, but they developed this relationship with Target where they have these Ulta stores within a Target now.
Yeah.
And, Target's challenges notwithstanding, I mean, obviously they're kind of dealing with some challenges. I think those are more relative when you compare it to like a Walmart. It's not like people don't go to Target. Plenty of people do. But it feels like those little stores within stores are good opportunities as well to continue promoting the brand and offering, something that a lot of people really consistently want to buy. And then the loyalty program, like you said, that is a very strong one.
I have a real quick, what I think is a funny story about Ulta. A long time ago, I was working with one of our analysts, and I asked her, what do you think of Ulta? And she was like, oh, I love it. She was like, you should go into a store. And I was like, okay, I'll do that. So I went into a store with my wife, and my wife was looking for two things. She was looking for a hairbrush, and she was looking for a very specific color of nail polish for our daughter. So I'm walking around, and this associate is just looking at me because I'm like literally studying like all the stuff on the shelves, and I'm like looking over at the hair salon, and this associate doesn't know what to do with me. It's very clear. Like, can I help you? What are you looking for? Exactly.
Do you need me to help you match your?
Are you a springtime color? No, I'm more fall colors. But she came over and she was like, hey, is there something I can help you with? And I was like, yes. Can you tell me like which products here are moving and this? And she was like, wait, you're not. And I'm like, no. And I'm like, I don't want to take any of your time away. Like, cause you have customers to serve. Like, I get that. But like, if you have a little time, just, can you answer some questions? I'm from the Motley Fool, but yeah. And I'm just doing some research. And she was like, wow, you're the second person who has come in here and from the Motley Fool. So my guess is it was Catherine who came in as well. But I never verified that. But yeah, funny. So I was in there looking around and the associates were sort of giggling, like, what do we do with this guy? But
he's just market research.
But I did learn a lot. It was at the time when they were just starting to really ramp up their loyalty program, and that was huge. Just how their sales process was consultative. It wasn't like, I'm pushing this on you. It was really, what's the solution that I can help you find, not here's the product I want you to buy.
Yeah.
And I appreciated that right? I mean, the woman, you know, I watched her interact with my wife who actually needed something, right? And, you know, it was amazing what they talked about. And I just sat there and watched it. And I at that point, I was extremely impressed with the way that they run their business and the culture that they've created and the way that they really take care of their customers. You know, that's been a foundational piece. Now we have to remember this was
Foundational. Did you get that, Kirsten?
Yeah.
Wow.
This was 10 to 12 years ago.
Incredible.
So, you know, so it's served them well.
Well,
I've always
it's
liked this
creating
business.
something beyond the transactional, right?
Correct.
I mean,
Absolutely.
I don't want to go to Walmart. Okay. I have to go every once in a while for whatever, if I can't find something. I don't want to go there. I don't enjoy going there. I mean, I'm glad that it exists and I can get something if I need it. But it's very transactional, right? It's just transactional in nature. But you create something beyond the transactional, and whether that is human interaction and an experience or the way the store presents itself. I mean, I think Costco seems like it would be transactional, but they're doing something that extends beyond the transactional. It's an experience going there. Maybe it's the nature of what they're, you know, the warehouse shopping style of experience there. Maybe that's what takes it beyond the transactional. But when you can find places that take it beyond the transactional, I think, I mean, it's not to say it's always going to be a good investment, but I think that's something that can absolutely play out in the company's favor. It makes them unique.
We're certainly seeing that with Starbucks, not to pivot too much to just different
Another
companies,
great example. Yeah.
It's exactly what we're seeing. Starbucks bought 200,000 Sharpies to give to its baristas to write little, you know, handwritten messages on cups, and for no reason, because they've gone through all of this effort to have these perfectly printed stickers. You know, most mobile orders, most of their orders that come through are mobile. And so they have this really efficient system of just like the order and the name are on the cup. There's no reason for them to write on the cup anymore as they used to 10 plus years ago. Right. But they're doing it again anyway, and they're bringing people back to the store. So they went full transactional, are seeing some issues with that and trying to pivot back in the direction you're describing.
Yeah.
Very good point. Very good point. I actually have another question that I'm going to take, but I wanted to read off some of the comments that we had on the self-driving car. Spiffy says, I'd rather have a self-driving car, and then I can look around and see new possible business to invest in. Boom. That's definitely foolish. I also think it will work well for the elderly. I think that is also
no question.
A good point there. Random Lake says, a car as a service business will have to solve the self-cleaning problem in addition to the self-driving problem. That is actually a good point. You're gonna have to figure out how to maintain these things.
Did you see the video? I guess Tesla put out a video of like they have like a robot cleaner.
That doesn't surprise me.
No, yeah, I mean, but I think that's
no, I haven't, and that doesn't surprise me.
I think that's one of the bigger things that they have to address there, because if these cars are going to be just shuttling people all around, there are a lot of disgusting stuff out there, and I mean, you're gonna have to keep those cars clean. Man, I don't want to be hopping in some junk pile.
Rebel brings up a good point. Cars are a depreciating asset. My children would rather not bother. Yeah, I would rather not bother too. But yes, my mindset is definitely different. And the question that I will actually get to, and I hope that I pronounce this name correctly, from Roz Gayado. I hope I pronounced that correctly. Thoughts on the tear that sports data firms like Genius Sports, the ticker symbol is GENI, and Sport Radar, the ticker symbol is SRAD, are on. Well, first of all, I'm happy. Sport Radar is a recommendation that I've made, but it's because the business, especially Sport Radar, they're performing well. Most recently, the earnings came in a little higher than expected. In 2024, the revenue growth was 26%, if I recall correctly. They're expecting 15% in 2025, but what really got the attention of investors was they're expecting margins to expand and cash flow to expand. as the investment phase of the most recent licensing deals that they did. This business, Sport Radar and Genius Sports, what they do is they purchase licenses from sports leagues around the world to get the data, all the data that's collected, and then they turn them into content and betting opportunities, and that's how they generate their revenue and cash flow. So they're seeing, basically Sport Radar is seeing very nice return on investment for the licenses that they have invested in, and that's exactly what you want to see, right? They make good investments, which turn into growth for their business, which turn into hopefully good returns on investment for their shareholders. But that's what's happening right now, and knock on wood, that's what will continue to happen.
I'll try to answer really quick this question again from Me Church. Pinterest or Match for next 20 years. You can only hold one. Minimal explanation. Go. We'll see how I do on minimal explanation. But I think these two paired together are really interesting. And it's tough. I would say both of them have the advantage of a really locked in user base. Pinterest, kind of a visual search engine. Match being Match Group, the company that owns a number of, and sorry, those are, so Pinterest is PINS and Match Group, MTCH, I believe. Match Group owns a number of dating services, including Tinder, the largest one in the world, and Hinge, which is, I think, the fastest growing one in the world. So a lot of really bought in customers, sticky, network effects there for both companies. Neither of them are founder led anymore. If I had to own one over the other, I think it would be Pinterest. And I say that because Match Group specifically has had, this is not a true number, but it is not far off, I believe, something like 8 CEOs in the last 12 years. It's wow. Really, really high turnover. And part of that is just that it was coming out of IAC to be its own public company. But the turnover rate in the C-suite there is very high. And while I see a lot of potential for Match Group sort of as the product and what they do, leadership, as we started the show with, leadership is incredibly important. And it's really hard for me to judge whether that business will come in line when their C-suite just keeps changing. Whereas, again, Pinterest no longer helmed by the founder, Ben Silbermann, but I believe it is, it's only had one turnover, and they brought in an ad exec, and that is the big opportunity ahead of Pinterest, is to further and better monetize the platform that already is so popular. So yeah, not minimal explanation perhaps for me, but I think if I had to choose between only those two and I could only hold one, I think for that reason it would have to be Pinterest.
Okay, follow-up question for you.
Yeah.
Do you use either or both of the platforms? And if so, which one do you give the advantage to from that perspective?
I don't really use either of them. But what's interesting is I have been a user of both. They're both the kinds of platforms that I think make sense at different points in life, right? Like if I'm in a relationship, I'm not on Match.
Right.
Ideally.
And if you are, then you're out of the relationship.
Exactly. And then I need it. But then, and same with Pinterest. I'm not a regular user of Pinterest, but I don't know, if I'm planning a kitchen renovation, I'm probably going to be on Pinterest, right? But not all the time. And so they both have brands in a prominent place in my mind, where if this, then I go to them.
Yeah, so that's what kind of struck me with them. They're not pervasive. And I think when you're looking at those platforms to find the best opportunities, you kind of want the ones that are pervasive, that people are just using every day. The most people are using the most amount of time every day. And I mean, obviously, yeah. Meta is the clear example there of just having platforms that people just can't seem to quit. But it's Pinterest. And so I speak with my daughters, and they use Pinterest from time to time, right? It's sort of idea generation, and they see things they like and they pin it or whatever it may be. Neither of them uses Match. So yeah, I don't know. It's I think a good
That
reminder.
you know of.
Well, yeah. I mean, I know my younger daughter is in a very serious relationship, and my older daughter is really not interested. She's focused on her education and career, and she just right now doesn't have time for guys. But which is fine. I don't care either way. But maybe she will use it one day. I don't know.
We were all over Pinterest planning for getting ideas for Caroline's wedding.
Yeah.
It was awesome.
Yeah.
One of the biggest use cases that I hear from most people.
A lot of recipes and stuff there too. I mean, I'm a big cook. I mean, I cook all the food in our house, and so like I don't use Pinterest for that. I just use Google and I find recipes all over the internet. But I bet Pinterest would be good for that.
Yes,
maybe I should try it. CEO
Bill Reddy has done a good job of getting people to do more than just browse. They have changed the ad technology stack in order to figure out how to get you to act more, right?
Yeah.
Make it worthwhile to take the next step of, oh, this is interesting. Hey, are you beyond a lurker, right? Like we were, or and turn that into an action, because that's what ultimately helps drive the revenue growth, is the advertisers and making the platform effective for them. So. Well, we are at the top of the hour.
Dave, just one follow up here real quick.
Sure.
Pronounced Raz.
I was close.
Guiado.
I was close.
Yep.
I was close.
He just noted here on the.
And thank you for the thank you, Raz. So with that, thank you for spending this hour with us, fools. It was a lot of fun. Really appreciate both Jayson and Kirsten. Their insights are awesome as always. And with that, it is time for financial planning with Robert Brokamp and Dan Caplinger. Gentlemen, take it away.
Thank you, you three. We'll see you on Match later on today. Just kidding. Welcome, everyone, to the Financial Planning Power Hour with Dan and Bro, a couple of former financial planners. Dan is also a former attorney. I still have my certified financial planner designation, and we are looking forward to spending the next hour answering your questions about retirement planning, college, estate planning, tax planning, Social Security, asset allocation. Go ahead and get those questions into Slido, and we will be very excited to answer them. As questions come in, we do talk about things that some reason are on our minds. I'm going to share my screen to talk a little bit about an article recently written by Christine Benz of Morningstar, one of my favorite personal finance journalists. And I'm sharing it because it's a different take on what to do with your portfolio in retirement. Here at the Motley Fool, we always talk about any money you need in the next 3 to 5 years should not be in the stock market. And then for retirees, we talk about the retiree income cushion, which is 5 years worth of portfolio provided income that you need from your portfolio out of the stock market in cash, maybe short-term bonds, maybe tips, maybe I bonds, things like that. And Christine recently wrote about her bucket strategy. It really started with a financial planning guru named Harold Novinsky, very well-known financial advisor. He's now retired. If you ever went to a financial planner who used Money Guide Pro as their software, which is, I think, these days the most popular financial planning software for professionals, Harold Novinsky was part of creating the return assumptions with that. So he's the creator of the bucket strategy, but Christine has expanded it and popularized it. So this is what the summary from her article, and you can see the name of the article down below there in case you want to look it up yourself, but it starts with this. So 1 to 2 years worth of portfolio provided living expenses in cash, maybe short-term bonds, and you adjust that according to your risk tolerance, right? If you want to play it really safe, do 2 years and have it just cash. Short-term bonds, maybe if you want to try to get a little extra return. I mean, these days you could get about 4% from money market funds. A short-term bond fund like the Vanguard short-term bond fund yields like 4.2%. So you get a little bit more, not too much more. Then for bucket 2, it's 5 to 8 years worth of portfolio provided living expenses in investment grade bonds. So maybe corporate bonds, maybe more treasuries, maybe more intermediate term treasuries, and maybe blue chip dividend paying stocks and or balanced funds. which in the typical balanced fund usually has a stock split of about 60% stocks, 40% bonds. And you can find some really good balanced funds from the likes of Vanguard, Fidelity, T. Rowe Price. Dodge & Cox has a good one as well. So this is mostly safe money, maybe taking a little risk. But again, this is a situation where you would adjust it for your risk tolerance and maybe your outside sources of income if you have a really solid pension, for example, or businesses or something like that. And then bucket 3 is stocks, maybe more volatile bonds. That's from Christine. She put, like, for example, high yield bonds. I'm not personally a big fan of high yield bonds, otherwise known as junk bonds. But they could play maybe a small role in your portfolio, and maybe other types of bonds could be international bonds, for example. So those are the way she breaks up the 3 buckets for retirement. And then just very quickly, how do you maintain it? Well, of course, you spend from bucket 1 over the year, but then you gradually replenish it with, first of all, any income you get from your cash, bonds, and stocks in your buckets. So any interest, dividends, that goes to replenish the cash. And depending on how you've arranged your portfolio and how much you need to spend, that can do most of it. And then you rebalance overweighted assets in buckets 2 and 3, right? After a year where the stock market did particularly well, you would sell maybe some of those stocks. You would sell maybe the stocks that did particularly well if one particular sector did well, for example. And then finally, principal withdrawal from the lowest risk assets in bucket 2. And you would be most likely doing this because you've had a string of bad years for stocks, and you're trying to sell maybe your treasuries, maybe your corporate bonds, so that you can leave the stocks alone and benefit when they eventually recover. Because, you know, when you sell stocks when they're down, you're locking in the losses. So I just thought I'd share that as a different way to arrange your portfolio in retirement. Dan, you all right over there? You ready to talk?
Yeah, fine. I'm just coughing my cough like I sometimes do. It's all good. Fools, welcome. Thank you for joining us for another Wednesday morning here on the East Coast. Always pleased to be here. I'm sharing my screen, which takes me a second to click the click and then click the other click. And boy, yeah, we can't do that here. Let's, make that bigger, cover up my mess, and share the screen. And here we go. So, wanted to talk a little bit about what one group of folks is calling buffer ETFs. I'm sharing my screen just to kind of show my work here. And how this got on my attention is that I was reading an article, and a well-known research company, AQR, which is run by the folks that Cliff Asness is a well-known investment professional. And the firm that he's affiliated with came out with a criticism of what's called buffer ETFs. These are instruments that are designed to give you some downside protection in exchange for giving up some of the upside that you have. And we've seen these in numerous forms. These are ETFs. These buffer ETFs are exchange traded funds. But we've also seen them in the context, we'll get questions about equity indexed annuities, kind of the same principle there. Basically, what AQR is saying is that these buffer ETFs, they don't get the job done. They don't protect you the way that they seem to protect you, and they cost you too much on the upside. And that it's better off if you are basically, if you're interested in trying to reduce your portfolio risk, then it's better just to do normal things like change your allocation of stocks, bonds, and cash, that you can come out ahead doing that. But, I'm not going to take Cliff's word for it. Let's take a look and see these guys a little bit more closely. I picked one. It is the well-named, some marketing professional came up with this, the Innovator Defined Wealth Shield ETF. It's ticker BALT. I don't know. I'm picturing Patriot missiles here or something, but it has what on its face seems like pretty simple task. It's trying to provide a 20% buffer against a market downturn. And so the way that it does this is it buys options to cover the risk of a greater, or to cover risk up to a 20% drop. Above and beyond 20%, if you have a 30% crash, you're on. That's probably more into options than we need to get. As a result of this, as an ETF investor what you are getting. Right now, for instance, in the quarterly period, this is a first quarter, this is a quarterly thing, there is a 20% buffer against downward movements in the first quarter of 2025. There is a cap, though, on the quarterly return that you can get. That was 2.41%, according to this fine print over here on the right. And what that means is, markets down 20%, you should be okay. Markets down 10%, you should finish flat. Markets flat, you're flat. Markets up 10%, you should be up 2.41%. Markets up 20%, you should be up 2.41%. That's how it works. It's pretty simple. And, you can kind of see, like this quarter, you can see there were periods where we kind of got up toward close to the cap, but overall we've had a down market. And so, as you would expect, the return for the quarter has been right about zero, which is what you were promised as an investor. So let's take a look. These funds haven't been around all that long, so the performance history is not complete, but let's take a look at how this has worked over time. This is a 3-year chart of the S&P versus the Innovator Defined Wealth Shield ETF. And you can see the purple is the ETF. The orange is the S&P as measured by the Spider S&P ETF, so that it includes dividend income, that kind of thing. And you can see that period, that 3-year period started in 2022 in the midst of a bear market. And so, as you would expect, things got off to a rocky start for the S&P, whereas this ETF was able to hold its own. You see, with this big downturn, this ETF hanging right around the 0% line, which is what you would expect. Then towards the end of 2022 and then into 2023, you have a big bull market. You can see that the bull market in the S&P has that orange line coming and catching up. The purple line's going up, but it's not going up that much. Going up at a pretty close rate. And then 2024 happens. We keep on going up on the S&P. Purple line here, that buffer ETF, still getting some gains, but limited, not nearly as much as the index. And so as you pull into this year, you can see big drop in the S&P, a modest drop, more modest ups and downs in that ETF. And if you pull it into a year to date, I'm doing this on the fly, I sure hope it works. Yeah, you can kind of see in early January and in January and early February, when the market was kind of pushing up a little bit, you can see this going up just a little bit, but now we've been down, and there you were. When you look at Morningstar to get a better sense of where things were, you can kind of see how this works. Modest gains in 2022 were very good compared to an index that was down. Modest gains in 2023, not quite as good compared to the big gains that you saw in the index. Modest gains in 2024, again trailing the index. And year to date, we're ahead because only down just a titch compared to where the market's down more considerably. And so you can kind of see here, percentile rank. This is kind of a funky category that I'm not quite sure what it does, but in 2022 in the bear market, it was top 1%. And in the 2023 bull market, it was bottom 2%. So you can kind of get a sense there of where things are with these ETFs. My personal view is a couple things. One is that at least these buffer ETFs are a little bit more transparent, a little bit less opaque in trying to understand what's going on. than some of the insurance products that do the same thing. Some of those insurance products, they are not very clear about what they do at all. You don't necessarily know what the cap is. You don't necessarily know, it's a little bit harder to understand. This, at least, you kind of get a sense up front what you're getting yourself into. The other thing to look at is fees. And, these ETFs have fees, and the fees, this one, the one that I just looked at, 0.69%. And so that's eating into the gains that you would get, obviously, doing your own more balanced portfolio of stocks, bonds, and cash. When you get a stock ETF for less than 0.10%, same thing, you get fixed income ETFs cheaper, or you can just go to your bank and do CDs and not pay any fee at all. So, yeah. So where do I come out on these? I don't know. I've taken a look at them. It's an interesting approach. If you're going to do, it's one of these things where I'm sort of like, if you're going to do this, I wonder if for foolish investors in particular, if you're going to do something like this, I wonder if it makes sense to do it yourself. I mean, you can get accounts, you get margin accounts that'll let you trade options in a what would it be? It would be a covered call plus a put spread. I think that most brokers would let you do that with sort of the minimal level of options. The brokers will have you fill out risk tolerance surveys to kind of get a sense of, are they going to let you do, how sophisticated options trading are they going to let you do? This would be, I think, probably not the most basic level, but sort of at a level 2, if I had to guess, with most folks. And so it is something you could probably do on your own, save yourself at least part of that 0.69%, but it is also on the sophisticated side. And so I think, in the spirit of keeping things simple, I think that if you have a choice between 100% exposure to this kind of strategy or some sort of balanced portfolio, I'm not going to, 60-40 is popular, but that might not be the right balance for you. I'd probably stick with the balanced portfolio just because it's easier to deal with. Bro, did you grab questions? I was researching, and so I didn't grab questions before.
Yes, I grabbed a couple of questions. And we do have some questions, but we will have time for many more than has already come in. So if you have any questions, go ahead and get those into Slido, because we will have time to answer them. So I'm going to grab this question from Raz. How might this bucket approach be modified if one expects to receive a state government pension? I'm going to share my screen because we did a whole presentation on what we call the income cushion earlier in the year. And so it provides an illustration of how you could incorporate a pension into the 5-year income cushion, but then you could modify it for your buckets as well. So you basically start by saying, okay, how much do I need in my first year of retirement, or this year if you're already retired? And then you project how much that's going to grow due to inflation. Here, I'm assuming that both income and Social Security will grow 3% a year. So you're projecting how much you need for the next 5 years. And then you subtract the very secure income that you expect. In this case, I'm assuming it's a $15,000 pension, and it does not adjust for inflation. But if you are receiving a government pension, it's actually more likely that you will have a pension that adjusts for inflation. And then Social Security does adjust for inflation. So I am growing that by 3%. So you start with the income you need, you subtract the guaranteed expenses, or the guaranteed sources of income besides your portfolio. And that tells you how much you're going to need each year from your portfolio. You add up, in this case, if you're going to do the 5-year income cushion, you add up these 5 years worth of the shortfall, and that gives you $190,457. So that's how you would determine the income cushion in this situation, how you would factor in a pension or any other source of income. Maybe you have rental properties. Maybe you still have a business. Maybe you have part-time income. Maybe you get distributions from a trust fund. You would just have to factor in how secure that income is into your income cushion. And then I'll take a question from Money Maven. What cash options that you mentioned, if any, are covered by FDIC insurance? So that's a good question, because often when I talk about cash, I use a few things interchangeably, and some are FDIC insured and some aren't. So if it is a savings account at a bank, high yield savings account, these days you should be able to get between 3 and 4% if you look. Checking account at a bank, CDs from a bank, money market account from a bank. Those are all generally FDIC insured. The FDIC does have a tool. It's called their ED tool. I think it stands for Estimated Deposit Insurance Estimator, something like, no, Electronic Deposit Insurance Estimator. And you can put in the information. It'll give you how much of your cash is FDIC insured. Now, these days, though, you can get slightly higher yields from money market funds, and those are not FDIC insured. Now, they tend to be very safe, invest in very safe securities. Often they're just invested in treasuries, or a large part of it is invested in treasuries. But you definitely want to dig into the details of a money market fund, because they are not FDIC insured.
All right. I'm being told I froze for 20 seconds there. I apologize, fools. This happens when I try to use outside resources while I'm talking, so I'm going to minimize doing that, and hopefully it won't happen again. Let's see. So, all right, I'll try Jimmy G. It's a risky question. I'm going to try it anyway. If Social Security were to be privatized, what do you think would happen? So, Jimmy, I tried to do some quick research here. It is a topic that has received attention globally. There are actually some companies that have done kind of trial balloon efforts to allow sort of a hybrid of public pension style retirement support, financial support, and almost what you'd call defined contribution stuff. I didn't have time really to look closely at the research. It seemed to me that at least the opinion of this particular researcher was that there are pros and cons to it, as you would expect research to find. But, I think that what you can do is you can, to get a sense of what it's like to go from from what Social Security is like now to what a privatized system looks like. I think that it's probably useful to look at the experience of just about every major corporation that you can think of that was around in like the 1970s, 1980s, and before. And look at how they made their transitions. Almost all of those companies now have made the transition away from a defined benefit, pay-as-you-go financial retirement pension system, and have moved to the more 401k style defined contribution, leave it up to the employees for the most part, perhaps do some employer contributions and matching on the side to help out. But I think you can get a sense of that. And what you will find among those is it's a change of responsibility. It shifts the responsibility from whoever it is who's providing the pension, in this case the federal government. It shifts that responsibility from them to the individual. And so the question is, well, okay, how well are individuals going to do with that? And the answer is it varies. Some individuals do a good job. Some individuals don't do a good job. And so the question becomes, is that the desirable public policy outcome for folks? And I think opinions can vary on that. But here's the issue that I have the biggest question about, and that is that conceptually, if you're starting out from scratch and you don't offer anything, and you have to go to the program and say, okay, what do we want to do? There are two options. We could start a new program and we could guarantee everybody a certain payout, and we could collect taxes to do that. Or we could make everybody be responsible for it themselves and not collect the taxes that we're collecting and just see how everybody does. If you make that choice up front, it's a lot cleaner than the situation that you have now, because the situation you have now is that You have several generations of people who have relied on the choice that was made before. And now you have people saying, well, we'd really have preferred not to have made that choice. Let's undo it. But it's the transition that's the most difficult. I'll tell you, if I had a 1-year-old kid and you told the 1-year-old kid, there's not going to be any Social Security, but we're not going to collect payroll tax. It's up to you to save the 7.65% plus the 7.65% that your employer is not going to have to pay either. Ideally, that should boost your pay, by the way. It's going to be up to you to save that 15% and to invest it well and to get to where you're going. Oh, and by the way, along the way, you need to buy yourself disability insurance because, oh yeah, that's part of what Social Security is buying too. It's easier for the 1-year-old child to make that adjustment than it is for 55-year-old me to make that adjustment because I've made decisions for 55 years that were based on that. And so, but the problem is that if you only apply these solutions going forward for people who are 50, 60 years away from retirement, it doesn't address the problem. That was one of the genius moves of the 1983 Social Security stuff, was that a lot of the things that took place, they didn't have to take place until 20 or 30 years into the future. That gave people time to adjust. But it was enough at that point to make the math work. We've squandered that lead time. Now we're down to less than a decade. And so it makes these things much more difficult. So I think that if Social Security were to be privatized, it's hard to predict what the impact would be because I don't know exactly how it's going to be privatized. If it were privatized wrong, it will do a lot of damage. If it's privatized in the best way possible, then there's probably going to be a mix of results, and some people will be better off and some people will be worse off. That's where I go with that.
All right, I'll get into a question from Sandy C. What happens when no beneficiaries, so a state receives a 401k? Do retirement rules apply depending on who it gets distributed to in the end? So first of all, I'll say that it depends on the state. And often there are documents associated with a 401k that sort of give a default if you don't fill out the beneficiary form. So it might say something like, if no beneficiary form was filled out, the 401k will go to the spouse. And then if not the spouse, the child, or something like that. So that might already be written in the documents, but then that whatever is in the documents, it has to be compatible with whatever the state laws are. So that's that. But if, after all of that, it goes to the estate and no beneficiaries, then it will be distributed according to however the will decides that anything gets distributed. So if the will says, everything I own will be distributed equally to my 4 kids, then it'll be equally distributed to the 4 kids. Or if there's no will, then again, it goes back to the state laws. The big difference is if it passes through the estate, whoever eventually gets it will have to drain it within 5 years in most situations, as opposed to if it goes to someone through a designated beneficiary, they will have more flexibility. It'll depend on who you are. Spouse could basically treat it as their own. Kids who tend to be more than 10 years younger than the person who is deceased have to drain it within 10 years. If you are older or less than 10 years younger than the deceased, you can stretch it out. So it really depends on your relationship. But the bottom line here is you definitely want to be filling out and updating the beneficiary forms for your IRAs, your 401ks, and your insurance policies. And then Sergey had an interesting question about the income cushion. Said, bro, in your example, is 190,000 pre-tax or post-tax? If it is post-tax, then the final number should be higher depending on the tax bracket. And that's true. And there's actually a good bit of customization you could do with your income bracket or with your income cushion, depending on, number one, your tax situation, and number two, the return you expect to earn on that income cushion while it's waiting for you to spend it, right? It's a different situation today where you can earn 4% on your income cushion as opposed to 5 years ago when you earned absolutely nothing. So the income cushion really is just a framework. You could certainly put it into a spreadsheet to tweak your assumptions. To answer Sergey's question, it's all, I guess you would say it's all, taxes are considered one of the expenses. So I think in my example, it was $75,000 was the first year of required income, and that included taxes. So that was one of the expenses that is included in that. And then so for the other part, I would assume I would say it's pre-tax. Like I'm not factoring taxes into it, but you certainly could. It would certainly be a big difference if that money is coming from, say, Roth money versus traditional. So you could create a spreadsheet that allowed you to customize that a little better.
All right. Sandy C asked a few minutes ago, what can be deducted from state level estate taxes? Does it depend on the state? Yeah, Sandy C, you gotta look at the state. Some states will mimic the federal estate taxes rules. And so in that case, it will match up with federal estate tax deductions. In some of those cases, it'd just be a different limit on some of that stuff. But there are also situations where states won't recognize the same exemptions or deductions as that the federal government does. And so, yeah, it's going to be a state by state issue. And then Kyle is a cabinet asks, does the federal government make money on or invest any Social Security money that it holds? Indeed, it does. And I'm going to share the data, the latest data from the end of February 2025 from the Social Security Administration, detailing the investment holdings that the Social Security trust funds hold. Those trust funds entirely invested in Treasury securities. That is mandated by statute. You can see the range of different bonds. These are specially issued Treasury securities. They are not the same Treasury securities that you or I have access to from brokerage account, from Treasury Direct, anything like that. But as you can see, they kind of work the same way. And so you can see the trust funds holding a variety of different bonds, ranging in, and we've seen interest rates go up. They tend to buy, in some case, bonds of differing maturities, some of them short term, some of them intermediate term, some of them kind of on the fringe of long term. The longest ones I see here are about 12 years out or 14 years out. There's one from 2039. But you can see a range here. The average interest rate on the overall 2.56% on $2.7 trillion in the trust fund at that point. I'll do the math in my head. You get to probably about $70 billion worth of interest annually on that, based on the interest rate that held true there, and the current value of those trust funds. Obviously, as the trust fund depletes, the amount of money left to generate interest will go down. The other thing to remember is that, unlike you or me, the Social Security trust funds, that one attribute of those securities, those special Treasury securities, is that Social Security has the ability to redeem those early without facing market risk. And that's a big advantage that they have, but it's a big advantage that, it's the government helping the government. And so that's kind of where we are with that.
Kent asked, can you go through the transition from insurance to Medicare options and pitfalls? That's a big question, Kent, and maybe in the future we should do a little show on that. What I will say is the most important thing is to factor that difference, first of all, in your retirement budget, right? So I just showed on the income cushion, and you have to estimate how much you're going to need in your first year of retirement. And that will have to include a big difference in your healthcare expenses depending on what you were doing before you retired, right? If you worked for a company that provided a lot of really good insurance and they covered most of the costs, once you move on to Medicare, your expenses are going to go up significantly. On the other hand, if you've been self-employed and you've been paying like premiums through the ACA, then going on to Medicare actually will seem like a savings. So that's number one. Number two, you'll just have to factor that in. Number two, the amount you pay for Medicare is based on your income, based on what's known as the income-related monthly adjustment amounts. So you could pay higher premiums if you are higher income. And I think that you start paying those higher premiums at a modified adjusted gross income of over $106,000 if you're single, $212,000 if you're married. Those are high incomes. So only about 10% of people have to worry about that, 10% of retirees. But it is based on your tax return from 2 years prior. So you have to start thinking about that when you're 62, 63, if you're going to be taking Medicare at age 65. The other thing I'll point out is that you do have to take Medicare once you're eligible unless you are covered by healthcare from work. If you don't take Medicare as soon as you're eligible, when you eventually do sign up, you possibly may pay higher premiums for the rest of your life. So you definitely want to be prepared to take Medicare as soon as you are eligible. And then as for the different options, I will just say this. There are companies out there that will help advise you on which are the best options for you. And most states have counseling services that will provide input on what might be the best option for you as well. So if you are confused by the choices, and it would be completely understandable, especially in your first couple of years until you get sort of the hang of Medicare, there are resources out there that can help counsel you and help you decide on what are the best options for you. And I think that was just one. Vihan said, thoughts on 529 versus life insurance policy for kid. Completely, I would say this. For the most part, I only think that you should have life insurance if someone is relying on your income. So unless your kid is a very successful child actor who pays the bills for the family, I would generally say life insurance is not the way to go for that. Life insurance as an investment is very expensive, generally speaking. Of course, it varies from policy to policy. So if you are really looking for a way to pay for college, the 529 is probably the more cost-effective way to go. That's not personalized advice. It would depend on the actual policy itself. I know Vihan included a link, but I don't have time to read the link itself. But you will find if you for example, get a estimate for a policy on your kid, the monthly premiums, put that into a spreadsheet or a calculator, and then compare that to putting money into a 529. My guess is you'll be happier. You'll end up with more money in the 529. I guess the exception would be that if the kid passes away before then, you get the life insurance policy and proceeds. But you're not. That's not the reason you're doing it. You're not doing it because you are relying on money from your kid. You're doing it as an investment. And generally speaking, life insurance as an investment just doesn't pay off as well as other opportunities.
Yeah, Vihan, I know that's been a recurring theme in some of the questions that you've had over different sessions. And I'm just kind of curious, do you have a life insurance broker who's telling you differently? Because it would be helpful for me just to see, if articles by an insurance company, that's going to be biased towards the insurance company. So I'm not necessarily going to get very much value out of that. But if you're getting, I don't know. I agree with Bro, but I'm also trying to dig at the question. And I understand a lot of the questions that you ask are right on the fringe of asking for personalized investment advice. And I struggle with that every single time. So let me ask you a favor. If you can generalize your questions a little bit better, it's going to help us. It's going to help me out. I won't speak for anybody else, but it will help me out. Random Lake says, it does not appear that U.S. Treasury bills and bonds are callable, but is it possible that municipal, state, and agency bonds may be callable? Yes, Random Lake, there actually were a few series of Treasury bonds when the that were callable. They're done. They've all matured. So, but they did this in the, if I recall correctly, it was the bonds. It was 30-year bonds that were issued like during the big inflationary period in the early 80s, where they're sort of like, maybe we don't want to have to pay 13% per year for 30 full years. Let's give ourselves the right to call these if interest rates go back down. And so that's what happened. But yes, municipal bonds especially almost always callable early. It always makes sense to look specifically at the provisions of the, you have to look at the issuing documents in order to find out what rights there are. Sometimes they become callable and then they are kind of consistently callable after that. And so, it's not just all right, we got a chance in 5 years, and if we don't do it in 5 years, then you're good to go. It may well be that at any month after that 5 years, they can pull the trigger and say, yes, we're going to call that. And I've seen the same thing for agency securities. I have seen the same thing for taxable state securities, although those aren't as common than municipals, just because, states tend to like to do the municipal bonds because you get lower rates on that by leveraging the tax exemption. But there are some times when states will issue bonds for purposes that don't qualify for that tax exempt status, and in those cases, you can sometimes see that as well. And then Money Maven with a question: is it possible for Americans to buy a foreign stock like the Chinese electric vehicle and auto manufacturer BYD, or is it generally only available in an international fund? So, Money Maven, it will vary. The specific company that you're talking about, BYD, does in fact offer what are called American depository receipts. And those are, you will find they won't trade on the New York Stock Exchange or on the NASDAQ, but they will trade over the counter. The ticker for those particular ones is BYDDY. Sometimes you have to add a period in there depending on the service between the last D and the Y. But yeah, Sergey actually points you to it, and so kind of walks you through that. The thing I'd be careful with those ADRs and with the things that trade over the counter is that the bid-ask spreads can be kind of ridiculously wide, and so it's always important to do limit orders. And sometimes the volume isn't very high. For BYD, the volume's reasonably high, but for a lot of other foreign companies, it's not. The other thing that you can sometimes do, many brokers now will allow you to buy shares directly from foreign exchanges, even in a U.S. account. Sometimes there are extra fees involved. Sometimes there's the question of having to take some of your U.S. dollar holdings and do currency exchange into the foreign currency in which the foreign stock exchange settles trades. And that can come with its own fee as well. So, the answer is yes. There's almost always ways to get direct access to the shares rather than having to buy them in a fund. The exception to that being that with some Chinese companies, China imposes capital controls, and so you may not be eligible as a non-Chinese citizen to invest in certain companies in certain ways. And so in those cases, it may well be that your best bet is to go with an exchange traded fund or some other vehicle that gives access to that particular investment.
Ronald asks, are there any circumstances where subscriptions to the Motley Fool are a deductible expense? And my quick answer is I don't think so. It used to be, before the Tax Cuts and Jobs Act of 2017, you could include things like fees for investment advice, IRA custodial fees, accounting costs as a miscellaneous itemized deduction, but that was eliminated. And it could come back in 2026 because the Tax Cuts and Jobs Act is scheduled to expire after this year, although I would be very surprised if Congress and the president don't do something to extend it. So I don't think so. Now you can deduct subscriptions for things related to your business, right? So if for some reason you can justify anything you pay to the Motley Fool or any other subscriptions that are related to your business, it might be deductible, but that might be a little aggressive. It just depends on your situation. Certainly if you work with a tax professional, ask her or him for their opinion. And then Jenny says, I always wonder when you discuss income needed, excuse me, in retirement, is that pre-tax or after tax? So I would just say I always include taxes as an expense. So again, in my example, $75,000 a year in that income cushion example, that includes taxes as an expense. But it is a good question, and particularly a good question because sometimes when you use a retirement calculator, it's asking for after-tax expenses. And that is the case of the Calc XML calculator that I've mentioned many times on the show as being a particularly good free one. You could just do an online search for Calc XML retirement planning module or something like that. You'll know you found the right one if the URL ends with 606. But in that situation, it's asking for your retirement expenses as after-tax. And the tool, frankly, doesn't make that clear. I had to find that out by emailing with the creators of the tool. So it is a really good question to ask whenever you are doing any sort of estimate of your retirement budget and the retirement calculator. Do they want pre or post-tax information? But when I talk about it, I guess I'm talking pre-tax. So, in that $75,000, some portion of that, we'll say $3,000 or $4,000, is going to be your annual tax bill.
All right. Oh, I only had one. Sandy, he asked, if the estate receives a 401k because no beneficiaries were listed on the 401k, can the estate withdraw money to pay estate expenses? So Sandy, if the 401k didn't have a beneficiary and it falls through to the estate, then it is an asset of the estate, and it's going to be subject to probate, and it's going to be subject to court administration the same way that any other asset that didn't pass directly to a beneficiary is going to be treated. And I was kind of looking through, there's a big long article that I found kind of talking about how best to handle decedents' 401k plans and what required minimum distributions you may have to take during the pendency of the estate proceeding. Just bear in mind that estates are generally not designated beneficiaries. It's hard to, I won't say it's impossible because I don't know, but it is hard to make the argument that the eventual benefit, the eventual heirs from the estate, that you can somehow look through to them and give them the ability to take required minimum distributions on an extended timeline beyond what the estate would be able to do. That's going to be a question for your estate attorney because it just gets complicated. And, with an estate where this happens, you're almost certainly going to be filing an income tax return for the estate as a separate entity. Taking withdrawals from 401ks have taxation implications there at the estate level. The estate taxation for estates ends up being a little bit like a taxation for trusts, where the income brackets tend to be pretty compressed. And so taking huge amounts out and having them taxable to the estate is not the ideal situation. You may, in some cases, be able to pass through the tax attributes to the eventual heirs of the estate, and that is generally beneficial for everybody. Obviously, paying tax isn't good, but it's better to pay tax at the lower rate than at the higher rate. But, as far as that money being accessible to pay expenses, I think that the answer would be yes, it's an asset of the estate. But how you do that in the most efficient manner, like that takes a little bit more, effort. And then I didn't confirm taking this, but I will take Jimmy G's question on thoughts on letting brokers borrow your cash in exchange for higher interest income. Jimmy, I'm not sure what investment vehicle we're talking about here. So if you can clarify, we got 10 minutes left. If you can clarify on that, that would be helpful. I will say this, that in essence, whenever you have a cash balance in a brokerage account that is not swept into some other type of account, whether it's a FDIC bank savings account, whether it is a money market mutual fund, whatever your broker may do, if you just have a cash balance, you're essentially letting that broker borrow that money from you, and oftentimes you're letting your broker borrow it from you for free, or at least very close to that. So if you are talking about some other kind of program, I don't know what it is. I'd love to hear about it. But just bear in mind, anytime you have a cash balance somewhere, you are potentially a creditor of that business. And so, taking default risk and the security of the company that you're doing business with into account, very important to do that.
We have 10 minutes left, and we will probably get through the remaining questions that we have. Yesterday, we had way too many questions. I mean, it was great that we had a lot of questions, but we were unable to get through them all. And this time around, we are a little lighter on questions. So if you get a question in here before the end of the hour, we might be able to get to it. I will take this one question from Cat D. Do financial advisors need to have a license to practice and provide services? So it depends. The quick answer is no. The real answer is sort of. It depends, first of all, on what they are offering, what they are selling, and it depends on the state. So you will often read that, anyone could put out a shingle and say, I am a financial planner. I'm going to give you financial advice. And that can be generally true, but you do have to have certain licenses to sell certain things. You have to have certain licenses. You have to be registered with the state generally if you're going to be managing money. So you have to have something. I will say this, as someone who had a lot of these licenses, or at least passed a bunch of exams way back in my broker days, the Series 7, the 63, the 65, they don't tell you anything about how to manage money or financial planning. I mean, it did not. I got, if I may say so, I got the highest score on the Series 7 in the history of my branch, as far as anyone knew. But I didn't know what I was doing. I was just good at memorizing facts and taking a test. So even if you have those, they don't necessarily mean you know what you're doing. I would definitely look for a professional designation, such as the Certified Financial Planner designation, CPA, enrolled agent when it comes to taxes. I would look for someone who has done education beyond the basic exams you have to pass just to get these licenses. And then one thing I'll just say, speaking of taxes, tax accountant, who's always helpful, pointing out stuff, said that some states like New York still allow 2% itemized deductions for things like management fees. So if you're paying, an advisor 1% a year to manage your money, not sure if this would include things like a full subscription. So thank you for pointing that out, because there is, there's federal issues and then there are state issues, and you might be able to find a way to write off full subscription on your state tax return. Just depends on your state.
So Vihan's question from 39 minutes ago, talking about the buffer ETF that I picked as my example. It's Defined Wealth Shield, ticker BALT. Asking, is this the same as ticker SQQQ, which I believe is the ProShares short QQQ Trust leveraged ETF? No, it's not. No, it's very different. SQQQ is designed to be an inverse ETF that moves in the opposite direction of the NASDAQ 100 index as invested through the Invesco QQQ Trust. And so if the NASDAQ goes up, then that ETF will go down. And if the NASDAQ goes down, then that ETF will go up. These buffer ETFs, they're not designed to do that. They're not trying to give you reverse opposite exposure. What they're designed to do is to try to keep your exposure within a tight range of where you are. And so the ideal situation is one where you know, if the tracking stock market index goes up, the buffer ETF goes up, but only up to a certain amount. If the tracking index goes down, then the buffer ETF stays the same or has no worse than a flat return, unless you have a really severe, super big drop above whatever the buffer percentage is. And then at that point, you are fully exposed to the risk of loss. And I think that is the criticism that some people have, is that you still have really big potential downside. It just takes it does take a black swan type event in order for that to happen. But yeah, you could still have a big loss. And oh, by the way, you know, in those relatively common periods where you'll get a nice big upsides move in the stock market over a short period of time, yeah, you don't get to participate in all of that. And so in some ways it doesn't get either of those things. It doesn't match either of its goals perfectly. The thing I'll say, though, it's pretty upfront about it. It makes it very clear what its limitations are, more clear, in my opinion, than like what you get with some insurance products.
Mike G asks, when doing portfolio allocation, should the percent allocated to income-producing stocks be bucketed with the stocks or the bonds portions? The stocks portions, because you know it's an apples to oranges comparison, right? Bonds do fluctuate in value, but not that much. If the company issuing the bonds goes out of business, you're higher up on the food chain. With bankrupt company, if you have a bond in a bankrupt company, for example, you tend to get anywhere from 40 to 60 cents back on the dollar, as opposed to stocks, you get nothing. And the income you get from bonds is, well, especially an individual bond, very predictable. Stocks, even dividend paying stocks, are volatile, can go out of business, they can cut their dividends. And the greatest example of this is the Great Recession. Going into the Great Recession, some of the best dividend paying stocks, some of those stocks have been around for decades and grown their dividends for decades, were financial stocks, bank stocks, brokerage stocks. You went into the Great Recession, financial stocks dropped 60, 70%, dividends got slashed or eliminated, and then some longtime great companies like Lehman Brothers and Bear Stearns went out of business. So I definitely think that you keep the dividend paying stocks, even if they do tend to be more stable and more predictable, you keep them on the stock side.
All right, we got 3 minutes. Let's see if I got a good 3 minute. I'll read Grandpa Jack's comment. It's tax time. I had a good experience with Social Security Administration yesterday. Jack, that's great news. I'm glad to hear it. Jack didn't get a paper 1099 for the 2024 year, but it was simple to find and download on my account at the Social Security website, ssa.gov. Yeah, I mean, frankly, if they're going to be letting a bunch of people go, they better make their website work even better than it does. I've had good experience with that website, but the one thing I will say is that they are not always good about updating everything, taking out of date pages. For instance, you can still find information on a feature of Social Security that went away 10 years ago. You can still find information on that. It's called the file and suspend method. And like you could, if you didn't look closely and say article last updated 2015, you might be under the impression that was still good law. So just be careful with that. But I'm glad to hear that these things are good. Jimmy G with the follow-up. A friend told me that her broker takes her money to use as a loan for 11% interest to certain companies, and she gets 9% in return. Jimmy, that does not meet my smell test. 11% means it's a high-risk kind of deal. Potential for default is quite high. A 2 percentage points off the top is a lot. I don't like it. I'm not saying that it might pay off for your friend. But you hear horror stories about these sorts of things when they go wrong. And I can't tell you statistically how often they go wrong compared to how often they go right. But I do know people who've gotten burned by stuff like that.
So comment from Jeff M. caveat. I think a 5-year cash safe investments is a good idea. FYI, I have enough dividend income to live year to year. I think that's a really interesting point. Another full member brought this up to me a while ago and basically said, do I need an income cushion if the dividends I receive from my portfolio are enough to cover my bills? And I would say it's up to you, of course, to make that decision. I still think it makes sense to at least have an emergency fund of some kind. And as I pointed out, there are times when dividends get cut. The Great Recession was the biggest cut. Dividends from the S&P 500 were cut by 20%. The next biggest was, I think, 1959, and it was around 12%. The 12 to 13 other times where you saw dividends cut from the S&P 500 from year to year were smaller, like 3, 4%, or even less. So as long as you can ride that out, that's fine. But I still think it makes sense to have maybe 1 year's worth of expenses sitting there nice and safe in cash, short-term bonds, just in case. And that is it for the Financial Planning Power Hour. Thank you all for tuning in. We got through just about almost all the questions. Coming up, I believe we have Andy Cross and Jayson Hall for an Ask Us Anything. Take it away, gentlemen.
Full on, everybody.
Thanks, Dan. Thanks, bro. Hi, Jayson.
Andy, how are you, buddy?
I'm doing great. Thank you.
Very, very good. It's
I'm doing great. Looking forward to the next hour. Thank you for joining us.
Yeah, time for lots of questions. We want to answer as many questions as we can this hour. Andy, how do people get questions to us?
Well, if they are members at the Motley Fool and watching us over on fool.com, they can enter into Slido Fool 24 and ask us some questions.
Yep.
If you are watching us, Jayson, I think as you're about to say, on YouTube or stream on YouTube, welcome to the Motley Fool. Thank you for being here and enjoy the next hour as we attempt to give some guidance and some insights onto stocks and investing. Jayson.
Yeah, absolutely. And you can ask questions too. That's one of the cool things about Slido is that maybe get out your phone if you're watching it on your computer. Open up your computer if you're watching it on your phone and go to slido.com. Same thing. The event code is Fool24. Get those questions into us. Ask us anything hour. Andy, you see any questions you want to start with?
Melisha asks, can you ask us, by the way, so many great questions, specifically, a little bit more tailored towards Robert and Dan on the retirement side. So thank you. They are often on. So save your questions if you missed them this past hour, or if they couldn't get to them, and ask them on one of the other hours. But Melisha had asked, can you recommend any autonomous vehicle stocks to invest in? Obviously the first one that jumps to mind is Tesla, just because of what it is doing. Now I know it is a lightning rod of a company and stock out there for lots of reasons, of course, as many of us know who own it, but they do have the FSD, the full self-driving, as they are pushing out more and more of that technology throughout their fleet. Obviously, as they are trying to build out, Jayson, the robo taxis is going to be a big driver of that. And so that one jumps to mind. Now, that is one that again has a lot of different opinions for lots of different reasons into the marketplace. But but for investors who are really interested in the autonomous push, Tesla jumps right to mind. But there might be others that are tied much more to the technology. Jayson.
Yeah. So building on Tesla, I think, and again, as much as like all of the political things that are happening right now that make it such a battleground stock, and I mean, it looks like too, there's some real meaningful impact on the business too in a few markets. We're going to find out whether or not those are temporary or long-term impacts. The other thing about Tesla, and Andy, I think you'll agree with this, is that today's valuation and the future of the business is as much tied to expectations beyond transportation as they are tied to just transportation.
100%.
Right. So artificial intelligence, robotics, so many other things the company's working on. Whether they monetize those things, we'll find out. Right. They've monetized full self-driving to the buyers of the cars. Can they monetize it with a fleet of autonomous vehicles? Again, we're going to find that out. So there's that. I'll say, go ahead.
No, I was going to say, Jayson, what's really interesting is absolutely right. They have the battery storage, and Elon's been open about this. Yeah. Talking about Tesla as more than just the your regular car company, but as they for some of the fleets currently are out there, if they're charging subscription fees to different FSD technology or whatever it is, how the competitive landscape shifts and tries to undercut that pricing. So there's a lot of dynamics, more so now than ever before. But that's not surprising me. I would be shocked. I would have been shocked if more competitors did not come after that space, because it makes complete sense. It's very difficult to do. And obviously Waymo's out there doing some really impressive, great things with different technology than what Tesla is doing.
Well, that's actually a perfect transition, because I was going to make the case for Alphabet here. So ticker Alphabet, the parent company of Google and PayPal, ticker GOOGL. I've always put, I shouldn't say always, but really the past 6 or 7 years, as Tesla's auto business has gotten up to scale and the valuation has continued to run based on these other next phase of the business things, it's kind of gone in the too hard pile for me. But I look at a business like Alphabet, and it's trading for some of the most attractive valuations that we've seen in many, many years, and partly on concerns about artificial intelligence potentially upending its search dominance and taking away that big ad revenue, which is so important to its business. At the same time, AI is also a catalyst for it with Google Cloud, right? So it's stuck in this kind of in-between period where the upside versus the downside, there's a little bit of lack of clarity about what's going to win out and how much it's going to affect Alphabet. I tend to think that right now it's probably of the hyperscalers and the Mag 7 broadly, all of these tech giants, it's the one that's most compelling to me from a valuation perspective, because that uncertainty, I think, has created opportunity. And then you talk about Waymo, right? You almost get Waymo for free in the price of this business. And so the different approaches that Tesla is taking versus Waymo, Tesla using primarily cameras and software and all of the hundreds of millions of miles that its vehicles have traveled to build the technology to be able to get to safe, autonomous, fully autonomous transportation, versus what Waymo is building, where it's geofence. The vehicles only operate in specific areas, using other technologies, including like LiDAR, which is like a laser-based radar, is kind of the shorthand way to think about it, in addition to cameras. But again, really building the technology in these very confined areas, instead of Tesla's like going everywhere, wherever cars are going, and using that to try to build out the technology. So they're definitely taking different approaches to get to the same goal. But looking at the businesses, to me, it feels like when you can buy a good business like Alphabet and get autonomous driving, it's there too, right? And the investors have very low expectations that it's going to be meaningful. I think that's an interesting way to invest. General Motors is basically moved on from Cruise. So there's not a lot of revenue generating, self-sufficient businesses out there where autonomous transportation is something that you can get along for the ride. And I don't think there's really any other startups that are publicly traded. So there's other companies that are playing it. I mean, Uber, for example, Andy, right? They were big in autonomous. They sold that business off and moved on and just said, let's build a platform. And however the vehicles are driven is going to come along if we have the network effect of being the place that people go to find ride hailing, right? And then they've done other things to really partner with their drivers to not create this situation where it's like, a lot of animosity between the drivers and the business. And I think they've done the smart things there to build that platform. So all that to say, even though Uber is not spending money to build out autonomous transportation, I think autonomous transportation will be part of its future. And you have that network effect of that great platform. So it's another way that you could win from that eventually, because it could become more profitable for Waymo, or for Uber, as we see autonomous vehicles come onto its fleet at some level, while it probably will always have drivers as well to some degree.
Did Tesla, is it right, Jayson, did Tesla come out and say they will not be on the Uber app, or was it?
I don't know that they've been truly definitive at this point.
Okay. I couldn't remember.
Yeah, and let's be honest, we have to remember with Musk, there's the bold statements that he makes and then what eventually happens. Yeah. And they don't always align, right? Because he's always been aggressive about timelines, and they've always been short of the timelines, but still also done amazing things. Even though they were late to Musk's expectations, they were still a lot of times early or great when they got there.
Yeah.
So, I mean, I think the answer to that is going to be, will Tesla's own network effect of the owners potentially be something that allows it to start a platform?
Yeah.
And we don't know the answer to that yet.
Yeah, it's fascinating. Google is such a fascinating one. And I'd be curious by maybe we can get a poll up about who would take a Waymo if people have taken Waymos. I don't know. Maybe we can get something fun up there about that.
That'd be cool. Yeah.
Because, you know, they've really exploded in different specific markets, California, I think Arizona, where they are doing, you know, thousands of rides now and getting much more buy-in from just, I think, from the public. But Jayson, to your point around Alphabet, they are so fascinating. I was talking to some investors yesterday about this because what they are doing with Gemini and Gemini 2.5 now coming out, and then Gemini Deep Research, like they are finally catching up. But it also is a very fluid market now. And the monetization behind all of this is what I just continue to think about. Can any of these companies really at scale monetize generative AI on the search side and on the enterprise side? OpenAI is certainly doing it on the enterprise side. So is Google, tied to GCP, as you mentioned, and others. So I saw on the breakfast news today that Amazon now released their Gen AI tools. So it is out there. It's becoming table stakes, and Gemini they are making progress. Meanwhile, Google has YouTube. They have the advertising platform, which is under fire a little bit by regulators and investigations. The EU is coming after them to a certain extent. YouTube is continuing to be one of the biggest podcast platforms out there. We're streaming on YouTube right now. It has, millions of viewers. It is exceptionally relevant right now. So, and then you have investments like Waymo and other things as well too. Yeah. So Alphabet is in such a very interesting position.
Right.
And it's one reason why you said, as you mentioned, the multiple is so discounted compared to maybe some of the other ones, because I think investors are like, how do I wrap my head around all of these? And for me, it's really the long-term ability to monetize all of these assets in a way. They have demonstrated time and time again they can do that. We haven't really yet seen that specifically from OpenAI and some others. Might be coming, but the cost for all the AI tools right now, Google has this monetization engine, but does it translate to generative AI search? That's going to be that is the fundamental question for me when it comes to Alphabet.
Yeah, no, I think that's a fair way to think about it. Okay, here, let's see here. Let's talk about Trade Desk for a minute, if you can.
Yes, go right ahead.
So Scotty, the Trade Desk. So before we do it though, we have. I absolutely love this, Eric. Thanks for putting this in. This is our poll question. So, have you ever ridden in a Waymo rideshare? Here are your three choices: yes, no, and I'll never accept robots as our overlords. So that's fantastic. So go to slido.com, event code FOOL24, same place you put in questions. In the top, you'll see two tabs. You'll see Q&A and you'll see polls. So select the poll and put in your answer for that. So thank you for the foolish little twist on that. That's great. So the question I was about to ask, Scotty asks, the Trade Desk ticker TTD seems overly beaten down over the past month or two. Goodbye at this price. In other words, goodbye BUY. Not maybe that's what we could do. We could say goodbye or goodbye, right, Andy?
That's actually a great segment. That's actually a very good segment that we can create for Jayson. Stock ABC, goodbye or goodbye.
Right. I love that. I absolutely love that. Okay, we'll have to do that.
Thank you for the idea.
Yes.
Who posted that?
Scott D.
Scott D. Scott,
yeah.
Thanks for the idea.
Yeah, it's fantastic. All right, so go ahead, Andy.
I'm in the BUY camp. I was, by the way, I think, Jayson, with you, I was not in the BUY camp a day or even within a week of the earnings fall with Trade Desk. The stock continued to sell off, and I started getting much more interested in it when the multiple started getting much more reasonable, even with somewhat muted growth expectations for this year, selling in the low 30 times earnings level. That's when I started getting much more interested in the Trade Desk, looking past this year and some of the operational challenges they're going to face looking to next year. So I was not there. I wasn't goodbye BYE either. I was just kind of like hold and wait and see. The stock continued to trend down another good percentage points. And that's when I got much more interested then and we started adding it much more back to, I think, our rankings.
Yeah. And I mean, I think that's here's the thing. What the company did coming in a little short of its own guidance and then putting out guidance going forward that was pretty soft, was describe the challenge that they're facing, which is the hardest thing that most businesses deal with, which is taking your customers that are happy with you, with a product that they use from you, and in this case, it's Solimar, right? Their legacy platform, and try to transition 100% of those customers to a new platform, a new service, a new product you're trying to move all of them to, that doesn't necessarily at this point have enough data to back up what management is selling to their customers in an industry where the return that you're getting on your spend is already very small, and anything that upends the benefit you're getting from this platform is hugely detrimental. Very, very risk-averse customers with this sort of thing. In an environment that we've moved into with a lot of macroeconomic uncertainty, where a lot of customers, a lot of businesses are probably looking hard at their ad spend to put themselves in a position where they can pull back on it quickly if we do go into a period of economic weakness, because that's one of the first things that companies do is pull back on their ad spend. So how much of it is, to paraphrase Jeff Green, operational mistakes by the trade desk, or the environment, or both, right? I think it's probably a mix of those. But to your point, when the company said, here's where things are, and Jeff Green said, look, here's the 15 steps that we need to take operationally to get on track. And by the way, it's going to take longer and cost more than we said before, because now we're figuring it out. We as investors owe it to ourselves to let things start to play out before making big decisions, because even the stock fell around 30% the first day.
35.
By most metrics, it was still in a pretty expensive stock, right? So it's not like there was a massive shift in the risk reward profile, but that's changed over the past few months, where this isn't a business that's in trouble. This is a business doing the hardest thing in the world to do, and move all of your customers to a new platform that's going to take time. And I'm not going to say it's deep value, but the risk reward, I agree, has gotten pretty compelling at this point.
Two points with that, Jayson. Thank you for making those points. Is one, what I often see is after that first drop, you have analysts, Wall Street analysts coming down, adjusting their stock prices, sometimes down. So it seems to trickle a little bit. So I hardly ever, I can't really even remember the last time I did that. When the stock has fallen dramatically, I go in and start trying to catch that falling knife on that day. Or even the day after. So I just let it kind of settle for a couple of weeks. And I think that's what kind of happened, which, by the way, I have not added more to my trade desk position. I'm just like, this is the way that I was thinking about it for members. So that's the first point. Second point, Jayson, the thing that I'm watching with the trade desk is not even just the move to the Kokai platform, which I think they've struggled with over the past few months, as you pointed out. I think they maybe have like a third or so of their clients kind of moved over there.
Right.
It is this balance between supply side, demand side, and their open path solution with UID 2.0. And what I mean by that is, and very quickly, then we can move on. The trade desk is a demand side platform. So they work with advertising agencies and clients to find inventory out there in connected television, online web, that kind of stuff.
Well, it's the biggest ad buyers in the world, and their agency representatives. That's who they work with.
100%.
Yeah.
The supply side is representing more of the publishers, more of the inventory out there, trying to do the matchmaker there. This world is starting to jumble all together with frenemies. You have Google's on like all 27 sides of the ad platform. You have Verizon in there. You have Microsoft. You have Comcast. You have the walled gardens of Twitter and Meta. You have and like YouTube. And then you have even some of the supply siders, the Pubmatics, the Magnites of the world are starting to also do a little bit more of demand side, reaching directly out to the clients. And so Trade Desk is doing that too. They're starting to build a supply side pathway. And they've been very clear saying we are not a supply side. We are still demand side, but we are opening up this channel. And so that's been a shift over the last year or so. And I just wonder how much that is kind of changing the internal operations of their business that's
Yeah.
played out in this past quarter.
Well, you have finite
they'll get
resources, and you have to prioritize where you're investing your money capital and your expertise capital, right? Those are finite resources.
I think they'll get it. I think they will get it right.
Mhm.
And they have such with UID 2.0, they're building first party data, like all this kind of stuff. So they are on the right side of this, but I do think it's just going to be this, period of adjustment. We may see the stock price lower than where it is today. Make it, I don't know, whatever, could get into the, what are 50s or something like that. But I think longer term, they're going to be set up to be able to continue to grow pretty steadily in the kind of mid-teens level. They might grow 15% this quarter, maybe throughout the year, drive their profits. Profits probably this year are going to take a little hit. But I think longer term, the asset strength they have is it will play out, and the stock I think right now doesn't necessarily reflect that because of all the pessimism swirling around it.
Yeah, I think that's fair. All right, next question. You see one you want to grab here?
Yeah, how about SB's question about how would you rank these insurance stocks based on their probability to beat the market over the 3 to 5 years? Thanks for the question, SB, and thank you for the framing. The companies are Kinsale Capital, Lemonade, Markel, and Progressive. Progressive's PGR, Markel is MKL, Lemonade LMND, and Kinsale KNSL. Jayson, I'm happy to jump in, or unless you want to rank yours first.
So I think of these, the first one listed on the question, Kinsale Capital. My knee-jerk reaction to this list is that one, to me, I think has the highest probability of being a market-beating investment. I would stretch it to 5+ years. I don't know how comfortable I am saying that in 3 to 5 years, because the insurance cycle can be weird. And if we see some of these larger property casualty companies start jumping into the excess lines where Kinsale makes a living, they can water down the profits because they'll try to compete on price to win business. And the underwriting results that Kinsale has gotten, which have been extremely profitable, could get lowered. Kinsale will still write within its own underwriting standards to write profitable policies, but it may be walking away from business because it's not going to write no profit policies, right? So I think that's an important thing to remember. I think over a 5+ year period, we get through any kind of weirdness with the cycle, and the big guys burn their hands on the stove of the market where they can't scale up and they're not really good at doing these specialty lines, and they shift their priorities back to the large markets where they make a living. So I think, and again, I don't know that that's going to happen, but it could, because everybody's been making money and underwriting really well broadly.
Yeah.
So they have extra money that they can go out there and say, hey, let's go after this thing, right? So that's a risk that I think is there. Of this group, as much as I like Lemonade, as much as it has a decent probability to beat the market, and there is evidence that they figured out the underwriting, there's also still some risk of more of a binary outcome where it's the one that's most likely to lose money from over the long term, just if the business doesn't pan out. But I like it a lot, so I want to put it on here, but that's the context. Progressive has always done a really, really good job. Trades for a high price to book value ratio because they're so profitable at scale.
Yeah.
And they've started to integrate more technology. They're trying to do a better job with telematics and things that can help them be more competitive while also still getting good underwriting profits, not just going cheap on customers that you need to charge a higher premium to. So I think if they can continue to integrate telematics more to get to better underwriting results, I think Progressive should do well. I love Markel, but it's never, to me, over the past 10 years, it has just failed to meet my expectations for what it could do. So I would say Kinsale, and then Progressive and Lemonade kind of in that same, in the running for 2 and 2A. And then I'd put Markel at number 4. I love Markel, the business, but I think it's probably the least likely of this group to be a market beater.
I echo much of what you said. I think we differ a little bit on Lemonade side. So I think Kinsale would stand out for me. I think as Jayson referred to, the excess and surplus, which is also called the non-admitted market, which is the much smaller, much more unique, much more specialty side of the P&C market. much more unique policies where the likes of Markel and Kinsale specialize in.
Yeah.
That market has been very attractive. It is growing. It's still very dynamic and still very difficult for, as Jayson said, the large players to continue, like Progressive, to write into. Now they do, all these players have different parts of the E&S market they tap into, but Kinsale and Markel are real specialists in it. So
Yeah.
Jayson, I would put Kinsale 1. I would probably put Progressive 2, and then like Markel and Lemonade kind of fit. Because like you said, Lemonade has a lot going for it. The stock got really, really cheap. I mean, I think it got down close to book value, but they're still kind of working through some of their operational.
And it's come back down again too. But yeah, it's the key. I like that. And so maybe here's some context that might be useful. Thinking about Markel versus Lemonade. Markel's very, very high floor. I think in terms of probability of losing money, Markel might be the safest of these over a 3 to 5 year period because it's a relatively diversified business. They own a lot of operating assets too, as part of their float, and a part of their Markel Ventures business. So I think that might be the one of this group that's maybe the least likely to lose investors' money. Lemonade's the one that's probably the most likely to lose investors' money of this group.
What's interesting about Markel is they have that investment book, right? So the thing, and then we can move on, Jayson, to the next question. Thank you for the question, SB. But Markel, they run the market where they invest a lot in equities. The others do not. Although Kinsale's, they tap into there, but really they're investing in bonds. They're not trying to build a book of investments as much as Markel is.
Which is great in this environment with interest rates are actually a good place to get some yield now for the first time in most of Markel's existence. It's the past couple of years that you could get meaningful yield. So that's good. I'm going to jump right to the top here with Vihan's question because we can still talk a little bit about Kinsale, but now we're moving over into private equity with KKR. So KKR versus Kinsale. I don't even think we have to do the gold and silver here. Looking at the two, I mean, there's a little bit of me that's like, why not both, right? Because there are very different businesses with a lot of different levers that affect their business. I'm curious your thoughts on this here.
But KKR is even different than the rest of the private equity companies.
Yeah,
There was
right.
a really good article, and I think Bloomberg this week talking about how KKR is kind of trying to be a little bit more like Berkshire Hathaway, where they're actually owning their investments. So they're carrying those investments on the books, unlike other private equity companies like Apollo and certainly Blackstone, where they're just kind of like investment and selling them off and trying to get that distributed cash flow. KKR is actually now starting to have those assets more and more and hold on to them than the other private equity companies.
It's very anti-private equity.
100%.
Yeah.
It's very different. And that
or
so
like
that-
the OG barbarians at the gates.
Yeah.
We're gonna lever up your business. We're gonna force you to sell it to us, and then we're gonna send it back out the door with more debt in 5 years. Right? It's such a change in that.
And this is Henry Kravis, leading this group up with their other CIO, their other CEO and their CIO, and one other leading this committee to manage these businesses as if they were owning the businesses. And that's a much different. That's like a merchant, investment vehicle, Berkshire Hathaway kind of style. So I like that, and that's of all those, that's one reason why I've always kind of favored. Blackstone is always so tied to real estate. They have lots of great, amazing real estate properties, but that's why I kind of like the KKR style. Choosing between those two, gosh, I got to think a little bit more about that one, Jayson. I'll shut up and you can talk.
No. I don't really have much to add here. I'm going to be Charlie Munger and say that I have nothing to add, and we'll move on. We both need to marinate on that one a little bit more.
Yeah,
okay. What's next here?
BC's asked about MedPace. Andy, what is your stance on MedPace MEDP now? What are your expectations for the next 2 to 4 years? I think they'll do better, besties. MedPace is a contract research organization, relatively small mid cap kind of company. MEDP is the company, founder led. They've been very successful the last few years. They have many contract research organizations over the last, say, 18 months have really struggled with the higher interest rate environment affecting some of their clients' funding needs, especially smaller biotech clients that rely on.
So just to break down what that means, what CROs do is if you're a biotech or a pharma, this is who actually does things like the trials and that sort of thing for them.
Yeah, the studies, the trials for these companies.
Yep.
That's essentially their bread and butter. And there's some bigger players in MedPace into there, but that's affected their business. And the stock has pulled back, pretty dramatically during this kind of last couple, let's call it the last year, Jayson or so. And the multiples got much more reasonable. Again, it's one of those businesses that was performing at a high level, and the multiple got a little bit elevated and kind of started to slow down like interest in like adding it to like top rankings, and just kind of let it sit there. And the stocks pull back. It's got much more reasonably on the multiple side. This year is not going to be a great year for them. They've already said that. Their bookings are, kind of like meh. There are maybe some slight concerns on are they as effective on the CRL actual side as maybe some of the competitors. I think I think they're okay there.
Yeah.
But it's not going to be a great year for them. And so the stock's probably kind of like meh, I think. But next 4 years, I think it's a different story.
Yeah, it's the cycle, right? That's the key. It's you have to get to the other side of the spinning cycle that's attractive.
And Jayson, I mean, the interest rate environment, like even if we go down
really weighing on these businesses,
50 basis points or so, it's not going to be like a huge driver of like business for CROs, but it would help a little bit. But like you said, and then what happens with this, Jayson, and then again, we can move on, is that, the companies start lapsing through good or bad quarters, and the growth rates start to affect that. And it's like, oh, they're now coming off a low quarter.
Yep.
And so the expectations, to beat that are kind of low. They do, because the quarter is so low, and you can start to see this kind of bounce a little bit. And I love trying to find businesses like that, because I think that follow the stock prices when you catch the I'll call it the cycle. Catch the cycle.
Well, it's you start lapping bad results that the market hated, and you can start beating expectations again. And the perception that starts to shift, along with the catalyst of better opportunity for the business, right? It's a good place to be in.
Exactly. And sometimes, by the way, the multiples, because the earnings have dropped so much, the multiples still look elevated, even though the growth rates have slowed, and people are like, whoa, it's still like overvalued, but it's also because the earnings or the sales have dropped. And so sometimes investors miss that. And then all of a sudden it kind of starts to flip as business comes out of these darker periods. So I'm still hoping it for the trucking companies and logistics companies. I've been stuck in this market for like 2 years, I feel, Jayson. But at some point that will shift.
It will. It always does, and it certainly will again. We just don't know when. That's the challenge. So, Andy, something's happening that I think is wonderful. We're getting lots of follow-up questions. I love the engagement. So again, if you have questions and you don't know how to get them to us, slido.com, event code is FOOL24. Whether you're watching on the Motley Fool's website behind the paywall with members, or if you're catching us on the YouTube stream, again, slido.com, event code FOOL24. Before we hit some of the follow-up questions, I don't want to miss Bestie's question and comments about BYD. So the latest announcement from BYD, tons of headlines. Bloomberg, when I can't remember exactly what it was, but basically Bloomberg's headline was, to paraphrase, BYD passed Tesla and it only took 5 minutes. Of course, great headline, super catchy, right? And they're referring to BYD's announcement that their next generation of cars, which they're going to start releasing in April, going to go up for sale in April, you'll be able to charge 250 kilometers roughly in 5 minutes, which is exceptional, right? That's exceptional to get to that level. No, actually, I believe that might be the miles you can get. I mean, no, that's the kilometers, but it's exceptionally fast, right? And it's getting closer to that. This is the range anxiety, the waiting around while your car charges issue that's been a big headwind for a lot of people that have decided to not buy an EV because of this. So I want to talk a little bit about this. So the question is, BYD is front of mind today because the press decided to print this. BYD have been developing batteries before Tesla existed. Musk has acknowledged Chinese EVs before. So the concern and the question is, how big of a competitive advantage does BYD now have with its fast charging? Compared to Tesla, it's 200 kilometers in like 10 or 15 minutes. So it's a substantial difference in that speed. And I want to unpack a few things that I think are important. The first thing is, in the US, BYD is not really a competitor, but this is a massive story in China, and it's an increasingly important story in Europe, right? So that is certainly a potential threat for Tesla that also doesn't have much of a vehicle refresh rate. So its vehicles are a little dated. They look the same, even though the actual interface, like you get a new interface every couple of months as they constantly improve the technology and send out those over-the-air software upgrades. So this is definitely some near-term threat and risk. But I think it's a reminder that with technology, moats are extremely rare. And in this case, we're talking about a technological innovation. The expectation with EVs is going to be that the charge times are going to get shorter. The miles you can get on your battery are going to get better. So I don't think investors should overanalyze this too much as some permanent moat that BYD has created. It may have a temporary lead in the markets that it's going to compete with Tesla and others. I also think that what BYD is doing probably is going to matter more for their medium and heavy duty vehicles, because those are the ones where being able to charge quickly really matters a lot. So I think it may move the needle for them there. Andy, I've also said that my prediction, because nobody has come out with a step change in battery chemistry and technology for lithium ion batteries that will allow you to rapidly charge and not damage and affect increase the degradation of the maximum charge for that battery, right? There's no way to get the chemistry where you could have a battery that'll last years and millions of miles and also charge super fast. That doesn't work. So my prediction is that the cars are going to be heavier because they will have loaded up on cooling to address the thermal load when you're putting that high current charge into the vehicles. And they're also we're going to see it in the owner's manual when they start releasing those vehicles, that you can only use this, every 5 charges or something like that, because they still want you to do the overnight charges at home and plug in at work, or, places where you can charge the battery over hours versus minutes. That's still going to be the recommended way to charge most of the time. So I don't see this. I see this as maybe a small step change, but this is not a sea change. Right, Andy?
Thank you, because you reminded me to pull my watch off my battery charger before it gets all the way full. Yes, Jayson, I think I don't think it's a sea change. I think it is an important step, because that is a key reason why I think many of us, and us, I mean my family included, are hesitant on the EV side is the charging capability. So BYD is exceptional in batteries. Like you said, they're not really in the US. It is going to be a bigger deal into Europe, and certainly into China. So I think it's important to note it. And I guarantee you they are noting it into Tesla. BYD, I think we just started kind of like just picking around at it a little bit more and studying it a little bit more, because it kind of doesn't really pop up a lot into the full research conversations. And, it has very impressive characteristics behind it.
Yeah. No, it definitely does. But to me, it's a reminder that automaking is hard and competitive and cyclical and capital intensive.
Yeah. And Jeff asked about, didn't Warren Buffett invest in BYD? I think it actually was Charlie Munger who really got him interested in it.
Yeah. And that was pre-IPO years and years ago.
Yeah. Many years ago, after meeting the founder. So
Jeff M asked, I think this was probably about the time I was giving that answer. We don't know for sure, but I'm willing to put the Jason Hall stamp of guarantee here, which is it's about worth what you pay for. It's almost certain that BYD is going to limit how often you can charge at those rates, because it's going to ruin the battery if you try to do that on a regular basis. All right, let's get into some of those questions where we're kind of continuing the conversation. Some of the follow-up questions. What's jumping out at you?
You want to definitely do follow-ups, or you want to go to so like Bessie says, and there's a few other questions in there. Jayson, we should take the Dreamfinder one as well too, talk about home builders a little bit. And Jeff asked about the LMD AI model, but Bessie says Progressive has been given the nod by Geico's managers. That is true. They talked about, I want to say 2 years ago, Jayson, they were saying like Progressive just really
I was actually at the annual meeting when Ajit Jain said it, just unvarnished answer that, look, we're behind where Progressive is with telematics. Particularly they talked about telematics, but but broadly with technology. And I think it's easy to forget. And I can't remember who I was on with. I think it was Lou Whiteman and I the other day, Andy. One of the things that's the realities for a lot of these large legacy insurers is part of how they've been built over time is some acquisitions and other things. And they have legacy software and they're a lot more siloed than you would think.
100%.
That can make it very challenging to fully integrate technology across the entire enterprise.
Yeah. Yeah.
And
Geico's lead for many years was their quick customer service, all of those and the direct model they had built. But that got, as many things do, right? That got commoditized. Progressive works with direct model. They work with agents, as all those players do, right? But where Progressive started really having the lead was on that telematics and that technology. Ironically, I was just reading the annual letter by Progressive's CEO, and she doesn't mention the word technology or AI at one time in her annual letter.
Yeah.
It's all about the combination of the customer. And then when you read the earnings release and the commentary in there, they talk about the importance of technology, but the technology with the people and the partnership and all those kinds of things. They've done exceptionally well at that. So the way I think about insurance, why the actual product is mostly commoditized. It is mostly very price sensitive. People chase the lowest price, all those kinds of things. The operations underpinning that are not commoditized. And that's where the likes of Progressive and Kinsale to be able to do that at scale. Kinsale in writing smaller policies in a part of the market that's very fragmented and is very hard to do at scale, and to really kind of like while they use partners, they really own a lot of the operation nuts and bolts of there. And Jayson, to your point, they built their technology stack from the ground up, from when they originally came over from, the founders came over from James River, including the CTO, and they've not made any acquisitions. So they built it all up themselves, as opposed to, like you said, the legacy ones that are stacking on top of technology that needs to get updated and refreshed. And that's exceptionally expensive and difficult to do.
So, and that actually ties perfectly into Jeff M's comment. On another hour, one of the analysts said that the insurance companies will quickly adopt the Lemonade AI model. The issue is everything we've talked about. These legacy insurers, it's a lot harder than when you're a clean sheet company like Lemonade or Kinsale or I can't remember, Root.
And even in the pet insurance business, there's some of the upstarts, right? Like if you're starting with with a blank slate,
right? Well, one of the things that we've heard from Lemonade's executives is really what their goal is not to have to compete on price, but really be thinking about competing on their cost. Where if they can be at the same price, one of the legacy insurers are, to still have more underwriting profit in it and to be at a better combined ratio, because the places that Lemonade has succeeded with AI, and again, a lot of it is that clean sheet model, is there's less people in between the customer and the premium. And when you have less people, things happen faster and you have lower cost, right? So having their operating structure leaner, they've leveraged AI pretty well in their operations. It's the underwriting thing that they've only started to figure out over the past year and a half. So I think it's going to be more difficult for these larger players to do it, but they have those benefits of scale, where they're multiple orders of magnitude bigger, and that helps soak up some of the additional operating costs that they have in between, just because the number of policies per employee they're writing can be so much larger that they can still be very, very competitive. But I think it's big enough that you can have these disruptors that maybe aren't as disruptive as we think, but they can carve off enough of the market to have a pretty successful business.
And just very quickly, for those who may not be as up to speed on the insurance business, most insurers, again, property and casualty, but in general, most insurers tend to write their insurance at about just break even, or maybe even a loss, and then they make up the profits with their investments. So they collect that cash up front, the float, they invest it in typically very safe investments, and they make some income on there. Jayson was talking earlier with what Kinsale was getting some yield on. And so then you have a nice business, right? So you and you match up your liabilities in a beneficial way and all those kinds of things. The best underwriting insurance companies like a Kinsale or even a Progressive will write their policies at a very profitable level and not have to rely so much on the investment side.
Yeah, no, I think that's exactly right. Okay, so what's next here, Andy?
Sorry, I was looking through some of my questions. Let's take Bestie's question on Dreamfinder Homes.
Okay.
And the home market, home builders in general.
So
I think home builders are very interesting to look at right now because again, the narrative is so negative.
Yeah.
I mean, like there are almost no positive threads going on with home builders right now, Jayson. Interest rate, affordability, regulations, tariff costs, employment costs. I mean, like you have to really look here. And then you saw KB, or maybe
KB Home actually started talking about land costs and
land costs. I mean, there's no positive threads with any of the home builders right now, and KB Home kind of echoed that.
Yeah.
This week.
Yep.
So I hear that and I'm like, okay, I don't own any pure home builders. I start to get really interested for the first time in a while.
Yeah, we need to change that, Andy. So Besties, I can't remember if you were commenting or not, but the 8 a.m. Full 24, which I like to call the morning show. Tyler Crowe and I spent 30 minutes.
Yeah, great.
30 minutes talking about home builders. So if you want a good crash course in home building stocks and home builders in the industry and what's happening now and what to understand and to look for, I encourage people to go back and take a look at that, because I do think we're in one of those compelling times where the near term is going to be probably painful and it could get a lot worse than it is right now. And the stocks could continue to fall. But if we look back 5 years from now, we're probably going to say, wow, that was an opportunity, right? That was an opportunity. I fully believe that, because the cycle's ugly, but the secular tailwinds, we're still millions and millions of houses underbuilt. Even if we see a lot of houses that are existing homes start getting listed and we get to like a healthy market there, Andy, there's a dislocation between where a lot of that supply would come online and where the demand is for new homes.
Right, so, Jayson, we were talking about this yesterday among some of the investors inside the DC area. You are starting to see existing homes list far faster than you have in years because of what's happening at the federal government level. How does that impact the market here for a company like NVR, which I think has a pretty good Northeast Mid-Atlantic kind of presence?
Right.
So again, there are very few positives that you're in the narrative going on. Now, Jayson, I don't think these companies are selling below book value, which for home builders is one way to value those, depending on how you treat the assets. Yeah. So I don't think it's like that dire, like we saw, I think, during some really tough times, financial crisis kind of thing. But you are starting to get down to the companies that are looking very cheap relative to the longer term earnings potential.
Yeah, I mean, we're seeing forward earnings estimates, 7 times.
Yeah, sub
10, 7.5 times, 8 times earnings. Now they were the same place a year ago, right?
Right.
The stocks climbed a mountain and then have given up those gains because of the cyclical risk. Let me say, I want to add this one little thing here, because Dreamfinder Homes gets a ton of love across the Fool. It's recommended in multiple services, but I want to make the case for Meritage Homes, which is a long time recommendation and stock advisor that has really figured out the formula, has really unlevered its balance sheet, has really attractive leverage ratios, and most of the debt that it does have, most of it is attached to land that it owns. Dreamfinder Homes, despite being the land light model and using land options to buy land and not debt to borrow to buy land, has a lot of corporate debt, and its leverage ratios are a little bit higher than a lot of its peers. So that could put it at a little bit of a disadvantage if we do go through a protracted downturn in housing, which could happen if the economy gets weak. That could definitely affect some of these businesses. So just be mindful of that, because that cyclical risk is the biggest risk with home builders. And the approach that I've taken is a basket approach, where I own Meritage and a little bit of Dreamfinders, but Green Brick Homes is one that doesn't get enough love. That is a wonderful business that trades for very attractive prices. Even buy a little bit of NVR, and it's $7,000 a share right now, but with fractional investing, most brokerages, it's easy to buy a little bit. So I think buying 4 or 5 of these great home builders, some of the smaller ones, maybe throw some Lennar in if you want exposure to the top of the market. I think that's the smart approach. Build that position out over the next year or two, and I think we look back 5 years ago and we all think we're really, really smart for investing counter cyclically when everybody else is worried, and it's the opportunity.
Jayson, it kind of reminds me of what Peter Lynch used to do for Magellan, where he would identify markets, industries that were just really beaten up or not getting any love, and he would go in there and try to identify 4 or 5 of the best ones and buy them.
That's the way to do it.
Right time, and I think I don't know. Again, I'm still I don't own any, but they just get more and more interesting when you start to see this kind of narrative, because I mean, there are no good threads out there or a piece of news that people would be like, yes, home builders are a great investment.
Can I take Zach Safool's question about EPR properties?
Please do.
Would either of you peg EPR properties as a market beater over the next 5 years? Total return probably makes no sense for this, but you do you. Yeah, so absolutely. Really, any stock you should be thinking about total return, because you know what? The dividends is part of the return too. Return of capital is part of the return. They do a spin out and give you a dividend that's part of the company. That's all part of the return. So for a business like Dreamfinders, or excuse me, like EPR properties, absolutely. So EPR properties is a real estate investment trust, and the most recent yield for EPR based on the current stock price is 6.7%. Now, it was in the 8s for a while there. So EPR properties, a big portion of its business is it owns theaters, and it leases those properties to the theater owners, the big operators. And this was viewed, obviously coming through the pandemic, as a massive, massive risk for the business. And they cut their dividend at one point to get through, because, well, nobody's going to the movies and their tenants didn't have a lot of money. But we haven't seen this big blow up that was expected, that this was going to undermine and weaken the company's portfolio and hurt their cash flows. They've steadily decreased their exposure to it. They've been able to sell off a good bit of those assets while keeping the ones that are really important and good, and still get good traffic, and that are the important ones for their big tenants. So I think they've really managed that shift very, very well. And they've generally made money on the ones that they've sold too. It's not like they've taken a bunch of write-downs to asset values along the way. So they've done a really good job of reducing their exposure, while at the same time starting to increase exposure to other experiential stuff. I believe they own some of Vail's real estate, right? So you think about Vail, the big operator of ski resorts. They don't own most of the resorts. A lot of them are owned by REITs like EPR, but we've seen it transition and start to continue its shift away from legacy, less interesting experiential things like theaters, and moving into more of the experiential properties that are growing in demand and interest from consumers. So they've done that really well, and I think the risk reward is really compelling. And starting at a yield at recent prices of 6.6%, even if they're not able to grow the dividend very much over the next 5+ years, that is a heck of a high floor for a market that might not give us the 14 or 15% returns that we all have become accustomed to, Andy, over the past 15 years. If they continue to delever a little bit and continue to grow in these other areas, increase their rents on the existing properties, manage their debt load pretty well, which I think they will, I think an expectation of 8 to 12% in returns per year average is probably reasonable. Much more than 12% a year, I think, might be a stretch. Part of the catalyst might just be interest rates coming down over the next 5 years. If we see interest rates continue to come down a little bit, not back to like the 2010s levels, but just come down a little bit, moderate a little bit, that's going to help push the multiple up, reduce concerns about the safety of the business. The yield will go down because the stock price goes up, but that could be a bigger boost in returns than maybe we're giving the business credit for.
Jayson, I would be interested. I don't know, maybe we can put up one last poll for today, which would be about market expectations going forward. So, you know, any investment I make, when I'm looking at home builders, or I'm looking at, there's a question about, was it Vihan who has a question about Cintas, which had a great quarter and continues to perform and outperform. I'm always thinking about, what is the market? What am I battling against? Because I'm trying to beat the market. I'm trying to make money and beat the market. So I would be, maybe we can put a poll in there. What are the expectations for the market going forward? Will it be, you know, like 5 to 8%, 8 to 12%, or 12% plus, something like that? Because I do think it's healthy for investors who are investing in businesses, trying to beat the market, to understand, hey, what is the market? What are the market conditions right now that I'm trying to go against? Because when you start running those numbers, you're looking at free cash flow yield, you're thinking about valuations, that it all matters when you're trying to, at least in my mind, when you're trying to go against that bogey of the market. So when you were talking, Jayson, about EPR, I started thinking, oh, what do I think about the market is going to earn over the next 3 to 5 years or 5 years, and trying to find investments that, when I look at their earnings power, their ability to reinvest capital smartly and drive shareholder returns, what are those returns going forward? And of course, as multiples get higher and higher, as we saw at the end of last year, that gets harder and harder of a bogey to beat.
So what do we want the poll to say? Will the market generate? Go ahead.
How about 5 to, you want to go 5 to 8, 9 to 12, 12 plus? Or do you want to be more finer than that?
Yeah, let's do that. Let's do that. Let's do, again, this is the average annual returns over the next five plus years.
Dividends included in the S&P 500.
Yep. I like that. 5 to 8%.
And we'll go into the next hour and leave the folks
12
with
plus.
That, which could be kind of interesting.
I think that's good. So I will say this doesn't surprise me. Our existing poll overwhelmingly, more than 85%, about 85% of people have not ridden a Waymo. And of the cohort that had not, more had no interest in supporting our robot overlords of the future than would. So again, that doesn't completely surprise me. I
have not been out to one of their markets since they really started going out there in the last 8 to 9 months. My brother lives in San Francisco. I think I told Simpo, he sent me a video of them in a Waymo. I'm definitely signing up whenever I can get one.
Yeah, Zach's a fool to miss the beginning of the start of my answer at EPR. If you know, I was just describing EPR's business. So go back and you can rewind it. You got the DVR feature in there. You can rewind it. All right, 3 minutes left here. What's next?
Homebuilder ETF, Jayson, very quickly. Sorry, I lost the question. Bay Dreaming asked about an ETF for home builders. I don't own any of the ETF home builders. There are the two big ones that I know are XHB.
Yeah.
And I think ITB is the other one. ITB, XHB. What's interesting is they're not all just home builders. Also tied into the, I think one or two.
These are more, they're more like suppliers to home builders. So like
construction,
Johnson Controls, Train, Carlisle, Owens Corning, like those, if you look in the top 15 holdings, I think the first home builder is Toll Brothers, and it makes up 3% of the mix. Champion Homes is in there, 3% of the mix. But this is more getting like exposure to like the picks and shovels and the home builders is what you're getting there. So
that's exactly right. And I think I think I would prefer the basket approach of home builders if that is the direction, because that's different than owning something like Home Depot or other firms that are tied to home construction and home build outs and family enlargements, like even something like Williams-Sonoma or something like that. So
yeah, IHB. I will say this just quickly. IHB it is a home builders ETF. Mostly, its largest investments are in Horton and Lennar and NVR, Pulte Group. But then you get the Home Depot, Lowe's, and Sherwin-Williams as they get mixed in there as well. So all in all, something like that is probably maybe 20% of the mix is probably home builders. But again, if you want concentrated exposures, you're 100% right, Andy. I think that basket makes more sense. It's easier to build, and you're not giving somebody a 0.4% expense ratio along the way too. All right.
Betsy had a follow-up question on cycles, Jayson. Maybe we can take that as we kind of round out here. You talk about cycles, Jayson and I both did. How do you see the cycles and try to catch a down or a low? Do you look at the stock chart? What else? What is the mechanism? So I look at both those. I look at the performance of revenue growth and the stock charts, and usually they go hand in hand. But for me, it's really about the performance of the business and looking at the revenues. But obviously, I wouldn't be trying to find bargains in the market like we're seeing now in some stocks and some parts of the market if the narrative isn't really kind of going against lots of different companies. And I've seen this time and time again. And by the way, Jayson, sometimes we think we maybe are buying stocks that are, in the lower part of the cycle, and the cycle just keeps going, and the business is just structurally challenged, and it never comes back. In fact, as I've said before, many businesses come off those highs and the stocks never recover. So I'm not saying it's like easy to do, and it's just like looking at a chart or revenues down and it's an automatic sign. I do think it's an interesting tell if you are seeing businesses, and especially if they are starting to go through transformative processes to change their business, new management teams, as we've seen with the likes of PayPal and Unity and some of these businesses that are trying to turn things. Maybe Nike's there, but it's not like the footwear market in general, though I know Deckers has been dropping one that I think is really interesting very dramatically. It's not like Nike's been in like a 5-year kind of like trough, Jayson. So it takes more than just looking at a few different metrics to try to figure that out, and trying to time things too specifically can be a route for underperformance.
Yeah, no, absolutely it can. And as a rule, just to close this out really quickly before we bring Danny and Seth on, I focus on companies where the secular growth opportunity and the tailwinds are large, and I'm looking for long-term holds. And when I'm looking at the cycle, I'm not trying to time an exit, although I have every once in a while maybe lightened a position or exited a business that the cycle was turning and it just wasn't doing very well because I wanted to move on from that business for a time. But generally, I'm looking for opportunities to add. So like right now, and I'm not trying for precision, I'm trying for directionality.
Yeah.
With housing, we know there are going to be headwinds in the near term. We know a lot of these stocks are down 25% or more from their recent highs. We know the valuations are getting really compelling. I'm willing to pay too much and watch the stocks continue to sell off for a period of time and continue to add to them over that period, and maybe even start adding some on the way up based on the long-term trend. So not trying to get it perfect, but directionally being aligned with what's happening to buy at good value points based on the long-term earnings of these potential, long-term potential.
Yeah, Jayson, that's great. I've been very negative on just some of the alcohol and liquor business right now. And I sold my Diageo at the end of last year. Just 'cause I think that cycle is low. Oops.
Yep.
Sorry, a little dog barking. But so that is not a long-term, I think. So trying to identify those markets that have lots of opportunity ahead of them and trying to buy stocks when they're just no one is seeming to like them. That's what I'm trying to do.
Yeah, no, I think that's the smart way to go. I guess we can wrap it on that, Andy. This has been a great hour. Thanks to the fools behind the glass to do the hard work. And thanks to Seth, Jayson, and Danny Vena for taking over. So we can move on.
Say, bark, bark. I have to go outside, Dad.
And it's a long story watching my brother's dog here. So
love it. All right. See you.
Thanks, Jayson.
See ya. Hey, Danny. Hey, everybody out there watching us on the YouTubes and the Motley Fools. I'm Seth Jayson, drone, Sector 7G. Work on a couple of products here, trends now at the Motley Fool. And this is my colleague, Danny. I bet I can guess the weather where Danny is because I know he's in San Diego because he told me. Is it 72 and sunny?
Normally that would be the case, but today it's a little misty, a little drizzly, and cooler than usual. So, and that's okay too because we need the rain.
They sent San Francisco's weather down to you guys, I guess.
I guess so.
All right. So when we got in here, people were talking about housing and what else? And footwear. And so we can talk some more about that. I'm pretty familiar with both of those areas. I was, like probably many people, interested in those Lennar numbers lately, where they had some pretty big givebacks in terms of buy downs, closing costs, and other incentives, more than they've done since 2009, which sounds a little scary because 2009 is we were just pulling out of that giant crash, and people were still pretty hesitant to start buying houses. It was something like 13% of cost, average sales price of home, according to one article I read. So that is interesting, and again, especially because the article I read said that the weakness was in Texas and Florida, which were typically pretty strong markets for Lennar.
Yeah, home builders is not an area that I follow, but from a standpoint of the broader economy and being a resident of San Diego, There's, as long as I've lived here, there's been a housing shortage, or at least a shortage of affordable housing in San Diego. And so I always look with keen interest on, kind of the overall trajectory of the real estate market. There's a lot of interesting things going on out there.
Yeah, I mean, I live in Northern Virginia, where of course lots of people's jobs are disappearing, or they think they're disappearing, or they're not sure if they're disappearing because they were fired and then the judge stopped their firing and now they don't know what's going on. And this is an area where home prices, of course, it was kind of ground zero for home price appreciation, especially in like the early and mid 2000s. Unlike many other areas of the country, the drawdown following the housing bubble implosion was much reduced here. And that was because there's just so much hiring and so many people with decent jobs that there was really a backstop for it. And people in general out here would prefer to be closer in to the city, DC, rather than further out, because even where we are in traffic, it might be like 12 miles as the crow flies to get to downtown DC. But if you try to drive that during rush hour, good luck getting there in anything less than an hour to an hour and a half. And so we were talking about this yesterday in one of our investor group meetings as to what we thought might be going on with the housing market, especially around here. And one of the takeaways was that just about everybody in that group was interested in what they considered some of the better quality home builders. And I won't give those all away because we're not just throwing out stock picks here, but other members listening can dig in on their own and find some of these higher quality home builders or look to their services where some of these have been recommended. And in general, the mood was not that worried about some of the better ones, even though the prices are down, because they're a little bit of the only game in town when it comes to meeting the pent-up demand that is still out there. As far as, the DC area goes, my neighborhood sees for sale signs on a pretty regular basis. And anecdotally, like those houses are still disappearing pretty quickly. We live in a pretty decent neighborhood, which is oddly like the houses still look pretty much like they did in the 1960s when they were built. So McMansions never took over. So prices here are relative to the area. Prices are inexpensive, and it's in a very nice location in terms of getting to work and so forth. And so these houses are disappearing pretty quickly. I haven't looked at prices for a while, but the house next door to me sold for a neighborhood high, 5-6 months ago. And I'd be surprised if that changed much, because 5-6 months ago, mortgage rates weren't all that great either. So it is definitely, real estate is definitely location, and then job numbers. We have one question out there that I saw regarding real estate, and it was, what are the pros, cons of holding builder instead of home builders for exposure to this industry? That's Rose. It was 9 minutes ago. I'm going to assume you're talking BLDR, the ticker for Builders First Source. And that is if for those not familiar, it supplies building materials, manufactured components. I'm reading directly from their business description, and construction services to professional home builders, subcontractors, remodelers, and consumers in the United States. So pros and cons. I mean, it's a different kind of business. Builders First Source kind of supplies the picks and shovels in a way, although also just the componentry. But they're going to the extent that there's any kind of an economic effect that punishes the home builders, it's going to have probably a nearly equal effect on Builders First Source, which not unlike the home builders or some home builders, carries a decent amount of debt and needs to service that. But Builders First Source trades at a headline free cash flow yield right now about 7.8%, which sounds pretty good, although they do spend almost all of that cash flow and more the last couple of years, as I always explain to people, on stock buybacks. And whether or not you think that is good or not, depends on what you do when you switch over to look at the share count, as I am, to try to decide, is the share count moving in any direction. And so Builders First Source has been buying back a lot of shares. They had a share count of 203 million in 2021. It's 118 million right now. There are other things that contribute to the fully diluted share count, including like falling stock price. However, it looks like the shares the share number is getting smaller. So you might want to say, all right, that free cash flow is real. It's being used to help investors, and it's not just a component of pay. So you might be fine with that. And Builders First Source, according to the spreadsheet I have that does all my calculations for me, typically exceeds its cost of capital, its return on investment. It typically exceeds its cost of capital by about 12%, which is generally the mark of a really strong business. Some of the downside worry you might have if you're looking at Builders First Source, from my point of view, is that gross margins, they were up in the 34% range in 2022, peaked up a little bit from there, and then came down after that. They're on a downward trajectory. Revenue has also been. But operating margin from 2022 is 16.6% and down significantly thereafter, with net and free cash flow margin falling as well. So if I were considering this company, one, it's not really a proxy for the builders. It's not the same as a basket of builders. It's not the same as a builder ETF, which has a lot more stuff, but a lot easier to research. You can dig into those conference calls, look at the 10K over the past 3 years, and see what the reason is maybe for those dwindling margins.
So I saw a couple of interesting stories that I thought were, tangentially related to chips, clouds, and more AI related stories. And actually, I think they talked quite a bit in the last hour about Waymo expanding into or restarting its testing in DC, and they're planning on kicking off their robo-taxi service in 2026 next year. So I'll just mention that in passing. One thing that I saw that really kind of struck me was the 23andMe bankruptcy filing. They have somewhere in the neighborhood of about 15 million users, and they have DNA type data on many of these people. They had a data breach in 2023. They filed for bankruptcy protection. It's been said that they plan on selling substantially all of their assets. And that kind of raises concerns for me. Because, when you've got that kind of data out there in the wild, you don't want bad actors or other folks getting a hold of that data. And one of the things that I have seen was recommendations for users to go onto the 23andMe website and delete their account. There's a lot of privacy advocates, and even the California Attorney General is recommending that people go onto the site and pull their data, because right now their privacy policy says we don't share customer data with third parties without your consent. But if the company's up for sale and if its assets are up for sale, they might be skirting that third party issue.
It's going to be the first party when if there's any value assigned to all of this, which somebody presumably would, then they're going to step in, and you don't know what they might want to do with that data. I have to say, the whole genetic testing thing, my parents got me one of these for a holiday present one year, and luckily it turned out that it was one of those expired ones or something like that. It might have been Ancestry.com site, so don't quote me on which it was, but either one, I think it was 23andMe, but I was not interested at all. I was just not interested in having my DNA in somebody's database. And I'm not some tinfoil hat type person, but I just saw no need for this. And I also really don't care like what mix of whoever I am. I mean, like I'm just like this white dude from the US. I don't need to know that I'm like this much German or that much whatever. It just doesn't interest me, especially given the potential downside of having, you know, DNA in a potentially public facing database. So that was interesting. And one of the things that members may not remember is that 23andMe was heavily kind of spun out of personalities that spun out of Google. And so that is a very interesting story. And I'm sure we'll hear soon enough if anybody is going to bid on that data. I would guess that it would maybe be the folks at Ancestry if they're still around doing their thing. But getting back to the Waymo thing, I wanted to mention that if anyone has looked at the Lyft results, the latest Lyft results. So Lyft, as folks may know, is what people consider like the poor imitation of Uber, even though it's Uber that ripped off Lyft's business model. If I understand the history correctly, Uber was originally about getting a fancy car because their original CEO and founder was into being a fancy dude. And Lyft was more the like ride sharing thing where you just got into somebody's car and got a ride. And Uber said, "Ooh, we want to take that business model," and did it. But Lyft, like Uber, had years of kind of crummy performance, burning cash, not doing well. And I don't know why, but for some reason, I looked at it a few weeks ago, and the company had turned free cash flow positive. Revenue growth has accelerated again. And it looks like a pretty interesting opportunity. It looks like a company that has turned the corner. And as far as I know, I don't see a lot of people talking about Lyft. You'll still hear people talking about Uber. But I would go read, if you're interested in this space, I would go read the conference calls, because Lyft is very careful about how they treat their drivers, because that is the core of the business. And they also point out, interestingly, that in the markets where they operate, when robotaxis arrived, which at this point is basically only Waymo, it actually increased ridership for them. In other words, it seemed to sort of broaden the base for everybody. And then another point is that in many of these markets, I think it's still the case that the robot car costs more than the car driven by a human via Lyft or Uber. And so people have to be willing to pay a premium to sit in the car that doesn't have a driver. But if you're interested in this space, give Lyft a look. Put on your green visor, get your banking light out, and take a look at that one, because it's one that's interested me since I just stumbled across it again a month ago. Good Driver asks.
Sorry?
Did you see Good Driver's questions? Are we experiencing the start of a sector rotation from tech and growth into value and industrials?
My initial answer is I don't know. I would say that whenever valuations in the tech sector get high, and when there's any economic uncertainty, and we've seen some uncertainty, maybe economic, maybe not, but all of the uncertainty surrounding tariffs and the trade war, and the reorganization that's going on in Washington, D.C., people tend to take profits on their high valuation stocks in technology and growth stocks. And there may be, at least temporarily, a flight to safety happening into value stocks. I think a lot of what happens from here on really is going to depend on a number of factors, whether or not we actually get into a protracted trade war, whether or not there's any resolution to the tariffs issue. I know that some of the tariffs have been pushed out. Some agreements have been reached reportedly. And I think the other wild card, obviously, is inflation. So I think a lot of what's going on in the macro environment right now is weighing a little bit on the stock market right now. But even then, over the past several days, we've seen a rebound. So I don't know if we've gotten into a sector rotation yet or not. I think these, temporary flights to safety happen more often than many folks realize. And they're, most of them are short-term in nature. I don't think we've seen a big one for a while now.
Yeah. I always laugh because it's actually been like 15, maybe 15 now. 12, 13 years since I think we've been in what I would consider to be a normal market where things move a lot. I remember like in the mid 2000s, market was all over the place all the time and everybody was used to it. But I think there's a new generation of investors and of all ages, but people who started investing, say, I don't know, from 2018 on, things were going great. Then there was this COVID panic. Then no matter what you threw money at in the market, it made money for about a year and a half, right? And then we had a giant crash again. And then, but in general, the direction the past 5 years to 7 years has been pretty much up. And so I think people's expectations are skewed by what has been, in my opinion, a less scary market for the most part than we used to get all the time, or at least like there were only a few scare events versus the normal once a month scare events. I remember when I was working at the Motley Fool starting out. As for sector rotations, I don't know that I ever really believe in those numbers. You would need to get some money flow numbers from one of the data providers to find out if that's actually happening. And then you would need to know whether it was money manager money, whether it was hedge fund money, whether it was retail money. And so we talk about things like flights to safety, but if the economy is going south, there's almost no such thing as safety unless you've got stuff already in an interest-bearing checking account, and we don't get to the point where banks are failing. So I don't know that we're seeing that, but value is not a sector, of course. Value is a concept, and industrials are a sector. And I don't know that I would call those safe bets given the uncertainties we see right now, because we just heard this morning that we might get a 25% tariff on copper imports in the next coming weeks. They're fast tracking a report, quote unquote, I will say that to decide whether or not copper is, whether the country is in danger because we import too much copper from foreign countries. This has been the MO for putting tariffs on all these metals, is pretending that we're in some kind of an emergency and that we have to have what used to be wartime powers, like changing tariff regimes on the fly. And so it all comes down right now to the whim of one person. And probably we're going to see these tariffs. There's no study, there's no report going on. This is just going to be a decision made. And it's part of trying to squeeze our economic partners and allies for as much as we can get out of them. I will say that the U.S. imports about half the copper that it uses, and copper is already pretty pricey. And so it's going to make a lot of things more expensive than they were, like all the wiring that goes into those houses, any copper pipe that goes into those houses, if they're not using a lot of PEX, for instance. And then it's going to make things like, big electrical equipment much more expensive, the kind of thing we need to build out grids, power plants, factories. There's no replacement for copper for the most part there. You can use aluminum for some of that stuff, but aluminum's also going up and we import most of that as well. So the other thing to remember here is that none of this is going to work to reshore mines or factories over the short or even medium term, because these commodities are already pretty volatile, and it is a tough business to dig up mountains of rock and squeeze metal out of it. I know this intimately because I grew up in the part of Minnesota up north where for a long time all of the iron that was used in the U.S. Came from. And it's a place that was always boom or bust, and it's the same thing for any minerals. So capital decisions on whether to open plants and things aren't really made on the basis of kind of short-term whims and tariffs. I mean, you can imagine if Danny and I had a company that was, say we were selling copper pipes. Well, right now we'd be trying to buy as much copper pipe as we could or as much raw material as we could because the tariffs haven't hit yet, right? So we'd be trying to get as much as we could. And then, we're going to mark that up an extra 25% next month if the tariffs hit, because we're going to be able to say everybody, whoa, well, copper costs 25% more. And so this is exactly what happened the first time around. And it is what will happen this time around. So if this happens to all these metals, we're going to see input costs for a lot of items like appliances and cars go up a significant amount, even if the item itself isn't subject to an extra tax. We don't know how much, because we never know where these are going to fall out till we hear, and we don't know if they're going to be pulled at the last second. But all of that is to say that like there's no sure thing in industry right now either, given all of the uncertainties in policy and all the threats being made.
Yeah, and there's a lot of it's adding to the existing uncertainty. You talk about copper and you talk about steel and you talk about aluminum, and I don't know where this will end, and I'm afraid that if the U.S. sticks to its current policy of slapping tariffs willy-nilly on just about everything, we could potentially reignite inflation, and that's something that none of us want to see. So, not something I'm happy about.
Yeah, and if you look at the prices of washing machines and so forth that were hit with tariffs, not based on metals, but based on like what they were and where they came from, those prices kind of went up and sort of stayed high permanently.
Right.
And it really was an inflation rate that was far in excess of kind of everything else. We bought a new dishwasher maybe a year ago, and I couldn't believe how much it cost, because we had put one in about 7 or 8 years ago. Similar model. It was a Bosch. And I finally dug up the receipt, and in 7 years, that dishwasher price had more than doubled. And it wasn't like any new technological advancement. And in fact, there's less raw material in the unit than the newer unit than the prior one. I know because I lifted them and installed them myself, and I could feel like how they'd gotten flimsier. But when we decided to have a trade war, and then some of those policies and tariffs continued, like the price of a lot of these goods went up permanently, and it stayed there, and they could go higher again. So, and that all makes it tough. There's a roundabout way of getting back to the question about safety. And nothing is safe in an environment of economic contraction or a trade war, and you just don't know what's going to happen. So let's at least acknowledge that all equity investments at that point are risky, and that the way you safeguard your nest egg is to make sure that you have, the appropriate amounts of money in different asset classes, including that could be cash-like instruments, so that if there is a prolonged economic and equities price downturn, you're not forced into selling a bunch of things at a loss in order, to buy dog food and mac and cheese. So the rush to safety, you always need to have done it ahead of time, and it needs to be kind of part of your plan at all times. And safety is not trying to figure out which stocks won't go down. Safety is having money in other places that aren't stocks.
Yeah, one of the things that I learned early on, hanging around with the Fool, was that you should have an emergency fund. And my emergency fund for years has been between 6 months and a year's worth of what I would generally take in. And most of that money is in savings and in long-term CDs. And while I never expect to need it, it's there. One of the things that, because my wife and I both work, and if either one of us lost our job, that would put us in financial straits. If we did not have, like I said, 6 months to a year's worth of savings that would cover essentially half of our expenses, so, one party's worth of expenses. If we both lost our jobs at the same time, then that's a whole nother kettle of fish.
Yeah.
But
and ours is even bigger. I grew up in a place, like I said, that was boom or bust. I remember, I was, my family's finances were never too terrible, but I had friends who would be really, really out of luck when the mines closed. I remember one time taking my wife through rural Minnesota. There was this giant northern pike on the wall above a bar where we stopped to use a bathroom and get a beer. And I was talking about the fish, and this guy sitting next to me, this old timer, goes, "I caught that fish." And
of course,
and he goes, did. "Yeah." And I said, "Wow." And he said, "Yeah, it tasted real bad, kind of like styrofoam," he says, in his Iron Range accent. And my wife, poor dear, doesn't understand. She says, "Well, why did you keep eating it then?" And he was so kind, and it was so heartbreaking. He said, "Oh, honey, I guess you don't know." He's like, "Back then, it was a recession, and we had to eat it. That was the food we had. Like, we were out of money." And so I remember times like that, and I remember lessons like that. So I'm a much more risk averse investor in a lot of ways than a lot of my colleagues. Like, we keep a lot more than a year in savings, and we live still way below our means because, not only are our investments a lot in equities, but my job's kind of in equities, right? So when the market has a downturn, as you can imagine, the Motley Fool has a downturn. And so if you're in a position like ours, you're maybe double levered, maybe you're double levered to market, and your risk is amplified. So, the notion of safety is individual. And one of the lessons I've learned about money is that we don't spend on fancy stuff. And I tell my daughter all the time that the ultimate luxury is having enough savings that you don't have to worry if something happens. That is so much better for us than, if we were spending those savings on fancy cars or fancy furniture instead of our Costco couches.
Yeah. I have the same car that I bought. Geez, I'm trying to remember. It was 2012, maybe. And I work from home now, so I don't use it, but my daughter's using it. And we keep the car maintained, and it goes in for all its regular, maintenance, so that essentially, I have joked about we're going to drive that car until the wheels fall off, and that's maybe only joking a little.
My last truck was like that. I actually had to sell it to the scrappers because I couldn't in good conscience sell it used to somebody. The engine and the transmission were great rebuilds, but the frame was rotting out. And I was afraid if I sold it to someone, they would drive it and I'd never know, but somebody would get killed and I would never know about it, but I would know that it had been my fault. And I was not willing to take that risk. And I gave it away to NPR or somebody, and they sold it, and it gets parted out. So somebody recycled a good engine, good seats and everything. But yeah, you'll probably find if you listen to Fool 24 investors, and this is your clue that we're kind of regular folks like you. There's a lot of people here driving old cars. My car's a 2009. Our other car is like a 2014 that we bought used. And we just don't trade up a lot. And once in a while you put $4,000 into it and you're like, oh, that's a lot of money. You know what you do? Go down to the dealership and see what it would cost to replace that minivan. I did this a few months ago. Stellantis was in trouble. So I thought, okay, let's go check out the minivans, right? Stellantis had $10,000 discounts on the kind of minivan that we like. And they were still $45,000. So I said, and you drive it off the lot and the depreciation cranks a bunch right off it. So I said, you know what? We like the van we've got. $4,000 to keep the thing running. It'll probably run another 100,000 miles. That makes a lot better financial sense than plowing 40 grand into another car.
Yeah, one of the things that I recommended to one of my family members who was talking about, oh, well, I just got this car paid off and I was thinking about getting another one. I was like, why would you do that? Take the money that you've been making on that car payment and stick that monthly car payment into your savings account and save that for the next 4 or 5 or 6 or 10 years, however long that car lasts. And next time you could buy one for cash instead of making payments on it.
Yeah. Yeah. So these are, again, I guess we turned it into the living below your means show. But definitely, that's always been a part of foolish investing. At least it was one of the things that got me into the Motley Fool, was that they said, investing is not just for rich people, it's for regular people. And the way you as a regular person can get enough money scraped together to invest is by living below your means. And that was always part of the tenet of the early Motley Fool. And it really works. It really works. I'm looking for some questions here.
Sure.
I see here a bunch of valuation questions. What are the best opportunities in the market? Here's an interesting one from Besties. What do you think of Alibaba's, I think it's their CEO, Sai's comment on AI investments? So yeah, Besties, let's put that up on the screen. Besties and Alibaba Sai's comment on AI investment. And if I'm remembering this correctly, it was that we're seeing overinvestment in AI, especially vis-a-vis GPUs. And actually,
I've actually got that.
You got the whole quote?
It was one of the stories that I brought along to cover in case things were late.
Yeah, read that out to me.
Alibaba Chairman Joe Tsai at the HSBC Global Investment Summit in Hong Kong said, "I'm astounded by the types of numbers that are being thrown around in the U.S. about investing in AI." And in talking about data centers, he said, people are literally talking about 500 billion, several $100 billion. I don't think that's entirely necessary. I think in a way people are investing ahead of the demand that they're seeing today, but they're projecting much bigger demand.
Yeah. And I think that's absolutely fair. And I will say that I simultaneously agree and don't know if he's right. And the reason is that this is a very complex issue, and trying to figure out where the demand is going is super hard. So I'll throw out a few pieces of information that have come out recently and ones that come top of mind for me. And just today, Bloomberg reported again on a Cowen report, an analyst report, which I haven't seen except secondhand through Bloomberg. But they were the ones who broke the news that, Microsoft had canceled some AI leases, data center leases, and that they've done this again. And I posted on our advisor notes about this. And so the question is, does this mean, is this bad news for NVIDIA? Is this bad news for Arista Networks? Are we seeing a drop in AI investment? You ought to think about that in conjunction with a couple of things. One, if you want to think about it in conjunction with the thing that'll make you scared, is when Satya Nadella went on that podcast and said, by 2027, 28, we're going to be renting AI GPU capacity from other folks at attractive rates, which indicates they're not just going to keep buying and buying or spending and spending and spending. However, they are committed to spend, 70, 80 billion over the next year and maybe some more after that. Meta, similar plans. Google, similar plans. And if you read through the rest of that Bloomberg article, you see that they note that Meta and Alphabet or Google took over some of those lease options to put data centers in those spots where Microsoft was considering doing it. So there may be AI overbuild. We may see demand not not meet the capacity that is going to be built with all these new Blackwell chips and other chips coming out. That may happen. But on the other hand, the companies that are serving this compute right now are consistently saying that, that they're seeing more demand than they can serve for the most part, and they continue to keep building. So you have to ask yourself, are they completely irrational? My inclination is they're not completely irrational, but that they're doing some pretty complex math in the background, and that depends on a lot of second and third order phenomena like chain of thought reasoning. How much more in the way of tokens does that demand? Jensen Huang, I think last week at their conference, I think he said running the DeepSeek reasoning model demands 100 times more tokens than just asking a frontier model a question. And when I use like Google Gemini Advanced and I give it a fairly simple prompt that's maybe 250 tokens, and then I watch it spin through its thought process, I see it spinning through, thousands and thousands of tokens before it even spits out an answer, which is another several thousand tokens. So, if what were simple prompts that went to, simple chatbots and gave simple answers becomes this, then you're looking at, AI demand that's 3-4 orders of magnitude bigger, even based on the existing user base. Now you imagine the user base doubling, tripling, quadrupling, then it's easy to make the case that, no, we need all this, but we're not going to know until we get there, unfortunately.
Yeah, one of the things that I kind of like to take those comments and put them in the context of what, for instance, the cloud infrastructure providers are saying. And I went through and I read each one of the conference calls for Amazon, AMZN, Microsoft, MSFT, and Alphabet, ticker GOOGL. And what I read in every one of those calls said that their growth was constrained by capacity, which sounds to me like they don't have enough data center capacity right now to support the demand that they have from their customers for AI. Now, if that is the case, and I believe that it is, I don't have any reason to doubt the CEOs and executives of these companies, then they need to build out data centers in order to meet the existing demand. Now, you can only take them at their word. And growth was a little bit slower for each of the three major cloud providers in the most recent quarterly report than in previous one. And I think that's a result of, they said, hey, we're capacity constrained. We need more data centers. So I think from the outside looking in, for the Alibaba CEO to say, the US is crazy, they're, building this out ahead of the demand, I don't think he's actually got any inside information in order for him to make those kind of blanket statements. So, I do remember seeing where somebody had aggregated that Amazon, Alphabet, Microsoft, and Meta platforms were going to spend in excess of $315 billion on CapEx this year. And 3 of the 4 said they were capacity constrained. So, yeah, I don't think that's, I think he can say what he wants to, but that doesn't necessarily make it true or, backed by facts.
Yeah. And I want to point out, this feels a little tinfoil hatty, so I'm kind of embarrassed to say it, but I'll say it anyway.
No, go ahead.
There is definitely a concerted effort, I would argue, ever since the DeepSeek announcement, which I would argue was the beginning of this effort. There's a concerted effort to cast China as the scrappy underdog that can do AI just as well as the US with a lot less spending. Now, I've been to China and I've watched people in China do their thing, there's a lot of truth to it. If you want to see a lot of really smart people working really hard, go hang out in China for a while. However, I do think that open sourcing and building upon what others have done are important to. I think that's even codified like in the party rules for how these companies are supposed to be approaching AI right now, are important to what's going on with generative AI in China. But they're all going to say what they've continued to say over the past few weeks, which is that the Americans and the Europeans are crazy. They're spending more than they need to. Look what we can do with less. And I want to again go back to the DeepSeek moment, which surprised a lot of people. Didn't surprise me because I had seen the first DeepSeek model come out and had watched it, get pretty good results. This was before the reasoning one. In the places where they test these things, like Chatbot Arena, and I was like, oh, that's interesting. And then everybody acted like it was crazy that this new model came out and that it was so cheap and that it was so effective. I've talked about this before. The guy who runs Anthropic, the CEO there, wrote a long blog post about how, where they were on the cost and performance curve is about where you'd expect any good AI company to be. And what surprised people is that it wasn't a well-known AI company and that it was a Chinese AI company rather than an American one. Now, I don't like to believe everything he says because he says some crazy stuff, but this stuff seemed to make more sense to me because let's also note that like the costs that are attributed to DeepSeek's model creation are completely opaque and likely like vastly underestimated and maybe even lie about it. We're not sure how much of each those things it is, but the press coverage on that was just straight up horrendous. They took like this DeepSeek number where they apparently gave the final training run $6 million figure, and then they compared it to like all of the capital expenditure planned for the next year by American hyperscalers. So there was like 6 million versus 100 billion. Well, that's not a fair comparison at all. No. And now I'm not saying that American AI companies like OpenAI haven't vastly overspent on building these enormous frontier models that have then turned around to not only underperform the cheaper DeepSeek models, but also to underperform their chain of reasoning models that they had released prior. So we do spend too much on this, but this is on training and inferencing are two different areas. And inferencing is going to be the thing that eventually determines whether this AI infrastructure spend pays for itself. Because the days we've seen this for a while, and even I'm not an expert, but I know a few things, and there are diminishing returns on just about everything. And I could see a year ago that there were diminishing returns on these huge models because every time these big ones came out, they were a little bit better than the last ones. Mm-hmm. And OpenAI's last big model release, they didn't even call it a frontier model, even though it was supposed to be a frontier model. And it was just so enormously expensive, and it underperformed their chain of reasoning models, which are much cheaper to run. So we're kind of at the end of the road for these giant models, but that's actually good news because people are building on top of some pretty good foundations, and they're concentrating on putting this AI to use in better ways rather than everyone just going to chatbots and asking questions. So we're in a different era already, and whether or not that AI spend pays for itself will be determined by use, and we don't know where that's going to go yet.
Yeah, there was one other idea that I wanted to put out there. I remember in the wake of the DeepSeek announcement, we had a Full 24 episode that featured Tom Gardner and a couple of AI experts. And one of the things the one guy said really struck me, and I've been kind of watching the media since then. And what he said was that since the announcement of tariffs and the initiation of the trade war, against China, there has been a concerted effort by Chinese executives, by the AI community in China to kind of, he thought that they were purposefully undercutting, some of the things that were going on here by these announcements and the way that they were portrayed. And the fact that you said, perhaps not all of the information that was released about this DeepSeek model was completely factually correct. And that these Chinese officials and executives had no problem whatsoever with, perhaps throwing the U.S. stock market into a downturn because that was just one of the weapons in their arsenal to, basically come after us because of their disapproval of the chip embargoes and the tariffs and the trade war that's going on. I thought that was an interesting perspective, and you could argue that perhaps these comments by Alibaba's CEO might be along those same lines.
Yeah, I mean, I think that that's definitely something people need to consider when they're thinking about this. There is a party line, and we're seeing it come out of that. And the other thing is when you look at the costs, like the inference costs, what DeepSeek charges versus even the cheaper inferencing costs from services in the U.S. and in Europe, they're like an order of magnitude cheaper in some cases, and maybe they've got enough optimizations that that's a rational price. But I come at this again with some experience investing in Chinese companies like travel companies and other companies where online travel agencies. I eventually quit investing in like every Chinese company because there was always a new competitor coming up that had some kind of source of funding. And it may have been like backdoor government funding, backdoor local government funding. You never knew where, but they could discount their product so much for so long that they could take a giant chunk of the money away from a pretty good incumbent competitor. And they could just afford to do that for a long time. And so when you look at these prices at DeepSeek and you say like, is that real? They say it is, and I could see maybe the argument, but on the other hand, like I've seen this movie before. I've seen prices not turn out to be real. I've seen them turn out to be supported by some other source of capital that we're not seeing. So that's where I'm going to stop with that one. Random Lake had a related question here. If data centers do get overstuffed with NVIDIA equipment, what opportunities could arise from discount, overstock, processing capacity? Interesting question. Any of NVIDIA's AI data centers, as far as I know, can do any of the kinds of AI workloads that NVIDIA has designed these for. And that's not just generative AI and LLM. That's other kinds of machine learning and physics modeling and so forth. So those are all opportunities. You'd see price wars on rentals, on rental time. But certainly that would be great news for software companies building who need to access those kind of supercomputers, which is really what they are. Whereas, companies that are maybe looking at building custom LLM inference chips on their own would not have the same kind of flexibility.
It's interesting because this actually ties back to that comment that you made earlier, talking about that note by TD Cowen, and they were talking about. I went back and looked it up. So Michael Elias of TD Cowen said that the firm's channel checks at NVIDIA's GTC event basically indicated that aggregate data center demand had actually increased year over year, even though we were seeing more cancellations and deferrals from Microsoft, and that Alphabet and Meta were using that as an opportunity to backfill capacity. And people that are smarter than I am because I don't have, any insider information in the industry, have said that because Microsoft is spending money to build its own data centers, it thinks it can get a better deal by building its own data centers, and is canceling some of the forward-looking leases that it had, and is replacing that with these data centers that it's going to build from the ground up. I don't know if that's true or not. I've read that somewhere, but that kind of makes sense to me. If you can, spend less money building your own data center than leasing it from somewhere else, it might be a worthwhile endeavor, particularly if you're going to build more capacity than what you need, that they would get rid of some of that surplus data center leases they have. Yeah, and I think there's enough demand right now to go around. Now, I can't say as to where we're going to be in the demand curve, say 2 or 3 years from now. And a lot of that is going to depend on AI adoption by the masses, and whether or not, companies turn to these cloud providers for their AI services. So I think that's certainly worth watching.
Yeah, there's so many moving pieces. It's really hard. It's like trying to play 3D chess, but they keep changing what the pieces are allowed to do along the way. So we talk like, will LLM or generative AI be adopted by the masses? Kind of has to a degree. Will it be some more? We don't know. But if it does, then you get to the question of, well, how good does it need to be? Like, for the kinds of queries that people ask AI, is it like an on-device small model that can answer most questions, or quickly go to the web, find information, and then chew through it and spit it back out on your edge device without having to tap, a giant stack of NVIDIA GPUs? Will that be good enough? I mean, it's possible we're looking at a future like that, right? We already have, AI processing sub-chips and chips in cameras. And we've had them in cameras for quite a while, in phones and so forth. And so we don't know where all this is going and where the mass adoption will end up. It's a very interesting ride, but in the meantime, if you're worried about it, the simplest solution is you size your positions accordingly, right?
I could even see a future where AI adoption is split, where you have, you've got AI models on the edge, on devices like on your Android phone or your iPhone, that are smaller and less accurate, but that are good enough, like you said, for consumer use. And then you perhaps have the larger models that are located in the data centers and that are tapped for use by enterprise level businesses that perhaps need more accurate and more granular data. And we end up with, maybe two coexisting AI markets, as it were.
Yeah, I imagine we're going to actually probably see 200 coexisting AI markets. I think that we're going to see a lot of specialty. And already there are companies out there that kind of use AI or at least some algorithms to automatically steer what you're doing to various different providers. So like they're the front end and they look at your queries or what you're doing. And they're like, this would be better answered here. This one would be better answered here. This one would be better answered here. This one would be better answered here. And it also takes cost into account. So like, okay, you need that answer. Well, they're offering it cheaper right now. And, some of the individual models actually do this already. One of the purported advantages of the new DeepSeek model that's coming out now is that it basically shunts demands more quickly sort of towards a portion of itself, kind of excluding the rest, so that it then doesn't have to chew as many numbers in order to get an answer. In other words, it like points it in the correct direction conceptually before it starts wending its way through the decision tree to output the tokens that become the answer. This is all really tough stuff to keep on top of. But the one thing I'm absolutely sure of is that we don't know what it's going to end up looking like.
it's certainly more complicated than I can keep up with on a regular basis. So there's a question in the queue from several hours ago from Investment Vertigo, and I think this was initially addressed to some of the other fools, probably on the morning show. But what are your thoughts on Serve Robotics now that NVIDIA has exited its equity position in the company? Thanks. I think it's interesting. I believe that companies like NVIDIA will look at some of the newer companies in the space. They may, initially be intrigued, buy a position, take a look and see what the company is doing, and whether or not what the company is doing aligns with anything that they're interested in. And maybe they keep that position and maybe they sell that position. And I don't think it necessarily has anything to do with whether or not they believe that company is going to be viable or not. I think it is just as likely that their interest, they could have determined, well, this is not really going to tie into anything that we're doing right now, and they don't see it as a good fit, let us say. So I am intrigued by Serve Robotics, but like many of these early stage companies, I think a lot has to go right for them to be successful. So while I'm intrigued and I'm watching, I don't own shares in Serve Robotics.
Yeah, I'm going to be the heretic. I guess poor Serve is down. I know it's popular among some of my colleagues. I'm not a fan of Serve Robotics, never have been. Losing a ton of money, not a whole lot of revenue. And this is like not a space. This to me is like not a space where there's a super durable competitive advantage. It is George Mason University is the first place I ever saw food delivery robots trundling around, and they've had these robots from Starship for years and years and years. And, this is a company I think that pre-existed Serve, but it's definitely in the same space. And I just don't see a huge advantage for Serve there. And I think that to the extent that NVIDIA is able to make little super smart chips that can make little robots like this easier to produce for anybody, like if you believe in a robotic AI future and you believe in NVIDIA because of it, sort of by default, you have to believe that it's going to be really tough for any individual little company doing these things to make a bunch of money, because the idea is that like there's a massive market of competing robot companies that would be doing this stuff. So yeah, Serve, I would say, irrespective of NVIDIA, is just not for me.
Fair enough. And it looks like we're at the top of the hour, and we have Tyler here, and it looks like, and Jayson is back.
Yeah.
Yeah. So I don't know if it's my
folks.
internet. I'm going to go ahead and caution everybody that my internet just got really crazy laggy. So hopefully it doesn't continue, but you have
Let's
been
blame
warned.
Tyler. He's out there in the boonies.
There you go. There you go.
Yeah. I mean, I think it's kind of funny that I'm 9 time zones away, and somehow my internet seems to be working better than yours, buddy.
Yeah, it's weird. All right, Seth, Danny, we'll see you guys next time.
Peace, guys.
Hi, Tyler.
Jayson, we were just on a couple hours ago. Are we here? Are we back to do another 30 minutes on home builders? Because I'm sure that's what America craves. Actually, the world craves.
Oh yeah, no, I think we could even go outside the solar system and say that the galaxy craves it. But I think maybe it fits within the theme too. How to find multi-bagger stocks. We'll see. They might come up. It might come up a little bit, but it's a great theme, and it's going to be a good conversation. We're going to talk about some things we've learned through our career as investors, how we find potential multi-bagger stocks. We want to hear from fools, Motley Fool members. We want to hear from YouTube streamers as well. If you have questions about investing, about stocks that you think maybe they're multi-baggers and you'd love for us to weigh in, or maybe just questions about some of the things that we talk about that you want clarification and engagement on, ask those two. Go to slido.com. The event code is Fool24. Now, just remember, we'll answer your questions if we can. Sometimes I'll answer the question even if I shouldn't. But what we will never do is we will never tell you what to do. We are not going to provide anybody with individual or personalized financial advice for a million reasons. It's not something that makes sense for us to even try to do. So we won't. We'll share our opinions and thoughts, but that's about the end of it. Right, Tyler?
Yeah. I mean, like, as always, we'll give random opinions and maybe some advice on non-investing related things, buying houses, or I don't know, Jayson's solar system that's in his house and how to get solar tax credits in the state of Massachusetts. But, actual personalized financial advice, that's a third rail.
Yeah, we're not going to touch it at all. So, all right. So, Tyler, I say finding multi-bagger stocks. What does that say to you, and where does your mind go? Where does your brain go?
Jayson, it goes in a lot of different places, and it kind of goes back to, I'll just say some downtime that we've all had, and I used some of my downtime a while ago to just do a random study once. I was like, what are the multi-baggers? What are the companies that have just trounced the market over the long term? And so, I trend less towards the new ideas and more or less of what has worked over the long term, and is what's possible that could work over the long term. And we know all the great success stories, and there's lots of financial writing and financial marketing around the Amazons in the world and the Netflixes. And God, it used to be TripAdvisor. Is it Booking.com now? Because I remember TripAdvisor used to be one of the spectacular stock gains of a long time.
Booking.com used to be Booking.com used to be Priceline.
Priceline. That's what I'm trying to remember. Not TripAdvisor. Sorry, Priceline.com. So lots of these other companies that over the years were spectacular winners. I mean, you and I are gonna go celebrate at the altar of Warren Buffett, which was one of the famous multi-baggers of all time, coming up in here in May. But there are, if you start looking across the gamut of everything that's out there available, there are pockets of outperformance and wonderful multi-baggers to be found everywhere. It just involves turning over a lot of stones. And so, not only in the multi-trillion-dollar companies do you find multi-baggers, you can find them in small caps. You can find them in mid caps. You can find them in foreign stocks. They're to be found everywhere. And it's kind of the job to be the truffle pig or the truffle hound to go sniff them out, because they're out there. You just have to find them. Some of them are much less common than others. And as far as finding them, I don't know about finding the ones that haven't yet been multi-baggers that will become them. But when it comes to the ones that exist, I mean, there's plenty of market data that we could all comb through and find them.
Yeah, they're out there. And it's not just, like you said, the big popular ones. There's lots of paths here. I want to say that I think there's also kind of an anti-path that a lot of people fall down the path of, and down that road is typically nothing but investing losses. And that's thinking that you have to buy stocks that trade for small dollar numbers or even penny stocks in some case. And I think to a certain extent, Tyler, the financial community is a little bit responsible for that, because we'll share charts showing these massive winners when the stocks traded for a few dollars a share or $1 a share or less. But what we don't then explain is that that's split adjusted, right? These companies have gone on to such big runs with their stocks that they do 5-for-1 or 10-for-1 stock splits. And that chart that shows that makes it look like Netflix stock traded for $4 a share, it was actually $40 a share back then, because it's done a 10-for-1 split since then, or 1-for-10 split since then. So, and what we end up buying are things that are marketed to be great, fast, get rich fast opportunities that are generally not. You know, they're shells, they're marketed, they're not actually regulated, because you can get some of these over-the-counter thinly traded stocks that they don't actually have any audited financials that roll up through a regulator, because these are such small, low value entities. So, and a lot of investors don't realize that market even exists, that you can buy these unregulated entities that don't have to go through a fully audited process with an auditor that actually is regulated and licensed and has a reputation for doing the right things, on the same brokerage that you could also buy Apple, right? Or one of these really high quality companies. And we fall down that path of trying to chase low dollar stocks into big dollar gains, and not realize that the valuation of the stock is detached from the dollar price of the stock.
Yeah, and as I think I did in a long form kind of discussion about penny stocks we had over the weekend here on Full 24, there was kind of the idea of like, even penny stocks, small cap stock, large caps, you put any adjective in front of stock that you want. The thing that matters the most is the business and the way to, and the business's ability over the long term to create value durably for a long time. Because multibaggers is I think a little bit of a misnomer, because like people think multibaggers and it's like, oh, a stock that will double or triple in a year or two, which that's, in my opinion, that's not multibaggers. That's just the manic or the hysteria of the market for the most part.
And they're exceedingly rare. They're exceedingly rare
Right.
too. We see the Nvidias that, let's be blunt, Nvidia has earned the massive gains in its stock price over the past 4 or 5 years, because they've spent a decade before that, really 20 years before that, building the technology and the platform that's allowed it to be so massively successful in this massive investment in artificial intelligence infrastructure. So again, it feels like it happened overnight, but it was 20 years coming, right? 20 years in the making for a company like that. It takes generally a long time. And if you're earning 10 to 15% per year in annualized returns, you're probably doing really good. And to further contextualize what multi-bagger looks like, the market over the long term has averaged a little better than 10% a year in annualized returns. So that works out to, if you get that long-term average, you double your investment every 8 years, right? That's a double in 8 years. That's a multi-bagger, right? You've doubled your money. So when we're thinking about multi-baggers, we're talking about trying to do better when we can, but also we're not talking about it happening quickly, right? Because in the near term, we just don't know what the market's going to do, macro conditions, all of the things that affect sentiment, and sentiment drives the market, particularly in the short term. But what happens over the long term? Because I can promise you, investors right now are at a very, very low point. And a lot of consumers are at very, very low points in terms of their expectations for the economy, investors' concerns about the market. And we could have said the same thing about the market back in early March of 2020, when the pandemic was really starting to kind of roar its head. The market is up a ton from then, and the sentiment was probably lower from there. So what's happened is the companies are earning more money. So the value of those companies has increased in terms of contextualizing the whole weighing machine versus voting machine. We've weighed the market as being worth more now, even though we're voting it down in the near term.
Yep. And it works both ways, right? Like I think the story that we talk about, because you and I got, I wouldn't say we got our starts, but a very formative part of our investing lives was, investing in like 2009, 2010, 2011, the post Great Recession time, where a lot of businesses were on the verge of collapse. Businesses were struggling a lot, and many great businesses were weighed very differently, because people were taking money out of the market. I mean, it almost sounds crazy today when you say it out loud, but it's like, I remember Apple trading for less than 10 times earnings. Like, I remember it, 10, 12, 15 times earnings for a very long period. And this is that idea of the weighing machine and how we have to look beyond this, because there are going to be times where multi-baggers in your portfolio, or ones that you have picked along the way, are going to be trading for too much, or value that is crazy because the market is valued highly, and then conversely, there are going to be times when they're not. Just the example of Apple back in the 2010s, and when Tim Cook got started, I think in the late 2010s as well. The ability for the businesses to create value durably over the long term at a rate that is better than 10 to 12% has, for the most part, been one of the biggest key factors in developing the hundreds of multi-baggers that are out there. They durably create value regardless of what the market is telling you. Some have been lifted by the euphoria of the market over times, and some have earned higher premiums. I actually see a question in here about one of those that we can get to in a minute. But some, while others have just, it's all about just the business. And so when you go to look for them, business matters more than anything else.
It really does. And the catalysts, here are the catalysts that can drive value and move a company's stock price higher. One thing is expansion of the multiple, meaning the price to earnings or price to cash flow or whatever multiple you're using. Investors voting up that multiple that they're willing to pay. That has always proven to be a short-term catalyst. It never turns into a persistent, decades-long driver of value. It moves up and down with how the market is broadly thinking about the valuation of stocks against things like interest rates, economic growth, the market that it's in, other factors. So it's a nascent thing that can provide some uplift for a period of time. The things that can create higher stock price value over time really are tied to a company's ability to grow earnings per share and or free cash flow per share. Now, what are the two levers that a company can pull to grow earnings per share, free cash flow per share over time? Growing earnings, number one, you grow your earnings over time. And if you're growing earnings at a faster rate than you're growing your stock count, because most companies issue stock-based compensation to some degree. So you grow earnings per share at a faster rate than you're growing your shares outstanding. If that price to earnings ratio over the long time, that multiple stays steady, your stock price goes up. But you can also decrease your stock count, right, Tyler? So companies that are able to both grow earnings per share over the long term while earnings over the long term while decreasing shares outstanding are the ones that have proven they can really supercharge shareholder returns by growing your piece of the pie at a faster rate than they're growing the pie itself.
Yeah, I always like when share buybacks to me, and that sort of analogy. I always like to think of 1990s, early 2000s National League baseball, like bunts and sacrifice. You always heard this the topic of manufacturing a run, where it's get somebody on base, move them over with sacrifices, and then they come home on a sacrifice fly or something like that. It was like manufacturing runs. Buybacks to me is manufacturing earnings per share growth. It's taking a slow growth to maybe even no growth business that throws off a lot of free cash flow and doesn't have a lot of other things to do with it, and just buys back the stock and reduces the share count, and can take a business that's maybe growing its revenue 1 to 2% annually that doesn't look great, and all of a sudden it's growing its earnings per share by that 10 to 15% range that we're talking about. That is growing and manufacturing value. And so there are the ways in which companies can create value over the long term is far afield. It's not just developing the most advanced tech. Actually, sometimes that rarely actually works out, because tech it's a copycat league and everybody starts to adopt the tech. It's rarely, the one rock star CEO, because eventually that person's going to leave and somebody else is going to. So it all comes down to just the bare bones of creating value on a per share basis that we can all basically take to the bank. And on that, let's talk about a very, this is what we would call, this is a multi-bagger in one of the most unconventional senses. And Vihan asked about it 2 hours ago. So I want to
Cintas, right?
Cintas. If for those of you who do not know it, get to know it well, because when we talk about multi-baggers, this is one of the more like prime examples of a multi-bagger stock that you just didn't realize even existed half the time. I'm going to share the screen to give everyone a sense of the multi-bagger stock that is laundry services in North America. This is Cintas's price chart over the past close to 35 years. It is a 27,000% total return compared to the 3,310% total return of the S&P 500 over that time. Any chart that makes the S&P 500 look like a flat line is a beautiful, beautiful thing.
So let's be clear. Let's talk about that orange yellow line there. What is it?
3,300%.
So that turned every dollar you invested in the S&P 500 into $34, right? So $100,000 would be $3.4 million. That's what the S&P 500 did over that period. I want to contextualize. That's really good. People, that's really, fantastic. Really good. It's not like this was a period where the S&P did bad.
No, but we despite that, and the idea of it being a very, very good return with all of the considerations of what NVIDIA has done, what Microsoft has done, what the Mag 7 have done, and in lifting the S&P 500, and yet here we are discussing laundry and uniform rental. So I just wanted to take that chart, and then we can get to Vihan's question, which was more specifically, can you talk through Cintas's valuation today? At what point do you see this attractive? So uniform, I'm being very blasé. Uniform rental is kind of the component for it, where basically like any business that needs laundry services, restaurants, hotels, auto mechanics, or basically anyone who like runs through a business that actually has like uniforms or laundry or anything like that, but don't actually have laundry services. That's like Cintas's core business. They have expanded beyond that to, hey, while we're in here, do you want us to just take your like welcome mats and we'll take them home and clean them for you too? Hey, all your like your first aid kits and your safety equipment, do you want us to check them while we're there? Hey, restaurants, those really messy like fryer later hoods that nobody wants to clean, do you want us to take care of those for you while we're in it? And that's the kind of business that Cintas has developed over the years. It's just like this, servicing businesses and doing those essential functions that nobody really wants to do, but are incredibly valuable, and somebody is very willing to pay for them because they're not necessarily like a huge line item expense for the business, especially one that hey, it's a lot cheaper than putting a whole full laundry service down in the basement of my restaurant. So wonderful, wonderful business, incredibly high returns. As to the valuation, it actually just reported earnings and upped its guidance for its fiscal year. And so its stock's almost up 7% today, which is insane for a laundry company. As far as valuation, this is where I have to eat a lot of crow, because it's a company I owned and actually sold because of valuation concerns. Cintas to me is very much like, is approaching that Costco sort of like stock, where it's like, this is an incredible business. I want to own it forever. Why on earth would anyone pay 50 times earnings for it?
Right. Right.
It's a spectacular business. It's a little bit, yes, it's going to kind of go up and down with business activity, restaurant activity, things like that, general spending in the economy because of what it is. And so if we were to see a protracted recession, a company like Cintas would be affected. I've been saying that for 15 years. And yet here we are today with a company that's grown its its net income from 400 million in 2015 to 1.7 billion today. This is one of those ones that always makes me look stupid because I keep looking. I owned it for a long time. I should have held on to it. I sold it because I was like, how is this thing going to grow into a 50 times earnings valuation? Because it grows well at about double-digit rates, but for close to 50 times earnings, that always seemed a little crazy to me. But when will I see it attractive again? Obviously at a much lower valuation than where it is today. And it's one of those, there's probably like a dozen stocks in a box right next to the my just off camera here, and it says in case of a recession, break glass, and it's just a buy list of companies that I want to buy in a recession. And Cintas is like one of the 12 on that list.
Yeah, it's tough too, because I mean, one of the parts of this, the idea of finding multi-baggers, and this gets a little bit to something Bestie's put in here, is not looking for the multi-baggers, but finding businesses that can compound their earnings per share, right? That's really the key, is finding the companies that have the characteristics to do exactly what you described with Cintas, with being able to more than triple its earnings over the past decade or so. Valuation is important in a couple of different ways. So number one, if we're looking at, and we're talking about younger disruptive businesses that are still early in their, whatever their trajectory is going to be, where they're a small fish in what they're trying to develop in a very big pond or an ocean, right? That's when paying a higher valuation multiple, even something that might look ridiculous, might make sense when you do a little bit of math and you look at their growth rates and the operating leverage and their ability to start generating free cash flow as they expand in that market and take more and more share. And you realize 5 years, 10 years from now, today's price that looks like there's nothing about it that makes any sense. It's pretty easy to get to a multiple that's a reasonable multiple, and this to be a potentially a multi-bagger investment, right? For those sorts of businesses. But when you're talking about the Cintases of the world, the Homebuilders of the world, where you have stable businesses that are not growing revenues at 25 or 35% a year, with a pretty long tail of continuing to be able to grow at those sorts of very, very high revenue growth rates, valuation becomes more important, because time and execution of the business, that's really kind of your margin of safety for those, exceptionally high growth businesses. But when it's a more stable business, more of like the compounder today, you need to get valuation directionally right to have better margin of safety and improve your odds of getting those really strong compounding results. I think that's an important thing to mention. So to answer that question, I think starting with the finding the kind of businesses that have the features, you could say, or the characteristics to compound those earnings is important. So Tyler, you mentioned with Cintas, it's like the secret formula there is doing things for businesses that are really important for those businesses, but that the businesses aren't really built to be able to do very well. But also you can do it at a price that's really profitable for you, but totally makes sense for them to not even bother with trying to figure out how to do it internally, right? So for Cintas, that's their market. What are some other businesses that have kind of like they've figured out the formula that's something similar?
Yeah, I mean, there's tons of them, right? And it all comes to, it's not just like the business itself, but it also comes down to like, just the quality of the operations too. Because being a good operator in any industry matters a lot. But I'm thinking of things like taking out the trash, owning rock quarries, being distributors, insurance companies. There's so being like a parts supplier, an aftermarket parts supplier for the automotive industry, or being an automotive retailer. Businesses like this that serve core functions that for example, like the automotive parts retailing, I can guarantee you that Ford or General Motors don't want to own Ford's parts stores or General Motors parts stores, or, things like that, or that would, maybe be a benefit to its customers, but the cost to them would be so high and so prohibitive that would never be worth it. So you get into these, niche businesses like this, that I guess they're niche, but I've been wading in these waters for so long. They seem like the most common companies in the world to me, but businesses like this that execute incredibly well and serve that core function. And to add on to that idea of finding those kind of businesses, I'm not going to say this is a fail-safe way of finding them, but one common trait that you tend to have for businesses like this is, I would call them good but not great returns on capital. Somewhere in that 12 to 15 to 17% range, where they're making good returns on their money,
but they're not so big
so,
that they attract external.
they're not so big that everyone's like racing to compete with them because they're seeing the returns on those businesses, which, that tends to be businesses that last a long time, are exceptional operators, and can keep the competition at bay from some sort of, hey, we're pretty good at this. It's kind of hard to do. And it's not like the returns are so good that you becoming our competitor is really worth it for you.
Yeah, no, I think that is a big key that's attractive. I also think that there are often opportunities. Lou Whiteman and I, or you and I, talked about this pretty extensively earlier today for half an hour talking about home builders. It came up again when I was on Andy Cross a couple of hours ago, home builders. But one of the areas that I have found compelling are cyclical industries that have great secular tailwinds. Home builders right now, for an example, and this, when I first learned this with home builders, was back in the early 2010s, like 2013. I made my first investment in home builders. I bought a little bit of Meritage Homes. Fast forward a couple years later, and the stocks were in the tank. They were down a lot. And I could have just sold the stock and said, "Oh, you know what? That's a dud. I'm moving on." But I had spent the preceding 2 years while the stock was going down learning about the home building industry. I was really drawn to the fact that during that whole, really 2009 through 2013, 2014, we were underbuilding geographically. Also, the mix of properties, we were underbuilding, and it was creating this secular trend of need to build more housing at the same time that we were seeing millennials really kind of come into their own in terms of a generation with spending power that's going to want to own homes and do those sorts of things. But what happened is when the industry tried to ramp up, they got a double whammy. There were some macro things going on with lumber, where lumber costs were high. Land was challenging to get. And the industry had just been a half decade downsizing. They didn't have enough skilled labor. This young skilled labor had moved to other industries where they could actually earn a living, and older laborers had retired. So the industry, while the tailwinds were positive, all of them were being pressured on their costs and their pricing, and they were getting squeezed on both ends. And as a result, the stocks were down in the dumps, because I knew about the industry, and I knew, hey, secular tailwind. This is really good. Secular tailwind. Cyclical period right now, where it's like it's time to be a little counter cyclical. And I made some of my largest investments in home builders during that period. And that 2013 buy has vastly underperformed the S&P 500. Those 2015, 2016 investments that I made have more than doubled the S&P 500. We're talking 350+% returns over the past decade. It's wonderful to get. And again, it's not timing the market. It's understanding business cycles within the context of the larger trends and the larger tailwinds to accumulate when the market is giving you an opportunity, because the long term looks really good. And as long as you have the capacity to get through whatever the short term painful cycle is. So that's one thing that I think about. Now, I also, looking beyond like the cyclical businesses and those longer trend cycles, really finding great operators kind of that have carved out a niche. You were talking about with a lot of distributors that have done well. But Kinsale Capital as an example. This is one, to answer a question we got in here. What stocks have ever bought that when I bought them that I expected them to be multi-baggers? When I first invested in Kinsale Capital, I had expectations that it could absolutely be a compounder, because you had a management team that built an insurer from the ground up that didn't have a lot of the legacy pressures that larger insurers have, and that was also laser focused on, compared to the size of that business, a very, very large business in the excess and surplus lines. And even it specializes within E&S versus the size of the giant insurers in property and casualty that largely don't really even play in the space that it operates in. So you have an exceptional operator that's really, really good in what it does and has found a niche that is orders of magnitude bigger than it is, that it can be wildly successful in. And this is not one that gets those return metrics you were talking about. Its return metrics are kind of off the charts. They've been exceptionally good, but it hasn't really dealt with competition. And at some point, if it does deal with competition, it's because of the cycles of that industry. So sometimes you just find the very best operator at the right time, and you buy and you don't look back.
Yeah. So we lots of questions on multibaggers and some company specific ones. I need input as a question on highest conviction ones. We're going to punt that for the grand finale, I guess, if you will. So
yeah,
let's keep that one. We're going to leave that for our last question and keep everyone waiting with bated breath on best multibagger ideas.
I got us on the clock now, buddy.
Okay, so we're on the clock, and it's both to declare our multibaggers and to keep Jayson from talking about Brookfield for 20 minutes.
We got to get me off Homebuilders right now. That's the key.
I know. Between Homebuilders and Brookfield, we've really filled up some space here lately. So Ed, this is actually an interesting question, because this is a company we've talked about a little bit, and I think it'd be worth updating. Ed asked 15 minutes ago, any short-term concerns with UPS possibly reducing the dividend due to headwinds in the economy and maybe not having enough cash on hand? So, I don't know if it's headwinds in the economy that would concern me about the dividend specifically. What actually concerns me more about UPS's current dividend policy is the recent decision to, unwind its position with its agreement with Amazon for its parcel delivery, because it was the right thing to do. I'm not going to, say that it was a bad move. If you look at FedEx, they did the same thing. It was the right move for them to do. Amazon parcels and business to consumer, like e-commerce shipments, is a super high volume, pretty low margin business.
Right.
And
right.
And
it's also
time,
a business that Amazon is making it clear that they don't want to pay anybody to do. They want to take this on themselves.
Yeah. So, there was a period during the early stages of e-commerce growth where you had these, slow growth package delivery businesses that, they grew at relatively low rates for a long time. And then they just got like those like Looney Tune eyes where they saw like e-commerce growth and like, holy cow, we can ride this to growth heaven here. Yep. And the challenge is with something as complex as logistics of parcel service, it takes an immense amount of infrastructure to do this with your warehouses, with your your sorting lines, multiple cargo planes. Like you start running down the list of all the assets that make it possible to do like business to consumer, like 1 day or 2 day delivery services. It is baffling. Like I almost feel like you want to go to that like sorting house in FedEx is Memphis. I don't know where UPS's like main hub is, like, FedEx is head, but let's just use FedEx, for example. I bet if you went to their sorting hub and distribution hub in Memphis, it would blow your mind to see like the amount of like work that goes on in that facility at any given moment.
Yeah, it's
the challenge now.
UPS is in Louisville, by the way, so not too awful far from Memphis.
Not too far away. Yeah. So you've built out all of this capacity to do e-commerce, and not just e-commerce at any given time, because it is so cyclical. You have to do like all that extra additional capacity so you can get people's presents to them at Christmas time. So like the capacity that you had to bring for all this was massive, and it was relatively low margin. By ending this contract or this agreement with Amazon, and focusing on business to business, it is a much higher margin business.
Yep.
But it seems to me like you're going to have a lot of idle capacity. Your volume is going to go way down. And when you have like idle capacity for like, you're just thinking like on the manufacturing comparison, idle capacity is dead money. That's stuff that costs money to maintain.
It's worse than dead money. It's vampire money, because it's you have to spend money to maintain it to some degree for this asset that's not generating any productivity for your business.
Yeah. So my concern would be in the short term is as the business kind of adjusts down to the size necessary to be a business to business parcel shipper again, to get into the healthcare side of shipment business that they want to get into, and repurposing a lot of these high volume, fast transaction sort of businesses, it's going to take a lot of capital to make that transformation. There's going to be a lot of dead capital for a long time that just eats into free cash flow. And for a business that pays a pretty generous dividend, to have to require that much capital to make a business transformation, it is not absurd to think that management is going to stare at that dividend payment and probably the billions of dollars that go out the door every year and be like, we probably could use this for a couple of years. And so I'm not saying it's going to happen, but anybody who's invested in UPS has to consider that is within the realm of possibility over the next couple of years.
I'm going to share some charts to kind of hit home with some of this for UPS. So what you're going to see right here, net income is the yellow line, and it's come down from the peak we saw from 2020 and 2021, right? The e-commerce explosion days, right, which were really good for all of the shippers. And the other line here, the negative number, this is dividends paid. So you'll notice that, about $5.8 billion in net income over the past 4 quarters, $5.4 billion in dividends paid. Those numbers are getting awful close to one another. Let's throw free cash flow on here, because dividends are paid in cash, earnings aren't exactly free cash flow. So again, $6.2 billion in free cash flow. That number started to kind of come up a little bit. So the deficit starts to, or the spread between the two gets a little bit better, right? But to Tyler's point, bluntly, UPS is trying to shrink before it can grow. This is what they're trying to do. And there's things that they're going to do in the interim over the next year or so as they continue to fulfill their obligations to Amazon under the contract to try to bridge that gap. The question is, how much are we kind of at a floor with its earnings and cash flows or not? And I think I lean towards the answer being maybe we do see some continued deterioration. That's before we even consider what the macro environment could look like. And it might not be great. And this could look like terrible timing to have decided to rip off that Band-Aid, Tyler, with that transition. So I think there's some risk there with the timing just not working out. With that said, with regard to the dividend, because I do own it, I own it in part for the dividend, but I don't need the income now. So I was thinking a risk reward when I made the investment. You look at the balance sheet. I'm going to throw that on. I'm going to pull these other numbers off just to clean up the chart here. You look at the balance sheet, $21 billion in long-term debt, which they've actually reduced over the past 5 years, $6.3 billion in cash. So that cash is a pretty decent margin of safety to allow them to continue to be able to fund capital investments without having to change the dividend plan right now, without having to reduce or halt. I don't think that halting the dividend would be something we would see, but potentially slowing the growth, I think, is a much higher probability. Maybe even not growing it at all for a period of time, depending on what happens over the next year or two. But they're in a position where they don't have to do anything at all right now, but continue as they're going and probably be fine. The question again is the shift in their business, and this isn't a turnaround as much as it's just a refocusing on where they're going to find the best profits and building the business that they want it to be. We don't completely know the answer. I think on if I were to lay odds on it, I would say there's a 25% chance the dividend gets cut. I think there's a 75% chance 90% chance the dividend growth slows, and a 75% chance that the dividend doesn't get increased for multiple years from here. So it's risk reward. Tyler, you want to take the stock splits question?
Yeah, we'll hit this really fast. So Sanjar Hakmi asked, what stakeholders truly benefit from stock splits? Does anybody anymore? Look, I'm being facetious, but the importance of stock splits, in my opinion, has declined precipitously with the technological advancements that have come for most brokers. I can't speak to everyone, but for the most part, most brokers these days, you can buy fractional shares, you can buy dollar-based amounts. The actual cost of any given share in a moment has kind of lost its value. Often, for the longest time, they would do stock splits because you had to buy stocks in lots, and lots meant 100 shares at a time. And that's where you get the term odd lots, was basically less than 100 shares of a stock. And so often shares were split and things like that to make a lot or an amount palatable for an investor to make. At the same time, back when the Dow Jones Industrial Index was the thing for people, it was the the pure signal of the market. It truly is. I think in the 12, 15 years that you and I have been doing this has been that shift. At the beginning, it was the Dow. People cared about the Dow. That's what mattered. Today, it's the S&P 500. It's really shifted. And so, the Dow was a price-weighted index. It meant the stock price was what mattered versus the market cap. And so sometimes companies would, there was a price range that companies had to be to stay within the Dow, and some of them would do stock splits for that very reason. So those are kind of the more older reasons why. Some people might say liquidity and things like that, or I don't know, maybe Warren Buffett's or Berkshire Hathaway at $600,000 a share. That one could probably be split, because selling one share at $600,000 is a pretty big.
There's B shares.
Well,
that's
I know, but
even though they don't have the same voting power, that's his answer. I think there's
hashtag life goal.
There you go.
A share.
There you go. I think there's also a little bit of a benefit from insiders. And when I say insiders, I'm not talking about people on Mahogany Row. I'm talking about employees that get stock-based compensation. So as we've seen stock prices move into the many hundreds of dollars, and even a few cases into the thousands of dollars, it's easier for companies to offer stock-based compensation across a larger swath of employees when the stock price is lower per share of stock. So there's some cohorts that have benefited. The research is mixed, though, on whether stock splits are really, they're not value creative, right? Because it's the businesses, everything we've talked about, that's the business ability to grow earnings per share over the long term. That's where the value is created. And splitting your stock doesn't really do much to help that. Sure, maybe improves access to capital markets with a lower stock price if you're doing secondary offerings and that kind of stuff. But these are all just edge cases, marginal things. It's good PR for a period of time. I think that's the biggest benefit of it for companies. Real quick, Andy, thoughts on Bank of America, ticker BAC, versus JP Morgan Chase, ticker JPM. So, JP Morgan's become the gold standard in terms of, the best run and the biggest by assets bank in the U.S. Jamie Dimon has done an exceptional job of running JP Morgan. It trades for an extremely rich valuation. They've, like other companies, they've earned it. If you look at their return rates, they're exceptionally high. Return on assets, return on equity over the long term have done very well. Their investment bank is exceptionally profitable. It's the bank of choice for the Fed when they want somebody to take over a bank that the FDIC has had to seize. In a lot of cases, they got First Republic because they knew it would be a good operator and that its depositors would be protected and safe, and that they would handle the transition really well, and they largely have. So all of those things make it really attractive. I think it's untouchable at these multiples, though. It's so expensive to me. Bank of America is not cheap, but it's more of a fairly valued bank. It hasn't earned the levels of returns that we've seen, but in terms of Brian Moynihan has taken this business that was deeply, deeply troubled 15 years ago And over the past decade, it has turned into one of the more well-run of the largest banks, and they do a solid job. But either of these, I think you have to buy counter-cyclical. You buy them when they're deeply discounted because of concerns about the economy, but the businesses are perfectly strong. I can't make the case that for either one, that I think either one is worth buying at today's valuations. What's next, Tyler? We got a few more minutes here before we wade into more multi-bagger territory.
Quick follow-up from Besties saying Cintas went way down big before any earnings. Any idea why? Was that valuation low enough? As to why it went down before earnings, who knows? I mean, it's the daily machinations of the market. I don't think there was anything that was like so wild that it was, thesis changing for this business. I mean, it went from 12% gain year to date to a 3% gain, and now it's back to 14%. So like, I don't know. I'm sure there's somebody on CNBC that could give a 20-minute soliloquy as to why Cintas stock went down, 5% or 7% in 2 days, but I'm not that person. And as far as valuation, no, right? A few percentage points is not what I'm talking about. When I'm talking about valuation at Cintas at 50 times earnings, I'm much more comfortable in the 25 to 30% range of earnings to reacquire this business.
One more real quick before we hit the 10-minute warning on the show here. Rita S. writes, Lindy, ticker's LIN, a great company with little growth in the stock. What say you? I mean, if you look back over the past year, it's easy to say that the stock's roughly flat. And it's funny because we say flat, but it's not flat. It just looks like it's climbed up a mountain, then climbed back down the mountain and started back where it ended. But it went down a lot, went up a lot, went down a lot. And now it's back, kind of back where it started, down about 1% over the past year. But you start stretching that stock out over the past 3 years, it's up 44%. That's about 13% a year annualized. Over the past 5 years, caveat, ding, 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 ding. We're ringing from the low, the crash, the pandemic crash. So 23% average annualized returns from that period is up 180%. Just to keep things a little more adjusted, we'll go back to February before the crash. Still up 17.6% average per year over that past 5 years, 128%. 10 years, stretch it out. 14.
How about we go even further?
Yeah, there you go.
How about we go even further back?
There you go. So
because this to me, and I think Jayson will agree with this, this is kind of the concept of like the multi-bagger.
This is a compound.
The compounder, whatever you want to call it. Look, Lindy is the type of company that, month, week, 6 months, year, who knows? Like that's just basically how the market gets out of bed in the morning and decides how they want to value this sort of company. But the business fundamentals of industrial gas is right up there with the Waste Managements and the Cintases and the Costcos in the world in terms of compounders. It is a spectacular, spectacular business that, we could maybe, I think you and I could do a whole hour on industrial gas companies if we want to put everyone to sleep. I mean, we already did Brookfield. We did 30 minutes on home builders. Why not?
Let's do industrial gas companies.
Whole hour on industrial gases.
All right. I want to spend another second talking about Lindy though in the near term. So yeah, the stock is roughly flat over the past what is it? Yeah, it's roughly flat over the past year. If we go back to the beginning of 2024, getting to the beginnings of a quarter for earnings purposes, the stock's up roughly 12% since then. It's grown earnings per share about 8% since then. So the earnings multiple is roughly it's up a little bit. It's kind of flat, but what you've seen over the past year is really the earnings multiple is just compressed because over the past 3 quarters, earnings are up about 6% per share, and the earnings multiple has fallen a little bit. And I've consistently said the challenge with a company like Lindy's, when it trades for 34 times earnings, which is where it trades today, I think that's a little on the rich side, but it can absolutely compound. Grow your earnings per share, grow your earnings 6 or 7% a year, buy back a few percent a year of your stock. All of a sudden you're looking really attractive. Throw your dividend on top of that and it's a low yield, but then you can grow it because you're growing your earnings per share, because you're growing earnings and reducing your share count. Add all of those things up And before you know it, you're doing better than the market over the long term, because your customers are not switching. You know, they're literally directly piped in from your facility, literally directly piped in from your facility. They're not going to leave you. Your big customers, your what do they call them? The flagship, not flag, anchor customers. And then you've got a 200-mile radius around you where you're able to sell at prices that nobody else in the area can compete with, because they're having to deliver from 300 miles away. So wonderful, wonderful, wonderful business.
Just like rock bits.
You just got to zoom out, though. You just got to zoom out. All right. We got 6 minutes left. You ready for
grand finale? Dun, 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 dun.
Okay. I need inputs question. Hi, Jayson. Jayson. I'm Jayson, apparently. Hi, Jayson and Tyler. Based on the theme, what are your highest conviction stocks at current levels that could be multibaggers? Tyler, I want you to start.
You already know what I'm going to do. So here we go. Let's go to Mexico and talk about discount grocers. BBB Foods is the company I have been looking at for a very long time. Company I own, company I think could be a multi-bagger over the long term. Hard discount grocers. Anybody that's been to a grocery outlet bargain market, a Lidl, an Aldi, basically all those like no frills grocery stores, stuff's on a pallets on the floor. You know, we're trying to turn inventory here. We're not trying to impress you with plate presentation. This is the kind of business that BBB Foods is. Very, very smartly built business to tailor to its customer. You know, so, like down to the minute details of like, we know they're going to walk to there and go 2 to 3 times a week. So all the groceries that they want to get need to fit in 2 paper bags that they can carry in their arms. Like, this is in the IPO perspectives. That's the kind of things that they think about when they built this business. And it is showing same store sales are growing at double-digit rates for multiple years now. They say they're going to report earnings on April 7th. So we'll get an updated store count. But as of the most recent third quarter, way back in like November, they said that they had about 2,600 stores. Their white paper analysis says they can do 20,000 across all of Mexico. So ample growth on both the per store basis and on the like store count basis, which is a nice 1-2 punch when it comes to grocers. And like I said, double-digit store growth and just an exceptional operator. Inventory turnover is huge in groceries. That's how you generate your returns. It's low margin, but if you turn your inventory over, it's a work of art. And they have some of the best inventory turnover metrics I've ever seen in a grocer. Like, I think it's like 19 times of their inventory every year. And Kroger, which I think is arguably the best grocer in terms of operations in the United States, does like 14 times inventory turnover.
There you go. They're good at what they do. So, all right, I'm gonna bring up a stock I haven't talked about in a long time. I think we're getting to the point where the risk reward is getting exceptionally attractive, and that's Live Oak Bank shares, ticker LOB. So Live Oak Bank shares target market is lending to small businesses. They are one of the best SBA loan banks out there. They know that process. They're an approved SBA loan, Small Business Administration loan operator, provider. The stock went gangbusters. You go back during the financial crisis, or excuse me, during the pandemic, because there was free money out there to get with the payroll protection plan loans. And they were already targeted and focused on small businesses, which are the ones that needed it. So they got a lot of free money with these government-backed loans that they were able to just do exceptionally well with. We're at a point now where those loans are off the books, and the books are completely clear of that. And it trades for 1.2 times book value. Considering the long-term growth potential, how well they've proven to be a good originator, being really mindful about finding industries to grow into, understanding those industries, the puts and takes, but focusing on industries where there's profit and there's opportunity, number one, where they can lend responsibly and find growth. They've done so exceptionally well under Chip Mahan when he built this bank to do this. They're starting to grow from being just an online saver deposit funded bank where just it's people like us that are putting money in CDs online, and they charge those, they pay high yield deposits. They're starting to grow their banking relationships with small businesses as well, which is increasing their funding. So they're going to continue to be that high yield online savings bank as well. So they have diversity of funds, but they're going to be able to grow their fees business with these small businesses as they grow their banking relationships. And I think they're going to be able to consistently outcompete all of the small banks and the regional banks that are their largest competitors for lending. Because if you're a small regional bank and you've got a vet clinic in your town, the owner's done really well, and he wants to buy the vet clinic in the next town over, you don't really know how to originate that. And what you're going to do is what you're going to do. If you're Live Oak Bank, you got hundreds of vet clinic customers. You know that industry exceptionally well. So they're going to be able to outcompete a lot of other banks, I believe, and get better returns. And I like the return profile of the business because they don't have branches all over the place. So if they can turn their specialization as a lender into still providing value as a banking services provider to these banks, that's the unknown. But again, a 1.2 times book value, thinking through the cycles, Live Oak is getting really compelling to me.
And that leaves us with like 30 seconds left. Jayson, that was like, we timed that so well. It was almost like Tchaikovsky's 1812 overture, where all of a sudden the cannons are just blasting off at the end, because we just did a whole hour on multibaggers and we didn't talk tech at all. We did home builders, we did garbage, we did uniforms, small bank lenders, grocery stores, multibaggers to be found everywhere.
Well, we needed to leave for Danny and for Will. Make sure there's plenty of tech and consumer goods companies that those two guys could talk about. So you're welcome, Will. You're welcome, Danny. With that, Tyler, you and I, we're done. We're giving you guys back some time. You can kick your look at that. It's 2:00. It happened just like that.
Nailed it.
Full on, guys. Hello and welcome to another hour of Fool 24. I'm your host, Will Healy. I'm joined again today by Danny Vena. How are you?
I am doing remarkably well, considering that it is cool and cloudy in San Diego, but I am just as enthusiastic and upbeat about my Hawaiian shirts as always.
Well, that's good to hear. I'm dealing with some cloudy weather here in the Dallas area as well, but at least the temperatures are nice. So I'm happy about that. Today we have an Ask Us Anything show. However, we are going to focus on the ultra discount retailers.
Yeah, go ahead.
Oh, yeah. And by ultra discount, we mean lower prices than Walmart or Target. We're talking Dollar Tree, Dollar General, and also stores like Ollie's Bargain Outlet, which I'm going to talk about in a second. But if you've been watching the news, Dollar Tree announced that they're finally going to spin off the Family Dollar merger. I think they paid either $7 billion or $9 billion for it, or something like that, years and years ago. Now they're spinning it off at $1 billion, and it was never a good fit. So finally, they're spinning that off. Danny's going to talk about that a little bit in a minute. I'm going to go since we're talking about ultra discount retailers. I'm going to refocus on Ollie's Bargain Outlet. They reported earnings last week, and I talked about that when I was on with Rachel last week. And Bill, bringing back the slide with a slight update here. This is the slide I used right after it announced earnings. It will pop up in just a second. Here we go. So it was actually not as bad a quarter as that 3% growth might imply. The issue there was there was 53 weeks in fiscal year 23, only 52 in fiscal year 24. So that's why you had only 3% growth. In fact, if you take that out, you have about 8.5% growth, which is a little bit better. Maybe not quite where we'd like to see it, but better nonetheless. There were some supply chain issues and some product mix issues. That's why the net income was down a bit. Outlook, they expect growth to ramp up again as revenue is expected to grow by 14% this year. Yeah, but looking at their sales, I think the product mix wasn't ideal, but I think that's kind of a more of a hiccup than anything else. As you can see, it outperformed the the market over the last year, and it typically does outperform the market. By the way, if you're not familiar with Ollie's Bargain Outlet, it's a little bit different than say a Dollar General or a Dollar Tree that has more home goods. Ollie's can have everything, and the reason why is what they do is that they buy excess inventory from either manufacturers or retailers, and they sell it at bargain prices in their stores. And this is kind of a deal where everybody wins because these manufacturers and retailers get rid of some inventory that's actually weighing on their finances. Customers get these products at a very low price, and then Ollie's can maintain their margins without having to charge high prices, so they can build a viable business on that. So, and they are in the midst of a regional to national expansion. They're now in 31 states, and they added 50 new stores over this last year. They plan to add 75 stores this year. And I think a big reason for that is, as you know, Big Lots went under. So they're taking over 40 former Big Lots locations. So there's one less company in the space, I guess. But, it's consolidating a little bit. So Ollie's will capitalize on some of those old store locations. And I should have mentioned also the executive earnings. Also, that was also a factor in the net income. Sorry for not mentioning that before. Looking at their valuation, it's trading at 33 times earnings, which I actually think is kind of high for a company like this. I think it does grow faster than some of these companies like Dollar General and Dollar Tree, which are pretty much, well, I would say quite saturated, but they're approaching a saturation point across the U.S. Whereas Ollie still has a few states to which it can expand. But 33 times earnings, it's not crazy, but it's higher than average. I think a little high, but again, it is a faster growing company than Dollar General or Dollar Tree, so it is going to grow faster. That probably commands somewhat of a premium.
Yeah, I was looking at Ollie's coming into the show. So it's not a company that I follow very closely, but one of the things that I saw was when Ollie's talks about themselves, Ollie says that they are America's largest retailer of closeout merchandise and excess inventory. Our 574 semi-lovely stores sell merchandise of all descriptions and some beyond description. I thought that was a pretty, an interesting way to, maybe capture people's attention. And, the fact that they use closeout merchandise, from manufacturers and excess inventory that regular stores, might not want anymore, that kind of rotates out what their products are. So, you might get housewares or sporting goods or flooring or food or gifts, toys, home and garden, and it rotates because, you never really know what kind of bargains they're going to get from their suppliers, from manufacturers, from, retailers. And so I think that's a pretty interesting way that they go about marketing themselves.
Yeah, it is a true treasure hunt experience, especially if you go into their stores. You'll see as you described different categories of products. Whereas, as I said, a Dollar Tree or a Dollar General will generally stick to more specific categories. So you can find anything and everything in an Ollie. So that makes it kind of interesting. As for their stores, they're mostly, I would say, east of the Rockies. So, like I said, 31 states, though. Most of the states where they haven't gone is on the West Coast. So that might explain why Danny was a little bit less familiar. Although it has been a while since I've set foot in Ollie's. But it is an interesting place to shop. And I think it's a great business concept that can be very profitable without, as Tyler mentioning, talking about tech. So, yeah. As he mentioned, not all great stocks are tech stocks, and there's some opportunities like this one, which I think, although it's a little bit expensive here, I think it'll still do well over the long term, and you might find it a bargain depending on on how things go.
Yeah, I think the other thing that stands out to me about Ollie's was, I kind of had them mentally lumped into the same group as the, Family Dollar, Dollar General, all these other dollar stores. And what's interesting is that when I looked into it, it said that, while other discount retailers were struggling to hang on to their business, and they were, closing their stores, Ollie's bargain discount was being successful with a sense of humor and a goofy drawing on its founders as a mascot. And talked about, how they were actually, much more successful than, dollar stores in general. And it was interesting to me too. One of the ways that they did that was in 2018, they bought a dozen former Toys R Us locations that they got at the bargain basement price of about $42 million and opened up new stores there. So that was that's a good way to get into an established retail space on the cheap. So, good on them.
Yeah, maybe they should be real estate investors too at that rate. They're pretty much taking the same concept they do with goods and applying it to the real estate industry. So that's, yeah, like you said, good on them for doing that.
Indeed. The other thing that, I was looking into, heading into this show and, to talk about, ultra discount retailers, is the environment, the macroeconomic conditions and what's going on, because you would think, in an inflationary environment, that might be the optimum environment for stores like Dollar General and Dollar Tree. And it turns out that, and again, this isn't a space that I follow very closely, but, in preparation for the show, what I found out was that, with inflation impacting some of their core shoppers, and, these are generally, customers, low income households that are looking for these bargains. But that's also the customers that are most vulnerable to, economic headwinds and high inflation. So as a result of that, many of these customers were, cutting back on their discretionary spending. And one of the first places that discretionary spending got cut was places like these dollar stores. When I don't know about you, Will, but when inflation started rearing its ugly head and our grocery bills started going up, we had to cut back and we had to make some decisions, in the grocery store and at the gas pump. And sometimes, we wouldn't drive someplace that we would normally drive, or, we would buy maybe a lower end product rather than the premium brand that you'd usually get. And there was a lot less, non-essential spending. Had to cut back on a lot of the discretionary spending because, we didn't know how long is the inflation going to last. And as we've seen, it's been pretty sticky. So, you've got the economic backdrop. Then also, they're getting increasing competition. Retailers like Walmart are always looking to lower their prices. And so if you have to choose between going to a store like Walmart or going to one of the dollar stores, folks are probably going to go to Walmart, and they're probably going to just, make one shopping trip there and spend the bulk of their money there, which is, drawing customers away from these, dollar stores. Excuse me. And then there's also, the when we're talking about, the expansion that's going on in the, e-commerce space, as long as customers are, spending more money on e-commerce, they're likely to spend less money at discount retailers. And finally, in the case of Dollar General, they tried to expand into non-consumable products. They tried to go into home decor and clothing and more expensive items, and that's not really what their shoppers came for. So they ended up with a lot of higher inventory, a decrease in their profits. And then Dollar Tree, that acquisition of Family Dollar was supposed to be, a big deal, and it was supposed to, help them. And it ended up, being, just like you said earlier, a bad fit all around. So this is a tough industry. And it's one that used to be really well and used to be thought of as, recession resistant. But then when you hit inflation there, and the cost of their products going up, and they weren't truly dollar stores anymore. Some of their customer base went, I thought this was a dollar store, and you're charging me $3 or $2 or $5. I'm not buying it. So I think they might have become a victim of their own success.
Well, I think these would have been, 50, 60, 70 years ago. These were what were dime stores. So, the scourge of inflation is going to hit them sooner or later. So that Dollar Tree couldn't hold on to that dollar price point forever and had to raise it to $1.25. But I think I think the key here is inflation. I think that's where these stores have suffered, because a lot of their customers are frankly on the very lower end. These are not lower income people tend to buy more at these stores because they offer lower prices, obviously, than a Walmart or a Target. But when you get hit with inflation, there's not really anywhere lower to go than the ultra discounters, unless you just do without. So I think some of these customers that maybe were spending more or are doing without more often, and I think that's what's hit them. If we had a stable dollar, I don't think I think these stores would be growing a lot faster. At least in my opinion, they would be. And you're muted, Danny.
That kind of brings us. Sometimes I click on that mute button, and I think I'm already unmuted, and I just didn't click hard enough.
Yes, we all do that, unfortunately.
Unfortunately, nature of the beast.
Yes.
So that kind of leads to the big story that came out of Dollar Tree reported their results this morning before the market opened. I'm not going to get into the earnings themselves, because that's something we're going to cover on the earnings show later on. But they announced, and the story first appeared in the Wall Street Journal, but then what came out with Dollar Tree's financial results, and management said, after a thorough review of our strategic alternatives, the company entered into a definitive agreement to sell Family Dollar business to private equity investors for just over $1 billion. And of course, they had the standard boilerplate legal language, including with respect to working capital, net indebtedness. They're subject to a number of adjustments. So the closing of the transaction subject to satisfaction of customary closing conditions, including the approval from U.S. regulators. And then they said that the net proceeds are estimated to total approximately $804 million, and they expect the deal to close in about 90 days. And the company has been going through this strategic review, trying to figure out how Dollar Tree was going to return itself to profitability. And what they came up with was the fact that this ill-fated, as it were, purchase of the family or the Family Dollar business, that they they were going to cut bait, and so there's a duo of private equity firms, Brigade Capital Management and Macellum Capital Management, I think is how it's pronounced. And this has been, they were looking at their broader turnaround pictures. They basically asked some investment bankers to conduct a strategic review of the company, and they decided that the family dollar division was better spun off. Excuse me. And one of the things that I thought was interesting and something I wasn't aware of is they said that, that the family dollar locations are more concentrated in urban areas, and they sell, groceries and cleaning products and various other essential items, rather than just, the novelty things that you could get at Dollar Tree. So you can see that I don't spend a lot of time in these dollar stores. And in San Diego, a dollar store would have to charge you, like $5 for things. So I don't have a lot of experience there, but I thought hopefully this is going to be the catalyst that turns Dollar Tree around. They've had a tough time of it. That perfect storm of inflation, that ill-fated merger, and then now we're going into an environment where a lot of the cheap goods that might normally come from China might end up being slapped with tariffs. So I don't think that things are going to get any easier for Dollar Tree from here. So I think they have their work cut out for them.
Yeah, the funny thing is, Dollar Tree and Dollar General got into a competition when it was time to buy Family Dollar. And if you've been in a Family Dollar, their strategy seems to match Dollar General's more closely than Dollar Tree. So it's kind of interesting that the Dollar Tree ultimately won this competition. I think they were in a stronger position before the acquisition, and after that they bought Family Dollar, that changed, to say the least. So I think now Dollar General is probably, of the two, is probably a relatively stronger company. And as Danny mentioned earlier, now with Dollar Tree used to have that $1 price point. They've up to $1.25, but to get to that price point, you have to be, as Danny mentioned, in a lower cost of living area, and you have to have access to cheap imported goods. And with tariffs coming down the pike, I think those cheaper goods are going to be harder to come by. So they're probably going to be coming off that price point further as time goes by. So Ed had a question that I wanted to touch on. About 3 minutes ago, he asked, if a dollar store does not do well during inflationary or recessionary times, when does it do well? I actually think they do well during recessionary times if there's not a lot of inflation. Again, as I mentioned before, a big part of their customer base was very low income people. Dollar Generals and Dollar Trees will be in very often in small towns where they're lower income to begin with, and this is the demographic that's hurt most by inflation, because a lot of times they were barely getting by before the inflation, and now with the inflation they may feel the pressure to even cut back on necessities. So I think that's hurt them. In past recessions they typically have done well, and I think also they picked up some relatively higher income people in past recessions, especially you go back to the say 2008 2009 financial crisis, when a lot of middle class people were temporarily destitute, so they were frequenting these kind of stores more often. I think they still do to a degree. I'm not lower income exactly, but if there's something I acknowledge I need to spend money on, but I don't want to spend money, I usually go to Dollar Tree or Dollar General. So I will shop at these stores from time to time for that reason. So I think it's the inflation more than the recession that's hurt them. But again, I think this is these are the stores most suited to lower income people. I don't think they're going away, but how much they prosper, well, that's up in the air. I think Dollar Tree will do a little bit better now that they're unloading Family Dollar, but again, they have the tariffs and the lower access to cheap goods to worry about. So we will see what happens there.
And just to, maybe provide a little context to your point, I want to share my screen for just a minute and look at Chart Creator. And if you go back and look at this Y charts of Dollar Tree, during the recession that happened between November of 2007 and March of 2009, you can see that while the S&P 500 fell 47%, Dollar Tree actually grew by 22%. So as Will stated, in previous recessions, I mean, this is a company that did remarkably well. There was this initial fall off in early 2008. You can see on the chart here, but then it just gradually picked up from there. And this is the real recessionary period. And it outperformed the broader market by almost 69%. So that's, that is an impressive performance. So I'll stop sharing that now, but these dollar stores in general had done really well in previous recessions. But as Will said, when inflation reared its ugly head, we've had a period now that lasted for, I think we're on year 3 now, or year 4 of the inflationary environment. And when all of the cheaper stuff gets more expensive, not only are people cutting back, but then you have the cost inputs for these dollar stores, and they're having to raise the prices on these goods. At the same time, the consumers have less money. So I think it's, excuse me. I think it's definitely the issues with inflation that has caused, well, maybe not the demise, but certainly the downturn in these dollar stores in general.
Yes. So, looking at other questions, Jazz had a comment. Here in Massachusetts, Ollie's uses the cartoons they acquired from Building 19 and a half, 3/4, 5/8, used in other stores. Ollie's appearances just like Building 19. Yeah, I did notice they market themselves with a comic. I think of the founder. The name escapes me, but I think he passed away sometime in the 90s. But the company was founded well before that, and it has moved on to grow without the founders present. So yeah, I think that kind of speaks to the strength of its concept.
Man, I wish I could get rid of this cough. It's been dragging. So we do have a question from Besties from about 3 hours ago. What are the best opportunities in the market that you're seeing right now? I think a lot of that answer depends on your focus in investing. Now, me as a tech investor, and I think perhaps, Will might have a different answer, but I'm looking at, the opportunities represented by AI and the companies that are benefiting from the cloud growth, from the data center expansion, from the AI chip boom. For instance, I have talked a lot about, and I will continue to talk about NVIDIA. This is a company that grew their revenue by 74% in the company's most recent quarter. And yet the stock is down right now. Let's see, over the past year, the stock's down about, oh no, I take that back. I need to clear this Dollar Tree stuff out of here. From its peak, NVIDIA stock is now down about 24%. And this is for a company that grew their revenue by 74%. Now, there are those who would argue that NVIDIA's valuation is still high. And I don't necessarily agree with that. It's got a trailing 12-month PE ratio of 38, which I would argue is a pretty compelling, valuation, pretty compelling multiple for a company that grew its revenue by that much. Not only that, but even as their revenue grew 78%, Nvidia's earnings per share grew by even more. And yet, if you look at their forward price to earnings ratio is even more compelling to me. You're looking at a multiple of 25. And I showed charts yesterday where it's certainly not at its low, but this is well below the company's average PE ratio over the past 3, 5, and 10 years. Nvidia's average price to earnings ratio and forward PE has been much higher than this. So for me, I see Nvidia as being inexpensive. I see Amazon as being inexpensive. Amazon has a multiple right now that we haven't seen regularly, probably going back to 2019. Customers like Alphabet. Alphabet is also, kind of dirt cheap right now. I'm going to plug these into my chart real quick just to see, where we are. But let's see. So Amazon's got a price to earnings ratio of 32, and it has a forward PE. I'm sorry, a PE of 36 and a forward PE of 32. That's well below the average for Amazon. Alphabet is another one that I see with a compelling valuation. Alphabet right now is selling for 20 times earnings and only 18 times forward earnings. For a company that is a leader in its field, it's the leader in search, it's a leader in cloud computing, it's the leader one of the big three in cloud computing, I should say, and a leader in digital advertising. Alphabet gushes cash, and they're selling for, roughly 20 times earnings. I think that's an opportunity that's not going to last. And I want to stop talking about it so I can actually get my hands on, some more Alphabet stock. But I mean, that's the best opportunities that I see in the market. I don't know about you. What do you think, Will?
Oh yeah, the Alphabet I think is a great opportunity. I think there's some perception that it's lost a step in AI, even though it was an AI pioneer. I don't quite agree with that. I don't know this. The stock has been growing, but I think it's kind of suffers from that that assumption. So I don't think it's been growing quite as fast. But yeah, I agree. 20 times earnings for that is way too low. Amazon, in fairness, has matured some, so I think that's why it's not trading as high a multiple as it used to. But I think for what it is a bargain. One stock I bought recently amid the bargain was a Trade Desk. I had been in it before, but I pretty much doubled down when it fell below 60 because it lost more than half its value in a very short time, and it was overvalued. And yeah, it shouldn't have missed its own revenue estimate, but I think that was a one-time mistake. If I pull up the PE ratio, let's see where it's trading. I mean, it's not as inexpensive as an Alphabet or an Amazon. Yeah, the PE ratio is 76, but you look at the forward PE ratio, it's only 33 now. So I think that forward PE is hugely cheap for a digital advertising leader like the Trade Desk. So that's one I've been focused on lately. And like I said, I doubled down recently. It wasn't easy to stop talking about it for a few days because everyone was talking about it for a few weeks.
The Trade Desk is certainly one. I agree with that. It's the company's average PE ratio over the past decade has been about 193, and it's less than half that. And with a forward PE of 33, that to me, that's just dirt cheap. It hasn't been that inexpensive since, going back before 2018, as far as I can tell. So yeah, that's definitely an opportunity. I agree with you on.
Yeah, I picked up a few years ago. I picked up some at I think 68. And I thought that was cheap at the time. So I was very surprised it came back down to those levels. But since it did, I was sure to add some shares.
And in fact, it's below 60 again today.
Yeah. Oh,
Yay!
At least I'm making a profit on my second lot. I mean, a little bit more growth to go on the original lot I bought way back when. So Meat Church had a question from five hours ago. I thought was interesting. When are we going to leave XYZ? That means block for dead. I think that's a little bit strong. I was a huge fan of this company when it was Square, and when Jack Dorsey was, has attention divided between Square and Twitter. But when he dropped Twitter and focuses exclusively on Square, it became blocked, and it started doing a lot of these weird things. Like acquiring a music streaming business, for example, things that had nothing to do with fintech. And some of the stuff he's done with Bitcoin could potentially be interesting. But I know I've talked about this on other shows, but I did sell about 20% of my original Square position at what turned out was the top. I wish I had sold more. I've since sold out completely from that. I sold it at a higher price than it's trading now. Yeah, I don't know that it's dead money, but I'm not that optimistic about it at this point. Like I said on other shows, I'm focusing on international fintech now. So I'm not really a fan of American fintech in general personally, but I'm not a fan of this as a stock. But I don't, leaving it for dead might be a little bit strong.
Yeah, I mean, I am still a block / Square / whatever shareholder. And if you go back and look at their most recent results, they were not, I don't know, compelling to me. And one thing I don't like is they kind of obfuscate a little bit. Instead of just putting their revenue and their earnings per share numbers right there so they're easily comparable, they talk about, oh, we had a 14% year-over-year growth in our gross profit. Okay, but what was your revenue? I get the interest in your gross profit, but I want the base numbers first. I want to know exactly what's happening with the business. And then if I'm interested, I can kind of dig in a little bit more. But, they don't present it that way in their shareholder little letter anymore, which I don't know. I find that a little bit dubious. And certainly I know there are other companies that do that. This is a case where they had a clear market niche with small and medium-sized businesses, and they were able to leverage that for years in the fintech space. And when you asked anybody, say 5 or 10 years ago about the biggest fintech companies, the answers that you would generally get from most investors were PayPal and Square at the time. Now it's blocked now. But as Will said, I think that at first they had their natural evolution. They went in for, it was just merchant payment solutions, and then they expanded into consumer, financial fintech solutions. And then they got into cryptocurrency, and the cryptocurrency was moving so much on their financials that it was kind of masking what the real business was doing. I wasn't a real fan of that either. Now that said, I have not sold my shares yet. And the reason that I haven't sold my shares yet is I think there is still the potential that, they could find a path forward. I didn't really like, when Jack Dorsey was focused on that and then not focused on it and then focused on it again. I think we've had a little bit of issue there. I hang on to my stocks probably too long, simply because I really stick to that buy and hold strategy for the long term. If you'd have gone back, a lot of people were selling NVIDIA stock, for instance, after the cryptocurrency thing, and a lot of NVIDIA graphics cards were being used for cryptocurrency mining, and this was before the advent of AI, and they ended up with a lot of excess inventory. They had a bad quarter, investors sold, and little did they know that AI was right around the corner. And so all of a sudden, NVIDIA stock was up 700 or 800%, over a 2-year period. And people who sold their shares and got out because of the, cryptocurrency bust missed out. So I am hoping, and I know hope isn't a really good investing strategy, but I'm hoping that, Block finds a way forward to have a more viable business model. It's been kind of, I don't know. I kind of second Will's thought that, maybe it's not a company that's left for dead, but the stock has certainly been, not as profitable as I had originally hoped it would be. So, yeah, we've probably beaten Block to death now.
Yes. Let's see. Meat Church had another interesting question. I guess this is one for our consumer stock fans. He asked, Starbucks or Nike turnaround to all-time highs. What is your time frame, and who is your favorite to do it? To be perfectly honest, I don't have a time frame on either. Yeah, actually, but these companies have more in common than you might think, because they're both in highly competitive spaces, and they depend heavily on their marketing to really stand out and build a competitive advantage. Of the two, I probably like Starbucks better, because I think Brian Niccol, he's sort of an operations guru. He's kind of proven himself with his turnaround Chipotle, being the first successful CEO of that company that was not the founder. So yeah, Starbucks is a slightly different business, but I think he could do that again. Nike, I'm not quite so sure about, because like Starbucks, it's highly competitive, depends on marketing. I don't know. I think they made much bigger marketing mistakes than Starbucks did. So, like I said, I don't have a time frame on either, but I would pick Starbucks over Nike in this case.
Yeah, I think between the two of them, when you look at Nike, there are a lot of competitors in the athletic shoe market. I think, you've seen one of the big phenoms, I guess, in the shoe space has been Hoka. And this is a shoe that has been extremely successful in its market, and at the same time, Nike has kind of, if you'll excuse the metaphor, turned over the ball. I think when we're talking Starbucks, this is a company that still has a premium product. They still have, excuse me. They still have a lot of their core customers. I think part of Starbucks issues has to do with inflation, but I think also some of it has to do with, they got away from what they did best. And if you go back years, the thing that Howard Schultz, Starbucks founder and longtime CEO, said was that Starbucks represented a third place. So you had home, you had work, and then you had Starbucks. And it was a place that, was very consistent in the product that they served. They were very consistent in their atmosphere. And I think they got away from that a little bit, and they were kind of, chasing the shiny new thing. But, in terms of, excuse me, in terms of time frame, I could see Starbucks turning around in the next, On the early end, I think probably in the next 3 or 4 quarters, and on the high end over the next 2 or 3 years, I think Starbucks still has all the pieces in place where they could be successful. And I think once you have the issues with the economy, basically not acting as a headwind, you've got a guy who has proven his success in turning around Taco Bell, in turning around Chipotle. I think he probably has just as much chance of turning around Starbucks as he did the other two. Got a proven track record of doing that. So between the two, I'm with Will, and I believe that Starbucks is probably the better turnaround play, and will probably turn around faster than what Nike does.
So there's this one question I've been looking at for a while. I didn't. It covers 3 stocks. I've been, but no one else has answered it. So I'm going to talk about the one stock I somewhat know. About a week ago, 307 Fool asked TSCO, which is Tractor Supply, Jackson Financial, JXN, or Nextera Energy, symbol NEE, are my current favorite dividend payers. Do you see retail, finance, or energy having an easier environment over the next 5 years? That's a good question. I think it's a little bit too general, though. Just looking at retail, for example, we were talking about ultra discount retailers. That might have a different result than a Walmart or a Home Depot or an Amazon. Yeah, so I don't know really how to answer that part of it, because I think it's going to depend on the sector. I think they're going to be. I don't see any of these sectors falling off a cliff. I'm still as for retail, if we're talking generally speaking, I think the ones that are in regional to national expansion plans, like BJ's Wholesale, like Ollie's, like we were talking about earlier, I still think those are going to go on. I don't see anything falling off the cliff, but will they prosper? And I'm not so sure that they're going to. The ones that are well established and kind of already saturate their markets, I think they'll peter along. I'm not sure that they're going to be hugely successful. They might profit from just natural population growth, but and inflation too. But beyond that, I'm not really sure for a lot of retailers. I don't follow finance or energy quite as closely. I know oil prices have been falling. I used to follow energy a lot more, but I haven't followed it closely lately. So I'm not sure if I want to comment. Plus, that's a rapidly changing environment too, with natural gas, liquefied natural gas being used more, in the demand for electricity rising, for example. So it's going to be interesting, but I don't quite have a feel for that, quite frankly. Yeah, do you have any ideas on any of these, Danny?
The only one that I have followed at all is NextEra Energy. And I think this is a company that, if memory serves, has focuses on renewable energy. Here we go. They're a leading clean energy company. They're based out of Juno Beach, Florida. They own the Florida Power and Light Company, which is America's largest electric utility, and they sell more power than any other utility. But they also focus on clean, affordable, reliable, renewable energy sources. And this is a company that has, paid a pretty good dividend. I'm going to just run back here real quick and pull it up. Let's see here. And it's also been, more stable, I think, than some other companies. So right now, they have a dividend of $2.27, which works out to about 3.3% yield over the course of the year. The stock has been It's interesting. My Yahoo Finance is not acting well. I'm going to go back over here to Y charts. But Next Era Energy, yeah, the stock kind of peaked in early. Let's see here. Normalized percent change for the stock. So over the past decade or so, Next Era Energy's stock is actually down. It says about 20. That doesn't make sense. That doesn't make sense to me at all. Something funny going on with this chart. Maybe it's not just Y charts. Okay, so Next Era Energy stock is up 169% since late 2015. That's a pretty good return, considering that the S&P 500 is up about 235%. So no, it's not as good as that. I should probably look and see what total return is for the Next Era Energy, particularly given that it has.
Yeah, because that's going to have a dividend. So I think you need to.
Yeah, it's got a strong dividend, and they've continued. Yeah. Okay. So 242% total return. So it's outpacing the S&P 500 a little bit. And if you have compounded those dividends, you've done a little bit better than the market. I don't know Tractor Supply, or what was the name of the other one, Will?
Jackson Financial. I've never looked at Jackson.
Yeah.
Tractor Supply has been an interesting one, just because they're in smaller towns and in suburbs. They serve people that run hobby farms, basically. Given the price of eggs lately and the fact that the average farmer is, I think, 58 years old now, I think there might be some opportunity in that one. That's probably of retailers in that space anyway. I'm probably a little bit more optimistic about Tractor Supply than others. And their dividend pays about 1.7%. Which is higher than the S&P average. They tend to raise it annually. I think they also just had a 5-for-1 stock split. So I think this was not going to blow your socks off, but I think it's going to be a steady grower over time.
And it looks like over the course of the past 10 years, Tractor Supply has actually edged out Next Era Energy's total return, returning 256% versus Next Era Energy's 243%. So, both are slightly ahead of the S&P 500, which that's not a bad return.
Yeah, not at all.
So I've got a question from Ed about 32 minutes ago. Tariffs on April 2nd. What happens? Pushed off, reduced, increased, they go away, or they stay put? The only answer that I can give you, Ed, is I don't know, and I don't think anybody else does. When you talk about tariffs, here just a few days ago, the big news story was that the White House was going to narrow its approach to the tariffs that were set to take effect on April 2nd. And they were going to, grant exemptions to certain, industry-specific tariffs. They were going to apply reciprocal levies on a targeted set of nations that accounted for, the bulk of foreign trade with the U.S. But then, there have been stories that have come out since then where President Trump has said that he's going to be lenient on some reciprocal tariffs. There's been another story that came out that, now he's going to announce new auto tariffs in a major escalation ahead of the April 2nd deadline. So, to your question, pushed off, reduced, increased, they go away, they stay put, maybe all of the above. It doesn't seem to be, I can't seem to find any rhyme nor reason to how, these tariffs are being rolled out. I'm sure President Trump has something specific in mind, but, I haven't been able to keep up with it. So I think that's one of the things that is lending uncertainty. The market, investors don't really know what's going to happen with tariffs. As a result of that, they don't really know what the impact of tariffs is going to be on the economy. Is it going to bolster inflation? We don't know. Is it going to reduce inflation? We don't know. I have heard some economists say that if the Trump administration went through with all of the tariffs that they had initially proposed, they feared that the U.S. might slip into recession. But the truth is, they don't know, and we don't know. I wish I had a better answer for you, but that's the only answer I have. We just don't know. And until we get some semblance of assurance that that the tariff situation has stabilized, I don't think we're going to know. So maybe that's just an uncertainty we're going to have to live with for the time being.
Well, I think that's a keys on a very important investor lesson. This is a political decision, and political decisions just cannot be predicted. Now, it would be better for the markets if they could be. As you can see, the market's down today, and I think this tariff announcement is the biggest reason why. But yeah, unfortunately, it's something you just have to live with. I personally wish the government would be a little bit more predictable about this process. Unfortunately, we're not getting that, so we just kind of have to roll with the punches, for better or for worse. About 6 hours ago, Dave J asked it. This touches on Block again, so wanted to hit this question. Yesterday, I invested in Toast. The war on cash theme is a crowded space, but they seem to have a nice growing foothold. Frustrated with Block so far. Thoughts? Well, I think we did express our thoughts on Block pretty thoroughly, so I won't go there again. If you're going to invest in American fintech, I like Toast. I was a little pessimistic on it because of the nature of the restaurant business. The restaurant business is a mix of well-known chains and maybe smaller localized chains and independents. There's a very high turnover in this business. I frankly worry about the stock a little bit when it matures because that high restaurant turnover is probably going to hurt it. Right now, there's just so much growth, though, that I don't know that makes a difference. And if they go more serious internationally, if they become a bigger player internationally, we're going to delay that time where it does reach a maturity point. So, if you're going to be an American fintech, I think this is the way to go personally.
Toast is a stock that I have talked about on Fool 24 quite a bit. So I wanted to take a somewhat different approach to it today. So what I like most about what Toast does is that they have modules for all of the different things that go on inside of a restaurant. And so I've pulled up a list of the modules that they have. So of course they have a point of sale system. So, if you are in a restaurant and one of the wait staff comes up to your table and they are carrying a device that you can either tap your phone against or tap your a credit card against, the chances are pretty good that could be a Toast point of sale system. They also have modules that handle online ordering and delivery. So, it says it offers commission-free takeout and delivery channels. So you can do, third-party delivery services. It can integrate right with these third-party offerings. If the restaurant does their own takeout and delivery, it integrates well with that. They also have payroll and scheduling management for people that work in the restaurant. So, you can do your time scheduling for the employees. You can do your payroll processing. You can do the managing of your employee information. They have a module that works on inventory management. They can track your inventory, help manage your costs, reduce waste. They have reporting and analytics models that basically help restaurants, excuse me, that help restaurants manage, the data that they have and gives them insight into, some of the other, into some of the trends that they might be seeing. So, for instance, if there's one dish that has historically been a big winner with customers, but then another dish all of a sudden has become more popular, it surfaces insights like that. So businesses can act on that data. So this is just a number of the core modules, but then they also have email marketing. So if a guest gives up their email, Toast can send customized messages to restaurant goers. They've got an integrated loyalty program that restaurants can use. They offer restaurant specific gift cards. So there's a lot of different offerings with Toast that go just beyond the fintech piece, the point of sale piece and the payment processing piece. And I think this is one of the reasons why I am so bullish on Toast, because they've got a nice foothold. They just in the most recent quarter announced that they added a record 28,000 locations in 2024. That brings their total locations up to 134,000. Their annual run rate increased to 34%. They've got solid excuse me. They've got solid revenue growth. They are already profitable, which a lot of companies are not. So I really like the approach that Toast has taken to this space, and I think that offering that idea of being a restaurant operating system that they say. So I think this is a really good. A really good way to approach this space. And I'm a little more bullish on the restaurant space in general than Will is. But that's okay, because the market is made up of buyers and sellers. And we are actually coming up on the top of the hour, and we've got a treat for you. We are about to introduce Rachel Warren and Neil Rozenbaum for their take on valuation. Welcome to the stage, Rachel and Neil.
Hey guys.
Hello guys.
How's it going?
Good. How are you?
I'm doing well. We had a rousing hour of Ask Us Anything focused on some ultra discount retailers. And now we are going to leave you to the subject of valuation.
Awesome. Thanks, guys.
Thank you.
All right, fools. Welcome to another hour of Fool 24. Neil and myself are your co-hosts for this next hour. Neil, how are you?
Good. How are you? It's been a long time. I think 24 hours. 24 hours.
This has become our daily show together recently.
Yeah.
The valuation show with Neil and Rachel. Fools, if you have any valuation related questions, go ahead and get those in the Slido. We'd love to answer those for you. We'll also do our best to work through some of the questions that have already come in the queue in recent hours that we are able to answer ourselves. This is generally a broad hour where we tend to talk about a lot of different companies, some of which, involve valuation related questions or otherwise. But we're heading towards the latter part of the day. It's been a busy day in the news. There was actually one story that caught my eye that I wanted to get your take on, Neil, before we maybe look through some of the questions that are there in the queue. Well, a couple things that are related. One, there was breaking news just as we were coming on to the program here, reports that OpenAI expects that their revenue will triple to $12.7 billion this year, according to sources familiar with the matter. Bloomberg was the first to report the revenue expectations, and CNBC soon followed. Obviously, OpenAI is one of many companies that I think a lot of individual consumers as well as investors have watched with great interest as we've seen the AI revolution, go into full swing. And it was interesting to me because there was another story that I saw published today that featured some comments from a recent interview with Microsoft co-founder and philanthropist Bill Gates talking about AI and his opinion that within 10 years, AI could replace certain elements of the workforce. Now, the headline caught my eye and that I read a bit deeper, as is often necessary to do. And there was definitely a bit more context in the conversation. But one of the things that he said was, obviously, there's a lot of expertise in very specific fields that remains quite rare. We we rely on human specialists in many fields, for example, doctors and teachers. But one of the things that he said, and again, this is his opinion, but with AI over the next decade, he said that will become free, commonplace, great medical advice, great tutoring. In his opinion, the world is entering a new era of what he calls free intelligence. The result will be rapid advances in AI-powered technologies that are accessible and touch nearly every aspect of our lives, he has said, from improved medicines and diagnoses to widely available AI tutors and virtual assistants. And he said, it's very profound and even a little bit scary. It's happening very quickly, and there's no upper bound. And the article also talks about how, there's ongoing debate, as we've seen, about how humans will fit into this vision of an AI-powered future and what it looks like. Many say that AI will help humans work more efficiently, and I personally tend to fall on that side of the spectrum in terms of my own personal opinion. Rather than replacing them altogether, that there could be a real spur of economic growth related to the jobs created, coinciding with those roles. Obviously, there are others who counter that many of the continued technological advancements that we could be seeing over the next several years could change what many jobs look like, that it could have a destabilizing impact, that it is both exciting, but also could be, concerning for certain segments of the workforce while being still this really kind of fantastic and disruptive opportunity. And again, this was, co-founder of Microsoft, Bill Gates. He was talking with Jimmy Fallon. He was reaffirming his belief that different types of jobs will likely never be replaced. He said, for example, most people probably don't want to see machines playing baseball, but that AI's development, does come, as something he's noted in the past, with understandable and valid concerns. Today, somebody could raise billions of dollars for a new AI company that's just a few sketch ideas. And this is something he had said in another interview. And he has seen the AI revolution coming nearly a decade ago. We've seen so many developments the last couple years, and in ways that I think we're really only just now beginning, to recognize the full effects of. I personally, and I talk about this a lot, have been really intrigued by the ways in which these advancements benefit us as human workers, make us more efficient, and specifically as it relates to a lot of the specialized fields that are in the purview of the companies we talk about here on the show. I am a healthcare writer and investor. I talk a lot about how AI is being used to disrupt and make more efficient the world of drug development and discovery, clinical trial management. That's just one example. It doesn't replace the need for incredibly gifted scientists and researchers and physicians, but it does make their work more efficient. Something even as deeply complex as identifying the right molecules that might have the right components needed to actually eventually commercialize into a safe and effective drug is a process that can take years, and using artificial intelligence can help to winnow down the time that it takes to identify those promising compounds and molecules. So interesting article, a little bit of both pessimism and optimism there from Mr. Gates. And obviously, I think this is a subject that has a lot of different thoughts and opinions, and probably a little bit of truth from both sides there, depending on the industries you're looking at. Curious to hear your thoughts, Neil. I know this is a space you follow pretty closely yourself.
Yeah, no, it's funny because this morning I joked about the fact that a lot of these companies have spent hundreds of billions of dollars on AI investments, data center build out, infrastructure build out. And the only time people are really excited about AI advancements is when some of these players come out with a new image generator. So yesterday, OpenAI came out with a new image generator that made your pictures look like an anime style picture, and everybody's talking about that. And I'm like, is this why we are spending hundreds of billions of dollars to make cool looking images, or is it to advance science much faster, to help these engineers, these scientists, because essentially it is a tool, right? It is a tool to make a scientist, an engineer, 10 times, 100 times more productive. Lots of CEOs says, look, for every engineer, you're going to have 100, 1,000 AI engineers working with them. So your work will be more efficient. Again, it's all about doing more with less. Now, yes, there will be some jobs, some categories that will probably disappear. You said, yeah, people won't like to watch robots play baseball, but I'd say, I mean, you have battle bots. You might have, I don't know, bots in a boxing ring. There are movies made about this, so we never know. A new category can be developed, but no, it's going to be quite interesting because right now, like I said, I think the headlines are the simple things, right? Text to video, image editing. These things get a lot of headlines because it's easy to understand. It's like, okay, I can write a couple of things, an easy prompt, and poof, I have something great. But very few people will actually look at scientific reports and see, oh, okay, thanks to AI, thanks to this model, we just discovered XYZ much faster than previously expected. Gene sequencing can be helped with that as well because, well, the AI can see things and, well, it has just more compute than we do. It doesn't have to sleep. It's not tired. It's not sick, although it does have some viruses sometimes. So maybe there's that. But yeah, it's going to be quite interesting. Going back to what you said at the start with OpenAI generating, what is it, $12.5 billion in
about 12.7 this year. They're
12.7
thinking.
And how much money are they losing? Because I believe a couple of months ago
I
they
think
said
a
they're going to
considerable
burn
amount.
billions of dollars.
Yes, yes.
So, I mean, I'm not surprised, right? If you look at their pricing tiers, you have $200, you even have 2,000 or maybe even more. So revenue-wise, I'm not surprised, but I think they're still going to burn billions of dollars in the next couple of years. And I mean, this is a show about valuation. And yesterday I made a post about the fact that apparently OpenAI is worth between $260 and $320 billion. That's around 16% of Google Alphabet at the moment. And I was thinking, does that make any sense? Because Google Alphabet also has Gemini. So does that mean that the Gemini is worth $300 billion? If so, how much is the rest of the business worth? Should be way more than the $2 trillion that it's worth today. So either Google Alphabet is extremely undervalued or OpenAI is extremely overvalued. Because in OpenAI, we have Grok, we have Gemini, we have DeepSeek, we have another Chinese players from Alibaba, ChatGPT, Perplexity, Claude, all of those players. So I just, valuation-wise, I can't justify what's happening in the private market. We've been hearing about an AI bubble, but if we look at the Magnificent Seven companies, for example, or even a couple of software names, valuation-wise, I don't see the bubble status. In the private market, I mean, when you're looking at these valuations of an OpenAI, of a Perplexity, or even XAI, you're starting to ask some questions. Okay, does that make any sense? And if they are worth so much in the private market, why shouldn't the publicly traded companies that actually are extremely profitable, why shouldn't they be worth more today if we're playing this type of game? So yeah, lots of questions. I don't know. It's interesting times because each and every week something new comes out, and that's the exciting part, I would say.
Yeah, no, I think that's right. Yeah, I thought it was an interesting conversation to start the hour off with, for sure. It's a highly dynamic space. There's a question that was in the queue here from earlier that I wanted to hit as well and offer some thoughts on. I think this relates to a discussion that Will and Danny were having. But speaking more to consumer-centric stocks, if the dollar store does not do well during inflationary or recessionary times, when does it do well? Well, some of these stores, and it depends on the business, right? I know that Danny's going to talk about Dollar Tree's earnings in the next hour when he and I are on. Dollar General already reported, I think, back in February or earlier in March. These businesses can do very well during recessionary times. And I think it's kind of important to take it on a case-by-case basis, right? You think about the dollar store business model, which revolves a lot around offering a wide variety of goods at low prices, often for $1 or just above, focusing broadly speaking on everyday items and often achieving profitability through high volume sales and minimal overhead, including having smaller stores, reduced staffing, very kind of no frills stores environments, and aiming to keep prices consistently low to attract cost conscious consumers. And again, the model of these types of businesses is really all about achieving revenue growth, sales growth, and profitability by selling a large volume of goods, because these are very low margin items that they're selling. So they're not able to necessarily rely on high profit margins per item. Dollar stores keep their operating costs low by having a small store size, maybe limited staffing and low cost sourcing. That's key. A lot of these types of companies like Dollar General and Dollar Tree have historically sourced a lot of their products from suppliers in China at quite low costs, which has also minimized overhead. And looking at a very specific one, Dollar General, right? This has been their model. No frills, convenient, unaffordable shopping experience, focusing on small towns and more rural areas where other retailers may not be present, and having a really lean operating model that's characterized by smaller stores, more cost-effective real estate, and a more curated product selection. And their focus, again, on low prices and value has been a key driver of their success. One of the things that's notable with this particular business, I mean, if anyone has been following the trajectory of a business like Dollar General recently, they have been dealing with some struggles, and that has been partly due to some of the changing habits of the consumer, but also partly due to what I think are at least shorter term headwinds that the company has been working to resolve. But to kind of also go back to the question of how do these businesses do in recessionary environments. So there is data that showed how Dollar General did back in the 2008 recession, for example. Their same store sales grew 9% in fiscal 2008, another 9.5% in 2009. And that demonstrated a pretty recession resistant nature of the business, at least at that time. Dollar stores, ironically, including Dollar General, were among some of the better performing stocks in the S&P 500 during the Great Recession. This is a business model that has historically been seen as more recession resistant. Even though the customer base, the average customer base of these particular stores is often lower income individuals, these are also individuals who are going to be most affected by issues like inflation and rising prices, which is something that we've seen particularly in the dynamic that Dollar General has been facing the last few years. There was actually an interesting article that had come out at the end of last year about how dollar stores are struggling to win over bargain hunters. And the article cited the performance of companies like Dollar General and Dollar Tree, talking about how lower income households who, again, tend to shop at the deep discounters have been hit hardest by inflation. And that has also trickled down to the business performance of some of these types of companies that historically have been seen as very resilient. Now, with Dollar General specifically, they have been dealing with some, I think, more specific issues that they've been working to resolve. They have been closing some stores. They have been working to streamline their overall store count. And something that I noted about Dollar General is they focus primarily on rural customers. They've often sought out small towns, residential areas where shoppers otherwise maybe had to get to a grocery store or a Walmart, but over a very long distance. And so they have really worked to fill the gap there. In more recent years, they had debuted this store concept called Pop Shelf, which sells more discretionary merchandise, and that's aimed at shoppers with a slightly higher income level. And this would sell items such as these pop shelf stores, such as makeup, candles, throw pillows. But the thing is, they have, heavily relied, as a lot of these stores do, on new store openings to fuel sales growth. They do have many more stores than rivals like Walmart or Target, but high and persistent inflation has really tested their business models. There was a comment from CEO of Dollar General, Todd Vassos, at Goldman Sachs retail conference last year, and he was saying that about 60% of Dollar General's overall sales come from households with an annual income of less than $30,000 a year. And obviously, these are also customers who tend to feel the impact of inflationary headwinds first and the most keenly. And he noted that in September, they had seen a real slowdown in their quarter across almost every region and division they had in terms of sales. Now, they still had a pretty solid year. I've talked about their results a few times, but just their Q4 net sales increased about 4.5% year over year. Their fiscal year net sales in 2024 rose 5% overall. They also increased annual cash flow from operations by about 25% to $3 billion. So that's something that has been, notable. Those are pretty solid results for a business like this and the way they operate and the types of margins that they tend to report. Something Dollar General's also been dealing with is some of the financial impact of, for example, a settlement that they reached last July with the U.S. Department of Labor to pay about $12 million in penalties for workplace safety concerns. They had another $21 million in fines from the Federal Occupational Safety and Health Administration over the last several years that they have worked to pay. They've also been dealing with stores that, again, these are very, no frills model, but stores that have been quite cluttered and were receiving quite a lot of backlash on social media in terms of how they were kept. And that's something that Dollar General has been really working to refine. They've been closing quite a large number of stores, streamlining their overall store count and working to roll out, I think, a more effective model there. So that's an example of how one of the kind of key businesses in this arena is doing. Historically speaking, these businesses do tend to be more resilient in recessionary times. These are not usually very high performing stocks, though they might garner more investor interest, as we saw, in the Great Recession back in 2008 and 2009 from investors during this period. More recently, some of the issues I've mentioned are what have been impacting companies like Dollar General specifically, and that's really a myriad of issues, from consumer shopping behaviors down to some of their own internal headwinds that they are, working to resolve. I think if you're looking at this space, it's important to maybe evaluate if this is a space that you find compelling to invest in over a long and broader period of time, and not necessarily so much, based on what happens in the next couple years or so. There are certainly ways in which these businesses can be resilient over time. And if you're looking at the consumer stock and the consumer staples space, but they are, generally speaking, pretty slow growth stocks, and then businesses with quite, low margins. These are also businesses that are very reliant on their ability to source goods from overseas, from lower cost markets like China, something else that can be, impacted by tariffs. And some of the other news we're seeing there. So interesting business. Those are some things to think about, I think, if you're looking at this space. But the question of whether they do well, during inflation or recessionary times is important to take on a specific period of time basis, because it can vary. The ways in which these businesses performed 20 years ago in the recession versus perhaps how they would perform now following, the record inflation we've seen. There could be some notable nuances there to highlight.
Yeah, I mean, and today compared to 20 years ago, 15 years ago, today everything, most of the things happen online as well. So if you need something, you will probably order it on a Temu, on an AliExpress, or even an Amazon, for example. And I think that's also hurting businesses, the dollar store businesses, which I don't know if you can still find stuff for $1. Maybe you can, maybe you can't, but I highly doubt they'll change their name to a $2 store. But yeah, these are things. I mean, I did talk about Amazon, I think, last week, and I said, in tough markets, in good markets, I think Amazon still does well, because if you're looking for deals and fast shipping, free shipping, they'll probably provide it. And in good times, people like to shop, so they'll also shop with Amazon. So I think in this day and age, I would probably go with an Amazon over the traditional Dollar General or things like that, unless they somehow manage to change to change the business model. Yes, people still like to go shop in person. I believe last week you talked about that company. What is it called? Ollie.
Oh, Ollie's bargain outlets or something. Yes, so we talked about that more this last weekend. That's a weird, fun little store, though.
Yeah, but apparently it works. Apparently it works because the results were quite good. So yeah, it depends, I guess, how you manage that business. But in this day and age, where if you want to buy cheap stuff, you can just do it with a click of a button on an app, and it gets delivered to your door. That's a big difference compared to 20 years ago, 15 years ago, I would say.
Oh yeah, for sure.
I do want to touch on a question from Besties from 4 hours ago, maybe a bit less valuation on the topic of valuation, but still quite interesting on Waymo and Google. So Besties says, Waymo is everywhere in San Francisco and in some other cities. Google does everything and it is in the index. What do you expect for this in the next 2 to 4 years? So yeah, Waymo is under Google under Alphabet. They do launch in various cities. They will be launching in more cities in the future. I believe there was an announcement that they expect to launch in Washington, D.C., I believe in 26 or 2027. Now, in some cities, they launch purely on the Waymo with the Waymo app. With other cities, they partner up with the likes of Uber, or in Miami, I think they partner up with a company called Move. Or Uber has 2 board seats on that with that company, and I think they will somehow get something from that partnership as well. When this was announced at first, Uber stock did get hit because they were like, okay, they're trying to go into another city, they're not using Uber, is that going to be an issue? But then, well, people found out that Uber is actually invested in that company that will manage the fleet for Waymo, and I think that's what we're going to see in the future. We're going to see Waymo open up in different cities, whether they're going to do this straight through the Waymo app, and then Waymo does everything, or they're going to try out with Uber and some other fleet operators out there and see what works best. So far, results from Uber were quite good. I believe utilization rate is much, much higher as well, which makes sense because it's in the Uber app. You can say, yes, I want an autonomous car, I don't want one. And since Uber is that platform with millions and millions of users, I would assume that every time they try it out with Uber, they get way better data. And of course, San Francisco being San Francisco, I think that's an outlier because, well, everything tech-related gets launched there and everybody knows and likes and uses it. Although, if we go back to comments made by Lyft management, they did say that they've seen people try out Waymos, but then come back to the traditional way of going around, I'd say. So they try out Waymo, okay, so you see a quick increase in utilization rates of Waymos, but then after, they said, I think 5 days or a week or so, they see that user come back to a Lyft and use it more regularly. So it's always the early adopters. We have that early adopter curve that goes up quite quickly. Everybody wants to try out an autonomous vehicle. It's cool, take videos, take pictures, post it online. And then probably after a couple of days, maybe a couple of weeks, you're like, okay, great, but maybe I'll go back, or maybe I'll do both. And I think that's where we're at right now. 2-4 years in the future, I do expect Waymos and Teslas and some other players to be broadly available in multiple states. 4 years from now, I probably think it's going to be available in all the states in the United States, maybe in Europe as well, China probably. Tesla FSD in China is now available to some. And I have to say that the FSD testers in China are next level compared to those in the United States. They go on dirt roads where on the one side you can fall 20 meters. I don't know how much that is in feet, but since we're both in Europe, I will use meters here. But yeah, 4 years from now, I fully expect to see Waymos in a lot of states in the United States, maybe all of them. We're going to see a lot of robots, of drones towards 2030. I think things are going to get very interesting. And since this is a company under Google, well, my prediction was that in the 2030s, early 2030s, I think they will spin it off to be an independent company, maybe listed publicly as well. but I'll keep that whole explanation for the bold prediction shows.
Oh, okay. I'm intrigued. I'll tune in. All right, awesome. There was a question I wanted to hit that came in about Oklo, which I did a whole dive into their earnings yesterday, although earnings is a loose term because they are still pre-revenue at this point. And so it's mostly business updates. But Jacques Gaspo was asking, is Oklo a good buy? So I want to talk about some things to maybe consider if you're looking at this business. And for anyone who is perhaps not familiar with Oklo, they are an advanced nuclear technology company. They plan to make money by building, operating, and directly selling nuclear power to customers under long-term contracts, focusing on small, modular, fast fission reactors, which are cheaper and also more flexible than traditional nuclear power plants. They intend to really deviate from the traditional nuclear energy model by selling power directly to customers rather than relying on utilities as a means of driving sales growth. And that can obviously also offer them more flexibility, more favorable financial terms for the business over the long run. They've already secured multiple agreements with major clients like Equinix, Wyoming Hyperscale, Diamondback Energy, and they're aiming to supply power to power-intensive industries like data centers, which is something for which there is a rising demand in the age of AI. But they also are looking at ways to supply power to communities, to government clients, to companies that have high, octane power needs. They tend to generate revenue through long-term power purchase agreements or PPAs with customers. That is a model that is much more common in the renewable space than it is in the traditional energy space, nuclear energy most certainly, but that will enable them to build and operate their own small modular reactors and sell the generated power directly rather than making money from selling their designs to utilities companies. Though they're still, currently a pre-revenue business, they do have a somewhat healthy cash position from the proceeds of their SPAC merger, which took place just about a year ago. And I want to give a little bit more background on the business as well. For anyone that follows this stock, they went public about a year ago, a little bit less than a year ago. I believe it was in May of 2024. Shares are up about 20% year to date, more than 100%. Since the IPO. This is a company with a roughly $3.7 billion market cap, trades at about $26.46 a share at the time of this broadcast. This is a company that was founded over a decade ago at this point by two graduates from MIT, the Massachusetts Institute of Technology. And the goal, again, of the business is to commercialize and produce clean energy using nuclear fission technology, developing these small modular reactors and using them to directly sell power to customers. Oklo already has several project sites in mind, including their first commercial fission power plant in the US, which will be located in the state of Idaho. Their fuel fabrication facility design concept has been approved already by the US Department of Energy. That plant will be used to turn nuclear material into fuel. And they hope that the plant will be in operation before the end of the 2020s. One of their major focal points of their business is their next generation nuclear microreactor, which is called the Aurora. And that can produce anywhere from 15 to 50 megawatts of electricity and operate for 10 years or longer before refueling. And just to give an idea, that could potentially be enough power to power several thousand homes. That is the scale that we're talking about. And again, like I mentioned, they plan to develop these small reactors that can be deployed in numerous locations, including remote areas. And they want to sell directly to customers under long-term contracts, providing constant clean energy using nuclear waste to turn that into clean energy and supply that to clients like data centers, factories, industrial enterprises, defense clients, and even local communities. One of the most notable future use cases that Oklo sees is using clean energy derived from nuclear waste to fuel the huge demand for data center power caused by increasing AI adoption. Again, that SPAC IPO that they held last May, the special purpose acquisition company is AltC Acquisition Corp. That is owned and operated by the co-founder of OpenAI, Sam Altman. So that's a little fact as well to know about this business. I think it's important if you're looking at this business to understand that I think it's going to very much obviously depend on one's investing style and risk tolerance level. This is a business that is still needs to demonstrate sort of proof of concept for its functional long-term business model. It's a very speculative nuclear stock at this point. They have not officially engaged in any business operations or generated any revenue to date. They're still in the very early stages of commercializing their advanced nuclear reactor technology. And so they still have to really scale up operations to the point of being able to achieve revenue and hopefully, one day profitability. Now they've already secured some pretty important permits from the U.S. Department of Energy. They were granted fuel material from the Idaho National Laboratory. They also submitted their first advanced fission custom combined license application to the U.S. Nuclear Regulatory Commission. They are collaborating actively with the U.S. Department of Energy and the Idaho National Laboratory to develop advanced fuel recycling technologies, because again, recycled nuclear waste to create clean energy is a huge part of the crux of the business. Once operational, Oklo plans for its primary product to be energy that is produced from its Aurora powerhouses. And as I noted earlier, rather than selling its designs, which is something that's very common in the nuclear space, they want to actually sell the energy directly to customers using these power purchase agreements to generate stable, recurring sources of revenue. And they also, again, really want to tap into their nuclear fuel recycling capabilities. They're developing technology that could see them launch their own commercial fuel recycling facility in the US by the 2030s. Oklo has noted that you've got these massive AI tech giants like Amazon, like Microsoft, that are shifting to nuclear energy to facilitate some of their data center power needs because of the tremendous boost in power that such heavy reliance on AI requires. And so there is a real opportunity for this business, I think, over the long run. They've signed one of the largest corporate clean power agreements in history with a company called Switch. This is a company that provides AI, cloud, and enterprise data centers. This agreement with Switch involves the deployment of 12 gigawatts of Aurora powerhouse projects through 2024. So that's one major agreement that Oklo signed. They have a partnership with Equinix, which I mentioned earlier, a global data center and co-location giant, and that includes a $25 million prepayment for a future 20-year power purchase agreement for as much as 500 megawatts of power for its data centers. Oklo's also received non-binding letters of intent from several entities, including Prometheus Hyperscale. They're a leader in the hyperscale data center industry. That non-binding letter of intent would involve supplying 100 megawatts of clean power to Prometheus Hyperscale's data center campuses under another long 20-year power purchase agreement. So very early stages of commercializing, but they are signing these agreements that could be very key, to their growth again over the long run. When they gave some updates in their earnings results, which came out the other day, they noted that they are finalizing their siting agreement. They've secured environmental compliance permit from the Department of Energy to move forward on what would be the first commercial small nuclear reactor in the U.S. They are the only company with secured fuel for their first reactor. And again, the Department of Energy has approved the safety design of their fuel fabrication facility to support its utilization. As they continue to expand the long-term agreements and letters of intent that are coming in, that builds their future customer pipeline and sets the stage for what their revenue model could look like over the next 10 and 20 years. And because they have these small modular reactors that they are hoping to build, they say these powerhouses can be installed in parallel with a data center's phased construction timeline. While there are many different use cases for their powerhouses, obviously data centers are a huge area of focus for Oklo in the future. So they give the example of how you could have a 250 megawatt data center that needs 4 of these small modular reactors built. But as those data centers scale up to 500 or 1,000 megawatts, so can Oklo's modular reactors in kind. They said these multi-powerhouse projects can be built with backup units, providing data centers with something like 99% reliability. Again, some of these major power agreements they're securing, notably that one with Switch, was a huge boom for the business, and I think bodes well for their ability to secure additional agreements of that kind in the future. Now, again, they're still operating at a net loss. They are burning cash at this point because they are heavily in the building and commercializing phase of their business model. They're hoping to break ground for their first reactor site soon. So there's a lot that's happening with this business. Certainly a lot to watch as we're looking ahead. I do think that they are well positioned to scale. Something they also said in their recent report is that their 50 megawatt reactor platform now scales up to 75 to meet growing AI data center demand. And they are, again, continuing to have really positive licensing developments as they are hoping to break ground in Idaho very soon. So interesting business. There are a lot of really positive updates with this one. These are some of the most recent ones. They are also looking into their fuel recycling business. I think there was an acquisition that they made of a company called Atomic Alchemy, which they say really enhances their nuclear technology platform. And that provides a lot of opportunities for them in different areas like medical, space and defense, industrial, semiconductor manufacturing. Atomic Alchemy specifically specializes in the radioisotope market. They say that's a total addressable market of about 55 billion as of the year 2026. And they've said, aging radioisotope facilities are causing acute shortages in supply for critical applications across sectors. Radioisotope technologies can significantly enhance the economics of nuclear fuel fabrication and recycling through sales of high-value radioisotope co-products. They say joint ventures with customers on radioisotope applications, including radiopharmaceuticals, are one huge growth area for the business. This acquisition of Atomic Alchemy and incorporation into their business, they see very near-term revenue opportunities from that as soon as Q1 2026. And they said licensing and construction milestones for their first radioisotope production facility is expected to start in 2025 and 2026. That could be another revenue source for them in addition to their power purchase agreement model that I explained earlier. A lot to watch with this business. I think anyone that's investing in it needs to understand where they're at in their business journey. There is a lot that they have to demonstrate over the next few years, I think, to warrant the level of excitement that we are getting from around share prices right now. So those are some things I would be thinking about if I was looking at taking a position in this stock.
Yeah, no, I've seen Oklo popping around quite a lot because this stock has gone up quite significantly. In the last year alone, it's up 140%. It did peak in February at $55, but even today, pre-revenue, this is already a $3.6 billion company. So the market is definitely excited for it, which makes sense because all of these big tech players did talk about nuclear, did talk about SMRs for the future, but these things take time, a lot of time to build, pass regulation and all of that. So there is definitely a lot of future success baked into the price, even at $3.6 billion. Now, of course, 10, 15 years from now, could be much, much bigger as they generate a lot of revenue. But like you said, you need to know when you're buying a name like Oklo, you need to know what you're buying today, what's already priced in for the future, what can go wrong, how long these things can take to build out but definitely an interesting name, especially after hearing all the comments from all the big tech companies, from Jensen as well during GTC. He basically said, look, big players will be energy limited in the future. And of course, that's why most of them are going to work on some nuclear solutions for the future. So definitely one of those names that I have on the side in one of those long bet watch lists. That and some other quantum names as well. They've all ran up quite a lot in the last 6 months, a year or so, but they all have, well, a lot to prove in the future.
I think that's right.
I do want to touch on one question, and I forgot the name. That's great. From Enjoying Shores. Thanks. That's also a great name. Yesterday we had good names, funny names. Today we have more of those.
Now, this is some very creative handles that people are using.
Yeah, no, for sure. So yeah, he was asking about luxury stocks. So what luxury stocks may do better in a downturn? Now, we've had high inflation. We've had maybe a downturn coming out of the pandemic. So you've had stocks like LVMH, European stocks that did get hit. Also because China is a very, very big market for them, and the Chinese economy wasn't doing well. Spending there is still quite down. That hurts a business like LVMH when you're looking at luxury. But then on the flip side, you have a player like Hermes, for example, also a European player. And that one, stock-wise, I think it's still up in the last couple of years. I think even the last year or so, still doing okay. Margin-wise, it is a much stronger company than LVMH. It's if you want to pick a luxury player, a stock, again, not financial advice, just my opinion here, Hermes is probably best in class. But for best in class, you are going to pay a very, very high premium compared to an LVMH, for example. Or if you want to put Ferrari in the luxury stock category, I think you can put that as well. It's also, I think, trading near its 52-week low. But if we're purely looking at LVMH, Hermes is best in class. It's not even close. And they showed us the last couple of years that even in high inflation times, even in economic downturns, whether it's in China or in other markets, they are a business that still doing quite well. So if I had to choose, it's probably that. Although valuation-wise, since this is a valuation hour, valuation-wise, LVMH has come down significantly enough. It's still also one of those incredible businesses that have been created in the last 100+ years, actually. It started as Louis Vuitton, Moet Hennessy, and it just bought more and more companies throughout the years. That's a name that if I would look at a luxury player that I wanted probably in my portfolio and not pay a super high premium, it's probably something like that. Although a Ferrari, I like the cars, so maybe that would be number two. It's also not cheap, but like I keep saying, for quality you have to pay up a little bit more. And here we're talking about luxury, and luxury you're always going to pay a little bit more. So yeah, Hermes, LVMH, Ferrari is probably the names that pop up in my mind right now. Do you have any names in the luxury group?
I think you named all those for sure. LVMH and Hermes is one that I find really interesting as a business for sure. And yeah, Ferrari. I have to say that. I have to say Ferrari.
In Italy, so yeah.
Yeah, it's in my blood. I can't get around that one. It's an interesting space as well to think about because we have seen that kind of historically speaking, luxury stocks and the luxury segment as businesses have been pretty resilient in times of economic difficulty, broadly because the customer base is more resilient. They are not generally so affected by the same headwinds that other people are. But I do think that it's been interesting to see some of the struggles that some of these companies have cited the last few years as they've seen sort of slow down, even in some of their target, customer market. I know that's something that LVMH has noted in some of their recent earnings results is speaking about how they've seen slowdowns, for example, in the Chinese market, and how that segment, which has been a key driver of luxury shopping, particularly over the last decade, has really seen slowdowns in the last couple of years post-pandemic. And how that's something that has impacted some of these businesses. And so you do still see, broadly speaking, a more resilient consumer than the non-luxury consumer. But there have been ways in which this space has been shaped and shaken by some of the dynamics we've seen the last few years. And I think that's been interesting to observe as well.
Yeah, no, I agree. I mean, we talked about dollar store, Dollar General. Now we're talking about the complete
right.
opposite.
The complete opposite.
Target. Yeah. But no, yeah, like you said, I mean, that side definitely sometimes doesn't feel any economic downturn. I mean, if you're willing to spend $300,000 on a car or $50,000 on a purse or whatnot, then
right.
Okay, I don't think high inflation or tariffs is going to impact you that much. But tariffs could impact those companies with their margins, which maybe we'll hear more about in 10-15 minutes actually.
Yes, we're waiting to hear. I saw a story before we got on. We've been expecting, obviously, new tariffs to be announced on April 2nd, some being retaliatory tariffs, but I saw some stories that there are going to be new auto tariffs announced today, which was a bit of an unexpected development. And I believe the president will be giving a press conference at 4 p.m. Eastern. So I'll be watching to see what that news is, as well as, if we have announcements regarding any other tariffs that might be unrelated to auto, but might somehow creep into the conversation. So there's a lot happening with the space right now to follow. Let's see. Well, there was a question I wanted to hit as well from Ed about, is there an overreaction with VRT Vertiv stock? Or is the data center stock price justified? So there was a little bit of an update with this business today. I mean, shares are down about 11% today. The stock is trading down about 30% year to date. And that reaction to the stock today was because there were some major analysts at Barclays that cut their price target for the company. So shares slumped more than 10% after that. They cut their price target, saying, Vertiv is well placed for revenue and profit growth this year, but in their opinion is also very vulnerable to any hint of slowing spending on data centers. So they cut their price target to $100 from the previous $111, and that was well below the roughly 139 consensus estimate from analysts. Now, currently, and this is again partly a function of the fact that the stock fell quite a bit today, shares are trading at around $81 each. So again, that price target had been 111, cut to 100 by Barclays analysts, well below the $139 per share analyst consensus. It's obviously, for anyone that follows the stock, a reality that the stock and the performance of shares, as well as the performance of the underlying business, is very closely tied to the pace of data center spending. For anyone that does not follow this business, Vertiv provides critical infrastructure technologies and solutions, including power, thermal, and IT infrastructure management to ensure continuous operations and performance for data centers, as well as communication networks and other critical facilities. But data centers are really the leading needle mover for the business at this point. So they offer a range of products and services to ensure reliable and efficient power delivery. And they notably provide solutions to manage heat effectively in data centers and other critical spaces. Products like enclosure cooling, high density room cooling, in-row cooling, rack cooling. They offer also integrated rack systems, modular management systems, and other IT infrastructure solutions. They serve a wide range of industries outside of data centers, but given what we're seeing in the demand for data centers right now and the rapidly paced world of AI, this remains a huge opportunity for Vertiv. They also partner with other clients like communication networks, commercial and industrial facilities, government agencies are also some of their clients. But critical power services, thermal management, racks and enclosures, that's a huge part of the business. Again, data centers have really been a driver of growth that we've been seeing in recent financial results, and including hyperscale, co-location, enterprise, and edge data centers. They operate globally. They have a presence in the Americas, the Asia Pacific, Europe, Middle East, and Africa. And they really specialize in technologies that ensure, the reliability and availability of these critical applications. So this was interesting. Obviously, the market hates uncertainty. The market's already having a bit of a bumpy day after the announcement that there were going to be new auto tariffs announced ahead of the previously announced deadline. But again, that price target slash was what was really moving the stock today. I think that anytime you see news like that, the stock is going to react pretty strongly. And I think that that's what we saw today. So I don't know if that, is in particular an overreaction. Now, broadly speaking, I think the stock has been, pretty richly valued. But this is also a business that is continuing to do really well from a financial basis. Their net sales in their last fiscal year were about 2.3 billion. That was that was in their Q4 2024, and that was a 26% year-over-year increase. They also reported fourth quarter trailing 12-month organic orders that were up 30% year-over-year. Operating cash flow of 425 million, adjusted free cash flow of 362 million. It's an interesting business. Something that they've noted is that data centers are really the huge lifeblood of the business right now. And that's something that they see being, I think, the case moving forward. They all are still working to achieve consistent profitability, which I think is something to note about the business. They do have a pretty strong liquidity position. They had about 2 billion on their balance sheet at the end of the most recent quarter. And their full year net sales were about 8 billion compared to about 6.7 billion a year ago. They reported a net income of about 496 million compared to about 460 million a year ago. So that is really positive, even though they're still dealing with some cash burn on a free cash flow basis. So some things to think about with the company. I think that the note from analysts that they were slashing the target because the company is very sensitive to any changes in data center spending. I think that is very much a reality that is baked into this business. I think that's something to understand for anyone that is looking at this stock as a potential investment. And I think, yes, the performance of the business is heavily tied to that. And the performance of share prices is going to be heavily tied to, I think, any shift in sentiment, whether real or perceived, regarding how the trajectory of data center spending is going. So I think the market reacted a bit strongly. We'll probably see shares go up again. It's worth noting that even the price target that they cut down to is still a nice upside from where shares are trading currently. But definitely something to bake into one's risk analysis, I think, for anyone that's looking at this business.
Yeah, no, I agree. I think, the beauty of the stock market is that sentiment or headlines can move the stock, but then we have 4 times a year where the company actually shows exactly what's going on during the earnings report and during the earnings call. So in between one earnings report to the other, stock can be volatile, but then we reach the next earnings report and they're like, okay, we beat across the board. We're still quite confident on our roadmap. And so the stock and especially the sentiment can flip quite rapidly. But of course, with a company like Vertiv, you could get some clues from the big players. Like if they suddenly say, okay, we are seeing that we are at capacity, demand-wise, we're fine, and so we're slowing down. Okay, then you're getting already some information about what's going on in the market, and that of course can affect a company like Vertiv, and same vice versa, right? If there are positive comments, then this will will be positively affected as well. So it's an interesting name. It's one that I've been following more closely because of everything that's been happening in the AI sector, data center build-outs and all of that. So definitely became much cheaper. That's for sure. It was very expensive.
Yeah.
It was very expensive. It became much cheaper.
Yes, absolutely.
We have, I think, time for maybe 1.5 questions. So I want to touch on this one from a day ago from Matt. Is Rocket Lab a rule breaker-ish stock, or have none of you three ever studied Rocket Lab business? Much to answer that one way or the other. He was asking that to Sanmeet, Tim, and Tom. So I am a Rocket Lab shareholder. I've been a Rocket Lab shareholder since $4 and something. So now at $20, I am quite happy with the performance. But I do think that it can go up much higher. It is, in my opinion, a rule breaker-ish stock. For example, I mean, quick quote here from the CEO, Sir Peter Beck. He is already a Sir from New Zealand. He said back in 2024, he said that last year, so over 12 months ago, 38% of everything that went into orbit had a Rocket Lab logo on it globally, which is quite impressive, seeing that this company is quite small. A year ago, it had a market cap of around $2 to $4 billion. Today, it's a bit closer to $8 to $10 billion. When you look at what Rocket Lab wants to achieve, of course, everybody's going to look at a SpaceX. SpaceX in the private market is valued at, well, I can't remember last time, I think $200 billion or something like that, close to it. Rocket Lab, of course, much smaller. SpaceX has Falcon 9, which are reusable rockets, so margin-wise makes more sense. It also has Starlink with millions of subscribers, so that's one way that they can generate quite a lot of revenue. And they're already working on Starship, which is quite big. Rocket Lab at the moment is, well, they're trying to be that one-stop shop for all your space needs. So when you think about Rocket Lab, you think, oh, it's a rocket company, launch system, launch services, and that's it. But actually right now, launch only makes up 1/3 of their revenue. 2/3 is actually systems, space systems. In the future, well, this year, in the second half of the year, they're expected to launch their first Neutron rocket, which could say is the equivalent of a Falcon 9, which means part of it can be reusable, which means margins, the margin profile on the launch services are going to be much, much better. Then the third part, so you have launch, you have space systems, and then the third part is the application layer. So whether it's having and operating their own constellations, building constellations for others, launching those as well, and then other applications, whether it's for pharmaceutical companies or or maybe even internet, just like we've seen with the Starlink. But the opportunities are quite big, seeing how small this company is already today, but how far along they are in their journey. I mean, we talk about SpaceX, we talk about Blue Origin. There are some Chinese players there as well, but this small company is already launching. I mean, Electron is a small rocket, very small rocket, and I think they're already at their 61st or 62nd launch with 100% launch success, mission success, I would say. It's pretty impressive. Then Neutron is when things get unlocked, because Neutron is I think 10 times more expensive for a customer to basically order, but it is reusable. So on the one side, you're getting way more money for one launch, and on the other side, you can reuse parts of that rocket, which means that, well, your margin profile becomes better and better. And I do think that in the future, this one will be in the category of rule breakers, maybe Hall of Fame, who knows.
Awesome. Well, thank you for that, Neil. And with that, we are up to the end of our hour. I'm sticking around for another hour. I know Danny is waiting to be ushered into the room here for our earnings show.
Perfect.
And here
Welcome
I am.
back.
And let me say, Neil, I'm very impressed by your extensive knowledge of rockets. Does that make you a rocket scientist?
No, but one day my goal is to go to space. So who knows? Maybe I'll be the first full member in space.
Nice.
Ah, there you go. That would be awesome. Well, thanks so much, Neil. Great to
Thank you
do
both,
another
and
show with
enjoy.
you. All right, Danny, we're back for another earnings hour. It's become a daily tradition.
It is, but let me just say, I am tempted to break out in a chorus of Rocket Man, but I will spare our viewers that pain.
Oh, it's such a great song, though. So I understand the urge. Fools, we're going to be talking about the earnings of a few different companies for this next hour. I know Danny wanted to talk about a couple different businesses. I myself, one of the ones I want to talk about today is Chewy, which reported a pretty great result this morning, I will say. But if you have any questions related to what we're going to be talking about, companies that have reported earnings, go ahead and get those in the Slido. The event code for that is Fool24. Danny, there's a few companies that are reporting and have reported today. What are you watching as we're closing out another day in earnings season?
A company that I have not followed very much, but seems to get a lot of attention around Fulham is Cintas. They are a uniform specialist in the field of business. So if you need uniforms, if you need, and I think they have a couple of different areas. They identify corporate identity uniforms and related business services. So they run uniform rental and facility services, first aid and safety services, and other segments. They rent and service uniforms and other garments, including flame-resistant clothing, mats, mops, shop towels, and ancillary items, as well as restaurant cleaning, supplies, and services. So there's a lot going on there. And this is a company that, as I said, I haven't followed very closely, but I became interested in listening to some of the other episodes of Fool24. And so I am here to break out a little bit of Cintas's earnings.
Sounds good.
So I'll start with the big information. So they reported their fiscal 2025 third quarter results. That is for the period that ended on February the 28th. So pretty quickly, about 4 weeks in. So their revenue for the third quarter was $2.61 billion, which was an increase of about 8.4%. Now that was ahead of its revenue target for $2.61 billion. Excuse me. Yeah. Sorry, I'm still fighting with this cough here that I just can't seem to shake. So their 2.61 billion surpassed the 2.6 billion that Wall Street expected, up about 8.4%. 8.4%. Now, a lot of that growth, about just less than 1% of it, was due to acquisitions that Cintas made recently. And so the company also had pretty impressive bottom line results. Now, the results were negatively impacted on the top line by 0.4%, which was the result of foreign currency exchange rate fluctuations, but their organic growth was 7.9%, which adjusts for the impacts of the acquisition and the foreign currency rates. Their gross margin of $1.32 billion was up 11% year over year compared to $1.19 billion from last year's third quarter. Their gross margin on revenue was 50.6%. So they expanded their gross margin from 49.4%. That's an increase of about 120 basis points or 1.2%. Their operating income increased 17% year over year to $610 million compared to $521 million in last year's third quarter. One of the things we always like to see as fools is the fact that the bottom line is growing faster than the top line. That means that the company is leveraging their expenses and eking more profit out of each dollar of revenue. So that's always a good thing. Now, they did point out that their operating income was negatively impacted by a $15 million agreement. Excuse me. $15 million agreement in principle to settle a loss of purported class action contract dispute. And both of those items were included in their selling and administrative expenses. And finally, their net income of $463 million for the third quarter was up almost 17% year over year. And finally, their diluted earnings per share was $1.13 compared to 96 cents in the third quarter. That was an increase of just short of 18%. And they also noted that, the company had their 4-for-1 stock split back in September. So this has all been adjusted to reflect that. They paid out dividends of $158 million to shareholders, which was up about 15% from the amount paid last March. So Synthesis President and CEO Todd Schneider said the company delivered strong revenue growth, operating margins, and cash flow generation. Our results are a testament to the superb execution by our employee partners and the differentiated value proposition we offer to our customers, providing for their image, safety, cleanliness, and compliance. So this was a earnings result that was, warmly greeted by investors and by Wall Street. It was much better than what analysts had anticipated. The stock was up about just short of 6% when the market closed today. I was really impressed by the fact that, generally speaking, you think about a company like Cintas as being, just kind of a run-of-the-mill, in the background, boring kind of business. And yet, they were able to deliver really impressive results on both the top and bottom line. The other thing that Wall Street seemed to be happy about was the company's guidance for fiscal 2025. They raised their diluted earnings per share. Originally, they had forecast a range of about $4.31 at the midpoint, and they have raised that to $4.38 at the midpoint. So that's generally also good news when you're looking at, a company's able to raise its guidance, and that's pretty something Wall Street likes to see. I'm going to have to buckle down and get a cough drop here in a minute.
I feel your pain, Danny. As you know,
I've
been down with the flu for about 8 days, and I've had the cough persisting on air. I feel your pain. All right, thank you, Danny. I don't know if you had any other thoughts you wanted to share on that. We don't want you
I did
choking out on air.
Sorry about that. There was one other point that I wanted to make. So the company said that it had ended its discussions to buy UniFirst, which is a company that they were in talks to acquire. They first, talked about that back in January. On Monday, they said they terminated discussions with UniFirst after failing to agree on key transaction terms. So apparently, they couldn't come to an agreement on, who was going to pay who, how much, is generally what it comes down to. I don't think investors minded that either. They have digested the last acquisition fairly well. It contributed to increasing, their gross margin. their bottom line. And investors are kind of breathing a sigh of release, because it's always a wild card when you do an acquisition. You never really know if there's going to be culture wars, if they're going to run into problems, with the integration of the new business into your existing business. And so the fact that it has gone well and it's expanding their bottom line, investors seemed to like that just nicely.
Amazing. Well, that was a great report on Cintas's earnings, and that's also not a company I've been as familiar with. So really interesting to hear about. I want to go ahead and talk about Chewy's earnings. This is a company I follow very closely, talk about a lot. I was excited to see a lot of the results that they delivered. The market's response was somewhat tepid. I think the stock is down about 1% today, although shares of the stock are still up well over 100% over the trailing 12-month period. But Chewy,
cry me a river.
yeah. So,
don't make Rachel laugh. She'll cough.
Yeah, don't make me laugh. I'll cough. Seriously. So what Chewy does, they're still primarily known for their e-commerce business, right? Their flagship platform where they sell pet supplies, services, food, toys, medication. They have their own regular pharmacy as well as a compounding pharmacy that they run. They sell pet health insurance plans in partnership with companies like Lemonade and Trupanion. They have a telehealth aspect to their business where pet owners can access, have a conversation with a licensed veterinarian on demand if their pet is ill. But their primary revenue stream has been for a long time their flagship e-commerce platform, selling a wide range of pet products, as well as some products geared towards larger animals like farm animals, but mostly pets, companion animals. They did have their first international expansion into Canada more recently. That's still a pretty small part of their business. They sell a lot of third-party brands on their platform, although they do have, some of their own products that they have launched. For example, they launched their own line of pet medicinal gummies, I think something like a year ago. But they have this subscription program called AutoShip, which is where customers receive regular deliveries of pet food, medications, other favorite items right to their door every month. That has been and continues to be, as you will see in this recent report, a significant driver of revenue and customer retention for the business. Chewy has been expanding into a wide range of new business areas. As I mentioned, they have their platform, they have their own compounding pharmacy, they have their pet telehealth business, they have their pet insurance plans. One of the biggest developments for the business recently has been their decision to open their own veterinarian clinics. And this is something that I've been watching very closely as well, because obviously this is a much more capital intensive area for the business. Historically, they have been known for their e-commerce business. So the decision to open brick and mortar vet locations where pet owners can bring their pet to receive everything from routine to emergency or urgent care is a real expansion and somewhat divergence from their traditional model. However, it does appear, and in my opinion, it does very well mesh with the longstanding model that they've had for a long time. Chewy has provided various software services to veterinary clinics, which also in turn had historically been a really effective sales funnel to the Chewy platform. Now that is very much proving to be the case with their own vet clinics. Not only are they seeing solid foot traffic in those clinics from pet owners, but it has also been very much a dynamic where, at the end of these visits, customers are very likely to place an order on Chewy.com. It is a very inevitable, easy, and direct sales funnel to the heart of their business. So that's been something that's been really fascinating as well. So this was their results for their fourth quarter and full year fiscal 2024. In fiscal 2024, net sales of 11.86 billion. That was an improvement of 6.4% compared to 2023. Chewy reported a gross margin of 29.2%. That was an expansion of about 80 basis points year over year. They also reported net income of 392.7 million, so just shy of 393 million. Basic earnings per share of 93 cents. That was an increase of 84 cents year over year. Looking at Q4, net sales were 3.25 billion. That was a nice uptick of about 15% from Q4 2023. They also reported their gross margin in the final 3 months of 2024 was 28.5%. That was a 30 basis point expansion. They also reported net income of 22.8 million for the final 3 months of the year. The CEO of Chewy, Sumit Singh, noted that top line growth and profitability exceeded the high end of our guidance ranges for both the fourth quarter and full year. It is also worth noting that I believe Chewy beat what analysts have been projecting, certainly on the bottom line, and I believe on the top line as well. The CEO noted that our performance was underpinned by strong active customer growth and compelling auto ship customer loyalty. As we embark on 2025, the momentum in the business has remained strong. We remain committed to executing Chewy's strategic priorities as we continue to drive innovation across the pet category. The company closed out their most recent fiscal year with about 2.1 billion in current assets, cash and cash equivalents of about 602 million. And again, net sales for the 12-month period were about 11.8 billion. Which was a notable increase from 1 year ago. They also significantly increased their profitability. Chewy is a somewhat more recently profitable business. They've only become consistently profitable in the last couple years. So I mentioned how they reported net income of about 393 million for their most recent fiscal year. That was compared to net income of about 40 million a year ago. So they significantly increased on the bottom line, which is really positive to see as well. Looking into their earnings call, I had a little time to kind of look through some of the highlights of this that I think were worth noting. As noted, Q4 net sales increased 15% year over year. Full year net sales increased 6% year over year. One of the things that management said was, again, strong active customer growth was a huge driver there. They said that our auto ship program, which I went into earlier, which is a lovely recurring revenue model for the business, auto ship sales represented 80.6% of Q4 net sales. That means that most of their sales are coming from recurring customers who have loyalty to Chewy, who like to receive those recurring deliveries of their products. The fact that almost 81% of their net sales are now from their auto ship business, which is their recurring revenue business, I think is notable. They also said that growth in auto ship customer sales meaningfully outpaced overall top line growth. You remember their overall top line growth in Q4 was about 15%, but their growth in auto ship customer sales in Q4 was 21%. And they also saw in the full year 2024, growth in auto ship customer sales increase 11% compared to fiscal 2023. They said that they also ended fiscal 2024 with about 20.5 million active customers. And they said that was our first year over year growth in 8 quarters. That is a metric that I think a lot of analysts and investors have been watching closely, as they've seen really strong growth and steady growth in profitability. Net sales have been steadily rising. They continue to derive really consistent growth from their auto ship business, but active customers have remained at a similar figure for a number of quarters now. So that's something that's worth noting. And that growth really drove some of the top and bottom line expansion that we saw in this last fiscal period. They also said they expect to deliver active customer growth in 2025. Management also noted we converted approximately 80% of our adjusted EBITDA in the year to free cash flow. That resulted in a record $452.5 million of free cash flow in fiscal 2024. So a really robust cash flow producing year for the business, which is something that has also been really impressive to me, seeing as they are more newly profitable in the last couple of years, not just on a GAAP net income basis, but also generating really strong free cash flow is something that you really like to see. It's worth noting that they also are seeing nice growth in their sponsored ads business. That is still a very small part of the business. For anyone that's not followed this more recent update, Chewy, and I believe it was just last year, launched a sponsored ad program where select brands can pay to advertise to shoppers on the Chewy platform. They do see advertising revenue as being a future, long-term source of growth to the business. It's just around 1% of sales right now. That was the scale that business reached in full year 2024. And that was in line with their expectations. But management also said that while it's still just around 1% of their business, that improvement in their sponsored ads division was the largest single contributor to year-over-year gross margin improvement. So that is something to watch because this is obviously going to be the most asset-light part of the business. Ad spend is on the rise again. That's something where we have seen some deceleration and pull back in the last few years, given the macro environment at large. But this is still, I think, a tremendous opportunity for them over the long run. And it is one that I think will continue to contribute to their gross margin expansion as well. Another thing that is worth noting, they said, we think the upper limit of our long-term entitlement for Chewy sponsored ads is up to 3% of total enterprise net sales over time. So that's what they're working towards. Now, they also gave some positive updates with regards to their Chewy vet care clinics. They said we successfully opened 8 of these locations by the end of fiscal 2024, which was the upper end of their target range. They had been previously forecasting that they would open 4 to 8 new locations in fiscal 2024. So they certainly met that objective. And they said, as a result, new and existing customers are deepening their engagement with Chewy. They said our clinic network continues to exceed expectations in both utilization and overall ecosystem benefits, serving as both a strong customer acquisition channel and an engagement flywheel. And they see this as being a roughly $25 billion addressable market, the vet services market that they have now entered into with the opening of these clinics. So a lot of really positive updates for the year as well. I think it's also, worth noting that they continue to see a really strong shift in growth from their recurring, revenue business. Non-discretionary spending, like consumables and health and wellness, continues to also be a really strong driver of growth for the business. Even though we're in an environment where consumers are spending more cautiously than in past periods. Pets are part of the family for many and most pet owners, and costs like food and healthcare are resilient and consistent costs that pet owners spend it on, regardless of really what is happening in the economic backdrop. And those areas of spending continue to be the biggest areas of growth for Chewy, even though they're, of course, benefiting from other more discretionary pet purchases. Also, the fact that new customers are up, reactivations of past Chewy customers were up. They said that churn was better as well from a year-over-year part of view. And they added over 400,000 new customers just in Q4 alone to their business, and they're continuing to see really strong growth as well from that sponsored ads business, which, as I noted, is just about 1% of overall net sales, but is still something that is contributing heavily and was the single largest driver of the improvement to their gross margins last year. One other thing I'll note is they have continued to really build out their network of automated fulfillment facilities. There are obviously still humans involved in these facilities, but these do tend to cut down on overall cost of labor as well as just the cost of fulfilling packages. They've been starting to ramp up more volume in some of their key facilities, including their Houston facility, which is one of their major areas where they have concentrated their expansion of these automated facilities within their broader fulfillment network. I'm watching with, I think, interest and fascination as I continue to see the expansion of their ads business, the expansion of their vet care clinics. That is going really well by all accounts and from the updates that we're seeing from management. And this is a business that is growing their profitability, growing their GAAP net income and free cash flow in the process. And so I think overall some pretty great results from this business, pretty solid updates. I have more I need to dig into from their earnings call, which I'm sure will come up in some recent shows, but overall pretty solid results from Chewy.
Yeah, there was a couple of things. I wanted to point out that I actually am a Chewy customer, and I have a little puppy dog. His name is Milo, and Milo is about 27 pounds. From what I was told when we got him, from the shelter, that his mom was a Pekingese and his dad was a Labrador. No, switch that. Switch that. So he looks like a little mini lab, but he's got the Pekingese teeth where he's like. So he's a cute little guy, but apparently he has a heart condition, and so we took him to the vet, and the vet said, if he's got, can't remember exactly what it's called. He's got a hole in his heart valve, and it gets kind of squishy. But as long as he takes his medication every day, he just turned 13 last week. And so we get his heart medication from Chewy, where we're getting it from the vet, and come to find out that we could get a similar tablet with twice the dose, and you break the little tablet in half and you give him half the tablet each morning and evening. And Milo's doing fine. I like the fact that I was able to get this medication on Chewy. It's cheaper, and they ship it automatically. And every once in a while, like I'll get an email from Chewy that says, oh, by the way, this prescription is due for a refill. Please call your vet. And I call the vet, and they, either have me come in and take the puppy in for his checkup, or they just send the prescription through. And, Milo is expected to live a long and healthy life. So, I kind of like that about Chewy, just, from a personal perspective. There was one or two things that I saw in the call that I was pretty impressed by. You mentioned one of them, which is that even though their, revenue grew by 15% in the fourth quarter, their auto ship revenue grew by 21%. And that's impressive, because that means their most loyal and their target market, their most loyal customers are spending more money with them. The other thing I noticed is an area that has been, challenging, that has been a challenge for them, has been hard goods. And hard goods is the things like, pet toys and leashes and beds and grooming tools, as opposed to consumables, which is pet food and pet treats and such. And that was an area that had not been growing. And they noted specifically that they had a modest return to growth for their hard goods merchandise. So I think both of those things are a testament to the fact that even though we're still in that inflationary environment, even though people are cautious about their spending, eventually one of the areas that seems like it will return faster than general and overall consumer spending is spending on our pets.
Yeah, absolutely. And it's been a fun business to watch as they've expanded, particularly over the last couple of years. One other company I wanted to also chat about as we're looking at earnings today. Let's see. Paychex reported, and I know you also wanted to talk about Dollar Tree. I always confuse Dollar Tree and Dollar General, but I think I have them separate now in my head because I talked about Dollar General earlier. So I'll give your throat a bit of a rest with the coughing, and then I'll talk about Paychex, and then I'll kick it back over to you to talk about Dollar Tree. Paychex. This was their third quarter of their fiscal year, so not a full year of results. I actually haven't checked to see how did the stock respond. This is like a little game I play. Oh, up about 4% today during trading hours. Interesting. Okay. So the market responded pretty positively. Shares of Paychex, for what it's worth, are up about 26% over the last year. And earnings met what analysts have been estimating, or were just a little bit better, actually. So they beat a bit on the bottom line. The market seemed to really like that. Paychex, for anyone that's not familiar, they're a company that specializes in human capital management services. So payroll, benefits, insurance. They offer services for small businesses, large businesses, accounting professionals. So their services and solutions include things like running payroll, processing checks, managing employee information, helping companies select and manage benefits like insurance, retirement plans, flexible spending accounts, managing employee information, performance evaluation, so the human resources side of the business, things like time and attendance, helping companies calculate, file, and pay taxes, providing workers' compensation insurance, unemployment insurance, providing 401k options. So sort of the full spectrum of needs that these companies across industries and both small and large businesses face in their human capital management needs. So they have their all-in-one platform, Paychex Flex, which is for HR, payroll, administering benefits. They have Paychex PreCheck, which helps employers preview pay stubs before processing payroll. They have a platform called Paychex Analytics, which helps generate reports and analytics to help companies make integral day-to-day decisions about the business. They also have employee self-service options, so helping employees enroll in benefits and update their personal information. So Paychex primarily makes money by providing payroll processing, human resources, and other human capital management services to small and medium-sized businesses. A significant portion of their revenue also comes from professional employer organization, or PEO services, as well as interest earned on client funds. So they handle all the complexities of payroll, including wages, calculating deductions and taxes, and issuing paychecks for their clients. That's a huge part of their business. And then all of these different HR solutions I mentioned, like employee onboarding, performance management, and compliance support. They help businesses as well administer their employee benefits programs, including health insurance and retirement plans. And then there's that professional employer organization services, PEO services that they provide. And this is really taking on the role of co-employer, handling HR, payroll, and benefits administration. And then they actually earn some interest income by investing client funds that are not immediately needed for payroll or other transactions in high quality investment grade securities. So a really wide ranging business, and some elements of their revenue model that might not be as obvious at first glance. So they had a pretty solid set of results. As I mentioned, they beat on the bottom line in terms of compared to what analysts had been projecting. It is also worth noting that Paychex is a dividend payer, and they are a fairly long-standing dividend payer as well. Their most recent dividend was 98 cents a share, paid at the end of February of 2025. They have pretty consistently paid a dividend. I believe they've increased their dividend every year for about 15 years at this point. And their yield is about 2.6% based on current share prices, which is effectively double that of the average S&P 500 stock. Paychex Q3. So they reported total revenue of about $1.5 billion For the 3-month period, that was a 5% increase from 1 year ago. They reported operating income of about $692 million. That was a 6% increase from 1 year ago. Adjusted operating income of $709 million, up 9% year over year. They also reported diluted earnings per share of $1.43. That was up 4% from the $1.38 that they reported 1 year ago. Now, looking at the first 9 months of their fiscal year, total revenue was about $4.1 billion. That was a 4% year over year increase. Operating income for the 9-month period was approximately $1.8 billion. That was up about 5% compared to the same 9-month time frame in fiscal 2023. And diluted earnings per share, $3.76 for that 9-month time frame. That was a 4% year-over-year increase. Something that was noted by President and CEO John Gibson, he said the third quarter of this fiscal year has been a transformational time at Paychex as we position ourselves for the digitally and AI-driven future of human capital management. We believe the combination of our continued positive momentum and the pending acquisition of Paycor, which is something else to watch with this business, positions Paychex for future growth. They also noted our investments in automation and technology are boosting efficiency across the organization, and that resulted in operating margins of 45.8% and adjusted operating margins of 46.9%. That was an increase of 180 basis points compared to the prior year period. As noted, Paychex is in the process of acquiring Paycor, which has historically been a competitor, another leading human capital management company. Specifically, they want to expand their AI-driven HR technology and advisory solutions with this acquisition, which I believe is a $4.1 billion acquisition. Paychex's expertise in small and medium-sized business solutions should be really well complemented by Paycor's mid-market focus and focus on technological innovations. The deal is expected to close, I believe, in the first half of this year, so in the next couple months, subject to regulatory approvals and obviously other customary closing conditions. This is an interesting business. You know, they obviously serve a really essential need. One of the things that's been interesting to note and that they alluded to in this earnings report was how they have been leveraging AI to maximize the efficiency of their HR tools and processes. They offer tools like Recruiting Copilot, which is AI driven. They have, it's an AI powered tool, Paychex Recruiting Copilot, that helps small businesses find and contact qualified candidates quickly. They have a talent matching tool that uses AI to help identify potential candidates. They also have been using AI tools to help with their clients with candidate sourcing, assessments into applicant qualifications as well, but also to streamline things like HR analytics. So they have their generative AI digital assistant that makes it easier for business leaders and HR professionals to use and understand the data in front of them. So that's been interesting to note the way they've been incorporating that into their business. They do expect as well with the Paycor acquisition, which is also expected to add to their AI capabilities, that they will have a combined base following the acquisition of nearly 800,000 customers. And they said, you know, they think this will make them even better positioned to serve their total addressable market. So fascinating kind of business. They're doing quite well. Broken down by revenue, you know, their management solutions revenue grew 5%. Their professional employer organization and insurance solutions revenue increased 6% in the quarter. Interest on funds decreased slightly. So the growth rates in those other segments really offset any declines that you're seeing there. You know, net income as well for the first 9 months of the year was down. Some of that would be related to the impact of their acquisition that is pending. But in this most recent quarter, they reported net income of $519 million. That was a 4% increase from 1 year ago. So a pretty solid quarter for Paychex. A lot of things to watch with them, particularly the pending acquisition of Paycor is really the next big needle mover for the business moving forward.
You know, as a former accountant, well, I'm still an accountant, but as a former office manager and accountant in small and medium-sized businesses, one of the things that I recall was that long rivalry between ADP and Paychex. And I know that we used to regularly get office visits from sales reps from both companies. And we used, excuse me, we used ADP for the majority of that time, but Paychex was right in there. They were trying to get some of that business. I looked it up when I heard this was one that you were going to recover. And it turns out that ADP continues to be the leader. It has somewhere in the neighborhood of 65% of the market. And now at Paychex market share, it varies depending on what segment of the market. But I thought that was interesting. I think with this acquisition, I think what they're trying to do is they're trying to basically bulk up, get a little bigger, so that they can better take on ADP and maybe get some more market share. So that is something that's really interesting, I think, to watch, because that could basically be the next step in Paychex's evolution.
Yeah, absolutely.
Well, the company that I wanted to talk a little bit about here is one that I don't follow that much, but it's been in the news so much lately. Everything that's going on with these ultra discount retailers, particularly Dollar Tree. Now, if you just to kind of step back and give a little context, if you go back to the big recession that we had between 2007 and 2009, I looked this up earlier, and Dollar Tree actually grew by 21% during that period. At the same time, the S&P 500 was down 47%. So there was a big wide gap. And this was a company that was generally, considered to be recession resistant. The problem is, as it turns out, that they are not necessarily inflation resistant. So if you look back at the environment that we've had for the past several years, one of the big things impacting these dollar stores, and I'll use that term loosely, is the fact that you have the 1-2 punch of inflation is increasing the cost of the goods that they sell. So many of them are no longer truly dollar stores. But then also their core customers are lower income households that go in and try to get these good deals on whatever happens to be around. And because consumers have been pinched by inflation and having to really make decisions about where to spend their hard-earned dollars, because everything at the grocery store costs more, everything at the gas pump costs more, and so a lot of what's getting squeezed out here is these dollar stores. So this double whammy of less income for the people that generally shop there, because their discretionary spending is being pinched. But then also on the other side of the coin, you've got inflation making their products more expensive. So there's been a lot of trouble, in the dollar store industry. Lower spending, strained finances, the competition from Walmart, the growth of e-commerce, and some of the stores' issues were self-inflicted wounds, I will say. When Dollar Tree decided to acquire, I need to make sure I get the names right, but Dollar Tree acquired Family Dollar. And it turned out that that was an ill-fated acquisition because Family Dollar had a different demographic, and they had a different business model, and it turned out not to be a good fit from a strategic standpoint. So those are some of the things that we have seen. So when Dollar Tree reported its fourth quarter results this morning before the market opened, the headliner on their report was that after a review of strategic alternatives, they concluded that they were going to sell the Family Dollar, which, if memory serves, cost them about $9 billion years ago. They were going to sell that to private equity for just over $1 billion. Ouch. That's a case where they did not get a very good return on that investment, I'll tell you. Now, they are looking at that as one of a number of steps that they need to take to get their business back on track. They did report, same store net sales that grew by about 2% year over year in the fourth quarter. And that was about 1.3% on higher ticket or sales receipt, and about 0.7% on traffic. So they're increasing the traffic in their stores, and the people that are coming in are spending more. So that was, the good news. They still had a loss per share of $17.17 from continuing operations. And when they say continuing operations, what they're talking about is the fact that they are now selling, the Family Dollar. Excuse me. So there was some other good news. Their diluted earnings per share, when you adjust out the losses, they had adjusted earnings per share of $2.29, $2.11 from continuing operations, 18 cents from discontinued operations. They had a negative impact of only having a half year benefit from the Family Dollar stores. Now they are looking for first quarter revenue of about $4.5 billion for their net sales, and about $1.10 to $1.25 on adjusted earnings per share, with no benefit from the Family Dollar Tree. So I think, this they are a business that basically are being hit by a perfect storm. And so I think the decision to shed, this Family Dollar business, which has just been an albatross for them, I think that is probably the right decision. Then it's going to give them about a little bit less than $1 billion. I think the net proceeds are going to be about $800 million. And they expect that there's going to be, an economic impact of tax benefits from the loss on the sale of those operations. So you're going to see a little bit of a bump there on the bottom line. So be sure to focus on what their operating income is going forward, and not necessarily what their net income is, because you're going to have a little bit extra there from the tax benefits. But like I said, that is pretty good news. The fact that they had same store sales growth of about 2%, that was a result of both an increase in traffic and increase in the general ticket, and their gross profit was down. It contracted about 130 basis points, down to about 37.6%. Most of that was the result of an extra week of sales that they had in the same quarter in 2023. And so when you tack that on, it wasn't really an apples to apples comparison. They also had higher shrink, which is inventory parlance for stolen merchandise or lost inventory. They also had some markdowns. Freight costs were higher because of inflation and the cost of fuel. So again, tough business. I think the company is probably better positioned now than they have been, by shedding the Family Dollar business. But I got to tell you, I am certainly glad that this is a company I'm not investing, because they are just having a tough time.
Yeah, it sounds like it. I was talking in the earlier hour about some of the struggles that Dollar General has had, and some of them have been similar. I think Dollar General is doing a little bit better financially, for sure. But it's interesting to see some of the headwinds this particular space has been dealing with, and Dollar Tree in particular has been having a difficult time of late, it sounds like.
Slammed.
One company I didn't get to yesterday, and we have a few minutes left in the hour that I want to talk about, is Intuitive Machines. We're sort of covering the full spectrum of industries today. This is a lunar space exploration stock. We talked about pet stocks. We talked about Dollar Tree. Talked about human capital management company today. So a lot of different businesses that have been reporting. For anyone that doesn't follow Intuitive Machines, they're a space exploration company. They focus on providing lunar access, data transmission, and infrastructure services to support commercial and government exploration of the moon. Their mission is to open access to the moon for the progress of humanity. But they specialize in lunar exploration. They offer services for transportation and payload delivery, data transmission, and infrastructure as a service. They successfully landed the first spacecraft on the moon's South Pole region. It was the U.S.'s first return since Apollo 17, and it was the first commercial lunar lander to transmit valuable science data of each NASA payload from the lunar surface. They have won multiple contracts from NASA to send scientific experiments and technology demonstrations to the moon. This is a company that was founded back in 2013. And it has really evolved as from its origins as a think tank into a space exploration company. As noted, they've secured multiple contracts with NASA, including under NASA's CLPS initiative, which aims to deliver payloads to the lunar surface. They have a contract to deliver payloads to the moon's South Pole, exploring for water and other resources. They also have a contract to deploy lunar relay satellites and provide communication and navigation services as part of NASA's Artemis campaign, and have a contract to build a lunar terrain vehicle for NASA's Artemis 5 lunar mission. So it's an interesting business. They are more newly reporting revenue. Obviously, their revenue is highly tied to the trajectory of the government contracts that they secure. They are exploring opportunities to expand their business beyond NASA contracts, which is essentially what their revenue is composed of at this point. They've talked about offering ride-sharing services to non-NASA clients who want to deliver their payloads to the moon. They're also looking to develop new capabilities, such as in-space orbital transfer vehicles for government customers. So there's a lot of opportunity, for the business. As I mentioned, a significant portion of their revenue at this point is from the Commercial Lunar Payload Services, or CLPS, program under NASA. So they have multiple contracts under this program, which is all about basically entirely focused on delivering payloads to the lunar surface. For example, they had secured as well a major $4.8 billion contract with NASA for communication and navigation services in the near space region under NASA's Near Space Network. And this contract was really crucial for supporting NASA's lunar exploration goals over the long term. Beyond the CLPS and NSN contracts I just mentioned, they do have other NASA contracts, including a study contract under the Next Space Technologies for Exploration Partnership Appendix R program. So their backlog, it really represents that estimated revenue from awarded contracts, and that's obviously a major indicator of potential sales and a key factor in the company's long-term performance. So they hold several contracts under these different programs that I mentioned. Intuitive Machines was one of just 9 companies that was selected by NASA in 2018 to bid on their CLPS program, their Commercial Lunar Payload Services program. And that was when they were awarded $77 million by NASA to construct and launch their Nova C moon lander. And that was the mission that was launched in 2024, called the Odysseus IM-1. The spacecraft spent 6 months traveling to the moon. And upon its orbit and descent to the moon's surface in February of last year, Intuitive Machines' Nova C lander became the first U.S. aircraft to land on the moon in more than 5 decades. So it's an interesting, business. Obviously, they're rapidly expanding their government contracts. And the increase in project funding directly correlates with their growth in revenue. But it's still a company in their very early stages. It's obviously highly capital intensive. And right now, while they're looking to expand outside of government clients, their business depends entirely on their ability to fulfill a fairly limited number of contracts with government agencies like NASA. Now, just in the latter part of last year, they had snagged another multi-million-dollar contract, this one worth about $117 million through NASA's CLPS program. And that was their 4th contract award from the agency. Now, they just reported their results for their full year 2024. That was a couple days ago. They gave some updates. They said they were awarded additional contracts for NASA's Near Space Network, from direct to Earth services to regions around the moon and beyond the moon. They said we continue to diversify our customer base, that they had an in-space orbital transfer vehicle government contract with an unnamed government customer. They said they reported a record backlog of $328 million. That's a 22% increase year over year, and the highest quarter ending backlog in company history. They achieved $54.7 million of revenue in Q4. That was up 79% year over year. $228 million in revenue for the full year 2024. That was nearly 3 times the revenue that they reported in 2023. They said they are working towards profitability. They actually did deliver a positive gross margin in Q4 as well as for the entire fiscal 2024. And they said that that was their 2nd consecutive quarter of positive gross margin. They ended 2024 with about $208 million in cash. As of March 10th, their cash balance was $385 million. For 2025, they are looking to achieve positive run rate adjusted EBITDA by the end of 2025. They're also looking to generate revenue between 250 and 300 million for the full year. And again, that's compared to the 228 million in revenue that they just reported for fiscal 2024. So interesting business for a lot of the reasons I noted. This is obviously a highly speculative business. They are still operating at a significant loss. And this is something that will likely continue to be the case for the near future, although they are seeing improvements in gross margin, as I mentioned. They are also working to expand, their client base outside of NASA. They have this one now contract with an unnamed government customer that does not appear to be NASA related to their building an orbital transfer vehicle. So interesting business, Intuitive Machines. Wanted to talk about that one before we closed out the hour.
Yeah, we should probably get Neil back to tell us a little bit about, since he's interested in rockets, maybe he's got a take on lunar machines as well.
Yeah, it's an interesting business model. And this is a company I started to follow more closely, I'd say about 6 or so months ago. So it's a more recent one on my radar. As I mentioned, fairly speculative, but interesting business.
And with that, we're at the top of the hour.
Indeed.
it just seems to go by. But the good news is that you're going to get the analytics skills of Jeremy Bowman and Will Healy, who are going to talk to you about some of their favorite buy the dip stocks. And there are some good ones.
Awesome. Well, hey guys.
Whoa,
Hey.
Buy the dip stocks. I like them both.
Can't wait. Thanks, guys.
All right. Thanks, Rachel and Danny. Will, how are you doing?
I'm doing great. How are you?
Pretty good. Yeah, I think this is our first time on the show together, so nice to be here with you.
Yes, but I think we did some deep dive shows earlier, but this specific show, you're right, this is the first time. So good to finally be with you on Fool 24.
Yeah, definitely. Well, as Danny let the audience know, we're calling this the Buy the Dip hour. So here to our chosen theme is given the fact I think maybe the Nasdaq has slipped back into correction territory today, so maybe a timely theme for the day. But I think we've gotten a lot of questions on Fool 24, of course, with the market pullback about I think some people are obviously nervous about it and that sort of thing. But I think if you are a long-term investor, and depending on your time horizon and that sort of thing, it is a good time to think about stocks you might want to buy on a dip, or I think it's always good to have a watch list handy, that sort of thing for a potential pullback in the market. Putting a silver lining on that. So yeah, I think we were focused on tech stocks. Maybe I cover consumer goods stocks as well. I don't know, Will, is there any sectors in your wheelhouse?
I think we covered pretty much the same sector, because I focus mostly on tech and consumer. And even when I go outside of that, there's usually some tech and consumer tied to it.
Yeah. Right. Well, well, post any questions you have. We'll do our best to get to them. But I think, probably our best information would be in the consumer or tech sectors. But we can talk about a couple of stocks that have been on our radar.
Yeah, and for those of you just joining us, you can ask us questions at Slido. That's slido.com, and the code is Fool24. So feel free to ask anything you'd want. But yeah, as Jeremy alluded to, our wheelhouses are tech and consumers. We'll probably do a little bit better for you in those particular areas of investing.
Yeah, and as always, we can't give personal advice, but we'll happy to field any questions and discuss it as we can. But yeah, it's we don't know your personal investing situation, that sort of thing. But maybe to kick it off, I think, and I think this is a stock that you cover as well. Will, one stock that I always like to think about in times like these is Mercado Libre. Mercado Libre is a Latin American e-commerce and digital payments company, and this is one of those. I think it's some ways it's harder to get a handle on international stocks. It's these companies tend to be the kind of companies we engage with day in, day out. The way some U.S. companies, it's easy to think of Mercado Libre as the Amazon of Latin America, and there are a lot of similarities between the two things. I think Mercado Libre has done very well historically since I believe the IPO was 2009. But the company we started around 1999. It was sort of jumped on the e-commerce train pretty early in Latin America, and I think they've just snowballed with they kind of turned that into a first mover advantage. And much like Amazon, they've kind of built out a complementary businesses with a e-commerce marketplace, digital payments, which is called Mercado Pago, which is larger than the e-commerce business by some accounts, and they have point of sale machines, and they've kind of built out a brick and mortar network to complement it as well. And they have a logistics business known as Mercado Envios. They do credit, asset management, even, and they have a fast growing online advertising business as well. They just seem to deliver pretty stellar growth quarter in, quarter out. I remember after the pandemic, when we saw pretty much every e-commerce company in the world, or certainly in the U.S., kind of slow down and hit some pretty stiff headwinds, which makes sense after we were all shopping online during that period. And Amazon, I think, might have been down to single digits growth or something after that. Mercado Libre was still full speed ahead. So they do about half of their business in Brazil. Mexico and Argentina are their two other large markets, but they're focused across Latin America. But it seems like kind of business, and I think a lot of investors too are maybe looking to diversify outside of the U.S. given the noise around tariffs and the trade war and that sort of thing. So this is one for me that I've bought it a couple times on pullbacks like the one we're in now, and it's down about 13% or so from its peak. So not a huge crash or anything, but I think it's a good one to maybe keep in your back pocket or up your sleeve if we see a sell off here, because it seems like the business is pretty unfazed.
Yeah, it was down a lot more. That it kind of came back, and now it's pulling back a little bit again. So it's it's 13%. That puts it in correction territory. But this is a very interesting business, though. It operates in Latin America, which is not known as a great place for business, but this company has actually been able to thrive on Latin America's problems. For example, as Jeremy said, it started off as an e-commerce business. Well, especially 20, 25 years ago, Latin America was a cash-based society, and huge swaths of the population lacked a credit card or a bank account, so they really couldn't shop online. Hence, Mercado Libre created Mercado Pago to provide digital wallets, payment cards, products like that were workarounds that would allow these cash-based customers to shop online. They've since expanded Mercado Pago to serve customers that aren't tied to Mercado Libre's e-commerce site necessarily, and that's kind of they're kind of the founders of Latin American fintech in a way, because you look at an American fintech like PayPal or Square/Block. They were accustomed to dealing with customers that had credit cards or bank accounts. That really wasn't the case with Mercado Libre, so they've taken a completely different approach with that. I too own shares of this company. I bought some in 2022. I wish I had bought more now, because it's been one of my more successful picks. But I like how this company really thrives off regional troubles. If you've been following the news, Argentina's been having a hyperinflation issue. It's kind of come down lately, but Mercado Pago stepped in by creating investment accounts where investors or customers rather could shelter their income and maybe hedge against some of this inflation. And a lot of times the shipping isn't quite as robust. The supply chains aren't quite as developed. Mercado Envios was created to help customers, or specifically the e-commerce customers, ship and fulfill orders. So they've created a business that can work separately on its own or together with other parts of Mercado Libre. So it seems like the more trouble the outside environment throws at this company, the more it thrives. So it's that bodes very well for it, definitely.
Yeah, they've definitely built a wide economic moat through those those complementary businesses you mentioned, like logistics and payments, and that was a good walkthrough there with the history. I think they've also defended their market share very well over the years from Amazon has, Amazon operates in Brazil, but they really haven't made any kind of dent in Mercado Libre. They face competition from C Limited, Shopee, e-commerce brand. And they still continue to grow.
I think with Amazon, their bigger worry is Mexico, though, because that's right across from the U.S. But they've been able to thrive despite that. And I mentioned inflation in Argentina. Interestingly, in Brazil and Mexico, that really hasn't been an issue. I think it's marginally higher inflation than it is in the U.S. But their inflation, the inflation in both countries is still well into the single digits, despite all the challenges. So they've been able. That's helped the company to thrive, I think, or the country in general, but certainly the company.
Yeah, typically, I know the way they report, you see a pretty big or a gap between their as reported revenue growth, and then their currency neutral growth. So there's, I think a lot of that is from Argentina. So yes,
Argentina, this is the triple digits when it comes to currency based revenue growth. But I think it slightly lags Brazil and Mexico. For example, in Q4, this is in U.S. dollars. Brazil 38%, 43% for Mexico, and 31% for Argentina. But you look at the currency neutral, where they deal with local currencies. Brazil up 62%, Mexico up 64%, Argentina 212%. So a little bit different. Yeah, a little bit different picture there.
Yeah. Argentina is no stranger to economic crises, unfortunately.
Yes. But it hasn't stopped Mercado Libre from thriving, certainly. Although they did move their headquarters outside of Argentina a few years ago. The founder, Marcos Galperin, he was a student at Stanford, and used his connections there to help get the funding to get Mercado Libre launched, and then moved it to Buenos Aires after that. But he's since moved to Montevideo, Uruguay. I think Mercado Libre was having some trouble with the Argentinian tax authorities, at least in the previous administration. I don't know how their relations are with the current administration, but they've definitely had their political issues. But they've always been able to adapt and pivot to minimize the effects of that.
Mm. Yeah, I didn't know that. I knew they were based in Buenos Aires. Well, we got some questions in the queue, so maybe I'll tackle one of these.
Okay.
Hopefully we'll get some new ones in. I see Carson Joseph Heldman asked, I'm a stock advisor member and was wondering if there are any attractive dividend stocks that might pay 5% or so over time. I'm gonna assume you're talking about a 5% dividend yield. One dividend stock I always like to talk about, or I think is a good starter if you're looking for just a reliable dividend yield, is Realty Income. It's a REIT. They do they're a triple net landlords, so they pass off a lot of risk onto their tenants, such as insurance, taxes, and maintenance. Company, they pay a dividend every month, which I think if a lot of investors, certainly if you're a retiree and you get your bills monthly, nice to get a monthly check. Their dividend yield right now is 5.8%. They've raised their dividend every quarter for 100 quarters. So that the stock itself hasn't done. Like a lot of REITs, that's lagged the market a little bit in the last couple of years. There's the high interest rate environment has been difficult for the REIT industry for two reasons. It makes it more expensive to borrow money to expand and buy new properties, and then bonds are more attractive to investors, so you tend to see prices and valuations in the REIT sector come down a bit. But I think it's a good long-term one to hold. another dividend stock that's not quite at 5%, but I'm intrigued by at this price, and it certainly fits with the buy the dip theme. Is Target. Target has a 4.3% yield, dividend yield right now, and the business they've had some challenges, but I think they're differentiated enough in the retail sector that I think they have a good long-term position to grow from. They kind of announced this rebrand at their last earnings call, and they see themselves adding 15 billion in sales over the next 5 years. So I think they feel confident they have a strategy for getting back to growth. Stock has price to earnings ratio of just 12 right now, which if you compare them to Walmart or Costco or even some other retailers is really dirt cheap. So I think the sell-off has gone a little too far. A long-time dividend payer as well, dividend king, I believe, meaning they've raised their dividends every year for 50 years straight. So certainly a reliable dividend stock there. And if you're looking for value, I think it's pretty good right now.
Actually, those are the two stocks I was going to suggest as well. Also, I might add that Realty Income, it's not only the monthly dividend stock, but they've increased their dividend at least one time a year since 1994. Now, I think there's been 4 or 5 dividend increases over the last year. I can't remember exactly, and none of these increases are anything to write home about. But over time, they add up. So that is something to watch for that reason. As you probably know, unless you're a real estate investment trust like Realty Income, dividends can be taken away at any time. So often companies like Target or Realty Income will increase their dividend every year to build confidence in the dividend. Because if you back away from a dividend streak, I think AT&T did that a couple of years ago after 35 years, it tends to undermine confidence in the stock. So companies do not like to abandon these streaks unless they absolutely have to. So it's not a guarantee that you're going to get that income, but it does make it a lot more likely. Another thing to note on this before we get off this topic, I don't mind that people are trying to seek yields 5% or higher. Of course, we all want to make money we all want to make more money. Unfortunately, the S&P 500 average dividend yield I think is around 1.35% right now, give or take a few points. So if you're going 5%, you're already going almost quadruple that. So once you start getting into stocks that pay that, you really have to do your due diligence to make sure that the company is actually generating enough money to pay that dividend. Because you have Target right now, which I think it's paying a dividend above 5%. And it looks like on the surface it can keep making that payment. However, it has 144 billion in debt. It's not really making a dent in that debt. I think someday, in order to stabilize its balance sheet, it's going to have to either cut that dividend or eliminate it entirely for a while. So, that's an example of a stock that, yes, it pays above 5%, but the payout is probably not safe. So I wouldn't necessarily recommend that one. But it's always good to look for yield where you can, assuming the company can actually maintain that dividend long term.
Yeah, that's a good point. I just wanted to add, the S&P 500, we've seen the dividend yield kind of shrink over time there. So, it's definitely harder than it has been to find those high yield stocks.
Yeah, I generally encourage. I mean, if it's like maybe twice that, I'm not concerned about that. But once you're, really you should check anytime. But definitely when you're north of maybe 3%. You really need to do your due diligence and make sure they're generating enough free cash flow to actually cover the cost long term. Because if they go too many years without generating the cash flow, or they're like in Verizon's case where they have to spend too much money on capital expenditures, they're going to have to find money somewhere to cover those debts or to cover sometimes its expenses, and often the dividend will be the sacrificial lamb. A lot of dividends got sacrificed during the pandemic, like Disney and Carnival Cruise, for example, because of such trouble. So you always have to watch out for that as a dividend investor.
Yeah, good point with AT&T. Often, you see the declining businesses at one point or another, the dividend gets eliminated. We saw that with Intel as well.
Yeah,
I think
yes, we did.
Walgreens was another one, though. I guess they're being acquired now. But yeah, it's yeah, certainly a risk. Yeah, you gotta want to watch out for those yield traps.
Yeah, of course, Walgreens you could probably see coming if you knew how to read a balance sheet and a cash flow statement. But yeah, that's probably the silver lining in this. If you know how to read a balance sheet and a cash flow statement, a lot of times you can see these things coming. But again, it does make dividend investing at that level a little bit risky. But the good news is if you're in a stock long enough, that dividend yield can really rise. I think Warren Buffett keeps his Coca-Cola stock because he bought it back in the late 80s and early 90s. So the dividend yield, or his dividend yield rather, is like 60% now. And they're a dividend king, so they're probably not going to cut their dividend. But the stock's been a consistent underperformer for the last few years. So it's not what I recommend to buy necessarily, but it shows what you could do if you buy the right dividend stock at the right time and stick with it.
Yeah, that's a good point. Yeah, the yield over time, definitely with the dividend growth stocks. If you hold on for long enough, it can really pay off.
See, so moving on. This question from Bessie's 4 hours ago. It was actually for Tyler, and I'll ask the producer to keep it up because Tyler will be back on soon enough to cover it. There's part of it I cannot cover, but Bessie's asked Tyler, how do you handle cyclical business? Do you buy at the low of the cycle and sell at the high, more or less? Thoughts on oil for the next 10 years? I haven't really covered the energy industry with any seriousness, lately. So I'm not gonna speculate on oil prices or the state of the oil industry. Although probably it's a pretty stable business typically. But it can be volatile in certain areas, especially in the exploration and production. So I'm not going to go too deeply into that, especially with regards to companies I haven't looked at for some years. But I kind of, as for how to handle cycles, frankly, I just ride them out. The market itself always goes in cycles. It has a period where prices rise, and then people start taking more risks. Things get more exuberant. That at some point it turns around and things decline, and the declines, I think the declines are healthy ultimately because they clear out some of the bad actors or the poor decision makers out of the market, or at least reduces their position. So pullbacks are healthy. Most of the time the pullback is not as much as the previous bull market. There are a few exceptions, but in most cases that's the case. So frankly, I will just ride them out, and I'm not really selling stocks right now unless maybe the thesis, my original investing thesis gets broken. Then I might sell, but I will. But I do some buying when I think stocks at the low end of the cycle. Now cycles are unpredictable, so you can't call a low or call a high. I every time I've tried that, I'll just say I failed at that. I've actually been concerned about the overall market lately because the Shiller PE ratio, which is a measure of the long-term performance of the market, it's not at record highs, but it's at highs historically. So I've been a little bit more conservative about my buying. But with this recent correction, some stocks fell significantly. For example, I bought some shares of the Trade Desk last week. It's a digital advertising stock that I think leads. It's part of that industry. And that had fallen more than 50% over about 5 or 6 weeks. It had been overvalued, quite frankly, and they missed their own revenue number, which is not, which is something you don't want to see from a company. So the market just really punished the stock. I think it punished it to too extreme of an extent. So I did double down a bit there. So if I see something at a discount, I'll buy. But I look at the individual stock in that case, not the overall market. Again, with the overall market where it is, I don't know. I think we're in some respects we're at the high end of the cycle. But again, a stock can stay at the high end of the cycle for some time. So I'm not necessarily predicting any further drop than what we've seen recently, but it could happen. So I've been a little conservative. But again, if I see a bargain, or if I see a good deal on a stock that I think is a bright future, I will sometimes buy positions, even in an environment like this.
Yeah. Yeah, definitely made some good points there. Yeah, I think, yeah, I mean, it's, I think with the market, with, whether you're talking about, the energy market cycle or, any industry specific cycle or in the market, you don't know at the time when you're at the high or at the low. I mean, you might have a general, maybe when it's down and when it's up, but it's, yeah, you don't want to get too, as you said, Will, you don't want to get too deep into trying to time the market. But yeah, I mean, having said that, I think, if you are aware that the cycle is down, probably a good buying opportunity. One stock, and I think, yeah, that was a good example, that the trade desk, certainly a pretty substantial dip there, which right, kind of came out of nowhere after just one bad earnings report, or not even that bad, but just missing revenue guidance.
Yeah, it really wasn't that bad. It's just not. It's just pretty embarrassing when you make a projection for revenue 3 months ago, and then you can't meet that projection. Usually, I mean, you can project anything you want. So, I mean, if you're smart, you'll sandbag it a little bit, so just to confirm you're going to make their number. I guess they didn't do that this time, obviously, and things didn't go their way.
Yeah, it'll be interesting to see if they bounce back from that next quarter. But I was going to mention Micron is a semiconductor stock. They make memory chips, and they've historically, been a bit of a brutal cycle in that industry. But the business has done well, over a long, through the cycles and stuff like that, through a long-term time horizon. So, yeah, I mean, I think, to build on what Will said, riding out the cycles tends to, if it's a good business, at least it tends to pay off over the long run. And you don't want to get too involved in the timing, I think, certainly as far as selling. It does look like we have a few questions that came in.
Oh yeah, Quentin had an interesting one. I think we can cover. Will and Jeremy, better dip to buy the trade desk symbol TTD, Axon symbol AXON, or Mercado Libre symbol MELI, and why? That's a good question. Well, I mean, I since I bought the trade desk, I think I probably have to answer the trade desk. I don't follow Axon quite so closely. It is very intriguing, so I would. And then we talked about Mercado Libre. Mercado Libre had more like a modest correction. So yeah, I would, if the correction were big enough, I would definitely add shares there. But yeah, it's not. This drop didn't compare to that of the trade desk, which, like I said, lost more than half its value in like 5 weeks. So, in my opinion, the trade desk is probably the one to buy there.
Yeah, trade desk is definitely down pretty substantially. You know what? I'll put in a plug for Axon. I do own all three of these stocks, so I like all of them. I think Axon, and they're another one. The stock actually went up. They reported earnings at the end of February. The stock actually went up a bit, but they had already declined, or they had pulled back a bit before that, due to some issues with a competitor where they sort of lost Flock Safety is the name of the company, and they lost a contract with them, and then I don't know. They're still negotiating, it seems like, but the market was, worried that they're going to be competitors now. Just going to pull up how big they're down from their peak now. A little more than 20%, close to 25%, it looks like. So, all three of these stocks are fairly pricey, I'd say. But I was very impressed with their last report. And Axon has built a pretty comprehensive business in law enforcement technology. They make the taser, stun gun, or they call them conductive electrical weapons. They don't like to use the term stun gun, I think, but and they do body cameras, dashboard cameras, and they have a kind of wide-ranging software suite that helps law enforcement agencies manage records, evidence, that sort of thing. They're also moving into AI. They have a pretty cool product that's called Draft One that will take that body camera footage and draft an initial police report based on it. So it's a big time saver for police officers and other law enforcement officers. So I think they have a lot of growth in front of them, both with new technologies. I think that's a pretty one of the more creative uses of generative AI that I've heard so far. So that sort of innovation, and then just white space, and I think there's opportunities in the federal government to grow, certainly international growth, and there's private sector opportunities as well. One of their biggest contract in 2024 was with I think they didn't name the company, but I believe it was in logistics. So I think it was probably UPS or FedEx or something like that, where you give your frontline employees cameras in a job like that. Well, now you have an automated recording or an automatic recording of them dropping off the package, or maybe any interaction, maybe maybe a problematic interaction that you might want footage of. So it's a sort of a security tool for private sector companies also. So they've been a very steady grower. I also think it is a software or a tech sort of hardware software company, but they're kind of protected from the fluctuations in the kind of larger enterprise software or tech industry. So I think they're a little more resilient than some of those stocks. So I think it's definitely one of those that always seems like it's historically worked out. Buying on the dip. So that's my pitch there.
Yeah. So about a few minutes ago, Roberto asked, "Hi guys, you're speaking on Mercado Libre. May you spend some ideas on the perspectives of C Limited, which operates in Southeast Asia, and on D-Local then?" I haven't followed D-Local as closely, so I'm going to pass on that one. I do actually own C Limited, and you're right. It compares very well to Mercado Libre. Both companies operate e-commerce businesses in a specific region of the developing world. Both have very vibrant fintech businesses. Unlike Mercado Libre, C Limited has a gaming business. I think that makes it a little bit more unstable. I also, like I said, I own some C Limited. I bought at the dip. How do I say this? I think they haven't made as good decisions in general as Mercado Libre has. I think they paid for it. I think they have somewhat learned from some of their bad decisions. But for example, C Limited was a very high flying stock during the pandemic. I think it got past $370 a share at one point. However, it made some bad decisions. It went into some e-commerce markets like in Europe and Latin America, where it didn't really have a competitive advantage. And then gaming was popular during the pandemic, but as everybody went back to their offline activities, gaming activity declined, and then their popular mobile game Free Fire actually got banned in India, which is now the world's most populous country. So a lot of those factors took it down by 90%. I will say they found religion on the e-commerce side, because they got out of a lot of these markets in Europe and Latin America just months after entering them. They kind of saw that wasn't the way to go. They instead started investing that money in logistics within Southeast Asia and bolstering their competitive advantage there. Also, as of the fourth quarter anyway, the gaming segment has finally begun to grow. And as a result, the stock is up about 130%. Up about 130% over the last year. The forward PE ratio I think it's still under 35. I think it has a lot of room to grow. And like I said, it made some bad decisions in the past. I think it's moving on from some of those decisions. I was actually kind of recommending it over Mercado Libre a bit because of the valuation differential. But Mercado Libre's valuation is falling as well. I think it's a little bit ahead of where C Limited is. But I'm not going to speak. Well, I'm not going to discourage anyone from buying either of those stocks, but yeah, it's just basically the Mercado Libre of Southeast Asia. So if you missed out on Amazon, I think either one of these two stocks might be a good second chance at that.
Yeah, the good rundown there with C Limited. Yeah, there. Yeah, I think of those two companies. There are similarities, but definitely differences as well. I'll take this. Try to do an earnings question on the fly here. So Lou says, why did Chewy go down today with good earnings? Yeah, looks like, well, at least after hours, looks like maybe it was down originally, pretty much flat right now. But yeah, Chewy did report earnings just after hours today. Pretty solid report. All around 15% revenue growth in the quarter, which was a pretty substantial acceleration from first 3 quarters of the year when it was around 5%. 70 basis points expansion in adjusted EBITDA margin. Good in adjusted EPS up as well. Guidance. Let's see. They put the guidance in the report. My thoughts about Chewy, I think a lot of these pet sector stocks, they did very well. I mean, it's another kind of it's a familiar story with a lot of sectors in the stock market, but, Chewy did very well during the pandemic. People were stuck at home. They adopted pets, spending money on their pets. And then that industry maybe overexpanded, or there were a lot of headwinds, as the economy reopened. Growth slowed a lot. They seem to be bouncing back. I mean, I think 15% top line growth there is about as good as they've had in years, I think. So certainly a good sign there. I think my concern is still, I think the market really saw this as a growth stock and, disruptive, or as much of maybe a disruption as you're going to have in the pet industry. And they do really own that pet e-commerce space. I mean, I think they've done a good job. They've built their auto ship regular, it's basically a subscription shipping business for your dog food or whatever you get, whatever you get for your pets. I believe is in the 75% range. That makes up 75% of sales. But yeah, and then so it looks like they're guiding for actually pretty flattish, about 5% sales growth this year. So yeah, I think my concern is just how if they can't grow, the pet product sector it's not growing particularly fast, right? So it's you might think of Chewy as a tech stock because of e-commerce, but I think maybe that market has, even the e-commerce side has kind of reached maturity, or close to that. So it's hard to see a good deal of upside to the stock if they can't grow much faster than mid-single digit growth. I mean, I don't, margin expansion is still, they're still competing with Amazon. They're and certainly other companies, Petco. There's other places to get pet products online. Certainly can shop for it in stores as well. So I might like to know more about management commentary and that sort of thing. But yeah, for now, I'd sort of be on the sidelines with this one. I think until they've found their next chapter in growth, so to speak.
Yeah, I'm inclined to agree with you. While you were talking, I pulled up the income statement, and you're right. Yes, single-digit net sales growth for the year. Yeah, not a lot to get excited about. And you look at the PE ratio. Unfortunately, my one app isn't working right now, but I get a 37 trailing PE ratio, 31 forward. And that's not horrible, but it's not exactly low either for a stock growing revenue in the single digits. Net income appeared to rise tenfold during the year. It came in at about $393 million, up from $40 million the previous year. However, there was a $241 million tax benefit. That explains the majority of its profits, unfortunately, and its net income actually fell in the most recent quarter too. So yeah, I think this business will survive. It is very intriguing in many ways, but as Jeremy said, it competes with Amazon. And unlike Amazon, it doesn't have all these other businesses like a cloud computing business or an advertising business that it can depend on it as heavily. So it's definitely not as positioned in Amazon. Yeah, it might be carving out a niche that they're better on customer service. So yeah, I think they're competitive in that one area, but I don't know if that's really big enough or compelling enough to get me to buy the stock, quite frankly.
Yeah, I think there are a lot of companies or stocks out there that, I mean, Chewy's done very well as a business, and they have, I mean, they're a very large company, but if you're not growing at a certain value, or not delivering substantial growth at a certain valuation, the stock itself is not going to do that much in terms of growth. So they might be sort of stuck in that kind of no man's land there.
Yes, we had a question. I guess this is for Neil, but Vihan asked about Micron. Is Micron one you follow?
Yeah, I can talk about Micron a bit.
Yeah, so Micron, where is it in the semi cycle? What's your thesis for investing in Micron and Intel? That's a good question. It's the thing with the semiconductor industry lately. It's not just one cycle anymore. Back in the PC days, maybe 20 years ago, PCs was the only product that you really had to watch. And even 10 to 15 years ago, it was PCs and smartphones. So the cycles were more or less the same. But now you have all these multiple products, and on top of that, Micron. All semiconductor stocks are cyclical, but Micron is the most cyclical of them all, I think, just because they're the memory chip producer. Memory chips are a more commoditized product, and those are more volatile pricing wise. I think they are developing a competitive advantage, particularly over the last few years in high bandwidth memory. I think that may insulate them from the cycle. I'm looking at where the cycle is right now. My guess is we're maybe toward the bottom, but it's kind of hard to say. We are at least past the days, back in say 2010, where a down cycle would wipe out the entire previous up cycle. Nowadays it's holding on to a lot of its previous gains, and I mean actually the recent the recent decline wiped out its gains over about the last year. So. It's kind of hard to say. But, I think we're maybe toward the bottom, but who knows? I know it got hammered after the last earnings report, despite the rapid growth in high bandwidth memory. So I think this one I'm kind of watching and waiting.
Yeah. I mean, I think Micron. It's. I mean, they're. It's hard to say for sure. I think where they are in the semi-cycle, though it does seem to be bouncing back certainly from where they were a year or two ago. I mean, I think they're seeing a lot of growth in AI, in the data center, like beyond in high bandwidth memory, as you mentioned, having in your question there. So I think there's still a pretty promising outlook for them. NVIDIA is their biggest customer as well. Jensen Huang in the keynote address last week in the GTC conference, and I think this is from analysts. This is in his own forecast that AI or data center capex spending is expected to go from 500 billion this year to $1 trillion in 2028. So, I mean, no guarantees on that, but that's I think if we continue to see the kind of growth we've seen in AI, that'll be good news for Micron, as well as a number of other stocks. Intel feels like a bit of a penalty box company for me right now. I mean, I'm interested to see how the new CEO does, but they seem to have a lot of a pretty large hole to dig themselves out of.
Yeah, I have a small speculative position in Intel. The reason why I held it is because for all of its problems, it's still the single biggest it owns more fabs in the U.S. than any other company. And under the previous CEO, Pat Gelsinger, they were really working to upgrade those fabs to be more competitive with TSMC and Samsung. Will they catch up completely? I don't know, but I think there's a lot of political pressure to have a significant semiconductor production industry in the U.S. I think that bodes well, and I'm liking so far what I'm hearing from the new CEO. We'll see how well he executes, but I'm going to hold my speculative position here for now.
Yeah, and I think both of these companies. I mean, Micron. I bought a month or two ago. I think both. You can make the argument certainly with Intel right now that they're pretty cheap or well priced. For the growth in the industry. I mean, I think Micron's PE, or at least forward PE, is under 20, which when you look at some of their growth numbers in the data center, seems like a pretty good risk reward trade off. So we got a follow-up question here from Steve Mitchell, or follow-up comment on Chewy. Yeah, great quarter. Would love more new customer acquisition, but solid overall operation. Love the stickiness of the clinics, but what's the CapEx factor? Yeah, I mean, I agree with that comment. Yeah, I mean, I think the question is, what is the addressable market for Chewy or in the pet industry? Yeah, how many? I mean, I think at this point, these companies, whether it's them or Petco or Amazon, there's you probably, I mean, you can be somebody who just got a pet, I guess, and then you need to your pet products, but I think they're probably fighting for market share with each other a lot, as opposed to seeing the overall market grow much more. So I think that explains the single digit revenue growth and the guidance as well. CapEx was manageable last year, 144 million. Sorry. So that was about a quarter of their operating cash flow. So that's, I don't have a problem with that. Yeah, we are seeing companies like Chewy and Petco's doing this as well, sort of diversifying away from that core business and adding ancillary services, health clinics, veterinary care, pet insurance is one of them. I think there was a comment earlier in the Slido about which I think is the kind of business Rover does, that like sort of an Airbnb for pets. So, I mean, maybe Rover, maybe a company like that is the could be a takeover, an acquisition target for a company like Chewy. Because I mean, there are other directions for them to expand. So I think maybe that's one of the more attractive growth opportunities. Certainly, veterinary care has been a growth market, in that sector in pets. So there's an opportunity out there, but yeah, I'd like to see the numbers improve, or like you said, better new customer acquisition before I became a buyer.
Yeah, I mean the growth needs to get better before I'm interested. I mean they're great. They have a niche. They're great in their niche, but they got to find a way to grow it faster. I think if you're really going to draw more interest to the stock, in my opinion.
Yeah.
So Ed 17 minutes ago had an interesting question. Anything good to say about the market today? Well, yeah, the market today is a little bit hard. We got off to a great start during the week when we had that massive increase on Monday. Then it basically held Tuesday. But fast forward to today, and we get another round of talks about tariffs, and that spooks the market. I was talking about this earlier when I was on with Danny, but this is one of those political events. Unfortunately, there's just no way to forecast what a political event is. When a political event is going to come, what it's going to do. I mean, these are often based on, sometimes there is some real justification for some of these, but the timing and the manner is completely unpredictable. So unfortunately, this is just one of the occupational hazards, for lack of a better way to put it, when you're an investor. And usually the best thing to do is roll with the punches.
Yeah, I mean, I don't think volatility is entirely a bad thing as an investor, or for us as investors. I mean, I saw a quote. Elon Musk had that recent all hands meeting where he basically gave a pep talk to employees, telling them to hold the stock. And I'm not advocating for buying Tesla, but I do. One quote I heard was I thought I liked, generally, which was that, look, the stock is going to go up and down. But that's just based on future expectations. The company is different. The company is a business, and the business is going to do what the business is going to do, and it's going to make money. That sort of thing. So I think certainly Tesla has been through a lot of volatility in the last few months, but I think it's good to remember that in the back of your head that the underlying business isn't the stock, and the stock is just sort of a guess or a bet on what it's worth. That and it's kind of amazing too, to see the Nasdaq fall 2% just on. I mean, I don't know. It seemed like the big news of the day was auto tariffs. So
yeah, we don't know what that means really. How much they're going to be, or how that's going to affect production, or if or how much that shifts production to the U.S. There's just too many unknowns. I guess the fact that it is unknown in the first place is what's spooking investors.
Yeah, but yeah, I think we can sort of tie it back to the theme of the hour as that creates some of these opportunities for buying on the dip, so that we can use that to our advantage. I'll take a question here.
Okay.
But I do like anything good to say about the market. I do like that one. Vihan, 22 minutes ago, we got a list of semiconductor stocks here. It looks like Taiwan Semi, Broadcom, Qualcomm, Lam Research. I don't know the
analog devices.
Right.
I don't know some of these.
The last few look familiar, but I don't know the names off the top of my head. So I'll talk the two I know best here, which I like a lot. I think gold for me is Taiwan Semi. I think another good dip buying opportunity. If you're not familiar with this company, it's the world's largest chip manufacturer. They're a contract chip manufacturer, so they handle work for Apple, Nvidia, AMD, Broadcom. Basically all the big chip companies that don't have their own foundries, which seems to be most of them these days. Intel does have their own. Micron also has its own. But yeah, I mean, very strong competitive position. I mean, we saw a few weeks ago, President Trump was trying to bring them in and get them to invest in the U.S. And they're kind of the company that the whole world seems to have agreed on does this the best. They have the most advanced chip technology or capabilities right now. So and they seem to have a pretty large competitive lead. Samsung is the number 2 company in the industry, and I think Samsung has had its own issues. So very strong growth from Taiwan Semi, certainly benefiting from those AI tailwinds, and a very attractive valuation right now. I am surprised that certainly with this pullback, some of the valuations on in the semiconductor industry and Nvidia as well, I think are really pretty attractive right now. So I don't know if that's just the market's pricing and the general AI risk or the recession risk to cyclical industry like semiconductors, but I think pretty good valuations. And then Broadcom, I think another rock solid semiconductor stock. Very diversified. They acquired VMware, which is a virtualization software company, a little more than a year ago. So that added a nice boost to revenue there, and very profitable. Historically, they've made a lot of acquisitions through their over their history, and kind of have a cut the fat kind of mentality, and deliver very strong profits. EBITDA margins are above 60%, and they're well positioned in AI as well. Their specialty, or like what they're best known for, is networking chips, which and I think we've seen NVIDIA's gotten the lion's share of this AI demand, but there are other components, certainly memory chips with Micron, and Broadcom seems to have the lead in the networking area, and they're seeing pretty strong growth from that as well. So I think they have a good they offer a good mix of growth, as well as some diversification, which makes them a little maybe a little more resilient than maybe one of the more pure play kind of semi stocks. I don't know, Will, any of these well that
I don't follow ADI or MCHD that closely. I used to own UMC. I kind of gave up on that one because it's a competing foundry to Taiwan Semiconductor. It came along first, but they haven't actively competed with the most advanced semiconductors, which I think hurts them. So I'd probably they're a commodity player, so I don't know that they're really going to be a great stock to own, quite frankly, for that reason. And ASX I haven't really followed either. I would probably go like you, TSM, Broadcom, and then Qualcomm. I'd like to pick Qualcomm number one. I think there's a lot of potential because the valuation is so low, and they still lead the market in terms of smartphone chipsets. They're doing some pretty fascinating things with IoT and automotive. But I think you kind of need to see that catalyst with that one. Once it gets its catalyst, I'd like to look at this question again, but I'm probably going to make that my bronze pick until that happens. But I echo everything you say about TSMC and Broadcom. I think TSMC is getting interesting because, as you said, Trump has kind of acknowledged that TSMC is the best chip producer in the world, so they're trying to get more semiconductor production from TSMC onshore in the U.S. and then with all the work Intel is doing too, and then Samsung I know is building a fab outside of Austin right now if it has not been completed already. So I think a lot of interesting things are happening there, and with the recent discount in the valuation, I'd probably make that TSMC my number one pick.
Yeah, I think you're right, as you noted there. I mean, there's a lot of uncertainty in the tariff situation, or the trade war, or whatever you want to call it. But yeah, I mean, there are companies that could be stand out as potential winners, and if the U.S. or if somebody's going to throw money at TSMC to build foundries in the U.S., that could favor them. So I think you might you can look out for those companies that are being kind of invited to open up factories and that sort of thing in the country, which seems like the underlying point of some of these tariffs.
Okay, well, we have less than 2 minutes left, so I'm going to quickly hit this question before the top of the hour, because I think it touches on an interesting point if you're a cloud AI data center investor. Kent asked, would the data centers built first benefit the most from existing electrical grids / infrastructure? The answer is probably not, unless they're providing their own somehow, because usually when an electrical grid gets overloaded, there are brownouts, and those tend to affect everyone about equally. But it does speak to a very important issue, because to keep that business going, these data centers take up a lot of electricity. So the industry is going to have to find some creative solutions, I think, very quickly to avoid such a situation. A few months ago, I was hearing how in Virginia, Dominion Energy was partnering with Amazon to looking at mini nuclear reactors. I haven't followed up on that lately, so I don't know the situation there. But I think the fact that they're looking at ideas like that speaks to how critical how critical this problem is going to be. We're going to need to get more electricity generation, get our grids updated if we're going to remain the technological leader in this space. So that is something that is an issue everyone needs to watch, and someone like me probably needs to watch electric utilities more closely for that reason, because that's going to obviously they're going to be the power provider for these data centers. So it is a very important problem. And so with that, it looks like we are at the top of the hour. And we have Jose Najarro and Denny Vena, who are going to be hosting a semiconductor and tech show as soon as they come on, which should be momentarily. Oh, here they are.
And here we are.
Okay.
All right. Well,
thanks
we
for the
teed
show.
it up. Yeah, I was going to say we teed it up with you with some chip talk. So,
Woohoo!
Full on, gentlemen.
Well, thanks to our predecessors there. I am Danny Vena, Hawaiian shirt enthusiast, Fool contributor, and tech writer. And I am joined by Fool extraordinaire, semiconductor and tech guru, Jose Najarro. Jose, how are you?
Pretty good. I mean, maybe I'm a little bit better because I didn't look at my stock portfolio today, Danny. I was pretty busy. I think I only ended up looking at the market after it closed, and I'm like, you know what? Maybe I don't want to open it today.
Yeah, sometimes there are those days where I just don't even bother looking because life is too short. There's too much going on to be spending too much time looking at results and the day-to-day machinations of the market. Today, Jose and I are here to talk to you generally about semiconductors and tech. If you have your questions, please get them into Slido. That's sli.do, and the code is Fool24. And we are hoping to take your questions over the course of the next hour. There's a lot going on in the tech world today. So I thought perhaps I would kick it off with one interesting note. I talked a little bit about this with Seth, Jayson this morning, but given Jose's experience in this area, I thought perhaps I would bring it up with you. Excuse me, and see what your take was on this. So there was a report that came out yesterday from Alibaba Chairman Joe Tsai. He was talking to investors at the HSBC Global Investment Summit in Hong Kong, according to Barron's. And he said, "I'm astounded by the type of numbers that are being thrown around in the US about investing in AI." He said, "People are talking literally about spending $500 billion or several $100 billion. I don't think that's entirely necessary. I think in a way people are investing ahead of the demand that they're seeing today, and they're projecting much bigger demand." It appears that he is talking about investment in data center infrastructure. And the last numbers that I recall seeing were that the big three cloud computing company infrastructure providers, which would be Amazon, AMZN, Web Services, Microsoft, MSFT, Azure, and Alphabet, GOOGL, Google Cloud, and also tack on Meta Platforms, META. The quartet, we're going to spend in excess of $315 billion in capital expenditures over the course of 2025. And primarily that was to build out data centers that were able to support what they called strong demand for AI. In fact, I recall in several cases reading that they said that right now the demand was outstripping their ability to supply it. So I'm curious about your take on his statement, and what you think it means kind of in the broader, AI and semiconductor markets.
Yeah, Danny. So first, like you mentioned, in earnings that just happened, we got very good clarity from a lot of cloud service providers that if they had more capacity, they would have been able to grow their cloud service business a lot faster. So right now they're still capacity constrained. So at least it tells me that right now, we are not at that bubble based on current market movements and current market progressions, right? I mean, it wasn't just one cloud service provider. We got we got that same type of tone from multiple cloud service providers. So the other thing I would say is I saw that he really this Alibaba chairman really talked about the $500 billion investment, and the only one that I know that comes up with that number, at least directly or equal to that number, is the Stargate project, which is a $500 billion investment in the next 5 years. And this one, it's a little bit different. This one seems to be more of like a massive training data center investment for OpenAI, Oracle, and this Stargate team that has been created under the Stargate umbrella, which is SoftBank, Oracle, and OpenAI. But this is pretty much more of a project that's needed for OpenAI, as this is where what they believe they need to continue to train these amazing models and be able to have enough GPU capacity to be able to show these solutions to the consumer. I mean, we've heard of OpenAI's models still that they're still very limited on how many times you can use certain things on a daily basis, on a weekly basis, just because there's not enough GPU capacity. So if OpenAI keeps releasing new things and you're only limited to use those things a few times a day or a few times a week because compute capacity, it tells me there's still much need for bigger demand, for just bigger data centers. I think here in the United States, the AI solutions that we're seeing are being forced more into the consumer base, like OpenAI, like Grok and all this. And maybe in China, I don't live there, but maybe it might be a little bit different. I haven't heard of like a OpenAI application. Even though DeepSeek came out of China, DeepSeek wasn't really able to scale it to the mass public. And the reason they're not able to scale it to the mass public is because they don't have the ability to build that mass infrastructure. So it's that we're all in the same world, but two different. I think we're in two different sides of the AI spectrum right now. So I think here in the United States, it still seems, based on the commentary from earnings, based on just the data that we ourselves can find out from OpenAI's and all these other AI solutions coming out, that there's still much demand for computational power.
Fair enough. So there's a question that actually came in from our own Pro Shop guy here about a minute ago. And he asks or says that the AI model race continues to rage on Google's release of the new Gemini model. And OpenAI announces its next image generator. Is this the type of AI innovation that you like?
For me, Danny, yes. I think I've talked about it in the past, where I want this battle and race to continue. And one of the things that I want to continue to see is these top players just going back and back at it. So I think a few days ago, Google actually released a pretty cool image generator, Danny. And OpenAI yesterday was like, you can't hold the spotlight too long, Google. I'm going to release this new AI model. And on that same day, Google released a new kind of large language model that's is based on benchmarks, is better than some of the thinking models that OpenAI has. I'm gonna make a guess that within the next few days or within the next few weeks, OpenAI is going to release another large language model that's going to compete against Google. And I think this is what's going to continue to happen. And this is the innovation that I like to see, because it showcases that we're pushing to new levels. No one's standing still. And if no one is standing still, you're going to need more computational power to make the next model even better, and the next model after that. So yeah, Pro Shop Guy, that's kind of the innovation. Eventually, I wanted to shift away from large language models. Danny, I think right now we're still in that large language model optimization era. Now we're kind of moving a little bit more into images, it seems. But I would say maybe within the next 6 months, I would eventually start to look at where we're going from these large language models, or what type of other solutions can these large language models do from what they're doing right now.
Yeah, I think one of the things that we're seeing, or at least it seems to me as, kind of an AI layperson, that what we're seeing is it started off with most of the development that we were seeing was primarily in large language models. And now we're moving to, a little bit more outside of that track. And they're moving into the more experimental models. Google said that its Gemini 2.5 Pro experimental was a reasoning AI model that it claims was its most intelligent model yet. And it says that essentially they're saying all of their newest AI models will have reasoning capabilities built in. And that puts them kind of in the same league as Anthropic and DeepSeek and OpenAI. They all seem to be coming out with these reasoning models now.
Yeah, Danny, one thing that's super important about these reasoning models is even though they seem just like basic large language models that we've had about a year ago, they have better accuracy. The ability to solve problems is insane. The ability to kind of use these reasoning models to do web search, you get better results as it's thinking. It's right. It's previously you would tell it, hey, go look at the web search real quick and give me the best results of this. And it would just kind of do it one time. But now it would be like, okay, I'm thinking, I'm going to this web, I'm searching for whatever the user asks me to search. I'm going to collect this information. After I collect this information, let me reread the question that this user was asking, and let me see if I have all the information that's needed. If not, let me go back, search again, and continue that circle or that cycle over and over again. And one of the ways to kind of think about this is during NVIDIA's GTC event, Danny, Jensen kind of showed that the first version, the kind of one single version, it only used about like less than 100 tokens, and tokens is kind of like the energy that you can think of about AI. The kind of energy that you need for kind of these thinking models is massively two-digit factors larger. So then that's going to need more computational power. So even if we're just staying with large language models, but we're going into this thinking, you need more tokens. More tokens means more compute. And now more people are going to be using these thinking models. So you're going to see exponential growth, in my opinion, for compute demand.
So, I'm glad that you mentioned NVIDIA CEO Jensen Huang just a minute ago. We had a question that was in the queue from the last hour from Ed, who asks simply, is NVIDIA a buy today? I'll kind of give you my take on that. Now, remember that we can't give personalized investing advice. We can only give you our own, personal opinion on these companies. So, I always like to go to the chart, as it were, and look at, whether or not, if somebody asks whether or not it's a buy, this is not a question that I want to answer in a vacuum. And what I want to look at is I want to look at, where the stock is and where the company is now, and where we think it's going to be. In the case of NVIDIA, this is a company that just grew their revenue by 74% year over year in the most recent quarter. And as a result of that, they also grew their earnings per share by 82%. So these are pretty impressive numbers to me. Despite that, and I'm going to pull up a chart here in a moment so that we can actually look at, some of NVIDIA's ratios. But I think, what I see anyway, is a pretty compelling answer to that question. Now, the chart that I'm showing here is what NVIDIA's stock has done. I'm just going to take a quick look. Over the past 3 years, NVIDIA stock is up 482%. Just grew its revenue by 78%, just grew its earnings per share by 84%. And right now, NVIDIA's price to earnings ratio is just below 39 times earnings. If you look back over the last 3 years, NVIDIA's multiple has been around 81. If you look back over the past 5 years, NVIDIA's multiple has been about 81. If you look back over the past 10 years, NVIDIA's multiple has been about 60. So by any of those measures, the fact that NVIDIA stock is currently selling for 39 times or less than 39 times trailing 12 months earnings shows that historically speaking, the stock is selling at a discount right now. Now, that's not the cheapest that it's been. You go back to 2019, it was selling for about 17 times earnings. But, that was an anomaly. That was kind of a fluke. And it had to do with, the time. I mean, we were going into the pandemic, and it looked like for a very short time that NVIDIA chips, were not going to have a market. And that thought changed very quickly if you look at the chart. The other thing I would say is that if you're looking at NVIDIA's forward price to earnings ratio, which is the stock price compared to what analysts think its earnings are going to be over the course of the next year, it's selling for 25 times forward earnings. Now that said, I think that is a fair price to pay, beyond a fair price to pay for a company that is growing that quickly. And even if you think that estimates about the growth of AI may be pie in the sky, we know that AI is growing quickly. And, the more conservative estimates that I've seen are about a $3 trillion market. The pie in the sky estimates I've seen are about a $15 trillion market, even if the reality is somewhere between. And NVIDIA is basically, NVIDIA is the picks and shovels that is going to support all of this AI growth. So to me, NVIDIA stock is a buy, but I'm curious about what Jose's thoughts are on the matter.
Yeah, I mean, Danny, I would agree with you there. I mean, again, not personal advice, but just in my own process of when I do an investment, I like the charts that you pulled up, and one of them was the forward PE ratio, right? 25. I mean, if you look at other tech companies like in the Mag 7, NVIDIA is one of the cheapest. It's not the cheapest in the Mag 7, but it's definitely one of the cheapest. I think there might only be 2 that are cheaper than NVIDIA, but it's growing at massive levels, right? No other Mag 7 or even kind of big tech player in these levels is kind of growing at the speed that NVIDIA is growing. So this does come, especially with those forward PE ratios, Danny, right? It comes with the caveat that it's based on expectations that analysts are giving it. And that's what maybe might be sometimes beneficial to look at trailing 12 months opposed to, because those are actual data versus forward, which are based on expectations. But at least for now, Danny, I think if one looks to invest in NVIDIA, you have to really believe the AI market is going to be transformative from here. This is not the top of the AI market because this is a stock that's going to be very volatile, Danny. While you might have some great returns within the next 5 years, I think throughout these next 5 years, you're going to see some massive swings. And again, I think you shared the price chart as well, Danny, of NVIDIA, where there were times where we saw multiple double-digit percentage drop within a time span of a few years. So it's a stock that's going to continue to be volatile. A stock you need your thesis needs to revolve about the AI market right now. And it does have the growth opportunity of the AI market exploding into new industries, like we see robotics, automotive, healthcare, and the list goes on and on. So I'm bullish in NVIDIA. I'm bullish in the AI market, but I also understand that it's going to be volatile, and any kind of hiccups or scaredness in the AI market or AI cap base can create some negative pressure for the stock. But after GTC event, Danny, NVIDIA really showcased that it's the leader in this game by a far lead.
Fair enough. There was another news story that I saw that I thought was pretty interesting. Broadcom announced on Tuesday that it had developed new high-speed networking chips for AI data centers that used less power than their predecessors. They called these chips the Cyan 3 and the Cyan 2M, and they are additions to the company's PAM4 DSP PHY product portfolio. Boy, that's a mouthful. And said it offers data transmission speeds of about 200 gigabytes per second per lane, but they're much more power efficient. They said that they reduced power consumption by 20%. So I was wondering if you could explain to us, what this means in the broader terms of why this is a benefit to Broadcom and how this will impact, the broader AI marketplace.
Yeah, so Danny, maybe just a quick background on Broadcom. Right now, Broadcom has become a very popular stock, and the main reason is it does help big tech players build their own AI chips. So many people just believe that Broadcom is just an AI chip builder, but the core of Broadcom's actual revenue comes from networking solutions. And these networking solutions are very crucial, Danny, in the AI space, as first you have multiple servers and multiple racks talking all with each other. You have hundreds and you have tens of thousands of GPUs. Now we're seeing hundreds of thousands of GPUs, hundreds of thousands of ASIC or kind of these big tech chips AI chips that they're making talk to each other. And for GPUs, or any type of AI chip, the worst thing to do is having a GPU just waiting idle for data to transfer to that GPU for it to perform any form of task, right? You don't want to have this working. Let's think of it as this GPU as a working individual, and the networking is the kind of orders coming in of what this working individual should be doing. If you have networking speed, if you have very slow networking speed, it's going to take very long for that worker to get those orders of what to do. So it's going to take longer time for it to complete the task. But if you're able to send those orders a lot faster, and this worker is super efficient at all these tasks, the faster you can get those workloads or work orders to it, the more that worker can do within its working time frame for it, which GPUs are pretty much 24/7 for multiple years. So you'd like to see these things get faster. It helps dramatically with AI workloads. And Broadcom, like I mentioned, most people see it as kind of a AI chip builder, but their core revenue comes from the networking side. And this is just another way for them to continue to increase that core business of theirs?
Yeah, one of the things that I have seen, over and over again over the past couple of years is, these comments about the fact that AI is really energy intensive, and so being able to put out a chip or something that's used inside the larger AI chips, with the ability to reduce energy consumption by 20%. I think that would make that particular piece of equipment much more desirable, because it's going to save you money in the long run in terms of energy consumption, right?
Yeah, definitely, Danny. And like you mentioned, I one of the biggest things right now with that's also another great point that I forgot to mention is data centers right now are power capacity. They're power capacity constraint. So if you're able to save power somewhere, where if you're able to save X amount of energy in these networking solutions, now you have more power to use on more GPUs and more other kind of AI accelerators. So you make that data center even better because it can do more processing power, because you can add more computation as you save on some of these other components that could help you reduce that energy footprint.
And that's certainly something that I think a lot of AI cloud providers certainly are looking at right now, is the ability to save energy. And I actually saw another interesting story here. Let me find the correct tab here. So I guess, oh, here we go. So Meta Platforms made an offer to acquire AI chip startup Furiosa AI. They offered them $800 million for the South Korean chip company. And apparently they rebuffed that offer, and it said that they decided to focus on developing and producing their AI chips, according to a local media report. So it's interesting. I know that AI has been a big growth area. Meta Platforms is one of the companies that, while not being a cloud provider, certainly has a lot of data. And they have been working to develop their own chips for AI in-house and in partnership with others. And I thought it was interesting that, they tried to buy this company for $800 million, and the company said, nope, we're good. We're not interested in being acquired. So I thought it was interesting. A lot of times, it comes down to price. So perhaps this company thought it was worth more than $800 million. But, Meta has been developing its own custom AI chips. It said it was going to invest about $65 billion this year to support its own AI initiatives. So at the same time, Furiosa is working with private investors, and it's looking to raise about $48 million, and it's expected to complete that fundraising later this month. So I'm curious, what are your thoughts about Meta's ability to create its own AI chips, and why do you think it was so eager to buy this company, for its chip making prowess?
So, Danny, I mean, Meta is a huge AI player. And even though they're not a massive cloud service provider, they're still spending massive amount of money on capital expenditure. I mean, remember, this company, I think, mentioned 65 billion, if I recall correctly, for this fiscal year in capital expenditure, when some other cloud service providers are expected to spend about 80 billion. And all these other cloud service providers have massive customers where they kind of use these external GPUs. So Meta doesn't have that, yet it's spending that type of money. So you can see the massive amount of money Meta is spending on the AI market, obviously they use a lot of things for their own advertisement solutions and internal solutions. So they're probably, if they were a customer, it would be a lot, but they want to, what pretty much everybody's trying to do is reduce their wallet spending on NVIDIA. And this is something every big tech player is trying to do. And I don't know if it's because I'm such a big NVIDIA bull. Oops. Can you hear me?
Yeah,
Okay, so
I can hear you.
Sorry, Danny. Just I don't know if I'm just such a big NVIDIA bull that I don't believe these other companies should be attempting right now to build their own AI chips. And the reason being is NVIDIA is just innovating at such rapid levels. We saw the Hopper architecture that came out a little bit over a year ago, and then the Blackwell architecture is 40 times better, right? You don't normally see that kind of innovation anywhere. If maybe the innovation was a lot slower, it would allow competitors or kind of big tech player to catch up to NVIDIA somehow. But as long as we're seeing these types of movements of huge leaps between platforms, I think it's better for, unfortunately, big tech players to stay back right now, keep buying NVIDIA chips. But once NVIDIA starts to slow down that innovation, or once they can't kind of see those big leaps, that's when it's opportunist for you to kind of build your own AI chips, because you don't, if you build the chip, you don't get left behind. But if you miss out on an NVIDIA chip and you miss that 40x gain, you're going to miss out a lot. So I actually think it was a good thing that they didn't buy this company, or the company rejected. I think it would have been money wasted. I think maybe in the far future it would be needed, but not right now.
Yeah, I have heard a lot and read a lot about NVIDIA's basically stranglehold on the market, and the fact that other people like Meta are trying to develop their own processors so that they can reduce their reliance on these chips. There was one other story that I read that had to do with, let's see if I can find it here. Apparently there is, I know it's here somewhere, but I had read somewhere that Oracle had made a deal, and they were going to buy a boatload of AMD's MI 350 chips.
355. 355 they mentioned. I think 32,000.
So I was wondering what the the implications of that are. I'm not able to find the link right now that I had, but so is this another case of Oracle, trying to reduce its reliance on NVIDIA chips? I mean, that 30,000, here we go, I found it, 30,000 MI355X AI accelerators. So what's the thought process here for Oracle behind, picking up all these AMD chips?
Yeah, so Oracle has been a strong customer of AMD, Danny. They are one of the few cloud service providers that actually uses AMD's previous chip, the MI300. And I do believe Oracle is one of the, it has one of the biggest AMD cluster for that. I think it's a third, I forget the number of it, but they are already a big customer. Oracle being more of a cloud service provider, what it does is it builds kind of these infrastructure based on demand. Sometimes the demand for them, just like any cloud service providers, are going to demand NVIDIA chips. Maybe sometimes they're going to demand AMD chips. I think Oracle is just trying to play it safe, where if there is some huge demand increase for AMD chips, you're going to have the ability to rent them out at Oracle infrastructure. It can, a big amount of Oracle's infrastructures are going to be built on NVIDIA, but just like any cloud provider, you're going to have the optionality. And Oracle doesn't make its own chips, so the other optionality is going to be the other third-party vendor, which is AMD. So it's definitely very bullish. AMD did accelerate the release of their MI350. Danny, was originally expected to come out later this year. Now it's expected to come out mid-half of this year, during the mid of this year. So they're pulling the schedule faster than expected, which could be very bullish for AMD. And there's definitely some attraction right now, especially with the schedule up pulled ahead of time and Oracle making a big purchase like that.
So continuing with some of the big headlines that I have been seeing in the news, one of the things that came out today was that the Trump administration had blacklisted more than 50 Chinese companies and a total of 80 companies worldwide, basically banned them from buying certain U.S. tech. Essentially what they're trying to do, according to the report that I saw on CNBC, was that these companies were targeted for their alleged involvement in developing advanced AI, supercomputers, and high-performance AI chips for military purposes. And that these were companies that were originally a number of the companies were originally blacklisted by the Biden administration in 2023, and these companies are being added to the list. A number of them, the report said, were companies that were associated with these other companies that had already been blacklisted, and they were trying to essentially keep this U.S. tech from getting into the hands of Chinese companies to then be used for their military infrastructure. I wonder if you thought this had any implications for the US AI space.
I don't think much here, Danny. A lot of these companies have the Chinese market already has been export restricted a lot by current and previous administrations. I think this is just more of that going in place, but a big blunt of the hurt for revenues in various tech companies has already happened, right? This would be more like minuscule changes compared to what we've seen when a lot of these export restrictions took place. But I think this is what we're going to see a lot in the AI market. One of the reasons the AI market is so volatile, Danny, is so many things can change, right? You have the first fears of AI bubble or overcapacity. Then you have the fear of maybe AI not innovating as quickly. Then you have the fear or the volatility of more restrictions into other parts of the world and tensions with other parts of the world. How can that impact the overall AI market? So I think this is the AI market is going to continue to be volatile for things like this because we're going to continue to hear various things impacting the AI space. But I want to say this one is probably not much of a it's not a nothing burger, but compared to other stuff, this would be a nothing burger in my books. I'm not sure if we're getting a little bit of lag here. Danny, I'm not sure if you're muted right now.
Am I lagging? How are we doing?
It is on my end, Danny, but I'm not sure if it's me.
All right. Well, in the meantime, I'll go ahead and just go over the information that I got on this. I was looking at Oracle's earnings call, which came out actually a couple of weeks ago. But one of the things that I noted was that they said that 4 of the leading cloud security companies, CrowdStrike, Newfold Digital, Palo Alto Networks, and Cybereason, had all decided to move their operations to the Oracle cloud. That seems like kind of a big deal to me. What am I missing about this?
Danny, I mean, Oracle has done really well at becoming a massive cloud service provider competitor. I mean, normally you would just, when you think of cloud service providers, Danny, one used to think of just the top 3, right? But Oracle has been making a lot of growth here, even though their top line numbers don't really reflect it, Danny. The reason being is they're shifting from a lot of legacy products into new products, and those legacy products are kind of hindering the revenue growth. If you look at just kind of their main cloud revenue, it's growing at massive double digits. So Oracle is becoming a big player in the cloud space. They're building data centers globally. They've talked about it in their earnings call, Danny, that they're actually able to build a lot of these data centers more faster than the competitors and cheaper than the competitors. And this allows them to kind of build as the market grows. So they're attracting a lot of customers. And again, they're one of the key players of the Stargate project, which is that massive open AI training cluster. So for OpenAI to have chosen Oracle against maybe some of these other cloud service providers out there, it's another indication or evidence that Oracle is moving on the in the right direction.
Yeah, when you look at some of the companies, the stocks that have really been some of the big AI movers, I wouldn't have thought so much about Oracle being one of the bigger providers of AI cloud services, but over the past year or so, it looks like Oracle's stock is only up about 17%. It was up as much as 40-some%, but it seems like Oracle might be the if you'll excuse the turn of a phrase, the redheaded stepchild of the AI companies.
Yeah, no, this one definitely turned things around. Like I mentioned, it seems like no one was paying attention to Oracle, and it's doing great. I mean, they mentioned that they have a lot of great their RPO grew about $40-something billion versus a year ago. I think a year ago they had it at about $89 billion, Danny, and they rose to about 130, if I recall correctly. So the main reason is this is another example, Danny, of kind of we're getting that color or that commentary from AI players that data center demand and computational power for AI solutions is still pretty strong. You don't grow 40 billion in RPO to 130 billion in a year. And I think on a quarter-over-quarter basis, it was still over like a 20 billion or almost a 30 billion growth as well. So it definitely showcases that the AI market at least has some evidence that is still pretty strong out right now.
Fair enough. So, viewers, if you've got questions that you want to ask Jose or myself, semiconductors, tech, AI, anything that's on your mind, go ahead and get your questions into Slido. That's sli.do, and the code is FOOL24. We're happy to take your questions. In the meantime, there's something here that I kind of feel like I don't understand well enough, and I was hoping, Jose, that maybe you could maybe give this to me a little bit in layman's terms. But I was reading a story that said NVIDIA and Oracle were pushing for a repeal of the AI diffusion rule, which essentially has something to do with the number of AI processors that can be exported outside the United States, even to allies. I'm not sure I understand that very well.
Yeah, so Danny, this was one of the final AI laws that came out with the previous administration. It was called the AI diffusion law. And in theory, the top level breakdown of this, first let me go say the top goal. The top goal of this law was to do the following. First, increase investments here in the United States. The second was to reduce the ability for China and any kind of countries that are seen as adversaries of the United States, it reduced the chance of them getting any forms of AI chips through smuggling or through other loopholes out there that were previously in place. So that was kind of the that's like the top level overview of this AI diffusion law. Now, some of the meat behind it out there is it broke down the whole world into pretty much 3 tiers. So tier 1, which would be extreme US allies. And pretty much if you are in the tier 1 category, you'll be able to send AI chips almost to whatever your heart content is. Then you had tier 3. So I'll talk about tier 2 in a bit. But then you have tier 3, which are kind of like complete US adversaries, and there's no way that AI chips can make it to that area. Countries like China, countries like Russia, certain places in the Middle East would fall into this tier 3 category. Then, Danny, there was kind of like tier 2 countries, which weren't complete allies, but maybe they might border or have a closer relationship to maybe some of these tier 3 countries. And what ended up happening here is if you were building in these tier 2 countries, you were only limited to build 7% of your total capacity, of your total US capacity. So let's say you had about 100 powerful AI data centers in the United States. You can only build 7% in individual tier 2 countries. So you will only be able to build 7 data centers. It all depends on the power computational, but just to make it easier, we'll talk in data centers terms. And then in overall, tier 2 countries can only have about 20% of the overall capacity. A lot of these data center players, being your Microsoft, your Oracle, they like to build data center solutions in other parts of the world. So something like this might limit them to kind of build in other parts of the world. So obviously it's going to reduce maybe some of the demand of NVIDIA chips in those other parts of the world. So NVIDIA obviously would want this AI diffusion law to kind of go away, and big tech players like Oracle that build data centers all over the world might want to see that coming true as well. I'm going to make a prediction here, Danny. I don't believe this diffusion law is going to go away because, like I mentioned, the top overview was more investments in the United States and less chance of US adversaries getting AI chips. What I think will happen, though, Danny, is maybe a change in the numbers. Like I mentioned, that tier 2 player, which were those middle players, only were able to get X capacity of chips. I think that X capacity might grow a little bit bigger just to allow kind of these big tech players to invest a little bit more, but still continue to invest here in the United States. So, yeah, the AI diffusion law limited maybe some of the markets. I think there's going to be some change to it, but not completely a revamp.
So the market was decidedly bearish today, and one of the stories that came out was that there was an analyst note that came out earlier today that some blamed for fueling the tech sell-off. That analyst note came courtesy of investment bank TD Cowen. And analysts there led by Michael Elias said that generally speaking, they following channel checks, they at NVIDIA's GTC event, they believe that aggregate data center demand has increased year over year and will increase year over year despite reports that Microsoft has canceled some leases and deferred some leases, perhaps more than even investors originally thought. Now, I was kind of curious about that. I remember Microsoft saying that it didn't have enough capacity, or otherwise its cloud growth would have been higher. But also, I think I remember reading that late last year, there were reports that Microsoft said it was going to spend somewhere in the neighborhood of $90 billion over the course of the next year, building out its own data centers. So I'm wondering whether or not those two things are related. Is Microsoft canceling these leases and maybe scaling back, its demand for AI data centers because it's building its own, or is there something else going on?
So, Danny, I mean, the thing with these checks, right, is we all, as investors, we only really get to hear during the earnings call. And I think actually Microsoft CEO has mentioned that he's still good for the amount of capital expenditure he is expected to spend this year. I think within that TD note, we also heard that one of there's a little bit something else going there where Microsoft is an investor of OpenAI. And Microsoft, Danny, was kind of really helping OpenAI build a lot of these AI infrastructure for OpenAI training and OpenAI's inferencing solution. If you listen to, or if one listens to Microsoft CEO talk in the past, he has kind of mentioned that OpenAI might be like more of a dreamer, where in their minds, if they need as much capacity as they can get. If there was an open check, OpenAI would use that open check and spend trillions and trillions and trillions of dollars on data centers. Microsoft says that they wish they could do that, but they're also running a business. So they can't really kind of have an open check completely for OpenAI. So this is where kind of that Stargate project came in, Danny, where Microsoft kind of said, hey, look, OpenAI, go find yourself a rich uncle, a sugar daddy, whatever you want to call it, that can cover the expenses that I can't cover, because I know you have all these goals of becoming an AI player and developing AGI, or the super smart AI. So we're going to give you, even though we're an investor, we're going to give you the okay to go look at other competitors or other players to be able to fund whatever adventures you want to go through. And that's where kind of that Stargate project rose up, Danny, is where SoftBank and Oracle rose their hands and say, hey, look, we have wallets that are pretty big. We want to benefit from you, OpenAI. We're willing to build that AI infrastructure. So TV Cohen mentions that he believes the slowdown of these data centers is Microsoft was originally planning on building these for OpenAI, but now since Stargate is going to be building a lot of these infrastructures for OpenAI, they don't have to really go with them. So it's not like the AI market is slowing down. It's just trading hands, right? It's just shifting from Microsoft to maybe some other player that's building that same type of AI compute, either in that same location or somewhere else. But I think fear sells the most when it comes to financial newsletters and kind of these topics where it's like the AI bubble is here. But even the TD Cohen note mentions that, hey, he believes most of this is just a transfer from Microsoft's OpenAI venture, moving more to that Stargate initiative, which is what it was supposed to do. So not too much worry, in my opinion. But we would have to, I guess, wait for the upcoming earnings that seems to be happening in a month away, where we get to kind of ask these questions to the CEO.
So we have a question in the queue, and it's directed at you. I don't know if you follow this company or not. Ticker VRT. The name of the company is Vertiv Holdings, and they one of their areas is data center equipment. Do you follow this company at all?
I know I'm on a top level approach, Danny. So this is Vertiv. They built infrastructure for data centers. So if you are a data center company, you need power solutions, you need cooling solutions for that data center to kind of connect all these servers together and making sure all that is cooled. You call up Vertiv or VRT. This stock took a massive hit today, Danny, 11%, almost down on the day. The big fear is if AI data center is slowing down, then you're going to see a slowdown in data center infrastructure, which in theory kind of trickles down to VRT, right? So one of the main reasons the stock was down today, it's definitely an interesting play, Danny. But at the it's something that I personally don't like to invest in. First, the infrastructure here, while they might have some form of strength, it's not a strong enough moat. I feel like it definitely you need a strong supply chain, you need strong customer relationships, and you need a lot of strong solutions. But none of their solutions have that massive moat test, in my opinion. So infrastructure plays like this are not something I would fancy, but there's definitely growth opportunities. And the other thing I would say is data centers are pretty much a construction play. You can't just build a data center in a few weeks. So you can't expect this company to see massive revenue. It takes years over time for data centers to be built out. So what you're going to end up seeing is maybe they even talked about it, low double-digit growth in the teens, maybe in the low 20s, but you will start to see a huge increase in their backlog. So a different way to kind of look at the AI market, not a way I personally will look at it, but I can definitely see the growth reasons behind it.
So we have another question in the queue, and I'm not sure exactly how to interpret this, but Roger the Fool says, I know you recommended selling Intel a while back. I'm not sure if he's talking about you specifically. He may be talking about one of the full services. Not sure. Wondering what would it take to get back into it. I'm not convinced about its new president. I was wondering if you had any take on Intel that you could share with our viewers.
Yeah. So again, Danny, I don't know. Maybe it might be one of the other services. I don't really make recommendations on stocks and personal advice. For Intel, though, they did get a new CEO. The new CEO is actually going to talk in next week. I think Intel has an Intel Vision keynote, which is kind of like their mini GTC, where they're going to discuss a lot about the future of Intel. So I would say I like the new CEO. The new CEO has experience in the semiconductor market, has knowledge in manufacturing and design, which is something Intel does really well. Regardless, Intel is a massive play. Re-advamping or remaking technology is something that takes multiple years. So this is a CEO that is coming during a crucial time, but it's still going to take a year, maybe 2 or 3 to really see the play out of the changes that this CEO might make. But what I would want to do is first listen to what he has to say during this Intel Vision event. I believe it's next week, if I'm correct. And just listen to him in the earnings call. Like, what are his goals? Are his goals to split up the foundry business in the design business? Is his goal to focus on building just a super strong Intel with both businesses together? Yeah, so I think it's still too early. I like his history. I like his resume. Now I would like to see what he has to say in the upcoming investor events.
Yeah, I just checked that out while you were talking. It looks like Intel Vision is scheduled to take place between March 31st, which is next Monday, and April 1st, which is next Tuesday in Las Vegas. So I guess, we'll be hearing more about that shortly. So we have a question from Besties. I don't know if Besties just joined us. Said, AI outlays and investments have been hot. How do you see Broadcom doing? And what do you think of Sai's comment about the bubble in AI? Yeah, we talked a little bit about the bubble in AI comments earlier in the show. And we kind of decided between us that, the cloud infrastructure providers all said that they're capacity constrained right now. And that, we believe based on their comments that the demand for, data center growth is real. And they are committed to spending heavily on CapEx next year to build out those data centers. So perhaps, Sai's comments weren't applicable to that. But, maybe you could quickly give your thoughts on Broadcom.
Yeah, I mean, Broadcom's definitely benefiting, Danny, from the networking space, the AI space. I think Broadcom has a huge opportunity in the networking space for AI. Like I mentioned, besties, I don't know if GTC made me a little bit more bullish in the NVIDIA space, but I would, if there was a red or yellow, maybe not a red flag, if there was a yellow flag that I would have for Broadcom, it would be more on their ASIC solutions, just because NVIDIA is growing so fast. But Broadcom's main revenue is networking. It's also the software side right now. And those, I don't think I see any yellow flags. I think they can benefit in that space. The only yellow flag I have from Broadcom is keep an eye on its competitors in the AI accelerating space.
So we have about 1 more minute left. I don't know if you had any closing thoughts about any of the things that we talked about.
Danny, the only thing I would say is maybe if you're investing in the AI market, you're going to get a lot of noise like we saw today. I think it's very crucial to kind of not just see the headlines of some of these topics, but maybe try to understand what's happening in the back end. A perfect example was that Microsoft data center layout or slowdown. We saw that it just might be a shift of capacity elsewhere. So if you are an AI investor, definitely be prepared for what I think is going to be a very, very volatile year.
And a wild ride. So we are at the top of the hour. Thank you for joining us for this hour of Semiconductor and Tech. Next up, we're going to be joined by Brian Orelli and Rick Munarriz, who are hosting an hour of bold predictions. So welcome to Brian and to Rick. I'm excited to see if one of these predictions has anything to do with Disney.
Not for me this time. So oddly enough, Danny and Brian probably not, but I guess we'll leave trivial on our own terms. But yes, thank you, Danny. Thank you, Jose. Welcome, Brian. How you doing?
Well, good.
Yeah. So how many bold prediction shows have you done? This is my third.
This is my third too.
Okay, all right.
But we haven't been on together, so
no, we haven't. So yes,
we'll be setting something up here.
That is very nice. So obviously, again, for those who are not familiar with the format, again, even though we're not, giving personal advice, we're giving our own personal bold predictions on things we think will happen in a certain amount of timeline. Again, not that we're like, we're not prognosticators. We're not like financial Nostradamuses here. But I think it's sort of interesting when we have this kind of challenge where we come up with things that we think might happen, and we're willing to, go out on that limb. Some limbs longer than others. Some, easy layup. Some of them, sort of like half court, desperation shots. But we'll see how this goes. I have no need for more basketball metaphors. I know it's March Madness and all that. But Brian, I don't know if you want to go first. We have 3 apiece, so this should be more than enough time to cover all 6. And obviously, the Slido deck is open for anyone who has questions. Ideally about stuff that we're talking about, but again, if we go through these quickly, anything can happen format-wise. But
Full Fan in St. Louis actually has a question about one that I happen to be predicting. So why don't we just start off with that one?
Oh yeah. So, go out of order. Whatever you need to do, go. Yeah.
Yeah. So Humacyte, the ticker is HUMA. My prediction is that they'll have sales of at least 29 million in this calendar year 2025. So they've gotten their tech approved. It's a artificial blood vessel, and so they will they manufacture these things, and they can sit on the shelf and then be used in a trauma when there's a trauma situation where a blood vessel's been severely injured and it has to be attached on either side of where the injury is. And so they're pricing it at $29,500 each. And they expect there's about 26,000 potential surgeries in the U.S. These are mostly trauma-based surgeries, car accidents, things where we have a large laceration of either an arm or a leg. They didn't launch until February, so we're only talking about 10 months worth of sales here. So that kind of hurts me a little bit. But price is again 29,500, and they expect 26,000 surgeries. So to get to 29 million, you got to do 1,000. You got to sell 1,000 of these artificial blood vessels. So basically 1/26th of their U.S. TAM is what I'm predicting for the first 10 months of the year. One more thing going against them is that they don't. The CMS does the codes for the things once a year, and that goes into effect in October. So they haven't gotten the code yet, but let's assume they do get the code. That should be an inflection point in the sales of the artificial blood vessels, because then hospitals, once that CMS code goes into effect, hospitals can charge more for doing the surgeries. So it doesn't actually benefit the sales of, Humacyte doesn't actually get more money when the code comes into effect, but the hospitals get more money and therefore maybe more likely to use it.
Yeah. So Humacyte again, 369,000. No, sorry, that's the market cap. Yeah, they have no.
They have no sales because they just got it. It got approved in February or in December, I think, and they launched like the last week of February. So basically, we'll get a month's worth of sales in the first quarter. When they announce first quarter results in a few, in like 2 months from now.
Yeah, so 29 million normally you would think for annual revenue, that's a pretty low number. But again, a lot of times these pre-revenue companies are just getting stuff on the market, very volatile. So it is a bold prediction, Brian. A full St. Louis, his question, I guess, was asking about the stock's drop. I don't know if it fell today or fell recently.
Yeah, it dropped like 30% today because yesterday they announced that they were raising $50 million through a secondary offering, and the share price was $2. They were selling shares at $2 a share, and last I looked, that it was actually trading right at $2 a share. I don't know if that's where it closed the day on or not, but so that's the reason for the decline. So I don't know. I was trying to figure out whether that makes me feel more likely or less likely that my prediction is going to come true. I mean, one, they've got extra money, so they can in theory, spend more money launching getting their sales force up and running and having all the resources they need to launch it. So in that respect, it's a good thing that they've got an extra $50 million. You would think if the launch, was going well, and they're basically a month into the launch, and they thought, they're going to announce first quarter results in a few months, and investors are going to be surprised on the upside, and so the price is going to go up, then you would think they would wait for a little bit to raise the capital. So I think there's a trade-off here. I think maybe it mostly makes me less secure, because I think that if the first month was going really well, I think they might have waited to raise capital, not raising right now where their market cap's only $250 million. So they basically diluted shareholders by a fifth by doing the $50 million secondary offering.
Yeah, and again, obviously, I don't know Humacyte. Again, it's a brand new company to me. I'm not going to say that I even pretend to know it a little bit, but I see these when these spot secondaries happen. The stock normally takes a hit because more often than not, especially like a company pre-revenue, sort of speculative, which is what Humacyte is right now, and you have a deal where they can't sell at the market price or a premium, obviously. So the stock closed at $2.87.5, last night. And when you see this breakthrough, this after hours yesterday news that, hey, we're selling 25 million shares at $2 a share to raise 50 million. That's, as you mentioned, it's just dilutive. And it's right away people saying, well, why was it worth as much as $3 if people are buying it for $2? Yeah, if you're selling it in big chunks like that, it's going to cause that. But again, the stock, the market cap hit was almost 90 million just on that news alone to raise 50 million. So clearly the stock, even if it didn't raise 50 million, if you put yourself back to yesterday, this company now has $50 million and it's worth a lot less than even the $50 million that it just raised. So it's always these kind of things are sort of misunderstood by investors. It feels dilutive and it's just shocking you. I want to move out. But sometimes, what you're mentioning, maybe they're just, building up their coffers for money that they're going to need to make sure this goes well. So I did vote with you on this, Brian. I don't know,
the result,
not that I know the company, but
the The results are in, and it just barely squeaked by. 57% of people agreed with me. 29% said they need more information, and 14% said they disagreed.
Yeah, that's fair. So we'll see, I guess. But yeah, do you think again? Obviously, it took a big hit on this. Do you think the stock will bounce back? I mean, obviously, it's 29 million in sales. Would that be satisfactory to investors, or is this just like small potatoes right now? It's just connect the dots, get on the radar, and then extrapolate sales from there, or like is this catapulting the big jump in sales in 2026, or are you just not convinced yet, or what's your thinking on this?
Yeah, I mean, I think that's so it's only 10 months, right? So the question is, can they, basically they have to do 1,000. They have to sell 1,000 of them at list price. So I guess there's a potential that there might be a discount for that. But 29,500 is the list price. So I think that overall I'm a little bit more convinced that I don't know. I mean, I think it's a bold prediction because they got to do 1,000. They got to sell 1,000 of these, which is basically 100 a month, right? Presumably it's going to ramp up. So the first month maybe they don't do. They probably aren't going to do 100 the first month, and then it's going to ramp up as doctors get more comfortable with using the machine, doing the procedure with, because there's other options right now. They can take a vessel from another, like from your leg, and then take, and then use that vessel. So that's obviously ideal, but also requires another procedure. So if you need another procedure, then it doesn't. Obviously when you're in a trauma, that's not an ideal situation. So.
All right, we'll see. 29 million. It's a nice odd number, but I like it. And
I went with 100. I mean, I went with 1,000 sales. So that's
right.
How I came up with that units, 29 million.
Yeah. And the price should stay consistent throughout, right? It's not something that'll likely go up or down over time.
No, like as I said, the doctors will get paid more for it, presumably October 1st, assuming they get the code, which there isn't any reason to think they won't get the CMS code. And so once that happens, then doctors will be more incentivized to do it. And they have some data that shows that that the procedures using Humacyte's artificial vessels is actually cheaper than doing it other ways that are currently standard of care. So I think again that should help them.
Yeah, fair enough. So we'll move on to my first bold prediction. And it's one of these market beaters. I'm going to say that this stock will beat the market, and I'm singling out Nintendo, ticker symbol NTDOY. Obviously, Nintendo's a big gaming giant, but it trades here as an OTC stock, an over-the-counter stock. NTDOY is the ticker symbol. That Nintendo will beat the market in the next 18 months. And Nintendo is a game. While gamers, or if you've ever been a gamer at any point in the last, the company's actually been around since the 1800s, but obviously they weren't making video games then. They were actually making playing cards. And since then, they've always been doing fun and games. But even back to the 70s, I remember 70s and around 1980, late 70s, that I went with my family as a kid to Hong Kong. And that's when the Game & Watch came out, which was these small little handheld LCD games. And it was pretty simple. It's just sort of like an octopus. You had to you were sort of scuba gear and like skydiving. Diving, sea diving gear. And you had to go down and get some treasure before an octopus got you. And it was a very simple game. It almost felt like the even earlier games, which is like the LCD little football games, were just kind of a little line going back and forth. But something about it felt different. And Nintendo was definitely different, as we found out. When just a couple years after that, they put out the original NES system, the 8-bit Nintendo, that pretty much revolutionized everything. They were doing arcade stuff like Donkey Kong as an arcade game in the early 1980s. But again, the company's evolved. And I think right now, we are at this great point right now in the Nintendo history where the company is still bread and butter. Still bread and butter is obviously the video game business, and we're seeing this happen. They roll out a console, and it goes through the same cycle. They introduce a new console, like let's say the Wii, and then sales initially take off, but it isn't until like the second or third year, or the third and the fourth year, since a new system hits the market, that sales peak. And that's because you need a large established base of gamers, and that usually happens around the third or fourth year when a lot of people have the new system, they've upgraded. And when they roll out a hit title or two, That's all it takes to just blow up, selling a ton of copies of the games. Nintendo has some games like the Wii U Sports or the Mario Kart, the latest Mario Kart 7, that have sold between 80 million to 100 million copies of these games. That's the kind of like global appetite for a platform. You're not going to find many records that sell for a lot less than a video game reach those kind of sales numbers. And this is a company that does it on the regular when they put out a hit franchise. And the reason I think that Nintendo's going to beat the market, and I just got maybe a little too much into the preamble of Nintendo itself, is because of what's happening in the next few months. And again, Rule Breaker subscribers and others that have heard me on this Fool 24 thing, whenever Nintendo comes up, knows why I'm bullish on Nintendo. But I'm going to say it here again because it's part of my prediction this time. I'm going out on that limb, so to speak. I have the little cheat code to say I'm blocking this in. Next 18 months is going to beat the market. There's a lot of cool things happening to Nintendo in just the next 12 and a half months. So right now, it's March. It's the end of March. You may not seem like anything's happening. Nintendo's revenue has fallen for three of the last 4 years, including the last fiscal year that it has yet to report, but it will. It's doing this because this is what happens because it's been so long since the Switch came out. The Switch came out 8 years ago. Nintendo's never waited 8 years for a new system. They went from the Wii to the Wii U to the Switch, basically in 5 to 7 years, 5 to 6 years between releases. They've taken a lot longer than usual, but we know that a new Switch is coming out by the end of this year. And April 2nd, so basically within a week, they have a Nintendo Direct event. They're going to have a lot more information on the system. Right now, they sort of teased it and put little details about it. It's going to be an upgrade in many ways, more portable, larger screen, new features that people were asking for in the original Switch is all going to come into the system. And ideally, a lot of people upgrade. And more importantly, games start coming out that only can play in the Switch 2. There'll be a lot of games that are backward compatible to the Switch initially because Nintendo's going to lose those people. But once the games come out that you need to have that Switch 2, a lot of people are going to pay, top dollar, whatever the price tag is for this. I've not revealed. They'll probably reveal it next month, what it costs. That's one thing. A new system always starts an upgrade cycle. Within 2 or 3 years, revenue is basically double, if not triple, in one case quadruple what it was at the last year before the system was introduced. This has happened without fail. And Nintendo's already had a nice, strong basis starting from $7-8 billion in sales in U.S. dollars. If this goes threefold, fourfold, it's going to be. I don't think it'll be fourfold. It's already pretty high right now, but that's happening. Another thing that's happening is theme parks. They got together with Comcast and rolled out Super Nintendo World. They opened the first one in Universal Studios Japan in 2021. Opened at Universal Studios Hollywood in 2022. And I've been to the Universal Studios Hollywood Super Nintendo World 3 different times. It's the only reason I really went to Universal Studios Hollywood all the way from Florida going out there. I did other things in California, but I made sure, let me just go see what's happening there because it's quite the phenomenon where you go into this park, this original movie lot park. They filmed a lot of classic movies in this place. It's an actual working studio lot. It's on hills. You take escalators to go up and down the different levels. Actually, there's 2 levels, but there's a lot of escalators to go from the upper lot to the lower lot. And Super Nintendo World is tiny. There's just one ride, the Super Mario Virtual. It's augmented reality. You get to drive around, but there's a bunch of people. There's a bunch of activities, and people buy a bracelet that they need to play games. And then once you win like 3 of the 6 games, you get to go into the super level. They won't let you in and your family. You can all go in if you win that level. But it's the kind of thing. It's an experience. It's definitely the kind of next gen theme park experience that's so cool. They're doing that. And not only that, so they have that, and so in May of this year, May 22nd, Epic Universe opens here in Orlando, Florida, close to where I am right now, where they are not only opening just the Super Nintendo World, it's going to be 3 different attractions, not just one. So you're getting a Yoshi ride, and you also have a Donkey Kong roller coaster, where it actually jumps the track, has the illusion of it's jumping the track. A very tame roller coaster, but a cool effect. Again, much larger than the project that they have in Hollywood, equal to the size of what Japan has evolved to. So they're doing a lot of cool things this is going to extend their brand to 3 parks that basically attract, assuming for Epic Universe, more than 30 million, probably 35, 36 million people a year will be exposed to the Nintendo brand year round. These are year round parks, so it's not going to be sort of a seasonal thing. And the other part is the movie. Super Mario the Super Mario Brother movie came out in 2023. It was the second highest grossing movie of the year. And only Barbie fared better that year. Those were the only 2 movies that topped $1 billion in global sales, the ticket sales. New movies coming out early April of next year. So you have 3 catalysts. You have the new system coming out. That's the biggest catalyst. And you also have this theme park expansion where Nintendo's becoming a force, a brand exposed to more people. Just go to a theme park. You don't even need to be a Nintendo fan. you enjoy the experience. You say, what is this vivid color whimsy? And they have so many properties right now. They're doing in development. There's a Legend of Zelda movie in the works as well. Stuff like Pokemon that they haven't even really touched at the theme park space or the theatrical space outside of animated movies, which are very limited. I think there's a lot of things here to Nintendo. So that's why I think the company has all these catalysts, and the stock has done well lately, but I think it's going to beat the market, continue to beat the market in the next 18 months. Brian, I know I took like 7 minutes to go into this bold prediction, a lot longer than I should have.
So, well,
yeah.
So get your votes in on at slido.com. I don't, there's no questions for you specifically. I'll just ask you, you said that the peak of sales is around, what'd you say, 3 to 4 years in?
Yeah, 3 to 4 years after the console comes in.
And
so, yeah.
you're obviously your prediction's only going out 18 months. So
Right.
do you think that's long enough for it to take off enough that the sales will have increased enough? I mean, you noted that the sales have been down for the last few years. So, sort of maybe any sort of turnaround is going to be good. So do you think it's going to be mostly margin, expansion of the valuation? So, price to sales, price to earnings ratio. Do you think it's going to be a lot of that, or is it just going to be the increased sales that are going to drive the stock price to be higher?
Yeah, so I know that a year and a half from now won't be peak Nintendo as far as the fundamentals go. I do expect it to continue to be longer. But what I do think is just the early uptake on the new Switch 2 when it comes out before the holidays this year, if that bounces sales more than analysts expected, which it could be the case, obviously I'm expecting that it would be. Strong games come out. We already know that there's always release title games that come out that get people excited about a system. But I think the whole thing is just the whole seasonality of it, not seasonality, but the cyclicality of it, where it peaks, the system comes out, sales peak, then they start sort of, slowly meandering their way down until the new system starts the process again. We're at that point right now. We're at the bottom. If you wanted the basement opportunity on Nintendo, it's happening sort of right now at its lowest revenue in a long time. And it is a case where now with the licensing revenue and the merchandising revenue that they can get from the theme park side and the movies, which really is the only reason that 3 out of the 4 years, the third year that revenue actually went up was the year that Super Mario Brothers came out. So the movie, all the merchandise, all the interest in Mario characters and the franchise and everything that's happened since then because of that movie led to it actually, it went a typical jump in a down part of the cycle. You're going to have all this happening again. So I do think that in a year and a half, you're going to have at least the effect of the movie, the effect of the third and most important, largest probably theme park presence that they've had since Super Nintendo World started rolling out at Universal Studio Parks. All these things are happening. I do think that would be enough to do it. So the poll right now, so it's 56%. Yeah.
Polls closed. I voted with you, Rick, and so did 56% of the people who voted in the poll. 33% disagreed with you, and 11% said they needed more information.
It's fair.
So let's go ahead and move on to my next one. It's about Twist Biosciences, ticker is TWST, and I expect it will reach a high of at least $64.41 in 2026. If you're wondering how I came up with $64.41, it's because it's of all the times I bought it, that's the highest cost basis for me. So just figured if I was going to predict something, I might as well make it personal. So I'd love to see it get that high. It certainly, that it closed today at 41.88. So that's a 54% increase over the next 22 months, which seems, doable, but not crazy high, not super easy either. They have in 2021, it was trading above $120 a share. And even as recently as last year, it got around $60 a share. So to get to 64.41 seems reasonable. They're guiding their quarters are off by 1 quarter. So they just, the end of calendar year 2024 was their first fiscal